Hello CA Inter students, prepare smarter for financial management in CA Inter with our top-notch marathon taught by Professor Balasubramanian sir, an expert with more than 2 decades of teaching experience. With this 11 hours of detailed marathon, gain knowledge, conceptual clarity and assurance to score 35 plus marks with ease. And here are the details of the chapters that we covered in this 11 hours of detailed marathon. So navigate through the chapters easily with the timestamps information provided in the video description. Generally, marathons are either extracted from pre-recorded videos or studio recorded content. But we recorded this marathon live during face-to-face sessions, ensuring an authentic classroom feel. Help us reach more number of students. Like the video if you found the content useful so that YouTube can recommend this helpful video to others as well. If you got benefited from this video, then share it with your friends as well and help them to get benefited from this marathon. Share your feedback in the comment section. It inspires us to create more videos like this. Exclusive materials shown during the marathon are now available for free download. And here is the detailed procedure to download the same. First, in an Android mobile or Android tab, install our app Masterminds Online Classes from Google Play Store. In the home screen, click the 3 horizontal lines icon in the top left corner and select Free Marathon Material option. In the Documents tab, you will find the required folder. Open it using Acrobat Reader or some other PDF reader app. And you can download or share it and can take a printout of the same. Marathon videos of all the remaining subjects of CA Inter are already available in our YouTube channel. So check the playlist, subscribe and press the bell icon so that you never miss an update. Now you can start enjoying the marathon video. All the best, my dear students.
Hello, good morning, dear students. Welcome to Marathon, particularly exclusive, great, grand subject. What is it? Financial management. But dear students, this marathon is really special to you because I'm going to cover such a core concepts which is going to very, very helpful for the coming exam. Because just now I told you, just it is not a simple conveying my subject from my experience, but I made it investigation on your entire study material. And I studied all your past exam question papers and RTPs and MTPs. This is a marathon summary of study material, rapid revision of RTPs, the gist of various MTPs. And finally, your attention gives you a wonderful return. Okay. But in this marathon, just we are not going to listen casually, but we are going to make note, right? And even management supported me to do this material and they allotted me much time. And that is the reason I have this material so that I can give you a productive information to you, right? First of all, coming to financial management, you see the first question, examination oriented marathon it is, okay? So from past introduction to financial management, this is the first chapter. So approximately 7 theoretical questions are there. Out of that 4 are repeatedly giving. So you see the from 2018 to 2024, maximum 4 and 2 marks. So what is this questions? What is this asking? Are past these questions are asked me in future, certainly they will cut, right? So that is the financial management. In this point is, first of all, you want to test what is the financial management. So financial management is, what is it? Financial management is, already I conveyed, this is a financial management is a combination of 2 words. What are they? One is a finance, another one is, what is that? Management, right? The finance is nothing but systematic study about money, money related activities. Systematic study about money, money related activities. What is the management? What manager do? So here the manager has to manage, what is that? Finance. So system come, it is gone. Yeah. Finally, what is the financial management? You remember MPC. It is a managerial activities with respect to planning and controlling of what resources? Financial resources. That's enough. That is a theme given in your study material. Don't write MPC. Remember the MPC and write that point. So financial management, here it is. So how many times they ask this question, right? So financial management is a subject of what making? Managerial activities, which is planning and controlling. MPC of what? Financial aspect of the company. Yes. Then what is the managerial activities means? Managerial activities, what does the manager do? Manager do decisions here. Yes or no? The manager's job is to do decisions. So what are the various decisions of financial management? That is the point to be considered, right? So financial management is a subject of what making? Decision making. What is that? Decision making. Here it consists of three major important decisions. What is that? Financing decision, investment decision, dividend decision. Only this. Only this. Your entire syllabus is only this. So financing decision means simple, raising of required funds at a low cost by considering risk, cost, control, and even government rules and regulations. That is your job. Whereas investment decision means whatever the funds you raised, you should not keep idly with you. You have to invest and you must generate that return. That return should be greater than cost to be paid. So that is the investment decision. And dividend decision means once you have good financing decision, once you have good investment decision, automatically you have surplus earnings, right? With that earnings, what to do? That is the most important. What to do with that earnings? So should we declare dividend or retain? So that indirectly you have to take on one more chapter is not R and D. When you have a E, what E? When you have a E, should you do R or D? But thing is, MP should be a top. MP means what? Market value. So these are the three decisions. Remember these decisions, right? So first question is, what is the financial management? What are the financial management? And another one is decisions of the financial management. What are the objectives of financial management? There is a question also is there. But here, I would like to tell you how this entire syllabus is framed. Financing decision, you have three types of decision. In the three types of decisions, you have to take effective financing decision means you must study three chapters. What are they? Cost of capital, capital structure, leverages. Whereafter, for the sake of investment decision, you have to study capital budgeting, advanced concept in capital budgeting, which deals with what? Fixed asset. And you must study working capital with respect to current assets. Total how many? Here 3, 6. And whenever you take effective this three decision, automatically you have what? Dividend decision. And in order to take some analysis, for the sake of decision making, you have to study one more. What is it? Ratio analysis. So this is the nothing but total syllabus. Yes. Whereas some theoretical part also is there. What is the types of financing and scope and introduction of financial management. So while studying all these concepts, you can handle the coming exam question paper effectively. Are you getting? So managerial financial management means what? It is the managerial activity concerned with planning and control. There are two major functions. What is that? Number one, procuring of funds. Another one is utilization. Whatever the funds you are procured, that funds you must be procured at a low cost. And whatever the funds you procured, that funds you should not keep idly with you. What you do? You have to utilize. Utilize means invest. Invest on what assets? Fixed assets and current assets. So what are the decisions of financial management? See, how many times they've been asked, right? What are the decisions? Three decisions. What are this? Financing decision, investment decision, dividend decision. Okay. And finally, objectives. Every company has certain objectives to be achieved. There are two types of objectives. You see, how many times this question been asked? There are two major decisions, dear students. One is a profit maximization. Another one is a wealth maximization. Profit maximization means the financial manager has to take a decision, functions, whatever the elements he may take, but ultimately the company profit has to increase. This is very, very narrow objective. What is that? Narrow objective, like a oak tree. But wealth maximization is nothing but the wider objective. It considers time value of money, it considers risk, it considers government rules and regulations. By considering all these things, right, if you achieve your company's long-term progress, that is called what? Wealth maximization. Profit maximization objective is concerned to 1 year profit. Wealth maximization is long number of years survival. So profit at any cost, this year we have to make a profit. That is a profit maximization. Wealth maximization means nothing but you have to take the equity shareholders' wealth somewhere. Already we discussed MRF share price is 100 rupees. Now it is 1,50,000. So now try to understand. It is not happen within a couple of days, couple of years. It is long period. So they financial manager of the concerned company, they kept in the mind, we are not concentrating, what is it? Profit. We are concentrating wealth. Understand? Thereafter, what is the agency problem? This is also repeatedly the one of the question been asking. What is the agency problem? You are a financial manager. There are two parties. Here is the company is there. Here is the owner. Owner are nothing but equity shareholders. Here the managers, financial managers. Even financial managers effectively work, right? The entire benefit goes to whose pocket? Equity shareholders, right? So owners of the company. So they never contribute any additional benefit rather than paying just a salary. In such a case, the opinion, interest of managers is a completely different from opinion, interest, objective of whom? Shareholders. So that opinion gets defected, then there is a conflict arises. That is called what? Agency problem. When agency problem arises means you cannot own your organization, your company. It's mine. You cannot own. Hey, if I work, after all, I will get a salary. Why should we do all these things? He is to get total profit. Why should I do that? Indirectly, that mindset came, What problem is there? Agency problem is there. In agency problem comes, the people won't work effectively. They will pretend wonderfully. They will work in such a way that they will ready to give blood to company. Okay? But the thing is, when it is there means automatically company productivity, what happen? Decreases. In order to solve that one, management has to pay some cost. That is called what? Agency cost. Along with the salary, provide certain medical facilities to your employee kids here. Yes or no? Along with salary. So provide some additional educational facilities, work environment facilities. At the same time, some charity work. You have to do all these things. When you do means automatically the manager of the company, they believe that they are not at all considering just I'm a worker. Because beyond salary, they are paying something. So in such a case, automatically the agency problem, what happens? Disappears. Then automatically each and every employee feels what? A commitment. With effect, agency problem disappears, company goes somewhere. So this is the repeated questions from financial management. Got it now? Financial management. Remember MPC. MPC means managerial activity concerned with planning. How many decisions? What are they? How many functions? What are they? Procurement and utilization of function. Two major functions. Generally, if they ask functions means you can write all these things. But if they write two major functions means procurement of funds, utilization of funds. Okay? Right. With this theory part, pakka question. Pass this attempt. Ab nahi to kabhi nahi. Lekin abhi ho jaye to. Are you getting? Next chapter. What is that? Capital budgeting. Yes. You see the capital budgeting. Actually, they are asking 1 mark. Yes or no? 1 mark. 10 marks. This is nothing but 5 marks. Very rare case they have been asking. So 10 marks means it's really worthwhile, right? So first of all, without knowing, without having much delay, right? We will jump into the subject. What is a capital budgeting? Do you know the meaning? What is a capital budgeting? Sir, capital budgeting is, what is it? Systematic. Just you write systematic what planning? Investment planning. To make investment on what assets? Fixed assets. That's enough, man. So it is fixed assets. Or you can say it is a process of, what is it? Process of evaluation of long-term project. What is it? Process of, tell me, process of evaluation of long-term project in order to maximize, it is a common dialogue. What is it? Wealth of the company to be maximized. Okay, recently I told you that Indigo learning company purchased how many flights? 500 jumbo flights, right? Whose cost is some $1 million. How they might have done this one? For that purpose, they had done a capital budgeting. Ratan Tata's nano car project again launching now, a failed project. Again, they decided to make what? Investment on that. How they done? Will they do 1 rupee tasa? They might have done capital budgeting. We are doing capital budgeting. I think they might be doing what? Capital budgeting. When their NPV positive, that is the reason they might be taking this. Okay, if they have doubt, get ready with notes. We will go there. మనం వెళ్ళి చెప్దాం, డోంట్ వరీ సార్, we will support you, right? So you got the capital budgeting ra. So capital budgeting is a systematic investment planning. It is a planning for what is that? Evaluation of long-term project. Significance, sir, why should we study? 4 marks question they asked ma. This question already I showed, here there is a chance to ask 5 marks question, I think so. What is the capital budgeting? Significance of capital budgeting. November 19 they asked this question. So why capital budgeting is very, very important? Because in capital budgeting involves what expenditure? Substantial expenditure. What is that? It includes more investment here, which consists what? A huge risk, man. It consists what? Less risk, huge risk. Thousands of crores of rupees investment you are making, right? Huge risk. And generally will influence short run or long run? Long run, it influence long run effect. Long run effect. Okay? This is nothing but significance, huge risk and long run. And finally, it is an complex decision. What decision? Complex decision. Because why it is a complex decision? Array, you have to consider cash outflow. Yes or no? You have to consider cash inflow. You have to consider TVM. You have to consider depreciation. You have to consider, yes or no, tax procedures. What is not? You have to consider all the elements. By considering all the elements, evaluation of a biggest huge investment project is not a simple. That's the reason past exam they asked, tell me significance of what? Capital budgeting. Can you tell me what are the significance? Very good. So process here nothing but you have to evaluate what project should be done. What project should be done and determine what is its cost to be paid. Hello? What is its determination? Evaluation one ra. Evaluation which project should be done and determination of how much cost is going to consider and evaluation estimation of what is it? Estimation of what is it? Cash inflows. Because you know what is the cost to be incurred, yes or no? Then you have to identify what is that? Inflow. First evaluation, what project should be done? Tata Motors not only doing Tata Nano, Tata Salt also. Salt, you mean uppu? Uppu. Uppu ani ala cheppakudadu, tappu. Because its cost is less than, what is it? Its inflow here. That is the reason you have to do that. Tata also selling salt ra, yes or no? And evaluation, determination and estimation, cash inflow, and finally you have to make selection. When you select ra, when cash outflow is more than cash inflow, yes or no? Yes sir. Now tell me, it's wrong sir. Cash inflow should be greater than cash outflow. That is the process here, capital budgeting, nothing else. Okay, that is nothing but what is the rule? EDES rule. Yes or no? Simple, you remember. This question is not asked, but there is a chance to ask what? MCQ, right? Now, in order to evaluate this capital budgeting means, will we take 1 rupee tasa? No, sir. No. Balu, sir, capital budgeting means, there is a one word, sir. Capital budgeting means it is various methods. What is that? M. Each method has its own C. C means calculation. And after calculation, each method conveys what is a D? Decision making process. MCD. Remember, what is that? MCD. I will give this file, don't worry, make it note fast. Fast. Ab nahi to kabhi nahi hai. Whatever the process we studied so far, right? That is a completely you change. You concentrate. You put the effort. Happy New Year. Okay. MCD means what, sir? Methods. Each method. Yeah, another one is each method need what? Its own calculation. And at the same time, you need to learn decisions. Chapter is finished. Let's jump into the first topic. What is it? Methods. Capital budgeting methods being classified into how many types? 2 types. What are they? Traditional methods and modern method, which is also known as discounting techniques. This method ignores what? Time value of money. This is only one point you have to learn. Coming to method. This method considers time value of money. Since this method considers time value of money, financial management considers this method effectively. So that's why in exam, I went, from past questions with this investigation, I came to know that they are asking only from what method? Only modern method, dear students. Keep it in mind. Pay attention for this method. But there is a chance to ask what is it? Traditional method also. Which method consider time value of money? Which method ignores time value money? Ra? Yeah. Can you tell me how many methods in traditional? ARR, payback period. Okay. Whereas in modern method you have 4. What are they? NPV, profitability index, IRR, and discounted payback period. In this method, first evergreen, you must learn NPV, profitability index, and the third one what? IRR. This 3 plays a dominant role, dear students. Got it? Now, so now you have to learn before going to use this cash flow, use these methods, you must calculation, right? When you want to calculate means, first of all, you should understand cash flows of the project. Once you don't know cash flows, even you know the formulas, you cannot do anything. Yes or no? So cash flows being classified into 2 types. Any project cash flows, you have to understand while reading a problem, you have to find it out what are the cash flows of the project. Cash flows being classified into 2 types. One is kya ja raha hai, kya aa raha hai. That is what cash inflows, cash outflows. Cash inflows again split into 2 parts. What is it? Operating cash inflow, terminal cash inflow. Do you know all these cash inflows? Means when you know all these cash inflows, then only you can solve any of the problem. So first of all, to understand this cash inflows, first you have what is that? Cash outflow. Cash outflow is nothing but in order to invest any fixed assets, what are the cash outflows to be required? The client may say that just I am investing, but you must know that there is a multiple areas to invest. For that purpose, you must study what is it? Cost of assets. Cash flow. For the cash flow, first you have to ask question number 1. What is it? What is the cost of asset? How much you purchased? Yes? Sir, 5 lakhs, sir. Okay, take 5 lakhs. Is there any installation cost? Sir, no, sir. Yes, sir. Take it. Is there any testing? Hello? Testing or transportation is there? You can also add. After adding, you will get the cost of machine considering all these things. Now add. What is it? In order to maintain that one, you need, what is that, man? Working capital is needed, yaar. Yes or no? Working capital is needed. You consider this one working capital. The question is arises here many times. Exactly how many times? 3 problems in study material given this point. What is the working capital treatment? 3 problems. What do you do with the working capital? If you don't know this working capital treatment, gone. Cash outflow gone. Automatically, all the methods gone. Testing, they given one material. Installation, one material. One problem they given. Whereas less subsidy. Subsidy, practical problem, they given one problem. Indirectly, they don't want to ask you directly. They will ask you, what is a subsidy? If you don't know treatment of subsidy, gaya tu. So that's why less subsidy. Less by chance, NSP off. NSP off means any old machine you sold, that amount is there, that amount you can deduct. Then you will get it. What is that? Cash outflow. Now, what is that, dear students? Many of the students, they know that cash outflow calculation is just a matter of what? Cost of asset. No, cost of asset plus installation cost. While calculating depreciation also, you have to take installation cost. Are you getting? There is a problem in study material. How to calculate depreciation? Cost minus cost plus installation. Then you will take a scrap value. Yes or no? Testing. Advanced concept model. There is a problem is that transportation, testing, everything. And if you get it, working capital treatment. Do you know real working capital treatment? I will tell you. Working capital treatment, 100% leads to 100%. Remember this word. What is it? 100% leads to 100%. I will give you. Working capital begins with a W, ra. What, ra? It will come, it will go, it will come, it will go. Again, it will come 100%. Working capital. Listen. Exam, ra, exam. Okay. Not a traditional. Some smart way we have to remember and break this exam, right? What is a working capital? Listen. Sir, in order to run a fixed asset effectively, only by investing fixed assets you cannot run. You need to invest on what assets? Current assets also. How much current assets is needed in order to run that business is called working capital. Balu sir, the point is this, sir. Fixed asset is there, while going on using the fixed assets gets what? depreciation. Yes or no? Like a law of demand curve. Aisa aata. Yes or no? Working capital is a pulse curve. If you go to the doctor, pulse rate. But still బతుకున్నాడు. తగ్గితే బీపీ బతుకు. Yeah, that is nothing but always. That means if you invest in fixed assets and current assets over the period, right, fixed assets depreciate. Sometime it may disappear. But working capital not like that. What happened? It circulates. Working. I am working, it indirectly says. At the end, it recover, what is that? 100%. An example, I do know, but no alternative. We have to remember, okay, how much working capital you can recover? 100%. How much fixed cost? Maybe zero or sometimes, right? Certainly you cannot get it. So that's why whenever in the problem working capital is there, means whether you are going to sell fixed asset or not, go to hell, right? But certainly what will going to get it? Working capital. Certainly working capital recovery should take 100%. Yeah, thereafter subsidy. Why? What is subsidy? What is subsidy? Whenever you are doing such a business, because of that, there is a much benefit to the society. Much benefit to the society. And your investment decision is going to improve the standard of the people of the country. In such a case, government will provide you what? Subsidy. They will provide you subsidy. When subsidy provides means indirectly you are getting a fixed asset, but your investment decreases. So subsidy decreases your investment. Okay, this is the favorable thing. And NSP of old machine. Whenever you want to replace your old machine, then you can, while selling old machine, you will get the cost, right? That cost may be used to acquire the new machine. Are you getting me? So this is the cash outflow. Any of the problem, total capital budgeting investment decision, I made it. Total investment decision illustration 19, practical problems 14, total 19 plus 14. 33 problems with respect to only investment. In the 33 problems, maximum 40% problem repeated mode. What they've been asking? Only this concept they've been asking. Got it? Cash outflow. Got the clarity? Yeah. Next one, we have to move to, what is that? Operating cash inflow. This is regularly happens. Operating cash inflow means by selling a sales, by making a sales, how much cash inflow you are going to get it. For that purpose, what to do? You need to consider, what is that? Cash sales. Because we used to operating cash inflow means this is called, what is that? CFAT. What is that? CFAT. We will take cash sales less. You deduct a variable cost. Then you will get what? Contribution, you will get it. Because this is a basic one. Once you don't know this cash inflow, you cannot do any of the methods. So that's why sales less what cost? Variable cost. Then you will get what? Contribution. Then what do you have to do? You have to deduct what cost? Fixed cost. After deducting fixed cost, you will get it a PBDT, which is also known as operating profit. Yes or no, ma? Operating profit, you will get it. From this less depreciation. Depreciation is a non-cash expenses. Hello? Depreciation is a non-cash expenses. You would consider only depreciation in the presence of tax. You know how many times I shouted in class? When T is there, D is there. When T is not there, D is not there. Then you will get it, what is that? PBT. Yes or no? From the PBT less what? Tax you deduct. Then what you will get? PAT. Yes. From that PAT, add back, what is it? Depreciation. Why you are deducting? Why you are add back? Yeah, because it is a tax benefit. Because you are deducting for the sake to reduce your taxable burden. Once tax is paid, again you have to add back. Are you getting ma? Then you will get it, what is that? CFAT. Okay. Then you need one more cash inflow. What cash inflow? Terminal cash inflow. Terminal. Last. What is that? The word last means terminal. I told you terminator. Terminal means last. The cash inflow, what you are going to get it at the end is called terminal. You purchased asset, fixed asset. You used over the period. At the end, if you supposed to sell, then what that cash inflow is called, what is it? Terminal cash inflow. For the terminal cash inflow, how should we calculate? You are, whatever the asset you purchased, why you at the end you are going to sell yes or no? Whatever the asset you sold, that would be called what? Gross sale proceeds. Once you sell this gross sale proceeds, your uncle kid will come. Who? Income tax. For that purpose, you have to calculate what value? Written down value. MCQ question. What is the written down value? Cost minus accumulated depreciation. Yes or no? You have to deduct this one. Then then you can recognize whether you have a capital gain or capital loss. Capital gain or capital loss, you find it out. If gain is there, pay tax. If loss is there, get what? Tax shield. Finally, you will have a net sale proceeds. How do you get net sale proceeds? Already you got it. What is it? Gross sale proceeds minus plus or minus of what? D, tax. You will get the net sale proceeds and whatever the working capital. You know that working capital. How much percentage? 100%. Working capital you have to consider it. And finally you will get it. What is that? Terminal cash inflow. So this is the very, very important. Sir, why you have question number 1? Sir, question number 1, sir. The question is this, sir. Sir, why depreciation is deducted? Why you added, sir? One of the $1,000 question. Another one is, sir, how few years back you invested in working capital, right? After 5 years happen, you recovered working capital 100%, sir. Why is it? Because working capital circulates, remains same. But fixed assets depreciates, disappear. Okay? Once you calculate the cash inflow, right? This would be good. In study material for investment decision, out of 19 problems, 4 problems only with respect to educate you only cash flows. Only cash flows. Are you getting? So 19, 4 gone. So that means just how many? 15. 15 problems are concentrating only for subject. For this one, they're concentrating. That is the reason I thought it basic model, you know. Should we explain? No. You should know this. Otherwise, you know, all the methods you cannot concentrate, right? Once you know the cash inflows, then we will move to each and every method. Payback period. They have given 2 questions. But there is a one question, payback period. In the history, I should not neglect this one. 10 marks question they asked. 10 marks they asked. Payback period. That question also I covered. Okay? So this is, what is a payback period? Payback period. Even if you don't know 0% knowledge of till to the date, with this class, right, you will clear exam. I have enough confidence on my class and I will trust you people also. Payback period. Cut it. Payback period. How many words? 3. One is what is pay, what is a back, what is a time period. So simply, what is a payback period? Examiner in this model, what is going to ask you? Do you know this? Examiner, what is going to ask? He will come, he will say that I am investing 10 lakh rupees. The project is giving cash inflow like this. How long I have to wait to recover my investment? Just to tell me, sir. That's enough. So his identity is, what is that? Investment. Where is my file? Here. For the payback period, along with that one, just I will give you. This is investment decision. This total I've written here. Simply you should. What is a payback period? Tell me. Payback period is a time period or length of time duration in which invested cash outflow can be recovered from its cash inflow. This is the payback period. Repeat, sir. It is time period in which invested cash outflow can be recovered from its cash inflow. Is called, what is that? Payback period. Pay. Yes. If you invest and how long you have to wait it. Pay back. It is a time period. For example, 5 years. What do you mean of this 5 years? Tell me. Sir, if I invest in my project, so how long I have to wait to recover my investment? 5 years. So this is the payback period. How should I calculate the payback period, sir? So just now, payback period is, tell me, it is a time period, right? Time period or what is it? Length of time duration. Length of time duration. Time duration in which invested cash outflow can be recovered. Yes or no? So that is called, what is that, ma? Payback period. Yes or no? Payback period. So how to calculate payback period? To calculate payback period, you must understand what is the cash inflows, how you are getting a cash inflow. Are you getting when the net uniform cash inflow? What is that? Not uniform. You can say equal cash inflow, unequal cash inflow. For equal cash inflow, unequal cash inflow, how should I do, sir? So that indirectly what it conveys, here you see, equal cash inflows. Calculation of payback period. When annual cash inflows, equal annual cash inflow is there. Multiple unequal cash inflows there. If it is, you see here, every year cash inflow equal, you see, how much? 25,000, 25, 25, 25, 25, right? When every year cash inflow equal, then tell me how should I calculate payback period? Equal cash inflow means payback period equal to, so initial investment divided by annual cash inflow. Okay, annual cash inflow, you can take it. So basing on this, can you tell me this payback period? So 1, 2, 3, 4, 5 years, right? Every year how much I'm getting? 25, 25, 25. Can I say payback period is nothing but payback period initial investment divided by annual cash inflow? Payback period 1 lakh divided by 25. How much I got it? 4 years. MCQ question you can expect. Okay, Balu sir, when cash inflows are, what is that? Unequal. In such a case, what happen? You have to find it out. You have to make a cumulative. What is that? Cumulative. For that purpose, payback period would be investment maximum recovered year, you take it. Recovered year plus what is it? Balance divided by next year CF80, you can take it. Okay. And you can multiply either with 1 or 52 into 12. That is, this is the way you can find it out. So, sir, how could it be possible? You see here, you invested 1 lakh. First year, how much you got it? Second year, third year, fourth year, like that. So, approximately every year cash inflow equal or unequal? Unequal. In such a case, what to do means you have to make cumulative cash inflow. What is that? Cumulative cash inflow. You have to use two words. What R, what is balance, what is a T? What is that? RBT. What is this R? What is the recovery I made? Hello? What is the recovery I made by waiting? Number 2, recovery. You use it any word. Recovery. 1 year I waited. What is recover? My investment I recovered. And what is a balance left? What is a balance left? While every year you have to analyze only this. You see, you invested 1 lakh. How much you invested? 1 lakh. First year, how much you recovered? 20,000. So, first year 1,000 recovered means what is the balance left? 80,000. So, means next year also you have to wait, right? So, similar to second year, you recovered 10. So, total 30. Balance would be 70. Next, third year you recovered how much? 30. So, total 60. Similar to fourth year, 25, 85. Fifth year, last year you got it 45. Actually, your investment is how much? 1 lakh. By waiting first year, second year, third year, fourth year, how much you recovered? 85,000. What is the balance? For the balance, you have to wait for fifth year. Got it? This is the logic behind this one. Don't get confusion. Right? So, payback period equal to what is that? Maximum investment recovered year plus balance divided by next year CF80. Maximum investment recovered. How many? 4 years. Okay, now? Then here, what is this? You are invested 1 lakh. Maximum recovered is 85,000. So 1 lakh minus 85. Balance, how much? 15. For this, you have to wait for fifth year. But fifth year, if you wait for that entire 1 year, it will give you 45,000. But I don't want to wait for 1 year to get 45,000. My balance is just 15,000. How much the time period means? This 15 divided by 45 into 1. This is the equation actually. For that purpose, what happened? The 15 divided by 45,000. So used to get it. How much payback period is? This amount gets added to which one? 4 years. So payback period equal to 4 years. How many months? 4 months. So decision making, then you should know how to take a decision basing on payback period. You got it? How to calculate payback period? Basing on what? Cash inflow. Number 1, equal cash inflow. Initial investment divided by annual cash inflow. Unequal cash inflow. Initial investment maximum recovered plus balance next year. What about the decision making? See, decision making of the project. Single project. When payback period is less than which one? Standard payback period. Every client will come that standard payback period. Standard payback period means is intention payback period. So he want to recover his investment within the given year. A client came to your office and he is saying that, sir, I am ready to invest in this project. But Balu said, I have to recover my investment within 2 years. That means indirectly standard payback period, how many years? 2 years. But whereas you worked out all the cash inflows, your payback period is 6 years. What you are going to convey? Sir, you thought 2 years, but this project 6 years. So you have to wait to recover your investment. How many years? 6 extra. Yes or no? So when payback period is more than investor standard payback period, investor never show interest. When he will show interest? When payback period is less than standard payback period. So you can take it to the decision, you see. Payback period is less than standard payback period. What you can say? Accept. Payback period is equal to standard payback period. Either accept or reject. Payback period is greater than standard payback period. What you can say? Reject. Balu sir, this is happens with respect to single project. Multiple project is there. Then sir, in such a case, multiple projects means you need to consider again one more category. Multiple is there. That means A, B, C, D is there. Whether these projects are mutually independent or mutually exclusive. So what do you mean by independent? Independent means I need all. What is it? All I need. Such a projects are called what? Mutually independent. Mutually exclusive means? Mutually exclusive means best I should select. In such a case, if payback period is less than standard payback period, accept how many projects? All the project. If payback period is, which project is the payback period is least, that would be considered as best. Yes or no? You are investing, you are getting money fastest made. In such a case, the project is always best. What ma? So that is the point you have to consider. So decision making, single project, payback period is less than standard payback period, accept. Payback period is more than standard payback period, reject. Payback period equal to standard payback period, either accept or reject. Multiple project, accept all the project whose payback period is less than standard. Mutually exclusive, accept all the project with what? Least payback period, right? So, you know, from payback period, then one more topic is left. MCQ's question, 2 marks question, there is a chance. 2 marks question is asked. What is a payback reciprocal? What is that? Payback reciprocal. Payback reciprocal. Are you aware of payback reciprocal? Payback reciprocal is nothing but the recovery of investment. Recovery of investment per annum from a project. So simple, you see, this is the recovery of investment. Payback reciprocal is the percentage of recovery of investment from its cash inflow from the given project. Dear students, here you see payback period of the project is 4 years. 4 years means indirectly what it conveys? Tell me. 4 years means you have to wait for 4 years to recover. That means you invested 100 rupees. So each and every year, how much you are recovering? 25%. Yes or no? If it is a payback period 10 years means 10%. That means whatever the payback period you calculated, basing on that you can identify what is the percentage of recovery. Very simple. For the payback period, what is the formula? You know, payback reciprocal equal to what do you say? 1 divided by payback period into 100. Payback period reciprocal conveys in percentage. Payback period considers in time. You have to consider that point. So 1 divided by payback period. If the payback period is how many years? 4 years means, can you say this one? Reciprocal payback period? 1 divided by 4, right? So with this, we can also identify how long we have to wait to recover our investment. Are you getting? That is. Next, basing on this problem, what is the given? You see, this is the problem May 2019. They asked at 10 marks, 100% problem. 100%. No any, even numbers also not changed. This is the proof. Okay? Past to become what? Best. Can you able to solve? 2019 ho gaya. 2025. Certainly he will ask so. If it is asked, can you calculate this one? AT limited considering that this is the problem, study material problem and past exam question paper also. That is the reason if you are able to solve by God grace, जो आया अगर आया सब कुछ गया. Yes or no? You will become a Badshah. If you won't solve, you know, they will what? If you solve it, this one. Can you hardly 1 minute, roughly you can calculate this one. Just no need to solve, take it hours, right? Because I took this even solution also for this. Within the seconds we can solve. So, sir, Balu sir, suppose if the past exam covers means I thought it, again, pucha to. Yes, let's solve it. So, ABC Limited, 3 projects are there. 3 projects cash outflow given. Project A, 10,000. Project B, 2,000. Project C. This 10,000 is inflow na outflow, Maji? Outflow. First year, how much giving? 2,000, 2,000, 6,000. What is 0? 2,000, 4,000, 6,000. C. C is how much? 10,000, 2,000, 2,000, 6,000 and 10,000. Are you getting my point? Yeah. Now, can you calculate? Calculate payback period of each of the project. What, sir? Very simple. You invested 10,000 in, sir. First year, how much you recovered? 2,000. What is a B? What I told you strategy. What is R? What is B? Keep it in time in your mind. What is R? What is R means? How much I recover? What is B? What is the balance? What is the time? Either time think karo. So first year 2,000, second year 2,000, recovery 4,000, third year 6,000. So balance 0. That means payback period is 3 years. What about B? 0 na? Here it is 0. 2,000. Recovery ho gaya na? Third year no need because we are speaking to recover our investment. Hello, excuse me. Yeah, that is reason how much? 2 years. What about here? First year 2,000, 2,000, 6,000. Tell me the balance. 3 years, right? This is the point you considered. Now, can this project calculate payback reciprocal for project A? Anybody? Project A na? Project A is how much, sir? 3 years, right? Payback reciprocal equal to 1 divided by, yeah, payback reciprocal 1 divided by 3 means 33.33. Can you please tell me what is 33.33%? Sir, it is a whatever investment you are making, you know, sir. For every year you are going to recover how much, sir? Yeah. If the cutoff period is cutoff period also known as standard payback period. If standard payback period is 2 years, then which project should be accepted? Which project should be accepted if the given? If the cutoff period is 2 years, then which project should be accepted? No. You're wrong. You see, that is the reason CA Institute provided this one. Just now I gave a decision. How to take it? B may be accepted or rejected. Whereas project A, what is this? Here you see. In the given statement, here you see. If the cutoff period is how many years? 2 years. Then only project B may be accepted or rejected. Whereas project A and C must not be accepted. Right? Thereafter, what is the third question they asked? Sir, payback gives too much weight to cash flows that occurs after payback period. No, yaar. After standard payback period, whatever the cash inflow arises, it is irrelevant. My purpose is not to judge the profit. My purpose is to recovery. That's why once payback period is recovery, right? I will take like a climax hero. When heroine gets marriage, hero takes bag and goes out, right? Sunset happens. There is a gets connected kada. Like that. Once payback period recovers, hero takes bag and goes out. Sunset and backdrop music, pathetic music. That's why will it consider a? No, right? Payback gives too much weight to cash flows that occurs after cutoff period. The statement is wrong, right? Then another one, if firm use single cutoff period for all project, is it likely to accept all short-lived project? Short-lived project means you have a standard payback period 10 years. You have project 1, 2, 3, 4. All the payback period is how many years? 2 years. You are expecting 10 years to recover. All the projects are giving your money within 2 years. In such a case, should you accept or reject? Accept, right? This statement is right. Is it true that payback method prefers the project where majority cash inflow occurs in the beginning of the project? Yes, man. If you invest now only you are getting means why should I wait for what? End. Immediately I can recover. Are you getting? Tiffin stall is there. 2,000 investment kiya to abhi paisa aa jata. Yes or no? This is the payback period. This problem certainly we can expect because there is a symptoms indication that past exam this model covered, right? Understood payback period? Is it traditional method or modern method? Yeah. Next method, Mahabharat. What is next method? Mahabharat means, can you guess, Ra? Yeah. Next method is NPV. What is that? NPV. Are majority problems, as per this investigation, majority problem they asked from only NPV. Practical problems 90% NPV only. अगर NPV नहीं आता बहुत गड़बड़ हो जाता, बहुत गड़बड़ हो जाता. Okay, what is the NPV, net present value? For this I will give you, this is the information. What is the NPV? You see the meaning. First you should understand. Listen carefully, because within the time period I want to give it all these things. I want to write some key point and I want to explain some most important point. I made it two versions of notes for you, for the sake of you. What is the net present value, Ra? Net present value. What is the net present value is, NPV is the value or benefit derived from the project as on the day of. Remember this word. When you make investment, how much benefit you used to get it. So it is the NPV, or it is the value or benefit derived from the project as on the day of investment. It represents wealth generated from the project as on the day. As on the day. How as on the day? A boy borns man, one mother touches, gives finger, the boy holds. Lagud radu, lagud radu, lagud radu. Bahubali, too much. Abhi born hua, Abhi Bahubali, she calculated, what is that? NPV. That's enough, Ra. And you know the climax story? He became, that girl, that woman who identified, she became Rajamata. Because she knows NPV. If you don't know this, results आता ना, हमारा घर में एक माता होता, लेता, that's why. What is NPV? Very simple. What is NPV? Tell me. NPV is nothing but it is a value or benefit derived from the project as on the day of investment. Very simple. That's enough, right? So how do you calculate cash inflow? Already you learned cash inflow, How many types of cash inflow? Inflows are two types are operating cash inflow, terminal cash inflow. That operating cash inflow arises in future. Terminal cash inflow also arises in future. You do one thing. You want to find it out now only, What to do? You have to bring it into present. For that purpose, if every year cash inflows are equal, use the present value factor. Hello? Present value factor formula. 1 divided by 1 plus r whole power of n. So, if the every year cash inflow equal, in such a case, use what factor? Present value annuity factor. How should I get annuity factor? Sum the present value factors. Hello? Sum it up present value factor. Or else you have to learn the formula. 1 plus r whole power of n minus 1 into 1 plus r whole power of n into plus r. 1 plus r whole power of n minus 1 divided by r into 1 plus r whole power of n. हमको नहीं चाहिए इतना formula. So examiner will give, don't get terrified with this, right? Examiner will give you factor value because he want to judge your capability, means the asking strategy is different. He never ask what, hey, you know the present value factor or you don't know annuity factor, he never ask. So now tell me, when should you use present value factor? Single, multiple, unequal cash inflow is there, then you should use what factor? Present value factor. Multiple equal cash inflows are there, annuity factor. So you, while using this one, bring the present value cash inflow, present value of operating cash inflow, present value of what cash inflow? Terminal cash inflow. Hello? Then whatever the cash outflow is there, you deduct it. So here NPV, PV of cash inflow, PV of cash outflow. So simple, this is nothing but. Now tell me, if the NPV means what you can write? Sir, NPV, NPV means it is the, tell me, it is the value or benefit. So derived from the project. When? As on the day of investment. That's enough. This is the every information I am giving, to remember to write the coming exam. This is not a comprehensive notes. Notes is completely different. But we should, what is NPV? Okay, this. Yes, okay. I can handle, sir, no problem. Right? Then how to compute cash inflow? NPV equal to what I told you? Present value of what cash inflow? operating cash inflow, present value of minus present value of cash outflow ra? Yes or no? To use operating cash inflow, bache, keep it in mind, you may have chance to use PV factor. When you will get a multiple unequal cash inflow, you will get it. You may has to use present value annuity factor when every year equal, but a terminal cash inflow you have only one. What is that? Present value factor. But you know, sir, cash outflow, sir, already it would be in present. Are you sure, sir? It would be in present. Are you sure, sir? CA Institute says that no, because sometimes from the investment 50% you can pay now, remaining 20% I can pay in future. Two models problems are given. In such a case, such a 80% paid now, 20% paid later, 30%, whatever the hell is given, don't worry. So you can, by using what factor? Present value factor, you can also bring it. But 90% he may give it so. So you have to consider this one. This strategy, don't forget, 3 problems, core important problems covered like that. Right? Once NPV given, then you have to take a decision making, right? How do you take a decision making on NPV? NPV is greater than 0, accept. NPV equal to 0, either accept or reject. NPV less than 0, reject. Whereas multiple project again I told you, mutually independent, mutually exclusive. Accept all the project if NPV is greater than 0. What is the mutually exclusive? Accept the project which has highest NPV. Are you getting? So this is the way to solve, what is that? NPV. Are you getting? In your study material, actually time is not sufficient for us, right? There is a problem called cello limited problem. What is that? Cello limited problem. You also once check that one. Cello limited problem, investment goes, I will tell you, cello limited problem, whatever the point, you keep this points, okay? Cello limited problem, 10 marks they given in Ora. In this problem, you identify whatever the explanation I made it here, you see. In this problem, dear students, 80% is paid when? In the being, yes or no? Remaining 20% paid when? Now tell me, what should we do? You have to bring it into present. You try to understand this problem also asked November 2023, RTP problem they asked. RTP only given, practical problem it covers. But in the problem, one more point, very, very important point, because of lack of time, I am unable to explain all these things. In this problem, tax is not given to the students. Tell me, what is the treatment? Yeah, understood? Because of this class, I explained all these points. That is the reason you will can understand in easy way. So tax is not given. So that's why don't consider what? Depreciation. Dear students, sometimes some expenses examiner may ignore, right? If examiner ignores, you have to consider if it is expenses. Particularly in this problem, sales promotional expenses are there. Sales promotional expenses, he ignores. He says that, sorry sir, I ignored sales promotional expenses. But sales promotional expenses is an expenditure, right? While calculating operating cash inflow, you must consider this one. But he considered depreciation when there is no tax. So you know this problem, you know, he considered something you must ignore. He ignored something you must consider. Okay, so that is the very, very, very important point, this problem, because you know I'm expecting that this problem would be given. One more question. Sales minus what cost you have to deduct? What is another name of variable cost? Direct cost. You see here, variable cost name not at all given. Student who mug it up, what is the variable cost? Variable cost not diya bhai. Champa pagul chod rada. Another name what? Direct cost. Just gets terminology changes means gaya. Yes or no? Variable cost ratio. Sometimes you may change variable. Instead of giving variable cost, you will use variable cost ratio, you will give it, right? In such a case, sales into variable cost ratio, you will get what? Variable cost, right? When variable cost ratio is 60%, contribution ratio would be, what is that? 40%. What is another name of contribution ratio? PV ratio. What is that? PV ratio. In this problem, you must able to find it out. Variable cost ratio, contribution ratio, treatment of depreciation and tax. When should you use present value factor? When should you use annuity factor? If the expenses is ignored, should be considered or not? Or if the expenses what he considered, we should ignore. This problem CRD 7 you take into the consideration, because NPV grandfather this is. Okay, this is the decision making. Thereafter, what is that? Profitability index. Profitability index. What is the profitability index? You know, profitability index, what it speaks. When you are investing huge funds, you are getting huge NPV. But the thing is, you know, for huge investment giving huge NPV, less investment giving less NPV. Whenever the NPV is very less, can we consider that is the worst? No, because investment is less, you know. In such a case, identification sometimes become, what is that? Clumsy. Kya kare bhai? In such a case, there is a one more technique comes into the picture called, what is that? Profitability index. Profitability index. It is nothing but outcome of rupee invested in a project. If you invest 1 rupee in a project, how long, you see, what is the profitability index? It is the outcome of rupee invested. Outcome. What is getting for rupee investment is called what? Profitability index. Profitability index conveys for, what it conveys? For every 1 rupee of investment, how much cash inflow to be generated from the project? For every 1 rupee, how much you are getting? Arey, anybody will make investment 1 rupee. See, I am not saying that you are going to invest 1 rupee. I am telling the strategy for every rupee in your investment, how much it is giving. That is called what? Profitability index, right? So it is also known as what ratio? MCQ question. What ratio? Benefit cost ratio. It is also known as desirability factor or desirability index. What is that? Desirability factor or index. Okay. Here, suppose you try to understand. Investment you made it how much, ma? Tell me, ra. Take calculator, ra. Cash inflows you got it how much, ra? 8,50,000. What is the profitability index? PV cash inflow divided by cash outflow. Array NPV, if you know this, profitability index is very easy to calculate. Because NPV formula, tell me. Cash inflow. Yeah. Cash inflow minus cash outflow is NPV. Yeah. Cash inflow divided by cash outflow is nothing but profitability index. Are you getting my point? Maji, clear? अगर लाइन स्मॉल है एनपीवी, अगर लाइन बड़ा है profitability index. Worst example, don't consider this one. But the thing is, this attempt what to do? You have to get past. Okay, NPV, okay, NPV, small, okay. Profitability index. Okay, that is profitability index, NPV very close to each other. How do you take decision basing on profitability index? What is the profitability index? Tell me. It is the outcome of rupee invested. Outcome is nothing but your cash inflow, boss. Yes or no? It is nothing but your cash inflow. That is PV of cash inflow. How do you calculate profitability index? Do you know the formula? Can you tell me how should I calculate? Sir, Balu sir, take a PV of operating cash inflow, sir. Plus karo, sir. PV of terminal cash inflow, sir. Divided by what is that? PV of cash outflow, sir. Got it? So you will get the NPV. Okay. Balu sir, how to take a decision, sir? So how to take a decision means, you see, if profitability index is greater than 1, accept the project. Profitability index less than 1, reject the project. Profitability index equal to 1, either accept or reject the project. Got it now? Whereas multiple projects are there, sir. In such a case, what to do, sir? Multiple projects are A, B, C, D, mutually independent. Accept all the project if profitability index is greater than 1. Sir, mutually exclusive, sir. Yeah, accept the highest profitability index project. Okay. So this is the very, very important point. NPV profitability index. Dear students, in institute material, there is a one more problem covered. Very, very important because this problem covered in 2 methods. What are they? This is, you see, this is the problem. So November 2020, RTP they given, and in November 2023, 10 marks, damn sure, 90% problem is given. 90%. Because this problem, if he asks, no need to touch water. NPV. This is the problem. You need to calculate what is that? NPV profitability index. Okay? NPV profitability index. Because in this problem, what happened? This is a Navajivani hospital. Okay? Navajivani hospital. Very, very important because this problem considers both cash inflows, both NPV. Yeah, here you see. Navajivani Hospital is considering purchase of medical protectional radiography, which would cost is how much? 2 lakhs. Are in the problem, immediately you have to find it out. What is cash inflow? What is cash outflow? What is terminal cash inflow? Keep the 3 boxes, ra. So what aata hai, no? ఇందులో ఏమొస్తుంది, వేసేయి. ఈ రెండింటిని యాడ్ చేసి దీన్ని డైరెక్ట్ చేయి, క్యాష్ అవుట్లో వచ్చేస్తుంది. ఇది ఎప్పుడు నేను క్లాస్లో చెప్పాను. ఐ నెవర్ ఎక్స్ప్లెయిన్ లైక్ దిస్, బట్ థింగ్ ఈజ్ ఐఎమ్ ఎక్స్ప్లెయినింగ్ బికాజ్ time nahi hai. That's enough. Now tell me, is it a cash? 2 lakhs is a investment. What is the life? 8 years. And if you invest 8 years, every year operating cost is how much? 22 lakhs. But whereas you used to generate revenue, how much? 1,20,000. 1,20,000 revenue you will get it. Whereas 22,000 is just expenditure. But while seeing this one, everybody will get a tempt to buy this one. Because very small, sir. Very small. But evaluate first of all. Don't see, evaluate. Right? So 8 years. The hospital is presently outsourcing the radiography work to test radiography work to outsiders. For that purpose, they are earning how much? 36,000 per annum as a net of taxes. What is this? Opportunity cost benefit. Wonderful concept. Wonderful concept. Opportunity cost benefit. So while evaluating a project, whatever the benefit you are getting directly, don't consider that one. But also, because of making investment, any additional benefit you are getting, that benefit also you must consider. That is called opportunity cost. Opportunity cost 2 types. Benefit means add it, loss means deduct. So in this problem, 36,000 they been getting. If they undertake this project, that 36,000 gets cremation. Cremation means opportunity cost loss. Because of investment you are getting benefit means opportunity cost benefit. So basing on this, you have to analyze whether the project should be accepted. For this purpose, how should we do? We should, you see, first what happened? You remember this is opportunity cost. What is the opportunity cost? An investment decision gives an opportunity to generate an additional income, then that is known as, what is it? Opportunity cost benefit, right? This is always a plus element to the company. Are you getting me? Yeah, an investment decision may lose an opportunity and losses an income and loss an income, then it is known as, what is it? Opportunity cost loss. Dear students, investment decision creates an opportunity if it is a cost loss, and indirectly it is creates a benefit. Sometimes it may generate the benefit. Your investment benefit, your investment decision or an opportunity may cremates or generates. Cremates and enti? That is called what? It is not benefit, it is what? Loss. Loss to be deducted. Benefit means added. So that is the most important. For this purpose, you see, this is the 11th problem. Cost of machine, how much? 2 lakhs. Tax is there. That's the reason we have to calculate what? Depreciation. Cost 2 lakhs minus scrap value 18,000. I calculated 22,750. Now I need to calculate PV of operating cash inflow. Sales revenue we generated 1,20,000 less what cost? Opportunity cost. Sorry, operating cost I deducted. Next I got it PBDT less depreciation I deducted. I got PBT less what ma? Tax I deducted. I got what? PAT. Add back depreciation. Why you are add backing? Yes, okay, tax. Then less, what is that? Why you are deducting this one, sir? Sir, in the format you could not explain this one. Hello, excuse me. In the format is considered standard. But sometimes what happen? Opportunity cost benefit also you must be considered. That is the reason even after explaining that one, I am considering here. So dear students, don't forget the way of CA Institute logic is this. What CA Institute says, whenever you will take what decision? Tell me, what CA Institute says? Whenever you will take an investment decision, an opportunity may cremates, an opportunity may generate. Okay? If generates, it is what? Benefit, added. When it cremates, it loss, deducted. Are you getting? Here, because of this, an opportunity is getting loss, that's why deducted. You used to get a 39,075. Every year you are getting same cash inflow, na? What, ma? That's why every year same cash inflow means, should we use present value factor or annuity factor? Annuity factor, you have to bring it. So that's why you used to get a 8,426. Whereas a PV of terminal cash inflow also is there. You used to get that at the end of the period, 18,000. But actually you purchased asset for how much? Every year depreciation is how much? 22,750. How many years you used? 8 years. So 22,750 asset is depreciating. You used it for 8 years. 22,750 into 8. You deducted from 2 lakhs. 18,000. That means you sold the asset for as per written down value only, no? So that's why no loss, no gain. So that is the reason no tax and no tax shield. But this 18,000 generates at the end of the period. Should I use present value factor or annuity factor? Tell me. Present value factor. I have taken present value factor 10% 8 years 0.467 and I brought into present. That is 8,409. Are you getting ma? So once it is calculated, what is the strategy to find it out NPV? Tell me. NPV formula. NPV formula, sir. PV of operating cash inflow, sir. PV of terminal cash inflow, sir. Minus PV of cash outflow, sir. Right? So 2,08,426 plus 8,406. Total cash inflow minus 2 lakhs. You got it? 16,832 plus a. Whereas profitability index, PV of operating cash inflow plus PV of terminal cash inflow divided by PV of cash outflow. You got it? What is it? 1.084 times always profitability index. Okay. So that is what is the decision making? Since NPV is positive, profitability index is greater than 1. So it is beneficial to invest on concerned project. 10 out of 10 if you write, God bless you. No chance to miss 1 mark. No chance. So that is the reason this problem is important. Because why this problem is so important? If it is only NPV means Cello Limited. NPV plus profitability index. Yeah, only payback period. That problem. Are you getting? Right. With this, we completed NPV. Then what is this? IRR. I'm not explaining any irrelevant topic. Total, what is core important to your public exam. Within given time period, within this 2 hours of capital budgeting, I have to spend maximum all the problems. Payback period I covered. Exclusive NPV I covered problem. NPV profitability index also we covered. And one more problem I will take which covers what? Total Mahabharat. What is IRR? What is IRR? First of all, you should understand what is the IRR is. I will take you. See, IRR is one of the innovative concept. Listen carefully. Here is the investor. I want to explain it with the image. So suppose an investor is there. He is investor. Convince not investor? Yeah. He is. Hey, Subbarao is gone. Now, madam, in the place of Subbarao, I bought madam. Madam is going to identify. Yeah, here it is. There is an investor. This investor wants to make an investment. Got it idea? Theoretically, you cannot understand this one. You have to understand logic behind this one. IRR is the discounting rate at which NPV equal to 0 means you will last word NPV. NPV, yeah? Champa bagulu, NPV, radhi? You see, after explaining NPV, this man, when comes to NPV, he will completely forget the word and he will consider it's a NPV. Listen. An investor has an investment. You want to make this wonderful artificial intelligence project. For the sake of investment, you need money, right? So he went to where? HDFC Bank. Bank is saying how much cost? 15%, sir. Give me, we will pay money. Okay. That is 15% is called IRR. Yes or no? We have to pay interest. But this man again went to SBI. SBI ready to provide what is it? 10%. There HDFC 15%. They will provide you money. SBI also knows 10%. Now this man certainly have a question that SBI is providing 10%. HDFC is providing 15%. Which is the best? 10% is the best. But they are saying that wait for 4 months. 4 months. What sir this is? HDFC says that 4 hours I will give you. In such a case, this man will run to your office. Sir, they are giving 15%, sir, within 4 hours. Then go to SBI. Sir, 4 months, sir. Sir, actually, by investing in this project, how much I will earn, sir? You will earn 2%. In such a case, no need to do any of the business. If you earn 30% అన్నా అనుకో అప్పుడు 30%, then why should I wait for what? SBI. Then I will go to the HDFC bank. When you are going to HDFC bank, your mother asks, where are you going? HDFC bank. Why ra? Go to where? SBI, HDFC bank. 15% rate of interest. Mummy, you know HDFC. You know IRR. You know my IRR is, how much my IRR is? 30%. 30%, then mummy gives Harati. If her IRR is nothing but what is that? 5% means she pour petrol and gives Harati. Okay. So you see, when company HDFC, you are waiting for HDFC, immediately you got a message. So we are calling from HSBC bank, sir. We will provide you loan, sir. So within 4 seconds. What? 4 seconds. But sir, 20% is the cost of capital. Then you say yes or no? Maji, IRR 35%, Maji. Yes or no? You will say what? Yes. You try to understand when you are when you know how much you supposed to earn means, then you can understand how much cost you supposed to pay. In such a case, some costs are not at all cost to your viewpoint. So each and every financial manager wants to know, hey, what is maximum return I can generate by investing in this project? That is called IRR. That means if the IRR is 35% means, what is 35% cost he can pay? He has to pay. He can pay. But it is not the actually he has to pay. Are you getting? So every company wants to pay. How much I can pay. But actually how much I am paying is cost of capital. Yes or no? How much I can pay is IRR. So that is called IRR. After completion of this class, right, I go to the Vajram hotel and offer coffee. Then try to understand my IRR is. After this, if I go to the Cheruk Rasam, I will ask 20 rupees Cheruk Rasam. You try to understand what is my income. Hello? And even I go to the Vajram hotel, if I offer I need a Cheruk Rasam, go and bring it at, sir, akkadun teeskura po. Sir, ఖర్చు అవుద్ది. దానికి టిప్పే ఖర్చులాగా ఇసపో, నో ప్రాబ్లం. బికాస్ మై ఐఆర్ఆర్ ఇస్ హౌ మచ్? ఇంగ ఇరుకు. ఎంగ ఇరుకు? ఇంగ. So that's why every company wants to know that IRR. Sir, how should we calculate IRR? No, nothing but just we will pay whether we can pay this much of cost by keeping this point. We used to calculate what is that? NPV. Are you getting? So for example, actually how much I have to pay if I take money from HDFC? 15% cost of capital. If NPV is positive, indirectly what conclusion I can draw? 15% NPV positive means I can pay comfortably, right? Now, once I know that I can pay 15%, thereafter I will think how much actually I can pay. Then I will start to move. Which one? Cost of capital. This cost of capital. 15% NPV positive. Thereafter, 20% I can pay NPV positive. 25% I can pay NPV positive. 30% I can pay NPV positive. This is IRR. No chance, yes or no? Because NPV is what? NPV is what? 0. That's maximum. Beyond this, it will go, screen goes, entire our life goes. So what is the maximum rate? I will push what is that rate. 15% I can pay. 15% I must pay. Then I will push it. 20%. Can I pay now? Actually, you have to pay how much? Why you are taking 20%? Are you extra doing? I'm not doing extra, sir. I'm doing estimation to find it out what? IRR. At the 20% NPV positive, again I will push it. 25, while going on, I will identify. So IRR is a guess rate. What is that? Guess rate. I will guess could I able. So at one rate, your NPV equal to 0 means Gaya 2. That is the last segment. So that's why can I say IRR? See, IRR, what would be the maximum rate of return I can generate by making investment in the project? This is a straight question. Tomorrow, if you become CA, one person will come and ask you. For that purpose, he will ask you one more question. What would be the maximum financing cost I can pay in order to undertake project? What is this point? First he is asking, what is it? What is the rate of return I can generate? Once I know this much of rate I can generate means this much of cost I can pay. That is called IRR. Yes or no? In simple line, what is IRR? IRR is the maximum rate of return one can earn from the given project. It is also considered as maximum rate of financing cost one can pay in order to undertake project. I understand, Ra? Yes. So IRR, simply institute is provided. Instead of giving all this explanation, institute says this one. What is that? IRR is a discounting rate at which what? NPV equals to 0. So here what happened? IRR calculation is identify maximum financing cost. When you get IRR, it is a maximum financing cost IRR at which NPV equals to 0. How to I calculate IRR, Balu? How should I calculate IRR? To calculate IRR, what happened? You have to understand there are single cash inflow. Hello? There are multiple equal cash inflows. There are multiple equal cash inflow with annuity and multiple equal infinite cash inflow. In a CA Institute study material, they covers with respect to IRR, cash inflows would be 4 levels. What are they? Tell me. Single cash inflow, multiple unequal cash inflows, multiple equal cash inflows, multiple equal infinite cash inflows. Whatever it may be, you have to calculate. What is it? Maha mantra. What is a Maha mantra? You take a cash inflow. Cash inflow may be single. Cash inflow may be multiple equal. Cash inflow may be multiple unequal. Cash inflow may be infinite, right? Whatever the hell it may be. Maha mantra. NPV should be 0. You have to, while going on guessing, what you have to find it out? You have to find it out NPV. At which NPV equals to 0. While finding that rate, you have to search for it. That's why you have to guess rate. It is also known as guess rates. So what is that? How do you take a decision making? Tell me, how do you take decision making? So IRR, if IRR is greater than, what is it? Cost of capital, accept the project. IRR is less than cost of capital, reject the project. IRR is equal to cost of capital, what do you say? Either accept or reject the project. Are you getting my point? Yeah, whereas multiple projects are there, man. In such a case, what do you say? Multiple project. What do you say? Mutually independent. Mutually independent means project A, B, C, D. 4 projects are there. Accept all the projects if IRR is greater than cost of capital. What about here? It is mutually exclusive project. In such a case, A, B, C. You have 4 projects. What do you say? Accept the project which has highest IRR. Okay. Whatever the dear students, Maha mantra, you know the cash inflows. How many types of cash inflows may be? Single, 1. Multiple unequal, 2. Multiple equal cash inflow, 3. What is it? Multiple equal infinite cash inflow, 4. Whatever the cash inflow is not Maha mantra. NPV you have to find it out, but that NPV is what rate? Guess rate. You have to find it out the guess rate where NPV equals to 0. Are you getting? Only one problem. CA Institute asked for 2 marks question. IRR. This is the problem. One problem they asked here. They never asked here one question. But whatever the identity may be, it may be this is single cash inflow. If you invest 10 lakhs, you used to get it how much? 2,50,000. You have to find it out guess rates. Whereas here a company proposes to install machine cost how much? 3,60,000. Every year, 5 years, you used to get the same cash inflow. But in the problem, you need to find it out. PBDT is given. From the PBDT, you have to find it out what? CFAT. Whereas same ROM limited is a multiple equal cash inflow. But most important thing is which one? This is. For example, you invested how much? 1,36,000. First year you got it. Second year, third year, fourth year, and last 20,000. Are you getting? So this is the 20,000 you got it. By investing this cash inflow, how much the cash outflow you made it, right? How much the cash inflow you generated? 30, 40, 60, 30, 20. Multiple equal cash inflow na? Multiple unequal cash inflow na? Huh? Unequal cash inflow. I will tell you, when you make an investment, will you get single cash inflow na? Multiple equal, which is very, very practical to multiple unequal. So that is the reason this problem you have to take. For that purpose, once you know the multiple unequal cash inflow, you start to calculate IRR. So whether if I make investment, whether I will get it or not, for that purpose, what to take? You see, this is the cash. First, I took cash inflow. How much more? 1,36,000. Hello? Then first year, how much? 30,000, 40,000, 60,000, 30,000, 20,000. Every year cash inflow, I got it. This is nothing but cash inflow, cash outflow. Then guess rate. I thought it whether, not the cash inflow, sorry, that 10% is the rate I can pay or not. I want to test myself. For that purpose, I have taken PV factors. By multiplying, I calculated NPV. How much I got the NPV? By multiplying this cash inflow with the PV factor and summing up of all these things, I got a 2,280. What do you mean of this? What is meaning of this? Tell me. Sir, in this project, sir, if I invest how much, sir? 1,36,000, sir. If I get every year 30,000, sir, for this, if I pay how much interest? 10%. After paying 10%, I will generate how much? 2,250. Okay, sir, this project should be accepted, sir. Accepted. Can I take 10%, sir? Comfortably, you can take it. Sir, I am earning 10%, sir. I am earning 10%. More than 10%. Sir, how do you say, sir? After paying 10%, you have a 2,280, no? Excuse me. That means your IRR is more than 10%. Your raised amount is 10%. You are capable to pay more than 10%. Actually, you are paying, your capacity is not 10%. Hello? You can raise again more than 10%. Sir, how much, sir? Let's check another rate. What is it? 12% I have taken. At the 12% PV factors I have taken, I multiplied and I calculated NPV. Gaya bacha. Minus 4,180. Now the situation is, what is being a CA you can convey? You can say that, sorry sir, you cannot pay how much? 12,000. Wait sir, because after paying 12%, you are getting how much? 4,180. My salary is 20,000 in masterminds. My apartment rent is 20,000. Could it possible to buy the rice? Rice కాదు కదా, రైస్ బ్యాగ్ కూడా కొనలేవు. ఎందుకు చెప్పు? I am getting 20,000. I am paying how much? 20,000 is not possible. So indirectly, what is your return? What is your cost means, sir? You can earn 10%, more than 10%. That more should not touch how much? 12%. Then how much, sir? It lies between. For that purpose, we use interpolation. Interpolation formula. Do you remember interpolation formula? L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus, right. This is, what is this 10.705%? Can you please tell me? This is IRR, yaar. What is actually your cost of capital? 10%. But actually you can pay how much? 10.7%. HDFC ready to provide 10.5%. No problem. You can take it comfortably, yaar. This is nothing but your IRR is how much? Yeah, I told you that IRR, cost of capital, is a responsibility. It is always on your shoulder. IRR is in your dimag. It is a guesswork. Cost of capital is, it is a responsibility. You have to pay. Compulsory you have to pay. IRR is guesswork. If IRR is greater than cost of capital, project should be accepted. IRR, cost of capital, both are same. Project either may accept or reject. If IRR is less than cost of capital, reject. Okay. How many ways of cash inflows? Single, multiple. Another one is multiple unequal. Multiple. Yeah. Thereafter, you can say any of the cash inflow, maybe Maha Mantra, What is that? NPV equals to 0. Are you getting ma? So this is the IRR. And what is the left? Another one is payback reciprocal, we completed. And another one is capital rationing. Ration, ration. Ration, they will give you unlimited rice, unlimited sugar, unlimited oil. Ration is nothing but limited. Few grams, not few grams, few kgs. Okay, dear students, IRR we completed. Before going to capital rationing, we can discuss a comprehensive problem with respect to what? All the methods. What is that? So far, what the methods we calculate? Payback period formula. Initial investment divided by annual cash inflow. NPV formula, you know, Ra? What is NPV formula? Yeah, profitability index. How should you know that at 15% a project can survive or not? How do you take? Sir, you take this 15%, you calculate IRR, sir. Okay, sorry, you take cost of capital. At the cost of capital, NPV equal to 0, sir. In such a case, that is IRR. Yes or no? What is internal rate? IRR. What is the payback period? It is a time period in which invested cash outflow can be recovered from its. What is the payback reciprocal? Yeah, this is the problem which provided in public exam. You see how many times they asked. Only one problem in a repeated mode he been asking. Are you getting? This is problem is there Hindlover company. It is nothing but I see a practical question which consists past all the questions. Are you getting, Maji? So this is the problem. You see, let's move to this problem. We will solve and next chapter, before starting this chapter, let me conclude this one. Okay. And next in this problem, we are going to learn the given concepts. What are they? Hindlever company considering new product line, its supplement range, its line. That means already they are producing. Now they want to add one more new project to the concern. Hello? For example, ITC is there, which been producing cigarettes. Now it enter into the dress materials. Now enter into the books. Now enter into the hospitals. See, hospitals. They are very keen about hospitals. Indukra hospital, cigarette produce. That means we create patients. We treat whom? Patients. Because we know what is the business is. So ITC, very worst thing. Okay? That the thing is, for they are moving. Maji, now you tell me, if you are capable to understand this problem with this knowledge, you can solve. Yeah, here the cash investment of the project is how much? So new project will involve cash investment 7 lakhs at what period? 7 lakhs at a 0 time period. 10 lakhs at the end of after first year. What is the CA Institute key point in this problem? Tell me. What is the CA Institute key point in this? That is investment is making in the beginning. Total beginning, Maji. Investment making beginning how much? 7 lakh. Whereas 10 lakhs you are making when? What to do with this? You have to bring it into present. Indirectly he is asking, hello boy, you know when to use present value factor? When to use annuity factor? Indirectly that question only, no? Yeah. Then after cash inflows, how much? 2,50,000 expected in year 2. What about year 1? No data. Sir, no data 2 lakhs. Can I take 2 lakhs as assumption? Business 2, first year nothing. So you should not take such a worst assumption. So what you have to do is first year nothing you got it, 0. Whereas year 2, how much you got it, ma? 2,50,000. Year 3, 3 lakhs. Year 4, 3,50,000. Thereafter, year 5 to 10, how much, Maji? 4 lakh, right? Although the project might be viable after 10 years, company prefer to be conservative and end all calculation at the time. Company's required rate of return is 10%. Balu sir, what do you mean by required rate of return, sir? Required rate of return also known as what? Cost of capital. It is also known as what? Discounting rate. It is also known as what is it? Cut-off rate. Now, what is NPV of the project? NPV of the project, if you want to do so, you have to find it out, the project cash inflow, cash outflow, right? Here, where I done it. This is the problem. You see, calculation of NPV at what rate? 10%. How many years actually? 0, 1, 2, 3, 4, 5 to 10. What, Maji? Beginning, what is it? 7 lakhs. Is it inflow na outflow na? First year, inflow na outflow na? Outflow. Thereafter 2, 3, 4, 5 to 10. I have taken PV factor 10%. Here also PV factor. Here also PV factor. Here also PV factor. But 5 to 10, how to I bring it into present? Very, very subjective line. Tell me. What should I do? I have to use annuity. How do you use annuity? If it is happens in between 10 and 5 and 10. For that purpose, what to do? You have to sum the present value factors. What is it? 4, 5, 6, 7, 8, 9, 10. You summing up of this value, you will get it at 2.974. Now you can multiply all these things. You will get the 7 lakhs, 9 lakh 9,000, 2 lakh 6,500, 2 lakh 25,300, 2 lakh 39,050, 11 lakhs 89,000. From cash inflow minus cash outflow, if you do so, how much you got it? 2 lakh 51,450. What is your opinion? Accept this project, yes or no? Then immediately he asked, Balu sir, what is a profitability index? What is a profitability index? Sir, profitability index is nothing but PV of cash inflow divided by PV of cash outflow. Are you getting? So what is a PV of cash inflow? Means cash inflow just now we summed up how much? 18 lakhs 60,450. Cash outflow 16 lakhs 9,000. So NPV profitability index you got it. What is it? 1.15. Profitability index always conveys in times. Always conveys in times. Then what is the second step they asked? Sir, is this project is financially viable at 15%? What to do now? Tell me. I have to take that 15%. I have to calculate NPV. Luckily at the trade NPV 0. If it is at the negative, reject. But is it IRR? No, it is not an IRR. IRR would be, it should be 0. So let's check it. We will check its pulse rate whether 15% is what? IRR or not. For that purpose, immediately what I have done, I have taken 15%. Same cash inflow I have taken. 2 lakh 50, 3 lakhs, 3 lakh 50, 4 lakhs. By taking this 15% cash flow, I factor value, I multiplied 7 lakhs, 8 lakh 70,000, 1 lakh 89,000, 1 lakh 97,400, 2 lakh 200, 8 lakh 65,200. So how much negative? अभी बताओ ये मेरा IRR है क्या? No, it is the right time to close the doors and cry. Because you are not able to pay how much interest? 15% interest. Then what is IRR, sir? Your IRR I don't know, but IRR where is I can smell where the IRR is. More than 10%? Less than 15%. Sir, how should I find exactly? Use what? Interpolation you have to use. So calculation of IRR. How should I calculate IRR? NPV at 10%. How much? NPV at 15%. That's IRR. You can use it by using what? Interpolation. So L1 plus NPV at L1. NPV at L1 minus NPV at L2 into L2 minus L1. By posting this value 10%, 2,51,450, 2,51,450 plus 1,18,215. You got it how much, ma? 13.4%, right? Can you calculate a payback period? Payback period means actually how much you invested, boss? First year how much you got it? No single rupee also. Yes or no? So Y1 is 0. What about second year? Third year? Fourth year? Fifth year? 4 lakh. Sixth year? What about sixth year? You recovered how much? Total balance. That's why payback period is. Can you tell me payback reciprocal for this problem? 1 divided by 6 into. Balu sir, can you tell me what is the difference between actually payback period, the 16.67%, sir? Payback period equal to 6 years. That means every year you are recovering your investment worth of how much? 16.67% you are recovering. So 16.67% you are recovering means how much you are earning every year? You are earning as an average 16.67%, you know. That means you are recovering means the project is earning. Hello. Logic you understand. For example, my payback period is 25%. Logic understand. Payback period is 25%. Then client will ask, what is 25? Payback period is what, sir? 4 years. 4 years. Sir, what is the 4 years indirectly? Indirectly indicates if you invest in this project, you have to wait for 4 years. Sir, that means my investment, can you tell me in percentage mode, how much I recover per year? 25%. Sir, how do you told 25%? 4 years means 100 cut into 4 parts, sir. 25%. Yes or no? Sir, that means my project is earning 5%. you are recovering 25% means your project is at least 25% it is giving. I cannot say more than 25%, at least 25%. Sir, then my IRR is 25%. Why, sir? You are only just now told that IRR equal to, what is that? IRR also cost of capital, right? So IRR is how much? 25%. What we can say? No. Your IRR is not at 25%. Your payback reciprocal may be 25%, but your IRR never be 25%. Why, sir? Because payback period ignores time value of money. IRR considers time value of money. Are you getting? IRR consider time value of money. This ignores time value of money. That is the reason you can smell where the IRR is, but you cannot identify payback reciprocal is what? IRR. MCQ question they will identify. Could you able to find IRR with the payback reciprocal? Yes, absolutely. I can identify where the IRR is. I never say that this is what? IRR. Are you getting ma? So that is, sir, reason for that, sir. Could you please elaborate? Reason for that? Because it could not consider what? Time value money, sir. It won't consider time value of money. Right, ma? That is. So with this, we consider this point. Next, what is another concept I told you? Last concept. Thereafter, I identify 36 key points for examination because I made investigation, you know. Something you need to get the bonus point, which is surprising. Beyond your expectations. What is a capital rationing? Tell me. Capital rationing. Array 5 marks. You can expect a 10 marks, ra? Capital rationing. Capital rationing. Here is a rationing. Rationing means, yeah, limited. Capital rationing means, dear students, it is a systematic allocation of what funds? Limited funds, ra? Limited funds. When funds are limited, with this limited funds, how much you will utilize? You remember one movie is called Suryavamsam, where idli, with that idli she will make upma. Richest father start to cry and he will ask, give me in small box. I will take to your mummy. Mummy also starts to cry because my daughter knows what? How to make idli to upma not. She knows what? Capital rationing. With this limited funds also, bachcha, mera daughter bahut acha. She made it, yaar. That is not a small thing, right? మిగిలిపోయిన ఇడ్లీని పడేయడం కదా, ఉప్మా చేసి పంపు సెలెక్ట్. అది within the limited. When you have adequate funds, what is their story here? You have a limited funds. If you make it, then it is a story. The story is the Dhirubhai Ambani, not Mukesh Ambani, because you are a son of who? Dhirubhai Ambani. What is there? If I the son of Dhirubhai Ambani, నేను కూడా విమానాలు తిరుగుతా. ఇక్కడ ఎందుకు ఉంటాను? మా డాడీ ధీరుభాయ్ అంబానీ కాదమ్మ. Are you getting? If my father is a Jagapati Babu, I would be Simantru. Whatever you need, I will give you. Laptop you need, take. Mobile you need, take. You need my chain, take. Watch. Because my father is Jagapati Babu, I would be Mahesh Babu. Babu, my father is not a Jagapati Babu. That's why I should know what is that. Capital rationing. With this limited funds, I have to spend it. I have to identify it. But if you become CA, you may become Jagapati Babu. To make your son as what? That is. So capital rationing is what? Systematic allocation of what funds? Limited funds. Where it is? Yeah. Capital rationing in the flow. Right. Here capital rationing is what is it? Systematic allocation of limited funds. Okay, on more financially viable projects. What is that? Financially viable project. I made some notes to save your time because I don't want to maximum information. I want to give it. See here, you see capital rationing. The word rationing means indicates what is it? Scare and limited. Because this video is possible, my notes is available here. Okay, just within the minutes, just you make it observation, then your this notes is available. The word rationing indicates what is that? Scarce or limited. Capital rationing means what, Balu sir? Balu sir? It is a systematic allocation of limited funds on more financially viable projects, which NPV is financially viable projects means that projects NPV should be positive. Are you getting? Types of projects. There are two types of projects, sir. Listen, MCQs they will ask you. How many types of project? Two types of projects, sir. What are they? One is divisible projects. What is a divisible projects? Proportionate investment is possible. Example, sir. Shares, gold, silver, bonds. Okay. Out of this, he may ask you example also MCQ you can expect. Thereafter, how do you do capital rationing for divisible projects? You want to learn how to do capital rationing? For this step number 1, you learn. What is the step number 1, sir? First of all, you pay attention to profitability index. Calculate profitability index of what? Each of the project and provide what is it? Ranking. Okay. PI, profitability index ranking could be done only what? For divisible project, you need a P, then you need to give what? R. For that purpose, how do you do capital rationing? Take the first column, projects, as per what? Rank. Then you make an investment. Find it out surplus. Calculate what is that? NPV. With this order, if you go as per this order, within the spending limit, with this limited funds, you can generate maximum NPV. Are you getting? I will prove this one problem. Okay. Thereafter, indivisible projects means, what is indivisible project? MCQ question. Sir, proportionate investment is not possible. Example, sir. Machinery, building, plant. Yes or no? Vehicle, etc. How should I do capital rationing, sir? Choose a combination. Here what I choose? Here what? Rank. Profitability index I calculated. Basing on that I provided rank. But here, no need of rank. Basing on NPV, you need what? A combination. Basing on that combination, you take the investment and identify the surplus and calculate what is that? NPV. So which combination gives what is that? Highest NPV, then that project or that one would be selected. Are you getting? For example, assumptions. There are different types of assumptions are there in this project. What are the assumptions of profitabilities? Balu sir, scarcity of funds only at the time of what? Investment. Not forever the company runs under what is that? Scarcity. Yes or no? There is a linear relationship between what is that? NPV and investment. Linear relationship between NPV and investment. Then investment decision never be urgent. Say yes or no. But no chance for what is that? Postpone. Right? No postpone. Profitability index. Right? Projects have what relationship? Projects are mutually independent relationship. A project can be either accepted or rejected, but not what? Postponed. Okay. These are the assumptions of capital rationing. Now, I will tell you the past exam questions. They've been asked one of the question. In our material also they provided. Yeah, you see here, this is the question. How many times they asked, you see. Okay. Each and every question, from this entire chapter, they will ask one question. Are you getting, one question? How many models? 7 to 8 models. 7 to 8 models, each and every model I explained. In the 7 to 8 models, they will ask you one model. Idhar nahi to udhar, udhar nahi to there. I put all the Volvos. What Volvos? Not right? Tempo? What is that? Vehicles. Sumos. Examiner is a Mahesh Babu, but this time he never misses from my tempos. Sumos. So this model, what I thought it, what should I explain? Shall I take capital rationing? 5 marks kadite? Okay, time is not possible. Profitability index, if they will ask, NPV they ask, IRR they ask, certainly all ask. Payback period ask, what should I do? We do one thing, take a Horlicks Boost Bournvita with the milkshake, drink and tell all the methods. First, projects are divisible, right? In such a case, what we have to do? Profitability index of each of the project. Yes or no? You see, in the project problem is, Shiva Limited has a capital investment projects, which has cost of capital is 15%. A, B, C, D, E is there. All the projects are NPV positive. NPV positive. So at 15% they given. This is the investment. This is NPV. Now the company has a capital spending limit of how much? 1,20,000. If you sum it up total, can you tell me what is the total required? 50, 40, 25, 30, 35. 1,80,000, but whereas they have a limited of how much? Right. So you are required to illustrate the return, best return from the given projects. A projects are independent each other, which are what is it? Divisible, which is indivisible. Another one is divisible. What I told you when projects are divisible, what is the order I told you? What this one? Divisible. First, what you have to calculate? Thereafter, give what? Thereafter, you have to go with what? The investment procedure. So here you see this one. What is that? First, what they have done? The profitability index they calculated. Basing on rank they provided. Yes, ranking is this. Yes or no? So project A they have taken. Investment, NPV they calculated. Investment, NPV, by adding you will get the PV of cash inflow. PV of cash inflow divided by investment. They got the profitability index. Basing on the profitability index, they gave rank. Now basing on rank, they made a capital rationing. First they selected E, B, C, D, they made it. While going on making investment, at the end, while making investment D, funds are become what is it? Scarce. Just now I told you proportionate investment is possible. So for that purpose, what they calculated, if you whatever the surplus amount is there, if you invest in this project, how much proportionate investment you will get? It means 7.47 you will get it. By spending total 120, they got it how much? 55.57. Whereas if the projects are indivisible, so in such a case, you have to choose the combination basing on what? NPV. EBC, this is the total investment required. NPV, you can get it. EBD, total investment required. NPV, you will get it. Since NPV is highest in which combination? EBD, so better to choose this one. So this is the capital rationing, and ARR is also is there, right? But ARR point of view, ARR can be estimated how many methods? ARR is the average rate of return, which can be calculated basing on what profit? Accounting profit. It is the average annual yield. This is only for, never ask this model, but ARR is the average annual yield or return or generated return. So ARR can be calculated. How do you calculate ARR? Based on what is it? Total investment, based on average investment, based on annual investment. Total investment formula is nothing but ARR equal to average profit divided by total investment. Average investment, ARR equal to average profit divided by average investment. Average investment equal to half of initial investment plus installation cost minus salvage value plus salvage value and working capital if any. And last one is what is that? Average investment, annual investment based. What is that? Annual investment based. Every year you have to take annual investment and you have to calculate ARR, and basing on that you have to consider. So this I will explain with the after break. So from the past exam point of view, in capital budgeting, ARR is not at all such a important, but the thing is, this is the problem. I made it for you. Here, key points. These are the key points. This is my research work from this. What they asked in exam hall. Hello. Do you know working capital treatment? Do you know how many methods are used in calculation of depreciation? SLM method, WDV method. You know the treatment of subsidy? Do you know variable cost ratio? Tell me variable cost ratio formula. Variable cost divided by, do you know contribution ratio? Another name of contribution ratio? When you should use present value factor? When should you use present value annuity factor? Do you know set off losses? Set off loss means what, sir? This year loss you will get it, This year loss you can shift to next year profit by deducting, you can make pay tax. Tax, when should be pay tax? When should you get tax shield? Profit versus gain. Profit versus gain. While producing a product by using an asset, right? If you sell in the market, you will get the benefit. That is called what? Profit. If you sell the asset, you will get the gain. So gain seems to be post-mortem. Profit seems to be operation, pet operation. You can do many of the operation every day. Written down value estimation. Tell me your written down value. Cost minus accumulated depreciation. Array, do you know capital rationing, ra? Systematic allocation of limited funds on more financially viable project in order to generate maximum NPV. Hello, excuse me, divisible project, non-divisible project, sir. Sir, proportionate investment possible, sir. That is called proportionate investment not possible, sir. Evaluation of financing cost. Financing cost means while calculating CF80, don't deduct interest. That should be deducted in the form of discounting. What? Compounding means interest is adding. Discounting means deducting. While calculating CF80, last problem is there. While calculating CF80, don't deduct interest. That interest should be deducted in the form of discounting. Internal rate of return means what? Maximum rate of return one can earn by making investment in the given project. At IRR, NPV equal to what is the cost of capital? When you raise the funds, you have to pay what? Cost. Yes, it is the minimum rate. This cost of capital is the after break. Profitability index means what? By investing 1 rupee, how much cash inflow we supposed to generate? Right? Every 1 rupee, how much it is giving? Profitability index formula. Balu sir, payback period, sir. Payback period, sir. It is a time period in which invested cash outflow can be recovered from. Sir, what is a discounted payback period, sir? Discounted payback period means it is a payback period which is calculated from discounted cash inflows. Sir, reciprocal rate of payback period means what, sir? 1 divided by payback period. Balu sir, opportunity cost benefit, opportunity cost loss. While investing in a project, an opportunity creates if you give benefits. It is called opportunity cost benefit. While investing, if you lose an opportunity, that is called opportunity loss. Balu sir, opportunity cost benefit. Balu sir, standard payback period means what, sir? In order to take a decision, right, always the client comes to with what? Certain standard payback period. If the payback period want to take a decision, certainly you need, what is it? Standard payback period. Payback period is less than standard payback period. Project should be, payback period is more than standard payback period. Project should be, Balu sir, what is direct cost? Balu sir, indirect cost. Balu sir, traditional method versus modern method. Ignores time value of money, considers. Balu sir, trial and error method used for calculation NPV. Huh? Balu sir, ask your student a trial and error method formula, sir. Trial and error method, indirectly trial and error method seems that IRR lies between 10% and 15%. Yes or no? It lies between two guess rate. But exactly if you want to pick it up means you have to use what? Interpolation. Interpolation formula. L1 plus NPV at L1 divided by NPV. Accounting rate of return. It is the average annual rate of return earned from the project, but it ignores time value of money. It considers PAT. That is the reason this method is not at all that much of popular. Okay. Sir, various methods used in calculation of ARR. How many methods? 3 methods. Total investment, average investment, annual investment. Sir, what is the meaning of finally capital budgeting, sir? Capital budgeting. Completed, Ask, sir. Beginning started, What is the capital budgeting? Just now I told you, systematic evaluation of long-term project. Significance of capital budgeting, sir. Substantial expenditure, long-term project, huge risk, complex. Meaning of NPV, sir. NPV, present value of cash inflow minus present value of cash outflow. How many cash outflows are there, sir? Cash outflow, operating cash inflow, terminal cash inflow. Sir, decision making table basing on all the methods, sir. NPV, profitability index and discounted payback period. Sir, how to bring equal cash inflow which arises at the middle of the year, sir? Which arises middle of the year. 1 to 5. In such a case, what to do? 1, 2, 3, 4, 5 present value factors you have to sum and you have to bring it into present. Sir, treatment of depreciation, how do you do, sir? In the presence of tax, in the absence of tax, how do you treat it? T is there, D is there, T is not there. Opportunity cost to benefit, pre-tax, post-tax. What do you mean of this? Sir, pre-tax means before tax, sir. Opportunity cost treatment should be done before tax. Post-tax means after tax. GBU. You put it in effort, how examiner makes a strategy to make us fail. he has to fail. Okay, take break. Cost of capital. Dear students, after making a summary of entire your study material, total cost of capital, illustrations 18, practical problem 7, MCQs 10, theory question 6. This is the total summary of what your study material, new study material. Maximum the game he may design for us is nothing but only from 18 plus 7. How much? How many? 18 plus 7, 25 problems. From past exam, by taking this 25 problems, I checked the past exam what has happened. Because you know that if you want to become at most best in future, you must check what? Your past. But I observed this one with the study material. I analyzed that what happened. Maximum they are asking, what is it? 10 marks. 10 marks maximum. This is a 10 also. This is also 10. But the theory part that covered, that is point. 10 marks means what the concept they are asking means weighted average cost of capital book value, weighted average cost of capital market value, weighted average cost of capital and marginal cost of capital. Only this. This 4 parts. Wherever the chance is asking means only 5 marks. Here 5 marks they are asking means only in Gordon model problem they have been asking. What is that? Gordon constant dividend model, CAPM approach. Do you remember CAPM approach, constant Gordon model? Another one is a YTM technique in cost of debt estimation. Only this. But 99% they won't ask you because there is a much chance to ask what? Weighted average cost of capital basing on what value? Book value and market value. Dear students, the first of all, you should be very clear with respect to what is cost of capital. This is my notes I prepared for you. Actually, this is cost of capital. "82 pages I wrote. It's not a fingers. Okay? You have to write. For the sake of salary, I am doing this much of efforts. For the sake of career, how much you have to do? Are you getting? No balance sheet. You put a cost, you will get the return. That's enough. Luca partial, what he told. Debit what comes in? Yeah. First of all, dear students, what is the cost of capital? Within 1 minute, I will tell you. So this is the entire class is nothing but what? What is the theoretical one? Just to make you to understand what is the concept is. Okay. See, the fact is this. The business need a capital. That capital, the company may raise it for long-term sources or short-term sources or long-term sources. What is cost of capital? I will give you an idea. Cost of capital, Mahamarathon. It's not a marathon. Mahamarathon. Okay. Cost of capital. What is the cost of capital, ma? Very simple. Very, very simple. What is this? Sir, a business need a capital, sir. Okay. This capital, for the sake of capital, company concentrates only long-term funds. Keep it in mind. There is no chance for what funds? Short-term funds. Okay. No chance for short-term funds. Company keeps only long-term funds. What are the various long-term funds? Again, you have to think, right? Equity is there. Equity share capital, preference share capital, debt, debentures, or retained earnings. For equity share capital, you have to pay equity dividend. For preference shareholders, you have to pay preference dividend. For debenture holders, you have to pay interest. Whereas for retained earnings, you have to pay what? Equity dividend. For equity shareholders, how much capital you have taken, how much cost equity dividend you have to pay, right? That is the cost you are supposed to pay. Now here, what are the various costs you supposed to pay from various investors? This cost and this cost, this cost, this cost. If you sum it up all the cost, then you will get it what? Cost for raising of what? Capital. So this is cost of capital. So in the simple line, if you ask me to consider what is the cost of capital means, it is what? It is a summation of all cost of capital. Hello? So if you ask me what is exactly the meaning of cost of capital is, cost of capital is the minimum rate of return that a company must earn to keep the expectations of whom? Fund providers. Not equity shareholders. Fund providers. Who are the fund providers? Equity shareholders. Preference debentures. Equity shareholders, debenture holders. What is it? Preference shareholders and other. To keep the market price what? Alive. So for that purpose, you can see what is the cost of capital. In one line, you can write it is the minimum rate of return that a company must earn to keep the expectations of whom? Expectations of fund providers. Who are the fund providers? E plus, P plus, D plus R. What is that? Equity shareholders, preference shareholders, debenture holders, and with the retained earnings. Yes or no? Well, what is the significance of cost of capital? Sir, why should I study? Tell me, sir, first of all. Cost of capital is very, very important for any company. In order to identify this cost of capital, one more point I would say, you can also identify cost of capital is the systematic summation. What is a systematic summation? So whatever the various specific costs are there, all the specific costs you have to sum it, but in a systematically. That is KE, KP, KD and KR. It is also known as weighted average cost of capital. It is also known as overall cost of capital. MCQs they may ask you. Second question, what they asked, Sir Balu sir, cost of capital always represents in rate or percentage. It never be in amount. Cost of capital 45,000. Wrong. 45,000 not 14%, 10%, 8%. It represents always in percentage, but not in amount. Keep it in mind. MCQ question they will ask you. What is the significance? Why should I learn cost of capital, sir? You must learn here. That is the reason. Tell me, sir, why should I learn? Because cost of capital takes just now what chapter we completed? Capital budgeting. So in capital budgeting, in investment decision, if you want to take investment decision, right, IRR should be greater than cost of capital. Or to calculate NPV, you need to make a discounting rate. Hello? To need NPV means future cash inflow, you have to bring it into present. So for that purpose, you need what rate? Discounting rate. Simply here, if you are making investment means you are generating return. That return should be greater than cost. Without knowing cost, how should you determine what is that? R, right? So that is the reason what financial management says, excuse me, Balasubramanian ji, cost of capital enables the financial manager to take what decision? Investment decision. Sir, can't I take investment decision without capital budgeting? Absolutely no. Can you please tell me, sir, why? Because, my dear, IRR should be greater than cost of capital. Then only you should say accept. Okay, for only capital budgeting purpose, we have to learn cost of capital. No. Where is another purpose? Cost of capital conveys financial performance of the company. Financial performance of the company. How should I identify financial performance of the company? Mr. Baluji, here, company A, cost of capital is 14%. Company B, cost of capital is 24%. Can you tell me which company is the best? Sir, B would be best, sir, because 24, sir. Every 100 rupees you have to pay how much? 24%. This company is. So can you, being a financial manager, can't you make a comment which company is the best? Yes or no? So financial performance of the company can also be learned with what? Cost of capital. By seeing cost of capital, I can identify whether you are performing better or not. So performance. Another one is cost of capital also expresses what? Risk position of the company. Risk position of the company. How should I identify risk position of the company? Balu sir, cost of capital company A is how much percentage? Cost of capital company B is 18%. Balu sir, both the people for every 100 rupees, this company rising 100 rupees for 14%. This company rising 100 rupees at 8%. This company generated 5%. Let us take this company generated 20% return. 20% return means both the company generating 20. Hello? But this company earns only 20. How much goes? 14. How much left? 6%. Whereas 20 minus 8? 12. That means you try to understand which company has a more chance to earn more return. B. Okay, na? This is one analysis. Another analysis, which company has to pay high cost? Profit is reward of what taking? You have to pay high cost means you have to make more earning or less earning. When more earning means automatically you have to take more risk. So that's why which company is high risky one? A is a risky one. Because you have to take any of the strategy or go to hell. You must earn how much? 14%. Those that indirectly conveys risk is very high because the company has to earn return more. Why it has to earn? Because cost is more. So that is the additional point. And cost of capital supports the credit policy of the company. Credit policy of the company means what, sir? If you credit to be provided or not, that is a credit policy. It means that a company whose cost is very less, right? They can provide more credit. If they provide more credit, they can make more sales. They can make more sales. They will become what? Market leader. Do you agree? What? Every company wants to become market leader. If they want to become market leader means what they have to do? More sales or less sales? More sales means your cost should be more or less. My cost is less means then only I can give more credit. So that means when your cost is how much? 14%. You cannot become a market leader, sir. How, sir? Your cost is 14% rascal. You cannot provide credit sales. You cannot make a credit sales. You cannot make more sales. You cannot make a more sales. You cannot produce more product. You cannot produce more product. You cannot get the fixed cost advantage. When you fixed cost advantage means to produce more number of units, fixed cost will remain constant. So if you want to get the fixed cost advantage means you have to produce more. If you want to produce more means you have to sell more. If you want to sell more means your cost should be low. Hence your cost is not low. This benefits could not happen. So there is no chance for you to become what? Market leader. That is the basic observation we can identify. You see, company A, company B. Company B cost is how much? Now, which company follows liberal? Which company follows restrictive? Liberal means it says that, take money here, no problem. Tarvat ivandi. Liberal credit policy. Liberal means more credit it will provide, less credit. More credit leads to more sales. More sales leads to market leader. Market leader leads to wealth. By seeing this cost of capital of the company, you can construct a direct pyramid to what? Wealth. This is also possible. Are you getting ma? So this is the cost of capital. Significance. Tell me, what decision? Investment decision you can say na. Another one is risk. Another one is financial performance you can say na. Another one is credit policy, which leads to market leader. Yes or no? Yeah. Another one is what are the steps involved in calculation of cost of capital? How many steps involved in estimation of cost of capital? Here, steps required to estimation of what is it? Cost of capital. How many steps it involves? Step 1, calculation of what cost you have to do? Specific cost. What are the various specific costs? Sir, specific cost you have cost of equity, KE, cost of debentures, KP, cost of debenture, KD, cost of retained earnings, KR, cost of long-term loans, KTL. These are what cost? Specific cost. Tell me what are the various specific costs? Cost of equity, cost of preference, cost of debenture, cost of retained earnings, cost of long-term loans. These are all what cost? Specific cost. This is step 1 or step 2? Step 1. Thereafter step 2, you have to calculate weighted average cost of capital. It is weighted average cost you are doing means you are systematically analyzing. It is the systematic summation of various specific costs. That means either you can do it in what method? Product method, proportionate method. What is the product method? What is the proportionate method? I will tell you. Okay. But you know the steps, right? What are the steps? Tell me. Yeah. Finally, from the past exam, they used to ask, what is the cost of capital? Cost of capital, minimum rate of return that company must earn to keep the expectations of whom? Fund provider. Sir, cost of capital will be raised short-term funds or long-term funds? Why don't we raise short-term funds? Arubas, whatever the funds we raise, we used to acquire fixed assets. But current liability should be repaid within 1 year. How it is possible, right? How many steps required to calculate cost of capital? 2 steps. So, step number 1, calculation of specific cost. Step number 2, thereafter you have, what is that? To determination of cost of capital. To calculate cost of capital, step number 1, what to do? Various specific costs. What are they? KD, KP, KE, KR. And after summing up of all in a systematically, you will find what? KO. First, your 90% chapter is nothing but cost of capital, specific cost. But last KO would be an aggregate one. Are you getting my point? Now, first of all, you should understand what is cost of debenture. Cost of debenture means whenever company raises a debt, what is the cost to be paid? Okay, coming to here, what is the cost of debenture? Is it clear? Yes, you see, cost of debenture means, Maji, cost of debt. It is the minimum rate of return that a company must earn from its what capital? Debt capital. It is the minimum rate of return that a company must earn from its debt capital. It is denoted as KP. Yes or no? KD. It is denoted as KD. Is it an amount or rate? Rate. It is amount in rate. Okay. It is the minimum rate of return that a company must earn from its debt capital. It is denoted as what? KD. In generally, cost of debt is nothing but coupon rate. When company raises funds, right, it is to pay coupon rate. But in such a case, KD equal to what rate? Tell me. KD equal to coupon rate. For example, I need a capital man. I issued a 100 rupees debenture. I promised to pay 10%. That means cost of debt is how much? 10%. So no need to calculate cost of debt also, because cost of debt is nothing but coupon rate. Condition applies. What is the following, right? This is happens in the presence of following factor. In the presence of following factor, coupon rate may not be cost of debt. Balu sir, you only told just now. What is this? Cost of debt equal to coupon rate. What, sir? Hello, excuse me. In the absence of factor, coupon rate equal to KD. But in the presence of factors, cost of debt is not equal to coupon rate, dear students. Examiner gives you all these factors. Alright, take this factor, take this factor, take this factor. Tell me cost of debt. He will also provide you coupon rate also. In such a case, what are the factors, sir? What are the factors, sir? Flotation cost. Tell me what is the flotation cost? Issuing cost, printing charges, brokerages, banker charges. Yes or no? All these cost comes, what is that? Factoring cost. Whenever client comes and stands in front of you, right, you have to collect. What is your coupon rate, 10%. What you are expecting? Cost of debt. Cost of debt equal to coupon rate, Give me fees, go. Yes or no? Should you say like this? He will dump this much of information at you. What is that? He will give you what? Flotation cost, also known as issuing cost. And he will also say that issue made at what? Discount. Issue made at a premium. Tax impact. Tax is a favorable, unfavorable? Favorable. Why? Because how much interest you pay on debentures, it is to get what? Tax advantage. So redemption made at a discount. Redemption made at premium. 6 questions you have to ask him exactly to declare whether CR equal to KD or not. Hello? CR means what? Coupon rate. Coupon rate equal to KD or not. You see, 1, 2, 3, 4, 5, 6. 6 questions adagalavandi. Stupid logic, but valuable. What is the 6 questions you remember? What are the 6 questions you have to ask? Flotation cost is there. Flotation cost. The flotation cost means issuing cost, issue made a discount, issue made a premium, redemption made discount, redemption made a premium, tax impact is there. Just if you ask all these things, by considering all these things, you have to declare that coupon rate is cost of debt, coupon rate more than cost of debt, coupon rate is less than cost of debt. 5 marks question. Maji, okay? Yeah. These 6 factors you have to consider. For example, ABC company is there. Face value how much? 100. Coupon rate is 10%. Redeemable period is 10 years. Redeemable period is 10 years means it is redeemable or irredeemable? Irredeemable. Redeemable value, whenever any company, you couldn't see, any company, see, this is the debenture they will give you. They will give you, this is the one debenture, ABC company debenture certificate, this is. Debenture certificate would be like this. Whenever company wants to raise finance, they will print all these documents. Coupon rate, face value, coupon rate, redeemable period. They will say 0. 0 means irredeemable. If it is say 10 means what is it? At the redeemable means at the end of the redeemable value, you have to tell how you are going to give. How? Face value plus premium, face value minus discount, at par. You have to collect all this information. Okay? Finally, how to calculate cost of debt. How to calculate cost of debt. How to calculate cost of debt means, first of all, you have to identify, take cost of debt, how to calculate. Make it into 2 parts. One is what? Irredeemable debenture. What is the irredeemable debenture? Tell me. Irredeemable debentures are those debentures which never be redeemed by the company. Okay, this is irredeemable. Okay, another one is redeemable debentures. What do you mean by redeemable debentures? Redeemable debentures are those principal amount should be repaid. What about here? Principal amount never be repaid. Okay, whereas and only interest to be paid. What is that? Tell me. Irredeemable debenture. Tell me what is the story? Principal amount never be repaid. Only redeemable debentures. Principal amount repaid, but redemption done at. But here principal amount you are paying means, again one more question will come. How you are paying? What is that? That principal amount. There is a principal amount should be paid what? Lump sum at the end. Another one is redemption should be done at installment. When, dear students, when redemption is done at, what is it? Irredeemable debenture means the situation is the formula to be calculated is what? Interest into 1 minus tax divided by net proceeds or market price. Interest, how much you are paying. From that, is there any getting tax benefit? Sir, why you have to show in 1 minus tax? Because you used to get what advantage? Tax advantage. How much interest you pay, I repeat, how much interest you pay, from that interest to the extent of tax rate we will get what? Tax advantage. You got the interest, you will show on profit and loss account with effect that taxable income decreases, you will pay low tax or more tax? Low tax. That low tax you are getting because of paying interest. Indirectly, if you observe, opportunity cost benefit. Because of paying what? Interest, you are getting a tax advantage, right? So that is the reason interest into 1 minus tax you have to take. Now question, what do you mean by NP? Net proceeds. What is mean by MP? Market price. Who net proceeds means face value minus discount or plus premium minus flotation cost. Flotation cost also known as issuing cost. MP means market price as on today. See, which company will takes market price? Existing company. Which company takes net proceeds? Newly issued company. You must be clear about all these things. First question. Why KD is not equal to KR? Why KD is not equal to CR? 6 factors. Yes or no? Okay. How do you calculate? What do you mean by irredeemable debenture? Principal amount never be paid. But paid. What paid? Interest. How should I calculate cost of debentures? Cost of debenture. 2 things. Entire this chapter. What is numerator? What is denominator? What is that? What is numerator? What is denominator? Understand. What is going from your pocket? Numerator. What is coming to your pocket is nothing but denominator. Shortcut. Numerator, what is you are giving? Whatever you will give, first numerator. Whatever you receive, denominator. For denominator, how much numerator you are paying, convert into percentage is nothing but cost. That may be cost of equity, cost of preference, cost of debt, cost of capital. You should be able to find it out. Basic logic. ఎంత వస్తుంది ఎంత పోతుంది మొత్తం పర్సెంటేజ్లో కన్వర్ట్ చేయి. That's enough. You see here, you are raising money. That means net proceeds coming. For that, what you are saying? Interest you are paying, but that much not paying. Used to get what? Tax advantage. That's why what happened? Interest you cut it and you enjoyed the tax advantage. You are saying interest into 1 minus tax. Net proceeds means face value minus discount or premium minus flotation cost. What is going? Then market price, why you are calculating, sir? Market price means whenever market price of the shares always gets what? Fluctuated. In such a case, existing company may believe that what happened to my share value? For example, 10 rupees share value went to 3 rupees. In such a case, what will happen? 10 rupees means 3 rupees. That means I received from her 10 rupees certificate, right? 10 rupees certificate. This 10 rupees certificate value today is 3 rupees. With the 3 rupees worth I have to pay same interest, Recently, I will give you wonderful shocking news. One of the company, LCID Investment ORD company, 3 rupees to 2,46,000 went. 3 rupees to 2,40,000. 2 days I was in leave. Doors closed. ఏడాడమే కూర్చొని ఎలా ఏడ్చా నాకు కూడా తెలియదు యాక్చువల్గా. 3 rupees to 2,46,000. That company completely left to calculating cost of capital. 3 rupees turned to, try to understand. I too know how to invest. These many shares are there, but I could not find that one share. The market value what? Increased or decreased? Increased. Whereas the same company, if something goes wrong, right, market value gets what? Fluctuated. Dear students, market value increase and decreases means that is estimated basing on a temporary mode, because market price always gets what? Fluctuated. Are you getting? Yeah. So this is irredeemable. What about the redeemable debenture? Tell me. Redeemable debenture. Remember, redeemable. Balu sir wrote, what is the strategy? Redeemable, two part. What is it? Redemption done at lump sum, redemption done at installment. When redemption done at lump sum, we can use what method? Shortcut method we can use. Very, very important. 5 marks question. This is only asked. Shortcut method. When shortcut method you want to use, you must follow the conditions. What is the condition? Coupon rate remain same and redemption should be done. However, at the end, these two conditions work out. You will take what? Shortcut method. Shortcut method formula. Interest into 1 minus tax. 1 minute. Why 1 minus tax? Plus RV minus NP. Why plus? RV means what value? Redeemable value. You are giving 90 rupees. Net proceeds. You are whatever you are taking. Hello? You try to understand. You are taking 100. You are giving 150. You are taking 100. You are giving 150. Are you doing favorable or unfavorable to the company? Unfavorable. In such a case, cost is not only interest but also loss to be beared. What is this? Interest is cost. This is what? Loss. How you are redeeming? This formula takes interest, cost plus loss. What is it? Cost plus loss. Your net proceeds 100 rupees you are taken, but you are paying 150. In such a case, try to understand. 150 minus 100. 50, yeah. This 50 is the loss over the period of number of years divided by n. If you do so, per year loss will come, because interest also per year cost. This cost plus loss should be added. That is the numerator story. What about denominator? You are receiving net proceeds. You are paying RV. That's why you have to take what? Average, like average investment. So this is the condition. What is the condition for this shortcut method? Coupon rate remain constant. Redemption should be done at lump sum. Sir, formula always never be interest into 1 minus tax plus, sir. Sometimes it may happen minus also, sir. How? When you take net proceeds more, when you pay redeemable value less. So this is the considers. But here the point is, here it considers what? Cost, interest, loss is benefit. When it is a benefit, loss you will get it when RV is greater than net proceeds. But sometimes it may turns to benefit. How? When RV minus net proceeds. So this is the what method? Shortcut method. When redemption done at installment, then you have to do from whose point of view? So when redemption done at installment, you have to take what is that? IRR. IRR should be calculated from whose point of view? Investor point of view. IRR may be done at company point of view. Sir, a small logic. IRR, why you are calculating from investor point of view? Very simple, ma. If the investor invests in company debentures, company pays interest. Interest is serves as income to him. One fine day you are redeeming. Hello? That indirectly terminal value to him. He is investing your company, means indirectly you can reflect a capital budgeting. Inflow and outflows both are there. Then immediately you can calculate IRR from whose point of view? Investor point of view. Point of view, IRR. IRR 20% came. Then how it is become cost? When there is no flotation cost, investor IRR is nothing but cost of capital of the company. Investor IRR equal to cost of capital of the company. This is the basic idea for this. But if the flotation cost exists, you should not calculate from whose point of view? Investor point of view. You have to calculate from whose point of view? Company point of view too. Are you getting? Company point of view. You see, when no flotation cost, you are calculating yield. Yield means return. That return turns to cost. So similar to what is that? Capital budgeting. Here IRR is nothing but capital budgeting. Are you getting? How much you earned is not the matter. You, whatever you earned, I paid. So this is the observation. When flotation cost is there, you have to calculate from whose point of view? Whose point of view? Now tell me. Questions. If you complete this one, preference also finished, directly we will go to the equity. Now, what are the 6 factors you have to consider when KR is not equal to cost of debt? Why you are taken interest into 1 minus tax? When should I take net proceeds? When should I take market price? What is the calculation procedure for net proceeds? Face value minus discount. Market value used to take, this is calculated by newly formed company. Existing company. For newly formed company, what should we take? Okay, what about the redeemable debentures? Redeemable debentures means company promises to pay principal amount today or tomorrow. How they redeem? That depends upon their agreement, sir. Sometimes they may redemption at a lump sum. Sometimes they may go for. Sir, if I do lump sum, what method I can follow? You can use directly shortcut method. For shortcut method, you have to follow conditions. What are the conditions? Coupon rate remain constant. Redemption should be done only at the end. Sir, if it is a redemption, sir, in such a case, sir, you have to follow redeemable. That too, redemption is done at installment means you have to follow IRR. Sir, IRR means rate of return to be generated, right? Yes. Then why you are calculating from investor point of view? Here I am calculating how much return he earned. Yes, sir, that is he earned, sir. The chapter title is cost, sir. Hello, Balu. When no flotation cost, IRR of investor is nothing but company's cost. Are you getting? Sir, by chance if flotation cost is there, sir, then what to do? Leave the investor. Come to whom? Company. Company point of view, calculate. Company point of view, IRR, what it indicates? It indicates purely cost. IRR from investor point of view, what it indicates? Purely return. Return earned by not company, investor. But IRR from cost point of view is purely, IRR from company point of view is a purely what? Cost. Got it, ma? Right. This is the cost of debt, Maji. Thereafter, you have another point, cost of debentures, irredeemable debentures. Cost of debenture, what is this? Minimum rate of return, right? So, minimum rate of return. Minimum rate of return that a company must earn to pay to whom? Debenture holders. Okay. Cost of irredeemable debenture. How do you calculate? Interest into 1 minus tax divided by net proceeds or market price. How do you calculate, compute cost of redeemable debenture? Tell me. If it is redemption done at what is it? Lump sum. Lump sum means you will use shortcut method, right? Shortcut method formula. KD equal to interest into 1 minus tax RV minus NP divided by 2 whole divided by RV plus NP divided by 2. Huh? Here. Okay. Right, done. What about another one, sir? If redemption is done at installment, whose point of view? Investor's point of view. Another one is whose point of view? Company point of view, right? Here you will calculate R equal to C, we say. Condition applies. No F. What no F? No flotation cost. Here no R. Here cost equal to cost. Hello? Okay, ma? Right. Next one. Here you see this YTM method where 5 marks question they asked. You see 5 marks the question I asked. In the problem, what we have to do is you have to calculate 10,000 rupees, 10% debenture, 100 rupees each, premium at 10%, and 1/4/2023 matured at 1/4/2028. The debenture would be repaid on maturity. Tax rate is how much? 35%. Calculate what method? Shortcut method. You can also calculate YTM. So YTM means you can identify what is problem number. What is that? What is redeemable period? This is only, no? Here you see. A cost of redeemable basing on what is it? IRR or YTM method. 0 period. Issued at premium. Hello ma? 110. 1 to 5 years is to get interest. Well, sir, wrong. Interest is 10%, sir. You wrote it what? 6.5. He has to pay tax, That's why 10 into 1 minus 0.35. Last 100. So guess rates always he has to give. In the problem they provided 3% and 5%. By taking 3%, by multiplying this, we used to get it a 110, 29.7, 86.3. Finally NPV positive. 5%. By multiplying this, we completed NPV minus 3.475. Okay ma? So NPV equal to PV of cash inflow minus PV of cash outflow. Here positive, here negative. Whenever positive, negative is there, IRR lies between these two. This is called trial and error method. What method? Trial and error method shows the location. Exact I want. What should I do? Interpolation. Interpolation formula. L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into. By considering this, we got it how much? 4.27%. Whereas we can use cost of redeemable debenture using what method? Shortcut method. Shortcut method formula. Interest into 1 minus tax plus RV minus NP divided by N whole divided by RV plus NP divided by 2. Okay. So by estimating, you got it how much? 4.29%. This is the very, very important. Hardly there is a 10% to 20% chance to ask 5 marks this one. So once you know the cost of debentures, immediately you can calculate what is that? Cost of preference. Cost of preference calculation is similar to what is it? Cost of preference. So it is also known. It is the minimum rate of return that a company must pay to whom? Preference shareholders. Preference shareholders. Here you see, how should we calculate cost of irredeemable, redeemable? That for that, I made a statement here. For the notes you see here, I made you this one. Time is not sufficient for us. That is the reason I made it a 2 alternative notes parallel. Are you getting ma? But everything I cannot go with this. Here, what is the cost of preference? You got it? You got it? You see, cost of preference. What is cost of preference? Balu sir, meaning. Learn meaning. Cost of preference is the minimum rate of return that a company must earn from its what capital? Preference share capital. Balu sir, what it denote? It denoted as KP. Balu sir, cost of preference estimation is similar to which one? Cost of debt. Once you know the cost of debt, leave it this procedure, right? There are 2 types only. Sir, similar. Why can't you say exactly, sir? I can't say exactly because there is a slight difference. What the slight difference, sir? Balu sir, one is preference dividend. Their cost is nothing but preference dividend. Also, for debenture, we used to pay what? Interest. For debentures, interest we used to pay. For preference dividend. Okay, one is, what is second one? Tax impact. Can you tell me what is the tax impact? Tax impact, sir. For debenture, we used to get tax advantage, sir. For preference, no tax, sir. Because everything gets finished, sir. Sir, sometime, there would be some tax, sir. Dividend distribution tax. What is that? Dividend distribution tax. Actually, it is not there. Dividend distribution tax means in order to please sometimes preference shareholders, company goes to advance. If I give preference dividend, right, that would be income to you, right? Then income tax you have to pay on that, right? On the income tax also I will pay. Too much of preference. So it is estimation is KD, its benefit. Estimation of KP, no impact. What is it? Tax, right? Cost of preference is higher than cost of debt or cost of equity? Cost of debt. Cost of preference is higher because there is a risk to whom? Preference shareholders. There is no risk to? Now tell me, cost of debt is higher, cost of preference is higher. Cost of preference is high. Why? Because preference shareholders takes risk. For debenture holders, how do you calculate cost of preference? Same to same. Remember cost of debt, tell the formula. Cost of debt, sir. That image what you showed, sir, it consists two parts, sir. One is irredeemable, sir. Another one is redeemable. Irredeemable formula, sir, cost of debt equal to interest, sir. Here what will get? Preference. Sir, 1 minus tax there, sir. No tax. Yes or no? Divided by net proceeds, market price, as T, sir. What about debentures? What about redeemable, sir? Redeemable again split into two parts, sir. Lump sum, installment, sir. Lump sum, installment. Sir, lump sum, sir. Lump sum, we can use a shortcut method, sir. Yeah. But coupon rate remain constant. Balu, sir, shortcut method formula basing on cost of debt. Shortcut method formula, na? There, what is the formula? KD. Here, preference divided. There, 1 minus tax. Here, no tax. Plus RV minus NP divided by N, whole divided by RV plus NP divided by 2. Sir, NP, market price, both are similar terminology. Okay, what about redeemable, sir? Again, redeemable, just now we completed. Redeemable done at installment basis means you have to use what? IRR. IRR whose point of view? Investor's point of view, company point of view. Sir, if there is no flotation cost, it is better to calculate whose? Investor point of. Investor means that is his return, sir. Yes, sir. I am not calculating cost. I am calculating his return only. Since there is no flotation cost, I believe his return equal to my cost. Sir, if flotation cost is there, live how Ram Charan left Kajal. వదిలే చెయ్యి వదిలే చచ్చిపోని ఏముంది అక్కడ ఫ్లోటేషన్ కాస్ట్ ఉంది let her to die. So when flotation cost is there, what should I do? छोड़ दो, हाथ को छोड़ दो, मर जाती सर, जाने दो भाई. Because what is that? No flotation cost. Flotation cost is there. That is the point. Understood, Ra? This is the point. But flotation cost problem they never asked. Cost of preference they could not ask. Only they asked only cost of debt. But ultimately Mahabharat story is, the next one is, what is that? Cost of equity. He is a supreme hero. If you are able to handle this man right, that is okay, Ra. You are going for hunting to find rats in a tiger, yes? You are going hunting, Ra. Where? Somebody said, where you are going? I am going for hunting. Wow. To catch what? Rats. Enta daridranga untadi, right? When you are going for hunting means you are learning cost of capital means who is a lion? In the entire chapter, cost of capital is a forest. Yes or no? One of the most hunted animal is nothing but who? Cost of equity. Agar you learn cost of equity, pakka pass. Because in the market, cost of equity. To calculate, to hunt a lion, right? Straight గా వెళ్ళిపోయి రమ్మారా అక్కడ నిలబడుకో అంటే అది ఉండి ఓకే సార్ అంటది ఆట తీసా పట్టుకొని. దట్స్ వై యూ మస్ట్ లెర్న్ వాట్ మల్టిపుల్ మెథడ్స్. ఎస్ ఆర్ నో? మల్టిపుల్ మెథడ్స్ టు క్యాల్కులేట్ వాట్ కాస్ట్ ఆఫ్ ఈక్విటీ, బికాస్ ఇట్ ఇస్ నాట్ ఎ సింపుల్ థింగ్. యూ రిమెంబర్ దిస్ వన్, రైట్? డోంట్ రైట్ ఆల్ దిస్ హంటింగ్, లయన్ ఇవన్నీ రాశారనుకో ఇద్దరిని తలిపి ఓకే రైట్. You got it, Ra? That means you see cost of equity, Ra. I will tell you what is the cost of equity, what it indicates. You see, this is the notes I prepared for you. This information is available freely in social media if they keep it, right? So make it this notes. Even if your notes is not productive, don't worry. This notes will support you. My voice also will support you, Ra. Just hardly 10-15, maybe 7 to 8 hours, 10 hours compulsorily you will get. So total information, aisa pada, aisa giya, directly. What is this? Because it's not a simple random topics. In entire cost of capital also I told you how many problems are there. What problem they've been asking. All the methods problem we are going to cover. From past 10 years what is asked, 1 hour I am going to tell you. Yes, cost of equity. What is the cost of equity? Balu sir, what is cost of equity, sir? Cost of equity is minimum. What is that? Cost of capital is a minimum rate of return that a company must earn from its equity share capital to keep the expectation. What keep the expectation? You have to pay, For equity shares is a compulsory to pay. But if you not to pay, also you have to keep the expectations. If you write you have to pay means cutting. Cut just remarks word. So that's why be sensitive with respect to using the terminology. Yes or no, ma? So it is a minimum rate of return that a company must earn from its equity share capital to keep what? Expectations of equity shares. After all, he is also investor, yaar. He is also investing, right? That's why even though you are giving a title to as a owner, he will expect, "Arey mere ko kya hai?" Adutadu kada vadu. I am taking this much of risk, What is that? Sir, you are a owner, sir. So what? Sir, you are a owner. I am investing, sir. What I will is to get? Sir, you are a owner. What is a dividend? No dividend, you are a owner, sir. Sir, I invested 10 crores. That's the reason I am saying, sir, you are a owner. He will go to the... Okay. So, of course, he will get the title. But the thing is, what happened? You have to consider, if you take a bus, this bus manade ante మన ఇంటికి తీసుకెళ్ళమని చెప్పకూడదు. ఇంటికి వెళ్ళేదానికి బస్ ఎక్కాలి అంతే. ఈ బస్ మందంట, తీసుకో డ్రైవర్, టేక్ టు దిస్ బస్ టు మై హౌస్. I will sell it to onions అంటే తొక్కిస్తారు వేసి. Now you tell me, cost of equity, it is donated as what? Sir, you told it is donated as KD. KD for debt. KE for KE, right? In general, estimation of cost of equity, difficult task. Difficult task. Biggest headache. Why, sir? For debenture holders, simple. Preference, all. You know that you learned cost of debt, you immediately guess the cost of preference. Hello? You learn cost of debt, immediately you guess cost of preference. But cost of equity is not, it is a lion, multiple tasks you have to know. Sir, why it is difficult, sir? Because, shall I tell you one reason? Sir, there is no what? Specific coupon rate. Debenture holders, they have specific coupon rate. Preference shareholders. But here, there is no specific coupon rate. Reason number one. Number two, from the risk point of view, of the company risk point of view, it conveys that no need to pay cost. For example, if someone is raising funds, for example, my financial manager raising funds by issuing equity. I asked it, why you are raising equity, always crying equity. Sir, actually, if you raise equity, no need to pay cost. Enduru extra? Because, sir, he is the owner, no need to pay. So, no need to pay to what? Equity shareholders. Because no risk. From the investor point of view? From investor point of view, what is that? It conveys that high cost to be paid. Why, sir? Sir, universal truth of financial management, sir. Profit is reward of what taking. That means if you take more risk, who is highest risk taker? Then he should get more, At one point of it says that the person who takes highest risk, he deserves to get high return. Another point of says, since he is a equity shareholder, no cost to be paid. There is a contradictions between these two. But still you have to take a decision as a financial manager. పిచ్చి లేసుదు నీకు, అట్టంటాడు ఇట్టంటాడు అంటే అంతే, రెండో అదే అంటాడు. సార్ ఇలా హౌ సార్? ఐ డోంట్ నో సార్. దట్ ఈస్ ద రీజన్ ఐ కేమ్ సార్. యూ హ్యావ్ టు క్యాల్కులేట్ అండ్ ఈక్విటీ షేర్ హోల్డర్స్ ఎక్స్పెక్టేషన్స్. అండ్ వన్ మోర్ థింగ్ ఈస్ నో కూపన్ రేట్. దిస్ పరమ దరిద్రం. సెకండ్ దరిద్రం ఈస్ నథింగ్ బట్ one segment says that no need to pay. Another segment it says to say you have to pay more, yaar. He is a highest risk taker. Just now you told no need to pay. Again you are saying highest to pay. Is there any coupon rate? No. And finally, equity shareholders expectations is varies to company. The equity shareholders in Tata Motors is completely different from equity shareholders of Tata Salt. You are a Tata Salt equity shareholders and company is not giving dividend. Then what do you say? Why you are not giving dividend? Sir, I am retaining. Chase em chesavara? I will invest in where? Tata Salt. Then I will produce Tata Salt. Okay, you are retaining and reinvesting, you are producing Tata Salt. Tata Salt demand would be, what is it? Sustainable. I will give 1+1 offer. If you give 1+1 offer, people will buy salt. I will change pack. Oh, that's the reason they will buy 6 packs, right? I will change color. So if you do any experiment, sales go on. If you be like this, what? Normal. Sales goes what? Comfortable. Don't do extra. Be silent. That is extra. If you do extra, sales gone. But whereas Tata Motors declared nano car again coming with what? Electrical batteries. Now Tata Motors, if declare dividend, all the equity shareholders start to cry. So why you are declaring dividend, sir? Why? What is the problem? Because I am considering your opportunity cost. Go to hell opportunity cost, sir. Keep this amount. Invest in where? Nano project, sir. Because if you give dividend, again you have to take more number of shares, sir. If you take more number of shares, why? Because you are giving dividend, you have to raise capital. When you raise capital, number of shares, what happen? Increases. EPS gone. Why, sir? No, don't go for equity. I will go for debentures. When you go for debentures, you have to pay what? Interest. From the EBIT, what takes? Interest takes. So why you are giving? Who told you to give a dividend, sir? Dividend is this is the situation with respect to KE. That is the reason you have to learn what is it? Multiple method. This method, that, or this, or this. You have to consider multiple methods is needed. Why? Because cost of equity estimation is really difficult. Tell me 3 reasons. No coupon rate. Good. Next one. Expectations varies from equity shares. Next, another one. Contradiction between risk point of view from company. Yeah, that is the point to be considered, right? That is the reason different methods came. What are they? Dividend based, EPS based, yield based, risk based. Okay. So in dividend based, no growth in dividend. Hello? No growth in dividend. Another one is no growth in dividend. Again, no growth in dividend split into what is that? Growth in dividend. First one, no growth in dividend, growth in dividend. Yes or no? Growth in dividend again split into 2 parts. What is it? Constant growth in dividend, non-constant growth in dividend. Tell me in dividend, no growth in dividend, growth in dividend. Second one, growth in dividend again split into constant growth in dividend, non-constant. Sir, in cost of capital, constant, non-constant growth model not given, sir. Same model which is covered in dividend decision model. That's why total I am summing up it, because I made a total investigation. So that is the reason constant growth rate, non-constant. Now tell me, dividend based. No growth in dividend, growth in dividend. Constant growth in dividend, non-constant growth in dividend. Whereas EPS, simple, no growth in EPS, growth in EPS. Thereafter, realized yield approach. 2 types of yields. Dividend, when company pays dividend, we used to get a dividend yield. When share value increases, we will get what? Capital gain. 2 yield you have to calculate. What is it? Dividend yield, capital gain yield. Total you add it, you will get what? Total yield. Last one, risk. That is called, what is that? CAPM approach. According to CAPM approach, you have to give RF plus RP. RF means risk-free rate plus risk premium. Now tell me, what are the various methods? Various methods are dividend based, sir. Dividend based how many? Sir, no growth in dividend, sir. Growth in dividend, sir. Growth in dividend again 2, sir. Constant growth in dividend, sir. Non-constant growth in dividend, sir. EPS, sir. EPS, sir. No growth in EPS, sir. Growth in EPS, sir. Another yield based, sir. 2 types of yield, sir. Dividend yield, capital gain yield. You added both, sir. Total yield. Total yield, man. You asked KE, sir. When no flotation cost. Tell me, no flotation cost. Yield of investor is nothing but cost of the company. In yield based, you never find what? What cost? No flotation cost. Because you are calculating what? Yield you are calculating. Right. Another one last. Risk based. Risk based means what type of, how much risk I am taking, I should get a risk premium, sir. What are the risk rates I should get? One is I should get what? Risk free rate I should get. Risk premium I should get it. This is the methods, Maji. Okay. Out of this, the first method we used to discuss. What is that? Cost of equity. Methods completed. First one, dividend price approach. What is that? Dividend price approach. In this model, what is the KE would be calculated, whatever the dividend used to pay. This is the numerator. Dividend we are paying, net proceeds or market price we used to take. Similar to cost of debt. We assume that company is earning, what is that? Stable earnings. What is that? Stable earnings. So KE equal to DPS divided by market price. But I little bit developed this concept. This is also called dividend price model, also known as MCQs. Get ready. No growth in dividend model. What is it? This model also known as, what is it? Dividend price approach. Dividend model is also known as what? No growth in approach. So this model, how do you calculate this model means, you see, this model also known as dividend valuation model. So here assumption is earnings are what? Stable. In this company follows, what is that? 100% dividend payout ratio. How much profit company earns, it gives to whom? Equity shareholders. So equity shareholders expects only what dividend? Cash dividend only they will expect. They never allow company to retain their funds, right? Dividend remain constant. In this model, what will happen, EPS equal to DPS. DPS equal to DPS1. DPS1 equal to DPS10. Why? Because EPS, dividend, all are constant. So that is the reason KE should be calculated how? Dividend per share divided by net proceeds or market price. Where examiner may ask you, what is that? Market price. Hello? In this formula, if you decode, you will get the market price, right? Market price, how do you calculate? Dividend per share divided by KE. KE, sometimes he will hide the word. He will use another word. What is it? Yield rate or investor expected rate of return. Okay, that is the what method? Dividend price approach. Coming to another one is a growth model. What model? Growth model. In the growth model, how do you calculate growth model? You have to consider growth model. This is model proposed by Gordon. So this is also known as constant growth in dividend model. So this is also known as what model? Gordon's model. This model is applicable to stable and standard earning companies. This model is applicable to stable and standard earning companies. Here in this model, equity shareholders expects two things he will expect. What is that? Bhaiya mere ko kya chahiye? Dividend chahiye, capital gain bhi chahiye and kuch. When you want to give capital gain, how should I get, sir? Arey, pay more dividend here. Sir, more dividend does not make, sir. What to do? Sir, whatever EPS you will, some EPS you pay, some amount you retain. Retain amount again, reinvest. Again, you give growth into dividend. Automatically, people start to buy. Hello? So, this model, here what happened, EPS of the company will be split into two parts. Out of 100, 40% they are retaining means this is called DPR. DPR means remaining 60% they are holding means retaining ratio. Whatever the amount they will retain, they won't keep idly with it. What they will do? They will reinvest. Retaining amount into return on investment, you will get what rate? Growth rate. Tell me growth rate formula. Retaining ratio into rate of return on reinvestment. In the problem, growth rate is there. Company follows 100% dividend payout ratio. Will they follow 100% dividend payout ratio? 100% dividend payout ratio means retaining ratio should be 0. 0% dividend payout ratio, retaining ratio happens means automatically growth rate also will remain 0. When you won't give growth rate, you cannot provide growth in dividend in future. If you cannot provide growth in dividend, automatically your market value what happen? Decreases. So in this model, they will expect two things. Sir, mera ko dividend chahiye. Again, capital gain I need. Capital gain means share value has to increase. Share value has to increase means what should we do? We have to provide, retain it and reinvest it. Again, we have to give more dividend to it. This is the Gordon's argument. According to growth rate equal to retaining ratio into rate of return on reinvestment. Retaining ratio equal to retaining profit. How much you are retaining is called what is it? Retaining ratio. Seema. From the entire EPS, how much you are retaining is known as what? Retaining ratio. From the entire EPS, how much dividend you are paying is called dividend payout ratio. Retain dividend to payout ratio 10%. What is the retaining ratio? Dividend to payout ratio 90%. What is the retaining ratio? Then whatever the retaining amount you will retain, you will reinvest what? Somewhere, yes or no? So your growth rate depends upon how much you are retaining, at what rate you are reinvesting. Be careful with respect to this. When you provide more growth rate, people feel very happy and they will buy the company shares. With effect to market price, what happens? Increases. Then only you can fulfill the interest of whom? Equity shareholders. Are you getting? So that is the point to identify. In this problem, key observation, which is not at all covered in your material. See, EPS is not equal to DPS. Do you agree? Why, sir? Because we are not following 100% dividend payout ratio, sir. Then DPS 0 is not equal to DPS 1. Yes, sir. Growth is there, sir. Good. DPS 1 is not equal to DPS 2. Do you agree? Because of growth rate. Can I write DPS 1 is equal to DPS 0 into 1 plus growth rate? Yes, sir. You can write. Okay. Thereafter, sir, can I write like this? KE equal to? KE equal to, I have to give two things, right? So I have to give KE equal to, can I say like this? DPS 1 divided by net proceeds or market price plus growth rate. With this DPS 1 also I can write like this, right? So DPS 0 into 1 plus growth rate divided by market price. Where basing on this can I extract market price? Market price equal to DPS 0 into 1 plus growth rate minus KE minus growth rate. So growth rate, how do you extract? Retaining ratio into rate of return on reinvestment. Hello? Yeah, this is the problem to be identified. Now tell me, DPS 1 equal to? Dividend payout ratio formula equal to? Dividend divided by EPS. Retaining ratio formula? Retaining profit divided by EPS. Growth rate equal to? How much rate of return? Sir, I want to earn more growth rate. What should I do, sir? You want to earn more, then you do one thing. Retain more and reinvest more. Automatically you will get it what? More growth rate. Okay? So this is the point. You try to understand in the problem, entire study material, there is a growth. What is that? Growth is there means growth in dividend you should understand. Sometimes you keep it in mind. Dividend growth is not given. EPS growth is given. In such a case, don't worry. Growth in EPS is assumed to be growth in dividend. Got it, ma? So with this, how many models we completed? Dividend 1. No growth in dividend gone. Another one is constant growth rate gone. Non-constant growth rate I will discuss in dividend price approach. Another one is what model? Earning price approach. In this model, KE of the company is depends upon EPS, but not dividend paid. Not paid. Your parents' dividend. Parents' approach this is. How much you earned is not the matter. What the financial manager says, sir, how much you earned dividend, sir? 100 rupees, Balu. How much dividend you paid? 2 rupees, Balu. Sir, 2 rupees dividend. What is hell it is? Balu, 100 rupees I paid, 100 rupees where you paid, sir? I made, Sir, you made but not paid. But I made for you. I made for you, but I'm not paid for you. But that amount is with me, but it is not mine. This is yours. That's why don't consider what I paid. Consider what I made. Get lost from here and to that. A approach. Earning price approach. You ask your parents sometimes 200 rupees, they will cry. 200 తిట్లు తిట్టి 200 రూపాయలు కూడా ఇవ్వరు. కానీ మళ్ళీ ఏమంటారంటే సంపాదించేదంతా ఎవరి కోసం? 200కే దిక్కులే మొత్తం ఇస్తావు నాకు. అవునా? బట్ స్టిల్ వాట్ దే సే, మేము ఎత్తుకుపోతాం చెప్పి ఎవరికైనా రే నీకే మాది అయిపోయింది రా అంటారు. ఈ ఒక 1000 రూపాయల 100కి దిక్కులేదు అక్కడ. బట్ ఫైనల్లీ వాట్ దే విల్ సే, కోట్లు ఇస్తారంట. But what approach that is? EPS approach. What this model says, how much I paid, don't consider. How much I made, consider it. Because whatever I paid remaining is with me, right? But it's not mine. Hello? This is yours only. Simple. Whatever EPS is calculated, dividend paid or not to paid, that is hell. Keep it outside. You have to take EPS. In this model, KE of the company, what it speaks, KE of the company depends upon earned EPS but not paid dividend. Okay? So according to this model, KE equal to EPS divided by market price into 100. Whereas you can extract market price also, he will ask KE, but idiot, he will ask market price. Formula KE అడుగుతాడు అనుకుని మనం నేర్చుకుంటాం. ఎగ్జామ్లో మార్కెట్ ప్రైస్ అడుగుతాడు, అప్పుడు కింద పడి కొట్టుకుంటాం. అందువల్ల you must be two alternative. KE, okay, if it is there, if the examiner changes track, he will ask market price like this. So with this dividend model, no growth in dividend, constant growth in dividend, another model also completed. EPS, tell me EPS model formula. EPS divided by market price. Dividend model, sir. Dividend divided by market price. If the company follows 100% dividend payout ratio, EPS model, dividend price model, no difference. Both are same. Yes or no? Right. Which model financial manager job is very, very happy? Relax. ఏ కంపెనీలో చెప్పు? 3 companies. See, 100% EPS based, 100% relaxed. EPS is relaxed. Yes or no? Second one, dividend also relaxed. Why? No need. Difficulties happens, only growth rate. That's why examiner 99% they will ask you from this model. No growth rate. Thereafter, what is another model left, Maji? Thereafter, you left realized yield approach. What is that? Realized yield approach. Yield means what? Tell me, return. This model makes a student confusion. Sir, actually you are discussing with the KE, but you are calculating yield. What is this, sir? Boss, what cost is not there? Flotation cost is not there. In such a case, yield of whom? Investor is cost of whom? Company. That is the strategy of this. So in this model, you have to leave your shoes. You have to enter into the shoes of whom? Investor. How much you earned, you calculate, come to conclusion how much you paid. Because what cost is not there? Flotation cost. How, sir? Salary is one of the beautiful word I ever heard in my salary. 1000 Balasubramanian songs mixie les pettamఅనుకో ఎంత బ్యూటిఫుల్ గా ఉంటుందో salary. My mobile says ting, account is credited with the given balance అంట. That sound is there, beautiful sound. I used to think for every day, but every day that sound comes, I will get irritation. But when it comes, on first, beautiful. Because that is the more than 1000 calls, not 1000, 2000 calls, whatever it may be. Salary is credited. That beautiful. See, this is a salary. What a beautiful word. What our directors. Very, very irritating word. Yes or no? When 31st comes, the management is worried how to pay this many employees a salary. Salary. What is salary? But we people, salary. Are you getting? That is cost. This is what? Income. Yes or no? Sometimes company has to calculate what is the cost means. If they check my bank account also, that is cost. Because my yield is nothing but their cost. Condition applies if I don't have any other source to make income. So in this problem, realized yield approach. What is approach? The word yield indicates what is it? Earnings. According to this model, KE of the company, nothing but what? Yield made by the investor. In this model, investor expected rate or yield rate is nothing but KE. Condition applies, no flotation cost. This should not happen. In such a case, what is that? How should we earn return, sir? Very simple. When yield you can calculate means when investor purchase security, hello, holds for only how many years? 1 year. He purchases, holds for 1 year, sells the security, get the money. In such a case, yield calculation is different. Tell me, what is that? He purchased security. Tell me, purchase security, holds for 1 year, sells the security, get the money. In such a case, how to calculate yield? I will tell you. Second alternative, what is that? Purchasing security, holding for more than 1 year. In such a case, what to do? Here, for this purpose, first come to left side. What is that? Purchasing security, holding for 1 year. Holding for 1 year means take pen like a gun, go to the market, calculate. Because of dividend yield is to get it. So dividend yield means how do you calculate? Dividend divided by market price. Sir, thereafter one more yield also is there, sir. What is it? Capital gain yield. At what price you purchased, at what price you sold. Hello? MP1 minus MP1. Then you will get a CG. CG means capital gain divided by market price. You consider the capital gain you mold, dividend yield you mold, right? You hold, then finally total yield. Total yield equal to dividend yield plus capital gain yield. This is total yield, sir. Yes, dividend yield. This can also calculate DPS1, MP1 minus MP0 equal to this. But here, what used to calculate? You used to calculate total yield. Total yield is nothing but KE because, there is no flotation cost. What, Maji? This is the regular identity. Dividend yield formula. Capital gain yield formula. Yeah. What is, sir? Okay. If it happens only 1 year, if it happens more than 1 year, Balu, sir, in such a case, what is the story? When go to visualize the capital budgeting, right? I invested my money in equity. Investor, I invested in capital budgeting. Cash outflow. There I used to get operating cash inflow. Yes or no? Here I am getting equity dividend. There I used to get terminal cash inflow. Here I used to get redeemable value. At the end, I am selling it, right? So cash flows, cash inflows are similar. In such a case, I will calculate IRR. I calculate IRR from whose point of view? Investor's point of view. When investor's point of view, if I calculate, the investor's point of view IRR equal to KE, because there is no, again, what cost? Flotation cost. Okay, these two things are very, very, very important models. Maximum they asked only these techniques. Okay, now tell me all the models we completed. What are they? No, dividend we completed, EPS we completed, constant growth model also completed, yield based we completed, then last model, what is it? CAPM approach. There is a chance to ask specifically 2 marks, right? CAPM approach following, right? 10 years question paper strategy learning 1.5 hour. 1.5 hour, actually 10 days is there. Today, whatever the spark of attention you paid in subject, you continue from the same spirit. Capital asset pricing model. This is capital asset pricing model completely. CAPM. Okay, Nara? Right. Capital asset pricing model. Once this is completed means actually examination trend from past what the questions are being asked, we are going to solve that one. Because always they are asking only just commencement of this class itself. I told you weighted average cost. What value? Book value, market value, marginal cost, cost of capital. These models they've been asking. CAPM approach. This model was suggested by his name Sharpera. MCQs get ready in the year 1961. This model explains that, what it explains, KE of the company depends upon risk element of the company, man. KE of the company is depends upon, what is it? Risk element of the company. As risk increases, KE of the company also increases. Are you getting? So, okay, KE of the company risk increases means, you don't know financial management rule. What rules? Profit is reward of risk taking. The person who takes more risk. You went to ocean to get something, beach lo nilabadko chapal dorugutayi. If you go to inside, mutyal dorugutayi. How much risk you used to take, that depends upon the return you used to get it. Okay, that is risk means, sir, what is the risk, sir? Uncertainty of return. Uncertainty of return means whether you used to get it or not. Have you seen in patient box is there pulse rate? Itla untadra, అది ఇటు మూవ్ ఉందనుకో రిస్క్ అని అర్థం. స్ట్రైట్గా ఉందనుకో ఆమెన్ అని అర్థం. స్లైట్ మూవ్ అయిందనుకో రిస్క్ ఈజ్ లో, దిస్ మ్యాన్ కెన్ బి సర్వైవ్ యార్, నో ప్రాబ్లమ్. బట్ వెన్ రిస్క్ మీన్స్ వాట్ ఇస్ దట్? ఇఫ్ యూ డూ నాగిని డ్యాన్స్, సో దట్ ఈస్ కాల్డ్, what is it? Risk of uncertainty. There are how many? Risk means what? Uncertainty of return. There are 2 types of risk, man. One is unsystematic risk, which is also known as diversible risk. Another one is systematic risk, which is non-diversible risk. Unsystematic risk, diversible risk, risk premium not to be provided because it should be C. C means controllable, which can be manageable. Any risk which is controllable, manageable, it is not at all called what? Risk. I told you that my mother also used to say, ఎందుకు అబద్ధం చెప్పావు? చెప్పింది తెలిసిపోయింది కదా, మరి అబద్ధం ఏమవుద్ది? తెలిసిపోయింది కదా. Then why you are saying that there is అబద్ధం, right? Don't talk like that. అని చెప్పారు. What is this? ఏం మాట్లాడుతున్నాడు? Nothing but Sharpe, this is also told. No risk premium to be provided because what? Because this is what? Controllable. Hence risk is controllable, no risk to be, premium to be paid. This is called risk premium. Whereas a systematic risk, non-systematic, unsystematic risk, this is called uncontrollable. No risk premium to be provided to what? Diversifiable risk, because it can be manageable, it can be controllable. Whereas systematic risk will also known as, what is that? Beta, which cannot be manageable. Sir, how should I identify the systematic risk? I will tell you. There is a company, okay? Company is there. Company earnings are there. This company earnings always gets what? Fluctuations because of war, because of political instability, because of environmental factors, because of dollar value, because of inflation, because of other expectations. India also, America also yesterday warned Pakistan, please, I request you, be care. I said, ఉంటాంలేండి సార్. ఏంటి ప్రాబ్లం కాదు, వాళ్ళ దగ్గర ఉన్న న్యూక్లియర్ వెపన్స్ ఉన్నాయి, వాటిని వాళ్ళు అక్కడ పెట్టుకో, ఇటు ఇసిరేసుకుంటున్నారు వాళ్ళు, అక్కడ పెట్టరా అని. America, in order to make a shift, they study the temperature. To shift the nuclear weapons, they study the temperature, wind power, and the people who are going, their health report also they used to take, because shifting this nuclear weapons. We'll okay. What America is saying, Are namaskaram ra, that is nuclear weapon ra. If something goes, నీ పాపానికి మేము పోయేటట్టున్నాం నువ్వు ఎలాగో పోతావు. దట్ మీన్స్ ఇఫ్ ద గ్లోబల్ ఈజ్ అ మేడ్ అనౌన్స్మెంట్ దెర్ ఈస్ అ న్యూక్లియర్ వెపన్స్ ఇన్ పాకిస్తాన్, హ్యావింగ్ న్యూక్లియర్ వెపన్స్. వాట్ సార్ మా దగ్గర ఉంటే తప్ప? నాట్ తప్ప బాస్, హ్యావ్ ఇట్. వాట్ ఈస్ దట్? ప్రాపర్లీ హ్యాండిల్ ఇట్, హ్యావ్ ఇట్, నాట్ ఎ రాంగ్, బట్ హ్యాండిల్ ఇట్ రా. ఏంటిది అక్కడ పెట్టుకో, అక్కడ తీసుకో. ఇఫ్ ఇట్ ఈస్ గెట్ స్కిప్డ్, సబ్ కుచ్ what about Indian stock market, foreign stock market, everything gets collapsed because something happens there, everything goes. So that is the reason entire globe is worrying about what is that? Not having no problem with respect to what? Handling. So that is the reason. If something, dollar value, everything, you see that 2 days back, Trump won the war, right? Sorry, elections, not war. Elections you won. With effect, dollar value certainly he will make such a strategy that dollar value certainly he will take. Infosys, Dr. Reddy's laboratory shares are increased because they used to make entire global American business relationship. They've been having a wonderful way. That's why Infosys, TCS, Dr. Reddy's laboratory share value went to sky because they used to make exports. Software, IT products, they used to make exports and they used to get the dollar because they predicted that because of whom? Trump. Dollar value certainly will increase. So these are the certain factors, ma. If these factors influence, market value or earnings of the company also what? Gets fluctuated. This factors, being a manager, can you control this one? No. These are all called, what is that? Unsystematic risk element. If this, because of these factors, this variability is more, in such a case, you can say this systematic risk also called beta. This beta can be identified greater than 1, equal to 1, less than 1. Are you getting? So these are the points. If more variability is there, more risk. Less variability is there, less risk. Beta should be greater than 1, less than 1, equal to 1. Are you getting, ma? Yeah, this is the, finally, according to this model, KE of the company, formula is RF plus beta into RM minus RF, where RF equal to risk-free rate, beta equal beta, where RM equal to return on market portfolio, which is also known as total return. Total return equal to RP plus RF. Okay, this is with respect to KE. And finally, you have what is that? Retained earnings. Cost of retained earnings is nothing but retained earnings are undistributed profits belongs to whom? Equity shareholders. So for the investment purpose, repeat, for the investment purpose, company may retain the profit instead of distributing it to whom? Equity shareholders. Because of it, equity shareholders miss what? Opportunity cost. For the opportunity cost, they will expect a cost, sir. Hello? They will expect cost. That cost is nothing but what? Retained earnings. So cost of retaining can be estimated in 2 ways. One is simply, since retained earnings are funds belongs to whom? Equity shareholders. So far you learned what is that? KE. Already we learned KE, sir. You do one thing, KE equal to KR, but condition applies, there should not be flotation cost. Okay, this is one alternative. Another alternative, sometimes equity shareholders conveys that, sir, I will earn this much, sir, so you pay that much, sir. Means he may give you certain details. In such a case, equity shareholders opportunity cost based. In such a case, what do you do? KE is nothing but investor expects something, but you have to say, sir, brokerage goes, sir. Sir, from that personal tax also goes, sir. If a personal tax brokerage after deducting, if you calculate KE, that should be that KE equal to what is that? KR. Okay. So with this, specific costs are gets completed. EPS model. EPS model, EPS divided by market price. Dividend model, dividend divided by market price. Constant growth rate model, DPS1 divided by market price plus growth rate. Okay, realized model, total yield you have to calculate. Total yield equal to dividend yield plus capital gain yield. Dividend yield, DPS1 divided by market price. Capital gain yield, MP1 minus MP0 divided by MP0. Sir, if I hold more than 1 year, IRR you calculate. CAPM approach. CAPM approach, sir, RF plus RP. RP, how do you find? Sir, RP equal to beta into RM minus RF. How should I calculate KE, sir? Cost KE, KR, KR, sir, KR. KR is nothing but, hey, since retained earnings are funds belongs to whom? Equity shares. KE equal to KR, man. Okay. Then what about another alternative? Another alternative means sometimes he will give you K equal to investor expected rate into 1 minus brokerage into personal tax. Now, after considering all these things, you will come to final job. What is it? Weighted average cost of capital. So, weighted average cost means cost of capital is the systematic summation of various individual specific costs. What are they? KE, KP, KD. So, it depends upon capital structure of the company, how you are rising. It considers what? All specific cost. It considers all specific cost, thus it is also known as overall cost. Are you getting? It is also known as weighted average cost of capital. So calculation of weighted average cost, what to do? Step 1, you find it out. Calculate various what cost? Specific cost. Specific cost, cost of equity. No growth model, constant growth model, equity based, realized based, CAPM approach based. All this model you need to find it out what KE, and you have to find it out what is that for all the methods. Then you have to do step 2. What is the step 2? Calculation of weighted average cost. How should we calculate? First, already I told you first class itself. Product method. 4 column 1 formula, 5 column no formula. What is that? 4 column 1 formula, 5 column no formula. What is this? CA Institute study material. ఈ డైలాగ్ ఎక్కడ ఉండదు అక్కడ. ఓకేనా? ఇటువంటివన్నీ చెప్పొద్దు. చూడు, ప్రొడక్ట్ మెథడ్. ఇన్ ప్రొడక్ట్ మెథడ్ హౌ మెనీ కాలమ్స్? 1, 2, 3, 4. 4 columns. What you have taken? First, source of capital. Yes or no? Then amount. Then specific cost. Then product. A, B, C. D equal to B into C. Hello? If you multiply, used to get it. What is the total cost? You will get it. Total amount you will get it. Weighted average cost equal to summation of product divided by summation of amount. 4 columns, 1 formula, right? What about here? 5 columns, no formula. So source of capital you take it, amount you take it, weights you take specific cost, and the product you can multiply this. So by multiplying all these things, you used to get weightage. Also you have to know what is this weight, sir? How should we calculate weight? Equity, preference, debt, retained earning, for this capital you take the total. From the total you calculate weight. This weight to be multiplied with the cost. If you sum it up, weighted average cost of capital is the product. Okay? So thereafter you have marginal. Marginal means additional. You see, the word marginal represents what is that? Additional. So marginal cost of capital is the additional cost of capital. It is estimated when company raises additional funds. Additional funds for what purpose? Expansion, modernization, diversification, for any other purpose. It may raise funds. Hello. Now the situation is when company raises, see, when company raises additional funds by debt, then risk of equity shareholders increases due to increase in debt amount in its capital structure. Do you agree? Right. That is old debt plus new debt. In this case, KE may be recalculated by considering what is it? Risk element. By risk element of whom? Equity, which can be expressed in following ways. Whose risk? Equity shareholders. Number 1, they may ask you dividend may be increase, growth rate may increase, market price may decrease. What? This is everything happens because of increase in debt will leads to risk element of whom? Equity shareholders. Right? Sometimes growth rate is unchanged means okay, risk is there, not that much. Sometimes growth rate, market price remains same, only dividend increase means risk is very less. This point also not there means equity shareholders not feeling what? Risk. Why they were not feeling risk? Because we study leverage. Okay, we'll study leverage. Why debt is not a risk to whom? Equity shareholders. When debt is not a risk to equity shareholders, we'll study. But here there is a risk to whom? Equity shareholders. Are you getting my point? Right. So marginal cost of capital estimation is similar to calculation of which one? Weighted average. Don't think that it is a different. But only difference is it is estimated with what? Additional funds. Key points to remember. So calculate, when you are calculating marginal cost of capital, calculate new debt whenever new debt you are raising. Recalculate what is it? KE, because of risk element. The rule is CR rule. CR rule means that calculate cost of new funds, recalculate what is it? KE. When you are raising debt, raised debt cost you have to calculate. Because of rising debt, whose risk increases? Equity shareholders risk increases. Equity shareholders risk increases means again you have to calculate. KE should be recalculated. Are you getting? So this is the point to be considered. Right. Now let's, this is the theory point. You understood? What is the cost of capital? Marginal cost of capital. When company raises additional cost, certainly whose risk will increase? Equity shareholders risk will certainly increases. In such a case, you have to find it out. What is that? Marginal cost you have to identify. So here we can take, you see, this is the problem. See how many times this problem is asked. See, these many times they ask this problem. Okay, this problem I will tell you. This is a PK limited. This problem consists of two part. Calculation weighted average cost of capital, new weighted average cost of capital. At a time, two models I am covering here. Okay, ma? You see. Equity share capital, how much? 200 lakhs. Preference is 60 lakhs. Debenture is 100 lakhs. Three sources. You need to calculate KE, you need to calculate KP, you need to calculate KD. The equity share of the company sold in market price, how much? MP0. 200. It expects that all company will pay next year dividend. Next year dividend means DPS 1 and DPS 1 is 10 rupees, which expects to grow 5%. Assume tax rate is how much? 35%. You are required to calculate weighted average cost of capital of the company basing on existing capital structure. Again he is asking, what is that? Compute, what is that? New weighted average cost of capital if the company raises additional debt by 50 lakhs. By issuing how much interest? 12% debenture. This would result in, tell me, this would result in increase in expected equity. Previously how much 10 now it went to 12.4 and leave the growth rate is unchanged. But the price of equity shall remain, fall to how much? 130. Previously how much it is? 200 to 160. But growth rate remain unchanged. So now basing on this, you have to calculate cost of equity problem. So you have to find it out how the cost should be calculated. So here you see, what is the first part you should be identified. Here, problem. Changed. Here, nothing but you can calculate simple way. Tell me, what is you are the three sources. One is what? KE. KE formula, what is it? DPS 1 divided by market price plus growth rate. DPS 1 kitna ma? 10. 10 divided by 200 plus how much ma? 0.10. Kitna ya? Growth rate 5. 0.5. How much? 10%. Okay. So 10% you got it. Cost of preference nothing changed. 1.5. 11.5. KD equal to 10 into 1 minus 0.35. 6.5%. So weighted average cost of capital. You know the table I told you. What are the sources? Equity. How much capital? Amount how much ma? 200 into 200 lakhs into 10%. How much product you got it? 20. Whereas KP 60 into 11.5%. 6 point. What about debenture? 100 into 6.5%. Now 10 into, so this is amount 6.9. What about here 6 point. What is the total cost? 33.4 for, no, this is the total. 33.4 for 360. Can you calculate weighted average cost of capital? 33.4 divided by 360 into 100, right? Coming, how much ma? 9.28%. Whereas calculation of new weighted average cost, if you want to find it out, estimation of specific cost each of the sources. Cost of equity should be recalculated. Market price went to 160. Growth rate become unchanged. DPS1 went to 12.4. So KE equal to DPS1 divided by market price plus growth rate, where KE equal to DPS1 divided by 160 plus 0.05. It went to 12.75. KP remain unchanged. 10% debentures unchanged. But new debt you raised, 12%. So 12% into 1 minus 0. How much? 7.8. Now you can calculate weighted average cost, new cost. So what are the sources? 4 formula, 4 column, 1 formula. You need to take, what is that? Equity, preference, debentures, 12% debenture, that is nothing but new. You took the 200, 60, 100, 50. If you multiply this one, right, you used to get 25.60, 6.90, 6.5, 3.9. So what you have to consider? 410. So 42.8 you got it. So finally, new weighted average cost of capital equal to 42 point divided by 410 into 100. How much? This is the repeated model. More than this, you are not going to get it. But little bit, he may add some English terminology, right? He may make problem so lengthy. And the last one, model left to, what is that? Calculation of weighted average cost of capital. Marginal cost of capital, indirectly what it conveys? It is also, you see, weighted average, new weighted average cost of capital only, that is. Coming to here, you have one more concept, last concept. We will conclude this one. Weighted average cost of capital estimation basing on what value? Market value. So weighted average cost of capital can be estimated basing on book value or market value. Book value means what? Number of security into book value. Market value means what? Number of security into market price. But here, in general, most important point you have to consider. In general, weighted average cost of capital is estimated basing on market value because it represents present cost situation which is supposed to take financial decision as on today. Are you getting? You can take as on today effectively. Because book value speaks what? Historical. Market value speaks present. So that's why weighted average cost you are calculating, sir. Should I take book value or should I take market value? Means you always take what value? Market value, right? So weighted average cost of capital using on book value provides only historical value. That's why which is important? Market value is important. Key points to remember. In estimation of weighted average cost of capital basing on book value, one must consider equity share capital, retained earnings. Hello, this notes is very, very important, right? Okay? Retained equity share capital and retained earnings. Also estimate what you have to calculate. KE you have to calculate, boss. KR also you have to calculate because you are estimating what based? Book value. Whereas in estimation of weighted average cost of capital basing on what value? Market value. Then what is that? No need to consider retained earnings. Why no need to consider retained earnings? Because whereas when flotation cost exists, then market value of equity must be apportioned as per proportionate. So you have to consider two things, sir. You see, when in the book value I have equity is there, retained earning is there. If the share 10 rupees share value is gradually increasing means I am buying. I am buying means what is the reason for buying? Because I will look what? Retained earning. I will buy what shares? Equity shares. In the market, share value is increasing means indirectly that increased value, whose contribution is there? Retaining. If at all I want to buy a company share means you try to understand. Simply I will buy I will check, I will evaluate, right, whether the company is performing better job or not. So I will go and check the company's what? Retained earnings I will check. Retained earnings is there. Means company earnings are there. They are paying dividend. They are holding it. They are retaining it. This is one wonderful company where By chance, if at all next year company gets lost, no need to worry. Because what is there? Retained earning. Then we will buy this company shares. And ఏం చేస్తాడు? Purchases. While going on purchasing, share value, what happened? Increases. That means in the market value, if you accept or not to accept, there is an impact of what? Retained earning. Yes or no? Retained earning impact is there. That means if you see market value means hiddenly what is there? Retained earning is there. In such a case, for retained earning, you have to calculate KR. For equity, you need to calculate KE. When there is no flotation cost, boss, KE equal to KR. What is need to calculate? So that is the reason KE equal to KR when there is no flotation cost. No need to calculate. Bacha, agar flotation cost hai. In such a case, check the book value. How the total book value is considered. For example, book value 100 rupees is equity. 100 rupees is retained earning. 100 total is how much? 200. 200 for equity, there is a KE. For retained earning, KR is there. Since KE equal to KR, when there is no, by chance in the problem, no flotation cost is there. In such a case, KE is not equal to KR. There is not an issue. Why? Because, retained earnings. You stand up. Equity. Equity, retained earnings, right? Equity, retained earnings. K equal to KR. In book value, I have retained earnings and equity. I can calculate. But in market value, I have only one source. What should I do? 100, how much? 200. But here 500 is there. What should I do? But market value is there, sir. In the market value, what is there? Retained earnings also is there, In such a case, this market value should be, what is that? Apportioned. As per proportion. It should be apportioned as per proportion. Can you tell me how much equity would be? 100, 200. 200 mein equity kitna rahe? 100. Preference kitna rahe? That means here how much it is? 500. 250. First equity you have to take KE. For retained earnings you have to take KR. Only this is the difference. Okay, this is the time lagging, only that point. Remaining weighted average cost of capital procedure is same. So book value means number of security into issue price. Market value means number of securities into issue price. In the problem, no flotation cost, no issue. In weighted average cost CA Institute material, two problems are there. One problem dead easy because no flotation cost. Another problem is flotation cost is there. Flotation cost is there. This is the reason. I can shout, I can show, but I am writing this information. This information, you make it note, you study. How many times you will find a free time, you study. Because this is the most important point to be considered. Otherwise, you cannot know. You see, apportion. Apportion as per what? Proportion. So, this is the procedure to calculate what is that? Weighted average cost of capital, but based on market value. Key points. From my research, I studied 10 years question papers, all these things. I identified some key points. 10 years question paper I studied. That's why I will tell per hour 10 times. Because I studied, Okay. My mother also do. Why you are doing extra? Because I know extras. What should I do? Because I know extras, yeah. That's why I do extra. If you don't know extra, you don't do extra. Alright. Now, can you examination point of view? Key points. Pakka pass this attempt. Meaning of cost of capital. Do you know? Sir, cost of capital is minimum rate of return that a company must earn to pay to whom? Not to pay, sir. Keep the expectation, sir. Right. Significance of cost of capital. Significance. Investment. Risk. Performance. Yes or no, ma? Steps involved. How many? 21 steps. Yes or no? 2 steps. Okay. Why debt is cheaper than equity? Tax advantage, low flotation cost, and another one is low flotation cost, tax advantage, low coupon rate basically. Okay, low coupon rate. Types of debenture, how many? What are they? How to estimate fair market value of debenture? Alright, fair market value is nothing but, listen carefully, 5 minutes, because this important points, fair market value means present value is a fair market value. For example, in NPV calculation, we used to calculate operating cash flow, right? Terminal cash flow, right? Like that, if I want to buy any debenture, whatever the benefits I am going to get it from these debentures, I used to get it in future. What simply I do? I have to bring it into present. So that is nothing but fair market value. In dividend discount model, I will discuss this concept. In dividend, one of the model is called, what is it? Discount model. Again, this topic will come. So fair market value. What is a PE ratio? PE ratio. PE ratio, actually this should come under cost of capital structure. But in cost of capital, last problem it covered. PE ratio, it is the ratio which shows the relationship between market price and EPS. Sir, PE ratio formula dead easy, sir. Market price divided by EPS. Methods of calculation of KE. Methods of calculation of KE. Experts, sir. EPS model, no growth in dividend, constant growth in dividend, realized yield approach, CAPM approach. Okay. Sir, what are the types of risk? I think CAPM approach too, sir. Diversifiable risk, non-diversifiable risk. How to calculate growth rate? Sir, growth rate, retained amount you have to retain and reinvest. This is one technique. Another technique also I told in class. Latest minus late divided by late. Or else present value, future value by taking, you can consider that is also growth rate. MCQ purpose they may ask you. What is a weighted average cost can be calculated? Book value, market value. Book value means number of security into book price. Market value means number of security into what is the marginal cost of capital. The word marginal means additional. This additional cost of capital raised by the company for additional expansion, modernization purpose. What is optimum capital structure? Cost of capital problem, last problem, they used a word terminology, capital structure. You must also known as optimum capital structure, SS. Do you remember I told SS, same amount, same proportion. Yes or no? Same amount, same proportion. Estimation method of cost of retained earning. Two, you know, sir. One is K equal to KR. Another one is KR equal to investor expected rate into 1 minus brokerage into 1 minus personal tax. How to calculate KE under realized yield approach, sir? Realized yield approach, realized yield, you know, sir. There are two types of yield, sir. Dividend yield, capital gain yield for holding 1 year, more than 1 year. You calculate IRR, sir. But condition applies, Balu, sir. There should not be flotation cost. Why is key role flotation cost? What is the key role of flotation cost in estimation of weighted average cost? Sir, flotation cost is called issuing cost, sir. Either you issue equity, preference, debenture, whatever it may be, you have to incur what cost? When flotation cost increases, net proceeds decreases. When net proceeds decreases, weighted average cost, what happen? Increases. Technically called flotation cost is called show cost. Extra చేసే కాస్ట్లు ఇవన్నీ కూడా. కొంతమంది మ్యారేజ్ అంటారు కదా, అటు 7 తరాలు చెప్పుకోవాలి, ఇటు 7 తరాలు. ఏం చెప్పుకోవాలి 7 తరాలు? ఉన్న డబ్బులు మొత్తం తగలేస్తారు వీళ్ళు. బికాస్ దే వాంట్ టు కన్సిడర్ 7 తరాలు దే హ్యావ్ టు టెల్. ఓకే. After 7 terms, you have to tell what is your bank balance. How much bank balance? What is a, write a note of CAPM approach. 4 marks question asked. Write a brief note on CAPM approach. CAPM approach suggested by Sharpe in the year 1961. This model conveys that KE should consider two factors, risk-free rate and risk premium. According to this model, KE equal to RF plus RM minus RP. RP should be estimated beta into RM minus RF. How to identify risk element of equity shareholders when company raises additional funds? What are the indications, sir? How should I feel that when company raises debt, how should equity shareholders feel risk? Will it dance? No, sir. Sir, when you raise a debt, you know, market price will decrease. Just now I discussed, you know, market price will decrease. Growth rate may increase. Dividend price per share may increase. Sir, what is the yield rate? What is the yield rate? Sir, yield rate is nothing but how it should be estimated. Yield rate is nothing but investor expected rate of return, or if there is no flotation cost, it should be KE. Are you getting? So these are summary points, ma. Keep it in mind. So all the best. Okay? GBU. Okay? Yeah. Capital structure. What is exactly the capital structure it indirectly conveys? You see that meaning two things. What is it? Capital structure. The point is this: whenever company need a capital, the company plans for various resources through which the fund should be raised. Here, you see, before going to meaning, let me tell you what happened within 1 hour, right? What I'm going to convey means from May 2018 to year 2024, if you observe, maximum they covered how many marks? 10 marks. Maximum 10 marks. There is a chance to ask for 5 marks. This 5 marks, completely theory part they asked. Here there is a 15 marks asked. This is the 10 marks plus theory. So you try to understand, you cannot neglect this one. That to 2024, they couldn't consider from this chapter. So this attempt, absolutely. How many marks? 10 marks. So just to only learning capital structure, if you went for exam, if you go exam, padega tereko. Okay, ra? So what is a capital structure? Simple. What is a capital structure? You learn the capital structure. The capital structure, whenever company, see, very, very simple. What is a capital structure, sir? Whenever company need a capital, for this capital, what the company do? Company wants to raise this capital. To raise this capital, company identified what are the sources. What are the sources which are available? One is the long-term sources. Another one is short-term sources. For the sake of raising capital, company never concentrate what? Short-term sources. So for the sake of rising of company capital, company concentrates long-term sources. Long-term sources, you remember Naluguru. Who are the Naluguru? Equity shareholders, preference shareholders, debenture holders. Yeah, retained earnings, you can use it. This Naluguru. Will they provide as a free of cost? No, they will charge cost. That is a topic yesterday we discussed. That is nothing but cost of capital. Here, equity is there, preference is there, debt is there. But all this, given the sources, has its own positives, own negatives. What is that? Own positives is there, negative is there. Being a financial manager, what happened? You have to consider all these things. How much of the composition you have to design? My mother yesterday prepared Sunday sweet, but I could not take it because it's too sweet. Hello, excuse me. I asked mummy prepare a sweet because today is Sunday. Then my mother prepared sweet. Nakoddu. Why? Because it is sweet. Sweet kadra. Sweet. But sweet should be sweet, not too sweet. At least one sweet. So one sweet. What is sweet? Too sweet and go. No, nakoddu. Sweet should be sweet. Capital should be capital, but it should have what? Proper mix. If the balance is imbalanced, then balance sheet both. That's why. Are you getting? So that's why you have to make such a mix, such a combination by considering all these elements. So what are all these elements means? I will tell you, here you see some identity. If you consider risk point of view, risk point of view, equity, preference, debenture is there. Assume retained earnings not there. Risk, which is lowest cost? Equity. So risk point of view, which is the best? Equity best. But debt is highest risk mine. So, sir, I don't want. Immediately you will concentrate what? Cost. For the equity point of view, highest cost. But this is lowest. Which one? Debentures. But whereas ownership, what happen? If you raise equity, ownership gets diluted. But whereas from the debtor, your ownership is protected. So that's there is a positives, there is a negatives. Considering all these things, you have to identify what is the best debt equity mix. That is called, here we used to study the capital structure. So capital structure is nothing but, what is it? Mix of what funds? Mix of long-term funds in such a way that the company objective of particularly wealth should be, what is it? Maximized. Mix should be, long-term should be optimum. What is that? Optimum. Optimum means perfect, effective, right? That is needed. If you consider the notes what I written for you, raise capital structure. Can I say meaning like this? This is a CA Institute, what it conveys. Balu sir, tell to your students, capital structure is the mix or It's a combination here. It is a mix or combination of short-term funds. Yes or no? What funds? Long-term funds, particularly equity, preference, debentures. You may take it what? Redundant. Sir, why should we mix all these things? Just now you showed, sir, risk, cost, control, everything is there. The objective of capital structure is to determination of what? Optimum capital structure. So which combination should be the best? Which combination suits to the company in the best manner is called, what is it? Optimum capital structure should be identified. So then question arises, then what is the optimum capital structure? Here you have, what is the optimum capital structure? So optimum capital structure, again, you remember, right? At least one word, right? Optimum capital structure, right? Optimum capital structure. It is not a new structure, man. It is the mix of what funds? It is a mix of long-term funds, mix of long-term funds, okay? Mix of long-term funds. The ultimate objective is to either, what happen? You have to mix in such a way that either EPS of the company should be high, either market price of the company should be high, at least weighted average cost of capital. Yesterday, what the chapter we completed? At least it should be low. A client may come to your office. You say that, sir, I need a capital structure where through that I can increase my market price. Sir, I can increase my EPS and market price, and what happened? I can decrease weighted average cost. Which combination, right? Your debt equity mix will reduce your either increase your EPS or market price, and weighted average cost is called, what is that? Optimum capital structure. Remember, capital structure planning is to determination of what? Capital structure. The total chapter name is capital structure. Its ultimate objective is to determination of what? Optimum capital structure. How to identify optimum capital structure? Just now I told you. What is it? Either EPS parameter you may consider it, either market price parameter you may consider it, either weighted average cost maybe you consider it. But the thing is, while designing EPS and market price, you have to consider, what is it? Risk you have to consider, cost you have to consider, what is it? Control. By considering all these elements, what is that? Wealth of the company should be what happened? Maximized. So such a capital structure is called, what is that? Optimum capital structure, we can say. So here the optimum capital structure, risk should be low, cost should be low, market price should be high. Example for capital structure, suppose ABC Limited company is there. The financial manager of the company need a capital of how much? 10 lakhs. How he plan? He identifies sources. What are the sources? Equity, preference, debt. What are the characteristics he identify? Cost, risk, flexibility, and at the same time, what is it? Income generation ability also. He will consider, by raising these funds, can I able to generate income? Yes, then you better to go with the equity and preference, because you're supposed to pay what? Cost. Income generation is not there, sir. Only for the service purpose I am going means, then you better to move, what is it? Equity or debt. For example, I invest, immediately I won't generate income. In such a case, equity is better. Immediately I can generate. Debt is better. So, which source you have to consider means cost, risk, flexibility, income generation, control, that is nothing but ownership, and finally you have to consider what? Government rules and regulations. By considering all these things, you have to design a capital structure where the capital structure should be mix would be plan 1, plan 2, plan 3. Whatever the capital is needed, you would be given various plans. First plan, you may raise at 100% equity, where you don't want to take too much of risk. Yes or no? Whereas if you went for equity plus debt you are concentrating means you want to get the tax advantage. At the same time, low cost funds you want to raise it. So that is plan 2. Plan 3. Plan 3 is 50% equity, 25% debt, 25% preference, means you are also concentrating what? Preference. So this is the ultimate objective of any corporate company. Whenever they need a capital, they will raise all the sources. But at the same time, we have to identify which source would be at most important. What is that? Which source would be at most important, right? This is called capital structure. Are you getting ma? So you have to see the sources, you have to see the character, yes or no? You know the composition and you keep the objective. What are the sources you have to see? See the sources. See the factors. What are the sources? Equity preference. What are the factors? Risk, cost, control, all these things. Yes or no? By considering all these things, you have to keep the mind. What is it? Objective. Can I achieve that objective with this given sources by considering the given factors? That is not, it's not as easy. It is very difficult because if you don't know, you make a sweet, but you cannot eat because it is a sweet. Are you getting? You are making sweet to eat, but you cannot eat big sweet because it is not sweet. Okay, but that sweet is little bit too sweet. Okay, that is the combination. And MCQs, one of the theory questions they asked, well, sir, capital structure, financial structure, both are same. Capital structure is a mix of only long-term funds. Financial structure means long-term funds and equity funds. MCQ questions also covered. And this diagram I made it, this is covered entirely MCQs. All the MCQs points covered here. So capital structure, 13 MCQs. Out of this, 5 to 7 MCQs covered here itself. Okay, only this. Risk, cost, what is the financial structure, what is objective, what is optimum capital structure. Are you getting? Yeah. Then evaluation. How to identify, what is it? An optimum capital structure. That's you have to consider here. Here, the next point I would like to say, how to identify. Before going to this, let me tell you, to identify, what is that? You see, evaluation. You are a financial manager. You are a financial manager and you want to estimate which capital structure would be the best. You have to identify. So, evaluation of optimum capital structure of the company. How do you say here? This is the 10 marks question they've been asking. 10 marks. Tell me which combination would be the best. For that purpose, you have to make evaluation. You have to identify. For that purpose, you need to do analysis. What is that? Analysis. You should follow approaches. A, do. A, follow. Analysis means what? Analysis. You do and you find, right? Analysis means reason, systematic study to bring some conclusion in order to take what? Decision is called what? Analysis. And you have to follow approaches. You are not doing any analysis. You are following blindly approaches. So, in order to identify the optimum capital structure, every financial manager has to do analysis and approaches. The first one, EBIT, EPS analysis. EBIT, market price analysis. Financial break-even point analysis. Then, indifference point analysis. Okay, you got it, ma? So, EBIT, how many analysis? EBIT, EPS analysis. EBIT, market price analysis. Financial break-even point analysis. Indifference point analysis. Analysis we do. Each analysis as, this is analysis, what? We do. Each analysis if you want to do means you must know calculations. You must know calculations and after calculation you will get what? Results. That results, basing on results you have to take what? Analysis. What should you calculate? From each one you know that from EBIT you must know how to calculate what? EPS. Here you must know from EBIT how to calculate market price. You must know financial break-even point and you must know indifference point. All this required, what is that? Format procedure. What is that? Format procedure to find it out this. What about the analysis? This analysis also known as what is that? Theories. What is that? Theories. First theory, net income theory. David Durand projected. Net operating income theory. This theory also projected by David Durand. DD. DD means David Durand. Traditional theory. Isra Solomon. Yes, Isra Solomon he projected. And Modigliani Miller itself, you know that Modigliani Miller approach. So what we follow, we won't do anything, just we will follow. Tell me, what are the evaluation for optimum capital structure? What are the strategies you have? You follow analysis. You do analysis. You follow approaches. Examination 10 marks I showed, that all the 10 marks from analysis only. Approaches is the theories, hardly they given for how many marks? 5 marks. Clear now? So now first analysis is nothing but what is that? EBIT EPS analysis. So EBIT EPS analysis, what the EBIT EPS analysis means? You see, for raising any capital, if you raise a capital, with this capital you do EBIT. Hello? You raise a capital and you invest that capital and you make EBIT. From the EBIT, you should find it out what? EPS. So which plan you are raising? Which plan with the which maybe is a plan 1 and plan 2, plan 3. So each plan, what is the EPS you are going to find it out. So that means EBIT, basing on EBIT, you have to calculate EPS. Which financial plan will gives you, what is it? Highest EPS, that should be recommended as, what is it? Optimum capital structure, right? Optimum capital structure. Little bit elaboration, you see. EBIT, EPS analysis. These are 2 marks question they asked, the theory questions. What is EBIT, EPS analysis? Sir, Balu sir, it is the analysis in which one must estimate, what's it? EPS. From what, sir? Remember this word. Estimate EPS. From what? EBIT. Of what is it? Each of the given financial plans or options. Okay? In which financial plan EPS is high, that would be considered as, what is it? Optimum capital structure. Simple line. That's the matter is finished. So what do you have to calculate, man? Tell me. EPS. From what? EBIT. In which financial plan? EPS is high, that would be recommended as optimum capital structure. So, okay, do you know how to find it out, that EBIT from it? See, you must be able to find it out. What analysis just now we discussed? EBIT, EPS analysis. So, you have to calculate, what is that? From EBIT to, what you have to calculate? EPS. What is the procedure? Take EBIT, less what you deduct? Interest. Then what you will get? EBT. From that you deduct what? Tax. You will get what? EAT. EAT also known as earning availability to equity shareholders. Less you pay preference dividend. Then you used to get earning availability to equity shareholders divided by take number of equity shares and finally calculate what is it? EPS. So this is the EPS equal to earning availability to equity shareholders divided by earning availability equity shareholders divided by number of equity shares. This is the format CA Institute is provided. But the thing is, the hidden strategy is he never gives you EBIT directly. If he gives EBIT, you can find what? EPS. Mummy gives onions and knife. You can cut it because you are cutting onion. But the thing is, mummy never tell that where the onions are there. So you have to search where it is. Onion would be possible. Knife, where it is. We will search where is knife, where is knife. You see, common dialogue. Akkadundi chudu, akkada. Akkadundi chudu. You will get the tension. Same situation. EBIT, EPS, I too know. How to cut onion, how to know. But where is knife? That is the issue, For that purpose, you have to study income statement. For that, I identified the 3 ways you try to understand. EBIT can be estimated like this. What? Sales minus variable cost. Minus fixed cost. You will get what? Strategy number 1. To find it out what? EBIT. Strategy number 2. That is top to bottom, right? Bottom to top analysis. This is what? Top to bottom analysis. Now bottom to top analysis also is there, EBT plus what? Interest. You will get what? EBIT. Third analysis, the one of the ratio called return on capital employed. Hello? Return on capital employed. Return on capital employed formula. EBIT divided by total capital employed. So basing on EBIT divided by total capital employed means from that, basing on that, can you calculate EBIT? Yeah, EBIT equal to total capital employed into return on. See, 90% this analysis is very easy because EBIT to EPS. Issue is where the EBIT? Where the EBIT? Okay? That is the reason. For that purpose, you to make these 3 identities because the study material practice problems, he used this strategy only. Nothing else. So he used this strategy. First problem he used to give what? EBIT. Second problem? No. But he will ask you, calculate just EPS, get the marks, 10 marks, enjoy. But where EBIT? Right? For that purpose, strategy 1, tell me. Sales minus variable cost minus fixed cost. Second strategy. Third strategy. Yeah, once EBIT is given, nothing but you would be the great ever. Then how do you calculate EPS? This is a common story. EBIT minus kya karo? Interest. Then what you will get? EBT, right? From that what happen? You pay what? Tax. Then you will get it earning availability to equity shareholders. minus what? Preference dividend divided by number of equity shares, you will get what? EPS. This is a simple procedure. So this is the way you have to calculate. Just now I told you. So how the format you should understand. EBIT less interest. Interest means if the existing company, new company means, pay attention. One of the problem they asked, not the exam oriented problem they asked, that is not a new companies. That is called what companies? Existing company. Existing company means they have a old interest and a new interest. But student will consider only new interest. He will ignore what? Why, sir? Array, you see here, if you are raising funds by what? 100% equity means you concentrate only no interest, right? You will say zero. But no. Old interest you have to pay. That is the problem they asked. That's enough. For that, one problem they designed. Only for this purpose. For preference, one more problem. So because the students will concentrate that, sir, here debt is there, sir. Yes, he will take E plus N he will take. Here he will come, what is that? Preference. Preference means he has to take old interest and new preference, and for example, new debt is there means new debt also you have to, old interest you have to take, new interest you have to take, and new preference also you have to consider. You getting ma? So this is the way he designed. So E plus N means what? Interest means, keep it in mind. Balu sir told E plus N. E. Existing N. E is not there. Take N. E is there. E plus N. Then you will get the EBT. Pay tax. What is it? EAT. Hello. Less what you will get? A preference dividend. You also concentrate the E plus N. E plus N means old preference is there. Right? Earning availability to equity shareholders. Number of equity shares you can take it. EPS. While calculating EPS also you have to consider E plus N. Then you will take what? E plus N. E indicates. Sir, how many times you used to tell, sir? Are new shares, existing new, preference, existing new, debt, existing new, interest, existing new. These many things are there, man, right? EPS. In which financial plan EPS is highest? That you have to recommend. Are you getting my point, ma? This is what analysis? EBIT, EPS analysis. So thereafter you have one more analysis is known as, what is that? EBIT market price analysis. In the EBIT market price analysis, what you have to do means you have to calculate market price. So market price, what do you find it out? You will take what? EPS into what ratio? PE ratio. If your PE ratio, if you multiply market price, the question arises, what is the PE ratio? Hello? What is the PE ratio? PE ratio, there is a question is identifies. If you calculate EBIT, you must understand what is the PE ratio. PE ratio, it is the ratio which shows the relationship between market price and EPS. Number of times the market price is higher comparing to its EPS is called what? PE ratio. SBI PE ratio I showed 50 times. What is that? 50 times means it earning 1 rupee, but market price is how many? 50 times higher than comparing to its earnings. It is called PE ratio. PE ratio of the formula. PE ratio of the company is given means market price divided by EPS. So from this you can extract market price. Market price equal to EPS into PE ratio. Then EPS equal to market price divided by PE ratio. These many strategies they will ask you. Don't expect from this analysis they will ask you only market price. No. From this analysis, you may expect EPS also. From this analysis, you may expect exclusively PE ratio. Are you getting ma? So this is the analysis where you have to find it out what PE ratio you have to calculate. That is the most important point. So what is the EBIT market price analysis? See, EBIT market price analysis is one of the analysis used to select what capital structure? Optimum capital structure. To the point. That's enough. Very simple. Okay, in this analysis, what we going to do, sir? Tell me. In this analysis, right, one must estimate what? Market price in each of the financial plan. Each of the financial plan. In which, with support of what ratio? PE ratio, which is also known as, what is it? PE multiple. Okay. Whereas, in which financial plan, market price is least or higher? High. In which financial plan market price is high? You have to identify. That would be considered as, what is it? Optimum capital structure. Very simple. Very simple in simple English. But information is superb. Are you getting? Then how do you calculate EPS, sir? EBIT minus interest into 1 minus tax minus preference dividend divided by number of equity shares, you will get EPS. What about the PE ratio? Market price divided by EPS. Basing on this, can you calculate market price? Yeah, EPS into PE ratio. What is the observation? So in PE ratio, one of the characteristics, as debt increases, risk increases. As risk increases, PE ratio decreases. As PE ratio decreases, market price decreases. Keep it in this point, boy. Are you getting ma? Another one, as a debt decreases, risk decreases. As risk decreases, PE ratio increases. PE ratio increases, market price increases. Got it? Yeah, that is the another important point, right? Here, PE ratio, you know that? What is the PE ratio formula? Market price divided by EPS. Well, basing on this, how do you calculate EPS? Tell me. A, you have to take what? EPS. Hello? B, you have to take what? PE ratio. Third, you can calculate market price. Market price equal to EPS into PE ratio. Basing on this, we solve this one problem. You see how many times this asked? Only one problem. Enough. Right? How many problems you are solving is not the matter. What problem you are solving is not the matter. Right? ఎంతమంది ఉన్నారు కాదు నీ ముందర ఎవడున్నాడు అనేది ఇంపార్టెంట్. ఎన్ని ప్రాబ్లమ్ సాల్వ్ చేసాం కాదు, ఎలాంటి ప్రాబ్లం టచ్ చేసాం అనేది ఇంపార్టెంట్. సార్ హౌ సార్ వై యు ఆర్ డూయింగ్ దిస్ మచ్ ఆఫ్ ఎక్స్ట్రా? బికాస్ ఇట్ ఇస్ ఎక్స్ట్రాడినరీ ప్రాబ్లమ్ రా. ఓకే, దట్ ఈస్ ద రీజన్, రైట్? If you are able to solve means, see how many times this problem asked. So far said your seniors who become a chartered accountant with the blessing of this problem. Agar this problem aa gaya 2024, not at all asked. Take pen and calculator. Shall we solve ra? No time ra, but what to do? Because you know, I thought it only theory information I will give it. My soul is not satisfied. Why? Because itni bar aa gaya ra bachcha. Okay, shall we take ma? Yeah, see, this is the problem. The following data represented to TVS Limited. Profit before tax, kitna? That is nothing but EBIT, no ma. EBIT they given. Interest, how much? Madam, can you say how much debt would be? Can I say? Because you know that debt into rate, interest you will get it. Interest divided by rate, you will get debt. In such a case, 12 lakhs divided by 12%. 100 lakhs, profit before tax given. Income tax rate is 50% given. PAT is given 36 lakhs. Preference shares, how much? 18 lakhs. In such a case, preference share capital, 12 lakhs divided by 15%. Take calculator. 80 lakhs. Okay. Then earning to equity shareholders, how much? 24 lakhs. Number of equity shares, how much? 8 lakhs. EPS per share is 3 rupees. In such a case, equity share capital 8 lakhs into 10 rupees. How much ma? 80 lakhs. What is this 80 lakhs? Equity. What is this 80 lakh? Preference. What is this 100 lakh? Debt. That means company moving with the equity plus preference plus debt. Right? Now in such a situation, EPS is 3. Where is its PE ratio is a mystery here. PE ratio is a 10 actually. How much? 10. The company is planning to start a new project where total capital required is 70 lakhs. You are informed that debt equity ratio. What is a debt equity ratio, Maji? Debt equity ratio, it is a ratio which shows the relationship between debt. Debt. Equity em లేదు పాపం ఇడికి. ఇక్కడ డెప్ట్ ఉందంటే ఇక్కడ ఏముందండి? ఈక్విటీ ఉంది ప్లస్ వాట్ ఇస్ దట్? E is there, D is there, that's why stomach came like this. Here only what is that? Equity is there. You know that what is a debt equity ratio? MCQ question. One of the MCQ question. Total 8 questions covered, only 4 questions left. That is theory part. Debt equity ratio formula. What is the debt equity ratio, sir? Tell me that. It is the ratio which shows the relationship between debt and total capital employed. Debt equity ratio equal to debt divided by total capital employed. You can say debt divided by, you can also say total capital employed. Yes or no? Yeah. So that is the observation, dear students. Now we can move to again the problem. So debt equity ratio is a range between 20% to 35%. Then PE ratio is 9. Whereas if debt equity ratio more than 35%, then PE ratio would be 8 times. Now if the company raises debt, you know, they can pay interest rate how much? 14%. 14% for what? If you raise this 70 lakhs, sir, you have to pay 14%, sir. Sir, if you go with equity, no need of that, right? Then that is one point. What about the retained earnings? How much? This is the present retained earnings, right? But in the problem, EBIT, they could not provide it. This is one of the strategy they used. Sir, if I raise 70 lakhs, how much I am going to earn? Currently, you told that you are giving how much? 84 lakhs. What about how much I am going to earn in future? Nothing is mentioned. In such a case, what you do? Present return on capital employed, how much is there? In future also, return on capital employed would be same. This is the basic identity. That is the reason these many times you are given. So the students also must know EBIT, EPS analysis, not return on capital employed also you must know. Yes, ma? So for this purpose, what you do means calculation of present return on capital employed, you have to calculate. What is the given EBIT? What is the present capital employed? How much present capital employed is there? Tell me. Balu sir, debt is there. Debt, how do you calculate? 12 lakh divided by 12%. Preference is there. Yes or no, ma? Preference here they have considered. And the equity also is there, By considering total, how much you got it? 3 crore 80 lakhs. Then return on capital employed equal to 84 lakh divided by 3 crore 80 lakhs means 22.11%. That means company presently earning how much? 22.11%. Hello. In future also, same. In such a case, again, we used to calculate proposed EBIT. How much proposed EBIT? Proposed EBIT equal to proposed capital employed into return on capital employed. What is the proposed EBIT? 3 lakh 80 plus 70 lakhs into what rate? 22.11. Sir, what is this? This 3 lakhs. Not this zeros missed, right? Same, ma? Yeah, that is. So total EBIT would be how much, ma? 99 lakh 49,500. What is the observation? What is the condition? I made it. Note, in the absence of information, return on capital employed after expansion is remain same before and after. In such a case, how many plans they have? 2 plans. What is the first plan? First plan is the additional funds are raised by loan. Loan means what? Debt. Additional plan raised by equity. Nothing is given, only this. So now what is the plan 1? Plan 2. What is the plan 1? 100% debt. 100% debt. This is 100% equity. You have taken EBIT, yeah? Tell me. Less, what you done? Interest. What, sorry, this E plus N? Old interest is how much is there, ma? New interest. But the students sometimes ignore this one, right? So old interest, new interest. After deducting this one, A, B, C, you got the EBT, correct? Check, take calculators. Calculator used to use, not to show, right? తీసుకొచ్చారు అలాగే తీసుకెళ్తే ఎలా చెప్పు బండబూలు తిట్టుకుంటుంది అది అవసరమా ఎందుకు తీసుకొచ్చారని చెప్పు పీబీటీ హౌ మచ్ కరెక్టా 77,69,500 87,49,500 less tax how much 50% రా calculator sound మాజీ are you artificial intelligence take calculator how much 38,84,750 आ गया ना here 43,74,750 आ गया ना then you got the PAT sir PAT can I say earning availability equity shareholders yeah you can so but but here preference shares are there means you can say earning availability to shareholders yeah this is nothing but A B C D E less you have to pay preference dividend 12 lakhs next what you will say earnings for equity shareholders 26 lakh 84,000 31 lakhs 74,000 next number of equity shares either E plus N will also will come in this only what is that existing but here existing plus new 10,33,333 so EPS can you say EPS equal to sir earning availability equity shareholders divided by number of equity shares that means how much it is 3.36 what is this 3.037 next you have to calculate PE ratio you have to take right PE ratio means you have to calculate debt equity ratio in which plan concern plan right here how much debt you have old debt plus new debt hello so old debt plus new debt means total debt is how much 170 lakhs total equity capital employed how much it is 280 lakhs no here right 280 lakhs you have to consider In such a case, what about the debt equity ratio? Here, debt here, how much ma? Debt we calculated, old debt plus new debt. Old debt how much? 100 lakhs plus new debt 70 lakhs. What about the total capital employed? Previously, how much it is total capital employed? 380 lakhs. 380 lakhs plus 70 into 100. 37.5%, which is greater than 35%. Then PE ratio you have to take what? 8. If you multiply EPS into PE ratio, you used to get it? How much ma? 26.88. What about debt equity ratio Maji? Here debt is 100 lakhs. New debt is 0 because you are rising with equity. But total capital employed 380 plus 70, 480. 100 divided by this. How much debt equity ratio? 22.22, which is greater than 20%. That is PE ratio should be taken into 9. So if you multiply 27.63. What about your decision? Tell me, what about your decision? Since market price is high, which option? 100% equity. Thus you can say, because of not EPS, because of what you have to take? Market price high. So the proposed plan 2 to be taken into the consideration. This is the plan. What is the highlights you learned? If EBIT is not given, what is the strategy you have? Yeah, believe that present return on capital employed, whatever is there in future also, it should be learned. What is the debt equity ratio? Debt divided by capital employed. Yes or no? How do you calculate debt amount when interest rate is both are given? Interest divided by rate. How do you calculate preference? Preference dividend divided by. How do you calculate equity share capital? EPS into, number of shares into face value. Do you know what is meaning of retained earnings? You know the retained earning means? Retained earning, PE ratio, both are same. Yes or no? దానికి దీనికి అసలు సంబంధం ఏంటి సార్? కాన్ఫిడెంట్ ఉండాలి. ఎస్ సార్ అని చెప్పకూడదు. ఓకేనా? సో దట్ ఈస్ ద పాయింట్. సో వాట్ ఈస్ ద E plus N? యు ఆర్ రైటింగ్ E plus N. Existing plus new. That is a wonderful analysis. This is what analysis ma? EB. Not wonderful analysis only. That is EBIT, EPS analysis, right? Thereafter, what analysis? Financial break-even point. Array, theory question also asked, what is the financial break-even point? And one small MCQ given, small problem they developed. Basing on that, they identified. But what the problem is, tell me financial break-even point when company moves with what? Equity plus debt plus preference they asked. What is it? Equity plus debt plus preference. Okay, that is before that you should know what is the financial break-even point. So let me, what is the financial break-even point? We will move here. What is financial break-even point? This is the financial break-even point. What is the financial break-even point? Means it is the level of EBIT at which EPS remain 0. So EBIT equal to fixed financial commitment. Not but whenever any plan you have chosen, right? Any plan you have to chosen, you have to committed to commitments of the concerned plan. I told many times, when you are committed to commit the commitments of the concerned plan, means you have to commit the commitments of the plan. You have to be, what is that? Commitments. For example, plan 1, 100% equity. If a company raises 100% equity, is there a commitment? No commitment here, because no financial commitment on this, because all are who? Owners of the company, right? If you plan go with what? Equity. Equity plan 2 and 50% debt is there. Margaya 2. What is there? Debt. You have a financial break-even point. That is nothing but interest. Plan 3, sir. What is the plan 3? Sir, equity, sir. Okay. Preference, sir. Okay. In such a case, what, sir? Financial break-even point. When you want to pay preference dividend, you have to be with what? Tax also. Why? Because financial break-even point when preference is there means you have to take preference dividend divided by 1 minus tax. Why, sir? Because how much preference dividend you have to pay. If you earn that much of preference dividend, you cannot pay. Are you getting? How much preference dividend you have to pay? If you earn that much of preference dividend amount, you cannot pay. What is that? This is Mr. Subbarao, my friend, right? Subbarao raised preference share capital 10 lakhs. Equity is 15 lakhs. Total is 25 lakhs. Preference dividend is 12%. Tax rate is 30%. He asked me, what is my fixed financial break-even point means? I told that, so preference dividend Subbarao, 10 lakhs into 12% preference. How much? 1,20,000. Subbarao, if you earn 1,20,000, you cannot pay 1,20,000 preference dividend. Why, sir? What is the simple thing you are saying? Subbarao, come here. Ingapar. See, Subbarao, you earned how much? Interest kitna re? Nil. So EBT kitna hai? So you have to pay tax kitna? So 1,20,000 amount is there. 40% gaya. How much you have? 72,000. Actually, how much you have to pay? Talu pesukoni edustavu kuchu. So I earned 1,20,000. No. You have to pay means you have to earn how much? 1,20,000 divided by 1 minus 0 point. How much? 2 lakhs you have to make, man. So 2 lakhs minus interest. EBT also 2 lakhs. How much? Tax rate 80%. So gone how much? 1,20,000. That means 1,20,000 you have to consider. Maximum 2 marks they will give you with respect to only preference. Clear, ma? This is what point? Financial break-even point, right? The next one, what the given is, you understood, right? Yeah. Thereafter, what analysis? Indifference point analysis. What is indifference point analysis? Very simple. This is very, very important. That's the reason I made a note. Certainly, they asked this question for 5 marks. Or by considering all EBIT, EPS analysis, EBIT, market price, in all this, by summing up, they used to ask 10 marks also. But only one problem is very, very important. EBIT, EBIT, market price analysis. Indifference point also there is a chance. So the word indifference represents no difference actually. MCQs, MCQs, what is it? Indifference means no difference. Sir, what is this indifference analysis actually, sir? Indifference analysis actually means it is the level of EBIT at which EPS remains same in between two financial plans. It is not for one financial plan, dear students. It is not for what? One financial plan. It is for what? How many plans? Two financial plan. It is also known as what is that? EPS equivalency point. So let us take, I will tell you one simple example. The ITC India Limited need a capital of how much? 200 lakhs. Okay, ITC India Limited needed 200 lakhs. They have a two financial plan. Today they came to your office. Okay, the financial manager of ITC Limited came to your office saying that, sir, I have plan 1. Okay, I have plan 2, sir. So plan 1 is 100% equity, sir, right? Plan 2, sir, actually 50% equity, 50% debt, 25% debt and 25% preference, sir. Okay, corporate tax rate is how much, sir? Sorry, rate of interest. Coupon rate of interest is 10%. Rate of preference dividend is 12%. Face value of equity share is 100. So tax rate which is available 50%. He asked, what is indifference point? How should I take decision? Are you getting? Now take a calculators. Come on, take a calculators. So now you try to understand. You are ITC company. You are a financial manager. You have to prove how many plans you have. Good. How many plans? 2 plans you have. Plan 1 is what? Plan 2 is. So indifference point means what I told you. It is the level of EBIT at which EPS remains same. That means in this plan EPS, in this plan EPS, both remain same. Okay. Now can I write EPS like this? EPS equal to EBIT minus interest into 1 minus tax minus preference dividend divided by number of equity shares. Here also I can write EBIT minus interest into 1 minus tax minus preference dividend divided by number of equity shares. What, Maji? Yeah, this is the formula. Sir, you wrote the same formula. I write the same formula, but I won't put the same values. Because this plan is what? 100% equity. Coming to by decoding, can you take plan 1? Plan 1 is 100% equity, no? Take EBIT is X value. Interest is 0. Why? 1 minus 0.50 is there. What is 1 minus 0.50? Yeah, preference dividend also 0. Yes or no? Divided by how many? Number of shares 2 lakhs, right? 20 lakhs divided by how much the face value? 100. In such a case, it would be 2 lakhs. What about here? X minus interest. Sir, how do you get this 5 lakhs, sir? 5 lakhs, man. How should I get here? How much debt? 20 lakhs. Out of debt is how much percentage? 25%. 20 lakhs into 25%. Into 10%. How much? 5 lakhs you have to pay. Yes. 6 lakhs, how do you get it? Preference dividend, right? Divided by number of equity shares, how much? 1. If you make a cross verification, this one, how should we get this 0.56? 1 minus 0.56 is nothing but 0.56. 0.56 into x. 0.5x divided by 2 equal to 0.5 into x. How much? 0.5x. At the same time, 0.5 into 5. 2.5 minus is 2. 6 as usually. Now, if you simplify this one is, if you make a cross verification, when 1 is multiplied with 0.6, it would be 0.6. Sorry, 0.5x. This, if you multiply with this, what you will get? 0.5x into 2. How much? X. 2.5 plus 6 into 2. 17. Thus, x equal to EBIT equal to how much? 34 lakhs. What is this meaning? Sir, if you are able to earn 34 lakhs, both plan will gives you, what is it? Same EPS. Let's prove. Right. So, both are EPS remain same. But the thing is, which plan would be the best? I should ask. If I want to tell, you must tell. What should I tell? How much EBIT you are going to earn? Sir, I will earn, currently what the EBIT I calculated is 34 lakhs. If you can earn more than how much? 34 lakhs. Let us assume you are earning 40 lakhs means you better to take which one? Suppose you take a 44 lakhs. How much? Or you can take a 40 lakhs you are earning means which plan you are earning more than 34 lakhs means take a very, very risky plan. What is that? Very, very risky plan. If you are earning less than this means no risky plan or a low risky plan. You have to choose. Are you getting my point? Which plan would be the best? If I want to tell, you must tell. What I should tell, sir? Whether you are earning more than this or less than this. Are you getting? So if more than this means you better to go with which one? Risky plan. For example, if the 40 lakhs you will earn, can you tell me EPS would be here? 40 minus, you take a 40. 40 minus 0, 0 into 50%. 40 into 50%. 20, 20 divided by 2, 10 rupees. If same 40, if you put it here, 40 minus 5 into, what is the observation you find it out? If you are earning more than this means risky plan will gives you highest EPS. If you are earning just 25 lakhs, 30 lakhs you are earning. In fact, what is the story? 30 lakhs means you try to put it here. 30 minus 0 into 1 minus 0.50 divided by 2. 7.5 used to get it. If you earn here 6.5. Understood, ma? So indirectly what it conveys? Tell me. If you are able to earn more than indifference level of EBIT, then better to high risky one. If you are not able to earn means you better to low risky plan. Are you getting? So that is the very, very important point. Understood? With this we concluded 4 parts. What are they? EBIT, EPS analysis, EBIT market price analysis, indifference point analysis, financial break-even point analysis, right? 2 problems also we discussed. Okay. These are the very, very important models they've been asking from past exams, right? Thereafter, you have, what is that? Capital structure theories. What is that? Capital structure. Capital structure theories. Maximum, I studied all the problems, right? 4, maximum 5. That's enough. Maximum, they will ask you theory. Problematic part, already you got the identity. Yes or no? Yeah. Then we will move to which one? Capital structure theories. Let's have capital structure theories. You see, this is the exclusive notes. So, first of all, you should understand what is a theory. What is a theory? A theory is a statement of fact based on certain assumptions and conditions which are universally proved. It is a theory which are universally proved but based on certain assumptions and conditions. Are you getting? Then why should, what is the capital structure theories? Hello boss, capital structure theories are fundamental guidelines which supports to determine or construction of what capital structure? Optimum capital structure. How should I find optimum capital structure? So that is the capital structure theories. Here the capital structure theories being classified into 2 parts. What are they? Relevant theories. Another one is irrelevant theories. Bhalu sir, what is relevant theories? Relevant theories means capital structure, optimum capital structure is possible with the proper debt equity mix. What is it? With the proper debt equity mix, you can find it out optimum capital structure. That is what theory? Net relevant theories. Irrelevant theory is that optimum capital structure is not possible or no optimum capital structure is there in the market. Alright, there is no what? Optimum capital structure, because every capital structure is optimum only. That is their argument actually. That is, they will ask you MCQ question. I told you, no? MCQ question also covered. Relevant theories, irrelevant theories. Yeah, under one more question, they used to ask different theories, and they will ask you to identify which theory comes which segment. Hello. Under net income theory under relevant theories used to get what? Net income theory. Another one is, first one is net income theory and traditional theory. What is that? Traditional theory. In relevance used to find what? That net income theory, traditional. Whereas irrelevance used to find what is that? Net operating income theory and approach. But every theory is based on certain assumptions. What are the assumptions? Only there are two sources of funds. What are they? Equity and debt. Point number 1. This is the first point. Number 2, there is no what? Preference share capital. Cost of debt is less than cost of equity. Why? This is a 2 marks question they asked. Why? First, up to KD is less than KE. That is okay. Thereafter they asked why. Why means because of low coupon rate, because of low flotation cost, because of tax advantage. But actually in this theories there is no tax, and the capital employed remain constant. You may raise capital either by debt and equity, but you must define your total capital employed will remain same. Then there is a guarantee of EBIT. If you take a capital, if you do business, will you get losses, sir? No loss. Certainly you will get what? EBIT. Even it may increase. Business risk remain same. No tax, no flotation cost. And there is a perpetual existence. Perpetual existence means forever the company lives. Tell me what are the assumptions. 4 marks this question asked. One of the point I showed you. 15 marks one question is asked. I think second column 15. Out of that 15, 10 is, one is problem and another theory they asked this one. So what are the assumptions of capital structure? Tell me. There are only two sources of funds. What are they? Debt and equity. KD is less than KE. There is a guarantee of EBIT. No preference share capital. No tax. No flotation cost. Business risk remain constant. Perpetual existence. Okay, ma? And that is the theory. And first one we used to take what theory? Net income theory. Maximum MCQs we can cover from this. So maximum exam oriented, they won't ask you, but they will check your answer. And they will identify that, sir, how should I identify this is net income theory? Hello? How should I identify what is that? This is what is that? Net income theory. How should I identify? That is a question they've been asking. So instead of asking directly, they will make a twist. Whether this is a net income theory, this is net operating income theory. First of all, you should understand what is this net income theory. Okay, ma? Yeah, net income theory. So this theory was proposed by who? David Durant. Okay. According to this model, what is the market according to this model? I will tell you. According to this model, listen, in simplest way, a company may decrease what? Its KO. KO means weighted average cost. A company may decrease its KO and increase its market value of firm by employing least cost fund called debt. Thus, debt is always what? Best source. Why, sir? See, every corporate company, let us take, you see, you have to understand few things here. Market value debenture. Just now, yesterday we discussed market value debenture equal to interest divided by investor expected rate of return. Suppose if the interest remains same, but investor expected rate decreases, that is nothing but its cost decreases, automatically market value what happen? Increases. So market value of equity, you see, earning availability equity shareholders KE. If KE decreases, market value of equity also increases. In the same manner, market value of firm formula, EBIT divided by KO. If KO decreases, market value of firm also increases. For example, 24 lakhs EBIT, KO is 14%. Okay. Whereas another situation, 24 lakh, if the KO is 10%, try to understand what is its market value. 24 lakh divided by 14%. What is the market value? 121.171.43. What about second one? 240 lakhs. Are you getting? What observation you made it? When KO, that means denominator decreases, market value will increase. This point Mr. David Durant caught out. He identified that instead of, if you go with equity, your KO what happen? Increases. Instead of that, if you come with what? Debt, your KO decreases. With effect, your market value will increase. That is his point. That is the reason he told, tell me, a company may decrease its KO and increase its market value of firm by employing least cost fund called what? Debt. Okay, so that's his argument is debt is always best source of finance. Optimum capital structure is there, certainly. Where is that a capital structure? Where debt percentage is high. When debt is high, KO would be low. KO would be low means market value of firm should be high. So that is the assumptions. Coming to this theory, assumption is KD is less than KE. There is no risk to whom? Both the investors. No investor to whom? No risk to whom? Equity shareholders. And no risk to whom? Debenture holders. That is the important point. And no tax. So here he also graphical representation also you observe it. In the company capital gearing is there. Company KE remain constant while going on rising a debt. When rising a debt and you are redeeming equity, with effect KO gradually what happen? Decreases. When KO decreases, automatically market value of firm increases. So important formulas you should learn is market value of debt. Market value of debt equal to interest divided by KD. Market value of equity. Earning availability equity shares divided by KE. Market value of firm. Market value of debt plus market value of equity. KO also you can calculate like this. EBIT divided by market value of firm. Calculation procedure you follow the strategy is DEFO rule. What is it? DEFO means first you calculate debt. Then you calculate equity. Then you calculate firm. Then you calculate what? Overall cost of capital. So if you want to find it out, overall cost of capital should be low means you have to move from this. First D calculate karo, then E calculate karo, then firm you calculate, then overall cost of capital. This theory was suggested by, in this theory KE increases or decreases because of rising debt. KE decreases. Just now you see a diagram, Ray. KE diagram is same, right? Only what happened? KO decreases, keep it in mind. So indirectly you are going to prove that KO decreases. Why? Because rising debt could not increase risk to whom? Equity shareholders. So this much of debt you are rising, there is no risk to equity shareholders? No. Why? Because return on capital employed is greater than interest to be paid. For every 100 rupees I rise from debenture holders, just it is a 5%. But my return on capital employed is 25%. From the 25% I will give how much? 5% to whom? Whom? Debenture holders. Remaining amount I will give to whom? Equity shareholders. In such a case, why there is a risk to whom? Equity shareholders. That is his argument, right? Market value of firm formula. KO decrease, you always concentrate KO. In net income theory, what you have to prove? No change in KE, no change in KD. Because no change in KE, what happened? KO decreases with effect. Market value of firm increases, right? This is the theory part with respect to that. And coming to another one is, what is it? Net operating income theory. This theory also suggested by who? David Durant. So net income theory says that there is no risk to whom? Equity shareholders. But Modigliani Miller argument is not like that. Who told? You see, this is the one of the example. Our sir, who is he? Vijay Mallya ji has taken loan from the multiple banks in this bulk amount because he likes which theory? Net income theory. Debt is best because it's a low cost, no risk. That's why take-o. If at all any your relatives who ask, 10 నిమిషాలు ఇస్తాను అన్నాడు అనుకో. In his DNA is what his theory is there. Net income is theory. But whereas thereafter he projected net operating income theory. Argument is who told that? What చెప్పాడు? Means what, sir? Just now you identified, there is no risk to whom? Equity shareholders. Who told that there is no risk? Sir, no risk, sir. Why? Because, you are raising debt, sir. You are earning more and you are paying just cost to debenture holders. Remaining you are giving to whom? Equity shareholders. Thus, there is no risk to whom? Equity shareholders. This theory argument that who told that? That is wrong here. What is that? That is a wrong. What is that? Certainly there is a risk to whom? Equity shareholders. When risk is there, equity shareholders, then KE what happened? Increases. Whatever the advantage you raised the debt, right? That advantage of debt, disadvantages of equity, both will get what? Set off. With effect, KO remain constant. With effect, market value of firm remain constant. So debt is not a best. Debt is not a worst. Debt is just a source of finance here. That is the argument. Which theory? Net operating income theory. Right. Now you put it this word, right? Here you see. What I want to convey. This theory was suggested by who? Divide. According to this theory, debt equity mix of the company does not change what? KO and market value of firm. Why, sir? Because the advantage of debt would be set off with what? Risk element of equity. With effect, KO remain constant. Once KO remain constant, bhaiya, market value of firm also remains constant. Indirectly, he considered it is according to this model. There is no optimum capital structure. Every capital structure is optimum. So debt is, D is not a best, D is not a worst, D is a just source of finance. And he has taken certain assumption. There is a risk to whom? Equity shareholders. There is no risk to debenture providers. Only risk to whom? Only, I used the word, only to whom? Equity shareholders, but there is no risk to whom? Debenture holders. And KD is less than KE. Capital employed remain constant. KO remain constant because whatever the KE, you are rising KD, you are very, very happy. You see here the diagram. What is the point is, when KO is there at 20%, KD is available at 10%. If the company is KE, if you raise the debt, right? If you raise the debt, when you raise the debt, automatically KE what happen? Increases. So here it is increasing. Here plus, here minus. Plus again. So both would makes what is it? Set off. With effect, KO remain constant. KO remain constant means market value of firm will remain constant. In this point, what you have to prove means, in this theory, you have to prove that KO constant. Why KO constant? Even debt is coming. KE is what? Increasing. Because it is increasing, whatever the benefit you are getting by debt, what? It making set off. So for that purpose, first what you have to do? First market value of firm you calculate. Because KO remain constant. So EBIT divided by KO. Market value of debt equal to interest divided by KD. Market value of equity. Because your job is to prove that KE what happened? Increases. For that purpose, market value of equity you calculate. How do you calculate market value of equity? Market value of firm minus market value of debt. Then you have to calculate cost of equity. Your ultimate attention is what? KE. What is that? KE is going to increase. That is your strategy. Sir, actually KO decrease, sir. KO won't decrease. KO remain constant. Why constant, sir? You are raising debt, KE increase. Because KE increased, advantage of debt would be exactly set off. That is a David Durant's second theory also. You remember like this. It is the set off theory. What is it? Set off theory. For this, the strategy, what you have to follow? FDE for KE. You have to prove that KE is going to increase. To calculate KE, first you have to calculate what? Market value of firm. Then calculate market value of debt. F minus D karo. You will get E. Then you can calculate KE. KE equal to earning availability to equity shareholders divided by market value of equity. Earning availability to equity shareholders divided by market value of equity. Maji. KE formula what, Maji? Earning availability to equity shareholders. Can I write like this? EBIT minus divided by market value of equity. How should I get market value of equity? First market value of firm calculate. I want market value of equity. Then find it out market value of debt. I want market value of equity. ఇప్పుడు వస్తుందిరా ఎలా వస్తుంది? Market value of firm minus market value of debt. Okay, ma? Right. This is the theory suggested by who? David Durant. What about the next theory is nothing but third theory is traditional theory. Traditional theory. This theory was suggested by the Pawan Kalyan ji. Isro Solomon, he is young and energetic boy. Okay. Isro Solomon, he is a balancer. He resolved the contradiction between, what is it? Net income theory, net operating income theory. In simple line, what this argument is that, you see, this model was suggested by who? Isro Solomon. According to this model, a company can decrease what? A company can decrease its KO and increases market value of firm by employing least cost fund called debt, but up to certain point. Up to certain point. Okay. Beyond that level, what will happen? Beyond that level, additional debt increases not only KD but also KE. When KED increases, KE increases. With effect, what? KO increases. And KO increases means market value of firm decreases due to increase of KO. So that's why debt would be best. That's why have a limit. You raise the debt up to certain level. Beyond that, it become costliest, it will become riskiest, finally turns worst. That's why debt is not a best as per David Durant first theory. Debt is not just as per David Durant second theory. No. Debt is best up to certain level. Beyond that, it would be worst. So in this model, what we have to calculate means, so here debt is best up to certain level. Thereafter, it becomes, what is it? Costliest and riskiest, thus it is finally turns. Sir, how should I identify that a capital structure would be, what is that, best or worst means? What you have to identify, you have to analyze that various sources. Here you see the traditional theory, what the point is. Here the company has a various plans. How many plans? Various plans. What the plan one is, you try to understand. In the plan, company wants to go with a 0% what? Debt. 0% debt means equity 100%. Plan 2, this is the first option. Second option, 20% debt, 80% equity. 40% debt, 60%. 60%, 40%. 80%, 20. Total 100. So that means they have a multiple plans. Each plan is gradually giving a base to increase what? Debt. So now David Durant, this is the investor who went asked whom? Isro Solomon, that which combination would be the best. Then immediately said that, Arey, you calculate KO, you know that as KO decreases, market value of firm increases. You check it in which combination KO would be very, very low. You find it out that KO. So if you are able to catch that KO, market value automatically increases. For that purpose, you see, he identified KO estimation. Since it moves 100% equity, so KE equal to KO na? What about this plan? What about here? This is the only model they asked 5 marks. I told you, no? Are you getting ra? Only model asked 5 marks. Remaining 2 models, just they asked the MCQs. In which plan KE remain constant? Tell me. Net? That is one of the MCQ question. In which plan KO remain constant? In which plan KD remain constant? Sir, net income theory KD remain constant. Net operating income theory KD remain constant. But no. In which plan KD not constant? Traditional. These are the questions completely covered. Only 2 questions is there. MM theory I will cover. Are you getting? Now you have to calculate weighted average cost. Weighted average cost formula maji. Forgotten na? WCC. KE into equity share capital divided by total capital employed plus KD into debt capital divided by total capital employed. Now you calculate here how much it is. Your KE how much percentage? 16% into 80 divided by 100 plus 6% into 20 divided by 100. Anybody? 14%. What about second one? Anybody? 13.6%. Anybody next? 15.2. Anybody next? 19%. Now tell me which combination would be the best. Doing 100% equity is not a right. But the thing is, up to certain. How much it is? How much? No. This is the best. Which one? 40% what? Debt and 60%. So more than this is not a right, less than this is not a right. So this is the theory suggested by who? Isra Solomon. And finally, the another theory we identify, most important point is the young boys who identified this theory is who? Modigliani and Miller theory. These are that young kids, great people, Franco Modigliani, Merton H. Miller. They proposed, this is the relevant theory or irrelevant theory? Irrelevant theory. What is that? Irrelevant theory. Now come to this point is Modigliani Miller theory. These are two versions. What is that? Without tax. Remember, one without tax means it's not a MM theory. It is what theory? Net operating income theory. See, Modigliani Miller approach is a refinement of which theory? Net operating income theory. MM approach is an relevant model, not relevant. What is that? Irrelevant model. It argues that debt equity does not change what? KO and market value of firm. But market value of firm is affected with what? Business risk. Because of business risk it may changes. Because of debt equity it won't changes. So NOI is a irrelevant model which could not consider behavioral significance of whom? Investor and operational justification. Simply, man, you try to understand. Modigliani Miller theory believed net operating income theory when there was no tax, because his argument is, MM theory argument is that net operating income argument is that debt equity mix of the company always remain constant because of set off effect. But Modigliani Miller argument is that debt equity mix of the company does not change KO and market value of firm. They may remain same. They are same. Which theory? Net operating income theory. MM theory argument that they may same. If not same, they will set to be same. Finally same. If you can't understand, it is a shame. Okay? Once again tell me. Debt equity mix of the company does not change KO and market value firm will remain constant. Because of set off effect, market value of firm will remain constant. This is the argument of whom? Net up. But MM said, yes, that is okay. If not same means again they will set to be same. That means indirectly MM theory argument is they may same, but sometimes it may not same, but they will finally become because of whose behavior? Investor behavioral approach. What is that? Investor behavioral approach. If they are not same means one firm would be high, another firm would be low, then automatically investor behavior changes. Immediately he will take, what is that? Arbitrage. Arbitrage he takes means from highest market value to, what is that? Lowest market value he will move. You try to understand. I want to convey. David Durant, NOI approach is conveyed. Yes or no? NOI approach. What is this said that as a debt will increase risk element to whom? Equity shows up. With effect KO remain constant. Market value of firm will remain constant. This is whose theory? Net operating income approach. This theory also proved by who? Modigliani and Miller approach. These argument also this. Debt will increase, what is that? KE and market value firm will remain same. If not same, if again said to be same. Because of what? If the investor undertakes, what is that? Arbitrage process. If the two companies are there, if both the companies are same because of set off effect, because of business risk, market information, people start to buy, people start to sell the company shares. With effect, the market value gets what? Fluctuated. Hello? So whenever the market value, one firm increases, another firm decreases, investor moves from highest market value to lowest market value. He will start to sell this company shares and take the money. He will move to lowest market value because he want to earn two conditions. Same investment, more profit. What is that? Same investment, more profit. Second option, less investment, same profit. Because by moving from here to here, he may consider, is there any benefit for me? Because his behavior automatically changes because of considering all these things. That's why he will start to sell and he will start to buy. When he buys, automatically its market value will increase. When he sells, automatically its market value decreases. At one point of time, both the company's market value will remain same, right? So MM theory argument is two versions. Without tax, with tax. Without tax means indirectly 99% it is similar to which theory? Net operating. But when tax is there, the situation is completely different. When tax is there, MM model oriented, similar to MM model is amendment of which theory? Net operating income. Again, this theory was amended in when? 1963. MCQ question. Tax. MM model ignore tax in when? 1951. He amended tax in which year? 1963. And he gets that what? A levered firm, whenever tax is there, which firm get advantage? Unlevered firm gets advantage. Levered firm gets tax advantage. Levered firm gets tax advantage. That is the reason its market value would be high. Which firm market value would be low? Why? Because it won't get what? అని నేను అనుకుంటున్నా. అలాగే sometimes what happen, levered firm would be low, unlevered firm would be high. Because I buy unlevered firm. Because why you are buying? Because no risk. Are you getting? My behavior may changes. In one point of time, levered firm seems to be very good. Because I think what? Tax advantage on it. Another time, unlevered firm looks very attractive. Because of no risk. This is everything my behavior. You see in study medal, two problems are there. One firm, one problem, market value of unlevered should be high. Another problem, market value of levered should be high. What is this? Because it's behavior of whom? Investor. But finally, they will said to be same. Why? Because investor undertakes arbitrage. So in this problem, they asked 5 marks question. MM theory 5 marks question. How do you calculate market value of firm according to MM? This is the only question they asked over the period. What is that? Market. How do you calculate market value of firm according to what is that? MM. This is the point you have to learn at any cost. Market value of which company? Unlevered company. Levered company you have to calculate. When there is a tax. For that purpose, you have to follow what is that? CA rule. What rule? CA rule. Calculate one, adjust another one. So for that purpose, what you have to do means, first market value of what firm you have to calculate? Unlevered firm you have to calculate. Market value of unlevered firm equal to equity only, market value of equity only, no? For that EBIT minus interest is 0 into 1 minus tax. If you make a KE, you will get what? Market value of unlevered firm. Then market value of levered firm you have to calculate. Market value of levered firm, how do you get it? Market value of unlevered firm plus tax benefit on debt. How do you get the tax benefit on debt? Means debt into tax rate. So this is the most important point to be considered with respect to Modigliani Miller. So here investor, why market value firm will becomes equal? What the process? What makes? Because of what? Because of investor undertakes what? Arbitrage. What is arbitrage? Arbitrage is a mechanism where investor by selling security at high market value firm and buys securities at a lowest market value firm. Casually he will buy a intention he has a intention. What is the intention you have? Number 1, same investment, more profit. Another one, less investment, same profit. Your institute only this point is covered. Okay. But how do you calculate market value of firm? Market value of firm, how do you calculate? There is a 2 types. What is that? First, in the absence of tax. In the absence of tax, which firm you have to calculate? Unlevered. Unlevered means what? 100% equity. Levered means what? Equity and debt. So whereas in the presence of tax, what you have to do? You have to calculate market value of which one? Unlevered firm. How do you calculate levered firm? Tell me. You should do this, right? Market value of levered firm equal to market value of unlevered firm plus market value of tax shield. How do you get the tax shield on debt? Debt into tax rate. Okay. This is the problem. You have to keep it in mind, ma. This theory is just enough for you to solve the problem. Okay. So that is the most important points. And here, you got it? Yeah, here this is the most points, but coming to all the problems by considering here, these are the points you have to consider with respect to this. This is everything. These points you keep it in mind for the coming exam. What are they? Key points. Can you answer all these questions? What is a capital structure? What is a financial structure? What is the EBIT, EPS analysis? It is one of the analysis to find optimum capital structure, where we will find what? EBIT, and we take EPS. Okay? Various weights to estimation of EBIT. Sales minus variable cost. Then, yeah, thereafter, return on capital employed base also you can calculate. Various ways to estimation of EPS. Earning availability equity shares divided by number of equity shares. PE ratio base also you can calculate. EBIT, how do you calculate? Market price divided by PE ratio. How should identify risk element on equity shares? Cost of equity. Yesterday, while rising on debt, automatically what will increase? What will increase? In cost of weighted average cost of capital estimation, when company rises more debt, in such a case what will happen? Dividend may risk increase, that risk would be, I showed 2 ways, 3 ways. One is, what is that? Dividend may increase, growth rate may increase, market price may decrease. Risk impact of debenture holders. When equity debenture holders feels risk, automatically coupon rate what happen? Increases. Financial break-even point means what? It is a level of EBIT at which EPS remain same as 0 0. Indifference point means what? Same. Okay. Only I covered 2 problems and explained, right? Theory point is just you have to go with this, because major analysis they've been asking from what? EBIT, EPS analysis, EBIT market price analysis, indifference point analysis, financial break-even point analysis. All the assumptions of capital structure theories. All the assumptions. What are all the assumptions? 2 sources of funds. KD is less than KE. No preference. Capital employed remain constant. No tax. No flotation cost. Perpetual existency. Then there is a guarantee of what? EBIT. Got it, ma? Then each theory, who proposed? Net income theory. David Durant. What he proposed? Debt best. What are the assumptions? There is no risk to whom? Equity shareholders, debenture holders. Right? And what is the formula? This formula indirectly proves that KO should decrease. Hello? KO decreases means what you have to prove? Market value of firm will increase. Yes or no? KO remain constant. KO decreases in NI theory. KO decreases, right? Next, what about net operating income theory? Debt is just. Who proposed? David Durant. What's you are going to prove? KE increases. So what will happen? Because KE increase, it set off with KD. With effect, KO remain constant. Market value of firm will remain constant. Right? What is the traditional theory? Suggested by Israel Solomon. What you are going? Just debt best up to certain level. Beyond that, it would be worst. So who proposed this theory? Well, you know that. What you are going to prove? As a debt composition, each additional debt composition you have to calculate KO. Hello? In which combination KO would be low, you have to select and you have to pick that combination, right? Theory. Theory 2 versions. 1951, no taxes. 1963, tax. When there is no tax, then theory is 100% similar to net operating income theory. Simple logic of theory. Theory is a refinement of which theory? Net operating income theory. Argument is very simple. Debt is not a best, debt is not a worst, debt is just, it is a net operating. A company cannot increase its market value, reduce its KO market value because KO remain constant because of set off effect. theory said that market value may remain constant. If not, they will set to be same. Because investor behavior forces to take arbitrage. Because of arbitrage, he moves from highest market value to lowest market value. With effect, lowest market value increases, highest market value decreases at one point of time. both firm will reach same. Okay. What do you mean by levered firm? What is unlevered firm? How do you calculate tax benefit on debt? How do you compute market value of firm? Market value of firm according to NI approach. According to NI approach. KO won't change, That's why you have to calculate market value of debt. You calculate market value of equity. You have to add both. How do you calculate market value in net operating income theory? KO remain constant kada. EBIT divided by KO. Yes or no? According to MM theory without tax, similar. MM theory tax is there means market value of unlevered firm plus. What do you mean by if you don't know capital structure, if you raise a capital structure, automatically it may fall into overcapitalization. More than required. Whenever more than required, it is called what? Overcapitalization. Undercapitalization. Less than required. What is debt equity ratio? What is the PE ratio? What do you mean by identical firms? Similar firms. Similar firms, can you tell me the characteristics? Same business, same capital employed, same EBIT, same risk class. But the difference is capital structure. What is arbitrage? Arbitrage is a process where investor moves from highest market value to lowest market value by expecting any benefit or no benefit? Benefit. What is that? Same investment, more profit, less investment. Yeah. Then what is optimum capital structure? Optimum capital structure means this is the best equity combination, sir, where company raises debt and equity in such a way. What is that? In such a way, what happens? Either EPS may increase, market value may decrease, overall cost EPS may increase, market value firm may increase, overall cost of capital may decrease. What is EBIT? Market price analysis. Sir, it is also one of the analysis where we used to calculate what? Market price. Hello? Market price. Very, very important, this one. When the firms are identical. Identical means what the identical? Just now I told you. Because same capital employed, same EBIT. Okay. How do you calculate rate of preference dividend? Formula is what? MCQ question they asked. Preference dividend divided by preference share capital. Market value of equity. Several times they asked. Formula. Earning availability equity shareholders divided by KE. Market value of firm. EBIT divided by KO you can take. Market value of debt plus. Yeah. What do you mean by set off effect? Set off effect means advantage of debt would be risk element. Why debt is cheaper than equity? Low flotation cost, low coupon rate, there is a tax advantage. What are the additional assumptions of MM theory? Means MM theory whenever he moves for it where? Highest to lowest means there is no any restrictions. Yes or no? Investor is a free to move. Investor is free to buy, free to sell the security. There is no restrictions. And he is an intelligent investor. He must take a risk because he is moving from where to where? Highest to lowest. There is no restrictions. Yes or no? So whenever he needed temporary loans means he should able to identify this also. And finally, when investor moves from means there is no tax on the gain what he will make. Okay, that is the point. So with this, our chapter gets finished. Right, ma? Yeah. This 31 questions is the summary for asking one question. One question. From past 10 years, whatever the points he asked, I summarize this one. Only they are asking two problems. EBIT, EPS analysis, indifference point analysis. The two problems we discussed. And MM theory, market value calculation is maximum they are asking. Okay, ma? The purpose of this chapter is a financial manager says, hey, my company gross profit is good. My company's net profit is very good. There is no risk in my company. If someone tells like this, okay, what he says? Hey, my company's net profit is very good. My company gross profit is good. My company's net profit is very good. There is no risk to in my company. Then you have to identify, Have you checked your fixed cost? Have you checked the interest? Have you checked the preference dividend? If your company, okay, have you checked your fixed cost? Have you checked your interest? If preference dividend you checked, if 1%, if you are in your company, 1% sales decreases by 1%, then your business should be. So indirectly, this is what analysis? Leverage analysis. That's enough theory. So we identify risk element of the company by studying his income statement, by considering what are they? Fixed cost, interest, and preference dividend. We are going to tell how the warning is Chandramukhi giving to this financial manager. We used to say, the people will come with the shoot, right? Then we used to say, अरे तेरा business तो क्या हो जाएगा? Because of this element. So here to identify the risk element means you should able to find it out the given costs. What are they? Interest, fixed cost, and preference dividend. Because of all these things, how much risk the company is supposed to possess, right? That is called, what is it? What analysis? Leverage analysis. Leverage analysis, total illustration 5. Total illustration 5, MCQ 17, theory 3 questions. Practical is a 12 marks. But out of this 12 questions, maximum 60% is a dead easy. Because all the 60% of questions, they have given, what is that? Left to right direction. That is nothing but they will give you leverages. They will give you income statement. You have to calculate leverages. Last 3-4% is there, no? That is a right to left. What is it? They used to give leverages. You have to construct income statement. Last concept is nothing but this miscellaneous divided by 2. Some income statement is possible, leverages is possible. So you have to identify all these things. So simply leverages is nothing but what you have to identify by analyzing an income statement of the company. What you have to find it out? Fixed cost, interest, preference dividend. Because of this, if the company sales are little bit down, how much risk the company is going to suffer? That risk we used to measure, and finally we used to say that run your company with a moderate risk. What is that moderate risk? Now tell me, the simple fact is that every financial manager ultimate job is to what? Nothing but wealth maximization. Do you agree? Wealth to be maximized. Good. Wealth to be maximized means profit has to, you have to make more. Good. Profit you want to make more means, you know the fundamental rule, profit is reward of what taking? Risk taking. When you want to increase the profit means you must ready to take risk. Risk to means that you should able to handle the risk. For that purpose, it is only possible once you make what analysis? Risk analysis of the company. Hello, how much risk is there? Because of by managing risk only you supposed to generate the return. Because you are financial manager, you have to take a decisions, you have to make a policies. Everything is possible only with respect to that risk. If you are able to handle more risk, automatically your return also increases. So that's why when return increases, wealth of the company, what happen? Increases. This is the simple line. Wealth to be maximized, profit to be earned more. Profit is reward of risk taking. That's why risk must be analyzed in order to take or manage the risk. Before manage, first analyze how much risk is there. When you don't know risk, right? How do you take a risk, man? That is the point. Okay, here what is the risk associated with the company? You see, the point is very simple. The word leverage represents, what is it? Here the word leverage represents, what is that, ma? Risk associated with the company having fixed financial commitments. So what are the fixed financial commitments we used to consider? Fixed financial commitments means here you have, just now I discussed, what is it? Interest is a commitment. Preference dividend is a commitment. This is the financial commitments. So there is one more commitment is there. While running a company, you have what cost? Fixed cost. So this 3 will make you the difficult. So fixed financial commitment. Risk means what actually? Uncertainty of return. Risk means what? Uncertainty of return. So even financial manager job is to, what is actually financial manager job? To take what decision? To take productive decision with respect to income making. And another one is to make what is that? Policies in order to make the more income. To analyze a risk element of the company, either you take a decision, make a policies, wealth of the company should be, what is that? Maximized. In order to maximize that one, how much risk you have to take, you have to determine. But as risk increases, return also increases. So that's why when you want to increase the return, risk you has to increase. So this is, in order to take that one, you have to make what analysis? Leverage analysis. So simply, if you understand this company, let us take leverage analysis of the company. What we are going to study in the entire the institute material? Nothing but there is a company, ABC Limited. We are going to study risk analysis. What we are going to study? First of all, we will identify what are the fixed commitments of the company. Generally, by observing what account? Trading and profit and loss account and balance sheet. By observing these two, we will identify fixed financial commitments of the company. Are you getting? So first you have to understand the income statement of the company. From the income statement of the company, you have to study what? Fixed financial commitments. What are the fixed financial commitments? Nothing but fixed costs, sir. What are the fixed costs? Again, deep into the analysis. First, operating fixed cost. What is that? Operating fixed cost. Operating fixed cost means, in order to run a company, what are the various fixed costs you supposed to pay? Rent, salary, commission, wages. All these are what? Operating fixed cost, right? Either you make a revenue or not to make a revenue, go to hell, you have to pay what? All this cost. Okay, so this is the your income statement indirectly conveying to us. And thereafter we check the balance sheet. Even the balance sheet in liability side, you have a debtor, you have a preference dividend. Oh my god, debt is there means you have to pay what? Interest. Preference dividend means you have to pay preference dividend. Here interest is, rent is there, salary is there, commission, all this fixed cost is there. Along with this, interest and preference dividend is there. All are what is that? Fixed financial commitments. If sales increases or decreases, this won't change. They will stand like a China wall. Okay. So in such a situation, what will happen by chance if the sales of the company imbalances? What is that? If the imbalances, if the company lose its balance, company balance sheet chinigipodante. Okay, IP finished ante. Gaya. Within 3 months, right, company would be gone because you have that much of fixed cost. Are you getting? So this is the, we are going to identify. For that purpose, you have to study what? Because the strategy is nothing but ILA. First of all, you should be able to find it out income statement. Without knowing income statement, you cannot make an identity. If someone has to tell my future, they have to see this. Dhanareka, what sir? Dhanareka, sir? Shut up. If my Dhanareka is that much, why should I be high here? Yes or no? Yeah. So first of all, you should identify income statement of the company. What is the income statement of the company? You check here, income statement. Sales revenue you have to take. Generally income statement, right? In the profit and loss account, whatever is there, this income statement we will adjust for the sake of analysis. So as per not accounting standard we are making, for the sake of risk element assessment, we will readjust and we will prepare income statement for the sake of only what? Analysis. For this purpose, I will take sales. Less what I will deduct? Variable cost, which is also known as control cost. It is controllable cost. Sales minus variable cost, gone. Contribution. Less what cost? Fixed cost. Fixed cost is there means leverage is there, risk. Because risk is there. From the fixed cost, if you deduct, what is that? EBIT. EBIT is nothing but operating profit. So operating profit is there, company will take oxygen. The company will take. How? Why this much of extra? Extra, man. Because I overcome what? My variable cost, my fixed cost. When you cross this fixed cost, survived. But only variable cost gone. But you don't have a money to handle, what is that? Fixed cost. You have to keep oxygen. Again, not there. Because fixed cost is too much. Call ambulance. Okay? That means you try to understand your operating profit struggles a lot because of, what is that? Fixed cost. Because sales always fluctuates. What about the fixed cost? Without crossing fixed cost, your company cannot run to show what is that operating profit. That's why fixed cost is there. Interest you got it. From that, again, what do you pay? Less interest. Interest also one of the financial fixed cost, right? So financial fixed cost, then you used to get what is that? EBT. So EBT is nothing but whose income? Shareholders' income. Because the reason we know that there is no preference shares. Hello? Generally there is no preference shares. So there are only two sources of funds. What are they? Yeah. So equity is nothing but for the analysis point of view, how much the impact on equity would be there, same impact on EPS. Reason is this EBT, from that EBT used to pay what? Tax. Tax is a commitment to you. Leverage point of view. Tax is a commitment. No commitment. When you make a profit, then you will pay. Sir, actually equity shareholders income means from the EBT we have to pay tax and preference dividend, everything, sir. Yes, absolutely. We are not preparing the statement, man. We are analyzing what? Statement. Are I call in charge? Go on call. So EAT less preference dividend. So earning availability to equity shareholders. Are you getting my point? So dear students, from the EBT you will pay what? Tax. Tax is not a commitment to us. In such a case, EBT is equal to what is that? EAT. Preference dividend is nowhere in the market. That's why EAT is equal to earning availability equity shareholders. It is an aggregate income. EPS is a specific income. That means EBT indirectly conveys what? EPS. That means how much percentage change would be there in EBT? I repeat, how much percentage change would be in EBT? Same percentage change you will also find where? EPS also. So that's why indirectly what it conveys, because of fixed cost, because of interest, right? How much risk associated with the company we are going to study. Sometimes what happens, we will add this both and we will find it out the total, that is called total leverage. Total leverage or what leverage? Combined leverage. So here, first you should understand the summary. So what happened, every company, this is a company, this company sales always gets fluctuated. So what I'm going to study, after studying this entire income statement, my observation is this. In this company, suppose sales gets fluctuated. Okay? Sales gets fluctuated. What would be the impact on company's operating income? Operating income. Whether the company is going to survive or not. Sir, why can't it survive, sir? Because it has what? Lot of what cost? Fixed cost, man. So if the fixed cost is there, company able to earn more sales, because of the fixed cost, company EBIT will increase. By chance company sales decrease, because of this, company EBIT drastically decrease. So if the analyzing sales and EBIT, observing sales and EBIT by analyzing which one? Fixed cost. I repeat, observing what? Sales and EBIT by analyzing what? Fixed cost. If fixed cost, because of fixed cost, if sales changes, what would be the impact on EBIT? I can learn with one leverage is called what leverage? Operating leverage. Thereafter, again I will make analysis because of change in what? This EBIT, what would be the impact on either EBIT, EPS? See, how much percentage EBIT changes, same percentage change in EPS also. That's why both reflects what? Same impact. So because of what leverage? Financial leverage. Financial leverage arises because of interest. Now we will take both. What is it? Sales, and if sales changes, directly impact on EPS is how much? Because of what leverage? Combined leverage. Combined leverage considers what is it? Fixed cost and interest also. Are you getting? This is the two observation. Coming to what is operating leverage? Simple. For a operating leverage, they asked 5 marks. MCQs also they given. Operating leverage arises because of what? MCQ question. It is the leverage arises because of what? Fixed cost. It is also known as what? Operating risk. It is also known as unavoidable leverage. What is that? Unavoidable. Why? Because there are certain costs you must incur in the form of what? Fixed cost only. You don't have any other alternative, my boss. Are you getting? Certainly you have to pay certain fixed cost, right? So here, what is the observation? MCQ question asked. No fixed cost, no operating leverage. Low fixed cost, low operating leverage, right? So this is calculation. How do you calculate? If one income statement is given, operating leverage can be calculated. Contribution divided by EBIT. If two income statement is given, what it speaks? Percentage of change in EBIT, percentage of change in sales. You remember, both formulas gives you same answer. What is that? Same answer, divided by contribution divided by EBIT equal to 4. This 4 would be applicable. With this also you can calculate, and with this, whatever it may be, this would be formula you should use when what? 2 income statement is given. This formula you would use 1 income statement is given. But for the verification to one another, both will gives you what is that? Same. Because operating leverage arises because of fixed cost. Tell me operating leverage formula. Contribution, right? Okay, let me have that dialogue. Contribution, how do you get? I repeat. I will ask you, leverage is after the chapter of cost of capital, capital structure, capital budgeting. Yes or no? You know, whatever the information, what I observed from this material, you know, whatever the theoretical information they given, you know, from leverages, he could not ask from that theory. Theory he picked up from capital budgeting. Hello? You know, variable cost ratio. Variable cost ratio we discussed in where? Capital budgeting. From there he identified this one. Now tell me, if I ask contribution, what you used to say? Sales minus variable cost. 90% such a model they never give you. They will give you what ratio? PV ratio. PV ratio is what ratio, sir? Contribution ratio. What is hell is you doing? Why should I give? Why you are giving a PV ratio? My dear idiot, PV ratio 30% means contribution ratio. Sorry, PV ratio 30% means contribution ratio 30%. 70% is variable cost ratio. Why should I? How should I get variable cost, sir? Go to sales, multiply with what? Variable cost ratio. Are you getting? He will ask you to take a food, but not this way. తిప్పుతాడు అలాగే నేర్చుకున్నాం అనుకో తల తిరుగుద్ది అర్థమవుతుందా he never give you what is that spoon feeding. He will make you complete analysis. Now contribution equal to sales minus variable cost, top to bottom analysis. Ignore that one. From my observation, bottom to top analysis. What is it? Contribution less what cost? Fixed cost. Fixed cost equal to EBIT. There is a problem in your material. Out of this problem, contribution, how do you calculate? EBIT plus fixed cost. Are you getting, ma? Yeah, this is the one observation. You can find it out. So contribution divided by EBIT. EBIT, how do you calculate, Maji? EBIT, how do you calculate? Sir, EBIT, yeah. Contribution minus fixed cost equal to EBIT, yeah. Don't expect. You can expect. Don't expect. You can expect from capital structure. Capital structure. Return on capital employed, there is a problem. Return on capital employed formula, what is that? EBIT divided by capital employed. Where EBIT equal to? Yes, capital employed into return on investment. Make analysis, Ray. This is chapter itself is what? Analysis. What directly? This is the income statement. Tell me contribution 10 marks. Sales 1 lakh. Variable cost 50,000. So 1 lakh minus 50,000. How much? Take 10 marks. Become a CA. Champa Baguluddi. Never expect. He will make a small twist in this, right? That is a contribution mark, right? Then what is that used to calculate? Another leverage is, what is that? Financial leverage. By considering all these things, I will explain one formula, right? Yeah, financial leverage. What is a financial leverage? Financial leverage, it is the risk associated with the company having what cost? Here, financial leverage. Financial leverage, you try to understand, this is what an avoidable leverage. What is it? Avoidable leverage. Why avoidable leverage, Balu sir? Very good. There is a source, Inora, for you what? Equity. You can go with 100% equity, right? So this is avoidable leverage. It is happens because of what decision? FD. FD means financial decisions taken by the company. Yes or no? So when company takes financial decision, that too when company wants to raise what? Additional funds by debt, then only it will comes under the point, right? So it is avoidable leverage. It is happens because of financial decision. It is also known as financial risk. What is it? Financial risk. So sometimes financial leverage may be favorable. There is a MCQ question. Sometimes financial leverage is unfavorable. MCQ question covered. What is it? When financial leverage is favorable? A company raising a debt at a 10% interest. Right, stand up. And company raising, wait. And company raising debt at 10%. 10% is the interest. Whatever the funds you are raising, you are investing, your return on capital employed is at 25%. Now tell me, is it favorable, unfavorable? Favorable. Same question, question number 5, they asked this point. And there is a chance to convert into MCQs also. When the financial leverage is favorable, when the financial leverage is unfavorable, when the company taking a debt, a client is coming to your office means, if it is a favorable means he never comes to your office. Are you getting? He will think that something is wrong. It seems to be unfavorable. Then only they will come to your office. Keep it in mind. So it arises because of what decision? Financial decision. MCQ question. Right? When company raises funds by fixed cost oriented funds. What is that? Fixed cost oriented funds. What are the fixed cost oriented funds? Debt. But there is a contradiction. You may take what? Preference. But only one point they given, that if condition. Actually we do know that there is no preference dividend, sir. By chance preference dividend is there means, how do we calculate what? Financial leverage, sir. They asked. Yes. Here, how do you calculate financial leverage means? Financial leverage equal to EBIT divided by EBT. Financial leverage also can be estimated like this. What? Percentage of change in EPS, percentage of change in EBT. MCQ question. Percentage of change in EBT, percentage of change in EPS, both are same. Both are same. Percentage point. I repeat, EPS is not equal to EBT, but percentage change in EPS, percentage of change in EBT, what is that? Both are same. If EBT changes 10%, automatically you can guess what? EPS also 10%. That's enough. You blindly understand, right? This is the point. So percentage change in EPS or percentage of change in EBT or percentage of change in earning availability, equity shares, all will change in the same percentage. MCQ question, get ready. If you have any doubt, you can prove it. Okay? If take 10%, make it everything is a 10%. EBIT, how much it changes? Earning availability, equity shares also changes same way. EPS also changes same way. And percentage of change in EBIT. And this is the what leverage? Financial leverage. A company has how many leverages? Only 2 actually. But for the sake of impact, we used to take one more leverage. What leverage? Combined leverage. It is also known as, what is that? Total leverage, right? It considers both risk element in connection with fixed operating cost, fixed financing cost, right? Combined leverage can be calculated like this. Operating leverage into financial leverage. When operating leverage into financial leverage means, operating leverage formula is what? Contribution divided by EBIT. Financial leverage formula what? EBIT divided by EBT. EBIT get cancelled. In such a case, contribution divided by EBT would be possible. Whereas combined leverage formula, combined, you can also write operating leverage equal to percentage of change in EBIT divided by percentage of change in sales. So percentage of change in EPS divided by percentage of change in EBIT. This is what leverage? Financial leverage. Hello ma? So EBIT get cancelled. Then what you will get? Percentage change in EPS divided by percentage change in sales. So you will get this one. This is in times based. Okay. So that is the leverages point of view with respect to a corporate company. Yeah. If now tell me, what is the leverage indirectly conveys? Simple word. Leverage is nothing but what? Risk associated with the company having, what is that? Fixed financial commitment. Can you tell me fixed financial commitments, please? Yeah, one is, what is that? Fixed cost. Another one, fixed financing cost. What is the fixed financing cost? Interest. Another one is preference dividend. So what are the types of leverages? Leverages being classified into 3 types. Operating leverage, financial leverage. Actually, operating leverage, financial leverage. For the sake of analysis, what we do, we add both and we declare, what is that? Combined leverage. Operating leverage arises because of what cost? Fixed cost. It is also known as avoidable or unavoidable? Unavoidable. Yes. Unavoidable leverage. Okay. So every company in the market, whomever they are performing, certainly they have to face, what is that? Operating leverage. What relationship it shows? It takes sales into EBIT. Because of what cost? Fixed cost. You can find operating leverage. So formula, just now I told you. What about the interpretation? Interpretation. Fixed cost is high. Operating leverage is high. Fixed cost is low. Operating leverage is low. Fixed cost is no. Operating leverage also No. Okay. That is, what about the financial leverage? It arises because of what decision? Yeah, financial decision. It is also known as avoidable. Avoidable because you have equity. So financial leverage formula EBIT divided by EBT. You can also convey this formula percentage in change in EPS or EBT or earning availability to equity shows. Sir, how this is going to same, sir? I'm saying not same, ra. I'm speaking about what? Percentage of influence. EPS how much changes? EBT also changes. EAT all will reflect what is same. So once you know the EBT percentage, no need to expect what? Earning availability equity shows percentage. Sometimes they will ask you what is the percentage of EPS from the income statement means. Tuck, tuck, tuck. Calculate up to EBT. Stop. Hello? Because once you got what? EBT means already you know what? EPS percentage. Because till if you are going on calculating EPS means Gaya. Okay? Right. So interpretation, now tell me, interest is high. Financial leverage also high. Are you getting ma? Combined leverage, also known as what leverage? Total leverage. It considers, what is it considers? Fixed cost, preference dividend, and what is that? Interest. Okay? A company's risk means what is the risk? You know, what risk? If a company risk means not operating leverage, not financial leverage, boss. It is what leverage? Combined leverage, right? That is the identity. So you see only one problem repeatedly asked. How many questions? How many marks to state? New study material, old study material, practical problem. Added some point. November 2018, 98%. July, 98%. And the same problem also covered in our MM material, but we have added few points. E point is not there. But only D point also is not there. Only operating leverage, financial leverage, combined leverage is given. But you know, in this problem, what is that? Here, is there income statement is directly given? Not given. But this problem is very, very important. Why this problem very, very important means, in the problem, variable cost ratio is given. Directly not given what cost? Variable cost. So with the variable cost ratio, you have to calculate what cost? Variable cost. Okay. Asset turnover ratio. Basing on asset turnover ratio, you calculate what? Sales. Hello? Sales you have to calculate. With the support of break-even point, you have to calculate what? Fixed cost. Fixed cost is given, you know, sir. Fixed cost direct. He never gives you. He will ask you that, array, income statement first analyze and then create leverage. Sir, sales. I don't have sales here. Go to hell, find it out. Sir, variable cost. I don't have variable cost. Variable cost ratio is given, you know. Have a knowledge to find it out variable cost by using variable cost ratio. Contribution I will get. Fixed cost, sir. I given a break-even point. From that, able to find it out fixed cost. So this is the observation of this. Are you getting my emoji? Yeah. Now you have to find it out. What is that? You can, I will first, in the problem, you try to understand. Problem, this is, you see, in the problem, what is this problem is, Maji, equity share capital. Financial leverage is there? Equity share capital. No financial leverage. Reserves, ma? No financial leverage. Debentures? Yes. Undi. Hey. 10. How much? 10 lakhs into 15% means 1.5 lakhs you have to pay irrespective of your stupid theoretical opinions. Current liability. Balu sir, leverage. I will tell you one more shortcut. For leverage, current liability don't take. Tax is not at all commitment. Leverage, tax never be a commitment to you. Current liability not commitment to you. Fixed assets 12.5. Current assets 7.5. Total is how much? 20. Now what you have to do means, dear students, here break-even point is 10 crores. You know break-even point? Break-even point or break-even sales is nothing but 10 crores means, dear student, understand, at this 10 crores, your profit is how much? 0. Profit is 0 means variable cost equal to variable cost plus fixed cost equal to 10 crores, you know. What? Variable cost plus fixed cost equal to 10 crores. Okay, in such a case, break-even sales equal to variable cost plus fixed cost equal to 10 crores. That would be the reason profit is 0. If variable cost comes here, in such a case, BEP sales minus variable cost equal to fixed cost. That means any Variable cost is deducted from the sales means it will get contribution. Hello. Then BEP sales minus variable cost is nothing but BEP contribution. BEP contribution equal to fixed cost. So what to do, sir? Arey, bacha, variable cost ratio 65% means contribution ratio how much? 35%. When this contribution ratio, by taking this contribution ratio, multiply with what? BEP sales, directly you will come to what? BEP contribution, which is equal to fixed cost. Agaya na? So this is the fixed cost, you got it. Okay. Then, okay, sir, in income statement, where is sales, sir? Sales, sir? Wait. Asset turnover ratio, how much it is? 2.5. You know that asset turnover ratio? In leverages, in any corporate company financial statement, you have to find it out means, in leverage chapter, I will tell you, there is a clap principle. What is that? Clap. ILA for leverage, right? This is shortcuts, ra. What is the full form of clap, ra? If you don't know, I will slap. Any corporate company financial performance, if you want to know, means the clap you have to learn. Clap is nothing but total leverage in your study material. Capital structure ratio, liquidity ratio, activity ratio, profitability ratio. Nothing is. This is study material concept. What is that? Capital structure ratios. Capital structure ratio means you are learning, you are taking long-term funds. Could you be able to pay the debt or not? That is a capital structure ratio. Liquidity ratio. I went to petrol bunk, I filled petrol. They asked 35 rupees. I said I have chain. Petrol Boston. 30 rupees. I have chain and bike. I have 2 apartments. Go to hell under it. So what is not there in the company? Liquidity is not there. So when liquidity is not there means you are worst actually. And activity ratio. How effectively the company been using its assets. Try to understand. AC is there, not on. Right? Waste, having AC. AC unna, AC on check, AC lekunna, unna AC on check poina, rendu okate kada. Because no AC. Are you getting? That is called, what is that? Activity ratio. Last one, the profitability ratio. If you know this 4, any company performs in this 4, pillars. The company stands in 4 pillars. Being a manager, you have to identify these 4 pillars. If 4 thing is good is there, then company should run. In India, 4 things are essential. Potato, tomato, oil, and onion something. This 4 is enough. If unte jalnu batikipodu ante. Clap is needed. This 4 analysis is needed. One of the analysis is activity ratio. What is that? Activity ratio. What is activity ratio? Activity ratio indicates how much investment you made in assets. This assets, how many times it generating sales. That's enough. With a small investment on assets, you are generating sales means it's a good, For example, Pandavas 5 members went to Kurukshetra with 5 weapons. Kauravas are 100 members, came with the 100 weapons. Finally, Pandavas won. That means having 100 weapons, what is need? Avasaram tokkala weapons. The 5 members made it that. How many weapons you have does not make. How effectively you will use. That is the most important point. That indirectly conveys what ratios? Activity ratio. One of the activity ratio is nothing but, what is that? Assets turnover ratio. Means how much investment you are making investment on assets. How many times sales you are generating. Hello? For example, tell me, in the company, sales are 40 lakhs, man. Sales are 40 lakhs. But they have a total assets. That is a fixed assets is 10 lakhs. Current assets is 10 lakhs. So 10, how much? 20 lakhs. With this 20 lakhs, the company is doing sales of how much? 40 lakhs. That indirectly, how many times every rupee in assets is generating sales? 2 times it is making, giving a double. It's super, For example, here sales are 20 lakhs means రూపాయి. Sales are 10 lakhs means నేను ఎత్తిన రూపాయి పెట్టినా రూపాయి కూడా కొండేవాడు. అంత దరిద్రంగా ఉంది పరిస్థితి. Because your assets are maybe huge, are huge assets not giving what is that huge sales. That is the reason assets turnover ratio. Now tell me, asset turnover ratio, it shows the relationship between 2 things. What are they? Sales and MCQ question you can expect. So sales or turnover divided by total assets. In the problem, can you calculate asset turnover ratio? How? Asset turnover ratio already given kada. Basing on this, can you calculate what is it? Sales. You can calculate sales basing on what ratio? asset turnover ratio. Now, to find it out, now coming to here, you can find it out. Fixed cost here. This is problem I solved somewhere else. 5 ma? Not I think so. It's a printed solution problem. This one, right? What is the sales? Where is that file? Okay, no problem. You can calculate like this. Tell me, fixed cost equal to, how do you calculate? Fixed cost divided by PV ratio, you can calculate. Or else, what is it? Sales into, tell me, sales into what ratio? No. BEP sales, yes or no? Into what ratio? Contribution ratio equal to what is that? BEP sales into contribution ratio equal to fixed cost. So 10 lakhs into how much percentage? 35%. How much you got the fixed cost? 35. Right? Total sales, how do you calculate? Total assets, how much? 20. Asset turnover ratio 2.5 times. Total sales equal to turnover into total assets. How much? 50 crores. Now, income statement you see. Sales 50 lakhs less variable cost 65%, which is given. What, Maji? Yeah, next contribution, you got it. Less fixed cost. How do you calculate fixed cost? Working note 1 with the support of, what is it? BEP sales and into what ratio? Contribution ratio you calculated. Then you got the EBT less interest, which is directly given, right? 10 crores into 15%, 1.5. Next PBT less tax, you will get the PAT. Okay. Now what this asked? Once income statement is developed, operating leverage formula. What is operating leverage? Contribution divided by EBIT. Always consider times. Okay, financial leverage, how do you consider it? EBIT divided by EBT, 1.12 times. Combined leverage, operating leverage into financial leverage, 1.4 times, right? Return on investment, just now, return on investment, or keep it in word, return on capital employed. So what is the formula? EBIT divided by capital employed into 100. EBIT, capital employed, how do you get it? Equity share capital, reserves and surplus, and long-term debt. Total 16 crores. So 14 divided by 16 into 100 means 87.5%. That means every 100 rupees company earning how much? 87. Now find it out another one, whether the financial leverage is favorable or not. For that purpose, you ask the client, Aru, what is your interest rate? Tell me interest rate, ma. What is interest rate? 15%, ra. But whereas your return on capital employed, how much? Return on capital employed is how much? 87.5%. Now tell me, is it favorable or unfavorable? ROCE is greater than interest. That's financial leverage is F, favorable. Are you getting? See, if my salary is 2 lakhs rupees, taking lunch in Vajram Hotel is royalty. I have to take the royalty. So if my salary is 2 lakhs, I have to take what? Lunch at Vajram Hotel. But if I take in 20 rupees food, that is called kakurti. So once I able to earn this much means I comfortably pay that much of cost. Every corporate company, they will make such an analysis. At what rate you are raising funds and how much you are generating. Basing on that, we can identify whether you have favorable or unfavorable. I told you one fine day, my father used to brought the crackers with the 25,000 rupees of debt. Then I went to ask the dad, debt is favorable, unfavorable. Then my dad told, my dear son, my return on capital employed is greater than interest. Your mother don't know what is that, whether financial leverage is favorable or, but your mother knows financial leverage. Only third bit she knows. What is that? Operating. What is the question asked? Your mother knows what is that? Financial leverage. But your father knows last point. What is that? When is financial leverage is better? Favorable or unfavorable? Somebody, they used to say philosophy, appu తీసుకోకూడదు appu tappu. Hey, appu po. What is that? So, appu తీసుకో. But the thing is, when you are capable to manage that appu, otherwise that is maha tappu. Okay, ma? Clear, Maji? So, financial leverage, understood? How variable cost ratio formula? Variable cost divided by sales. PV ratio, how do you calculate? 1 minus variable cost ratio equal to PV ratio, right? Another one is, how do you calculate sales by using asset turnover ratio? Do you have capacity? Asset turnover ratio, Maji. B from BEP contribution to, you should able to get what? Fixed cost. That is the reason he asked several times this problem. Are you getting? Next one is, what is that? This is, here we don't have much theoretical concept. Only we have to prove. This is second problem. You see, this is the only problem. You try to see how many times this problem is asked. Once if you get just within 1 hour, this 3-4 problems you trained, pakkara. Because nothing is there to ask. But only thing is, don't take income statement and studying. What the new point you learned? That's tell me. First 5 problems up to in your material. Not in study material you take, not 50. 50% of the problem is nothing but you want to educate. This is the leverage. This is the leverage. But why you are going with solving all these things, income statement, leverage, gantal then కూర్చొని చేస్తుంటారు. దానివల్ల ఏంటి బెనిఫిట్ అక్కడ? Nothing you are going to get it, What problem is really problematic, you should handle that problem. So which problem is very comfortable? Sales 5 lakhs. Variable cost 2 lakhs. Oh, super problem. కూర్చొని చేస్తానే ఉండే జీవితాంతం అది. Contribution you will get it, So what you are doing? Studying. What you are doing? Sales 5 lakhs. Variable cost 2 lakhs. Contribution you got it. What you are doing? Studying. Go to hell. Is studying a time wasting process. So whenever you are doing means at least you should done it. So past exam they will ask only one question. Maha strategy if you make it means he is to pick it up this question because you see how many times they asked. If not so, right? ఇది అడగలేదనుకో ఇది అడగాలి. Because past ఇది అడుగుతున్నాడు. ఇది అడగలేదనుకో maximum this problem he has to ask. Okay, this is not possible anko inkem adagara. Only we have the one strategy ra. He will merge what? 3 problems he will put it in mixie, he will on it. Mood itla pettisthadu problem. So that's why you have to get ready. I will give you all the strategy last in student notes, right? Okay, now the second problem. You solve it the second problem. Sir, what is the second problem? You see, second problem is the what is the core observation from this one. Sir, kya sir isme? Let us take the capital structure of PS Limited for the year ended 31st March 2021 consisted as follows. Okay, equity share capital, financial leverage is there or not there? Not there. No financial leverage. 10% debenture. Hey, what are they? Financial leverage is there. 10 lakhs you have to pay what? 10%. You have to pay. You have to identify undi. Choose no BP sugar anni unnai indulo. Right. Now tell me, during the 2021, sales decreased 1 lakh units as compared to 1,20,000. That means 1,20,000 is there. So here the sales are decreased. How much? 1 lakh. In such a situation, very, very painful, So in such a situation, what will happen? However, the selling price is 12 per unit. Variable cost is 8. Whenever units is there, you try to find it out contribution per unit. Yes or no? So per units, both the years, and fixed cost would be how much? 2 lakhs, both the years. Income tax rate is 30%. Balu sir, tax is there, financial leverage is there, Balu sir, what I told. Current liability, tax, nowhere concerned to what? Leverages. Because current liability comes to 2 rupees. పక్కనోడి దగ్గర 2 రూపాయలు తీసుకున్నాం, అది కూడా కరెంట్ లైబిలిటీ కదా. ఆ 2 రూపీస్ కోసం కోర్టుకి వెళ్తాడు ఏంది? వెళ్ళాడు. Are you getting? What about tax? Tax is a commitment. When company makes a profit, then it pays. That's why don't take it. Now you have to calculate degree of operating leverage from 1,20,000 to, if sales goes to what? No, 1,20,000, 1 lakh. Whereas find it out financial leverage 1,20,000, 1 lakh. When operating leverage, financial leverage both are given, combined leverage also you will ask. Then he will ask what is that? EPS. Try to understand. 2 operating leverage, 2 financial leverage, 2 combined leverage, 2 income statements, 2 EPS, 2 change in EPS. 5 marks. Gaya tu. You know how you will write, while applying fair and lowly to face, how sensibly you will use fingers. In the same manner you used to give it. But unless until the student don't have calculation ability to solve the problem within the given time period, he gone. First problem is a subject oriented problem. Second problem is time wasting problem. He wantedly gives this problem. By seeing this problem, you will get, wow, paper is easy. Easy, yeah? కూర్చో అక్కడ చెయ్యి ఒకసారి. యూ నో దట్ సేల్స్ రాయడానికి 10 నిమిషాలు పట్టుద్ది నీకు. సేల్స్ నుంచి వేరియబుల్ కాస్ట్కి హాఫ్ అన్ అవర్ అయిపోయింది ఇంకంతే. సో because you will apply step number 1, look at the pen. Step number 2, take the pen. Step number 3, open the cap. This is our strategy to write. If this much of Sukumaram is there, Gayatu. So when you see the problem, yes, income statement you have to solve within the seconds, maximum. Yes, sir. Because, see, these many times they given, only one strategy to waste time. After completion of this exam, student used to come outside, how the paper? Shah Rukh Khan pose they used to give. What, ra? Very lengthy, sir. Problem started at Arangalpet, sir. Ended at Narsarapeta. That much of lengthy paper. Is it lengthy paper? Huh? Not lengthy paper. You are slow writing. That is the reason. Okay. Now you see, you have to calculate income statement, right, ma? You see here 1,20,000. A. Sales value at a 12% means 4,40,000. Na? Here 12 lakhs. Less, you have to deduct what cost? Variable cost. Time waste strategy. If I do so, what I will take? I will take directly units. I will take what? Contribution per unit, right? So if you multiply directly contribution per unit into number of units directly, you will get what? Contribution. What, Maji? Less what expenses? Fixed cost. You calculated a given, given, right? Then you will get the EBIT. Less debenture interest. You have to calculate which is given actually. After deducting this, you will get the EBT. Less tax. You will get the EAT divided by number of equity shares. Now, after preparing 2 years income statements or 2 times income statement, then you have to calculate operating leverage. Operating leverage formula, contribution divided by EBIT. So 4,80,000, 2,80,000, 1.71 times here. 4 lakh divided by 2 lakhs, 2 times. Financial leverage, EBIT divided by EBT, 1.5 times. 1.56 times here, 2 times. EPS is nothing but earning availability to equity shareholders divided by number of equity shares. EPS 12.6, here 7. Percentage of change or decrease in EPS is 5.6 divided by 12 point. How much? 44.4%. Dear students, this is the very, very simple strategy problem is, by seeing this problem, you will get 100% confident that I can do this problem. I do assure, 100% in this class, all the people will do. But the thing is, doing the problem within the given time period is the doing the problem. Are you getting? Not doing the problem is the doing the problem. Okay, doing the problem within the given time period is the doing the problem. Clear? This is another strategy. Examiner is a designing Padma Yuham for you. If you go with while taking a idli dosa, you will become Abhimanya. Enter the dragon. You don't know? Become always Arjun. You have to go and you have to come. You have to understand what is his strategy. You have to analyze the question paper within the given time period. Don't make immediately attempt. Just observe it. What is my time schedule? For example, I made it a 4 to 5 identity. I'm showing PowerPoint, sir. I'm making running notes, sir. I'm making exclusive material. Yes or no? These are, again, I'm making some, flyers to keep attention in the class. These are nothing but I'm holding it. But I'm ready with all these things. That's why I'm enough confident to give all subjects or all the conceptual clarity within the given time frame. Because I know if this strategy if the classes gets down, so what should I do? What concept I should give it? If the students knows everything, whatever knows, if I tell means not at all useful. My experience should count you this. My analysis should make you to this. Okay, this is the point he is giving like this. You have to observe this one. So whatever the problem you can solve, now onwards, don't solve that problem. Read the problem. Whatever the problem you cannot solve, so far not solved, solve the problem. But before that, take the past exam trends. Find it out this one. You don't have much time, right? Your time is very, very short. Within the short time, you must become a smart, not hard worker. Not gone. No need of hard work. Just having idea. Okay, this is the strategy. 4 years income statement, this one. Could I able to solve or shall I solve at last? We will take it last. Or no problem, we can do so. Make it that observation. Right, ma? And another important problem. This is a comprehensive model. You see how many times this problem also asked. But this problem, Subject come comprehensive model. You see in this problem, the following information related to Suzuki Limited. Equity share capital 50 lakhs, 12% bond. Are financial leverage is there? No. Whereas here 12% bonds, yes, financial leverage is there. Sales also given. Fixed cost excluding what? Interest, 8 lakhs is given. Financial leverage is given. PV ratio. Sir, what is the financial leverage given, sir? So far the strategies he given. Now you should understand why I used to said ILA. ILA. So far what is that? Left to right. Hello? This problem is right to left. You have to understand this. So he given what is that? Leverages. Once one leverage is given means he is not following this way. He is asking this way. Otherwise 1 plus 2 divided by I plus L divided by 2. So financial leverage is given. PV ratio. What is the PV ratio? Contribution ratio. Income tax is given. Is it a leverage? No. Market price is given. How much? 40. So directly he asked what leverage? Operating leverage, combined leverage, and what is that? Earning per share, earning yield, PE ratio. Sir, PE ratio is a concern to capital structure, you know, sir. Capital structure. Is there any rule that I have to ask only in where? Capital structure. Anywhere I can ask. You see, a PE ratio, earning yield ratio means EPS divided by market price. PE ratio formula what? Market price divided by EPS, you know. Earning yield ratio, EPS divided by market price. At what level of the sales, earning before interest tax of the company equal to 0. See, this is another version of asking company. So here what you do means you have to see how many times they've been asked. Sales, which is given a sales are how much? Less what is that? Contribution, how do you get? Tell me. Sales into what ratio? PV ratio. What is another name of PV ratio? Contribution ratio. A minus B. You got it. Less what you get it? Fixed cost. Excluding interest, including interest. Sir, my small doubt. Why is given fixed cost excluding this one? Both are fixed cost only, Nora. This is operating fixed cost. That is financial fixed cost. But both are fixed cost. Right. Once you deduct the fixed cost, you will get the EBIT. From the EBIT, you deduct what? Interest. You will get the EBT. Less what? Tax. You will get EAT. EAT also known as earning availability to equity shareholders. Now, can you calculate operating leverage? Operating leverage formula? Contribution divided by times combined leverage. Operating leverage into financial leverage. Yes or no? Financial leverage already given. Operating leverage just now computed. Yes or no? If you multiply, you used to get it. What is earning per share? Earning per share EAT is given. Divided by what you will take? Number of equity shares if you take means you used to get it earning per share. Earning yield ratio, how do you calculate? In the problem already market price is given in Oma. Market price EPS divided by market price into 100. What you used to get? Earning yield ratio. PE ratio. PE ratio is nothing but what is that? Market price divided by EPS. Hello? So next another one, at what level of EBT would be 0 means how should we calculate? You see here what level of sales? Sales we need a hello? Sales we don't know. Let us take less variable cost ratio. How much variable cost ratio given? In the problem, what is the variable cost ratio given? In the problem, Maji, it is PV ratio is how much? 33.33 means, can you say contribution ratio? So sales equal variable cost equal to 66.67, right? 67%. Then only contribution is 33.33%. At any cost, if you find it out, contribution, right? Hello? Contribution divided by contribution ratio equal to sales. Because the sales into contribution ratio equal to contribution. You know the company's contribution ratio is how much? 33.33%, right? If at any cost, if you find it out, contribution, okay, a problem. Then sales, we don't know. Variable cost, we don't know. Contribution. But one thing is company variable cost ratio, 66.6%, right? Contribution this, right? Less fixed cost. Fixed cost is whether sales may increase or decrease. Fixed cost remain constant. How much fixed cost? 8 lakhs. So 8 lakhs is there. 8 lakhs, right? If you deduct, you will get a EBIT. Hello? EBIT you don't know, but you have an interest to be paid. How much interest? Interest in the problem 50 lakhs into 12%. What is that? Huh? 6 lakhs. 6 lakhs is the interest. You need to get what? EBT. Now what their problem is asked. I have a commitment, this money commitments, Balu sir. Can you please tell me at what level of sales my EBT should be? 0. So that indirectly conveys that my EBT should be 0. But he is asking what? Tell me my sales. Could you able to tell this sales? This is the point he asked. But what I can say, just to make analysis. My dear Balasubramanian J, when EBT is 0, you have an interest means EBIT should be 6 rupees, right? 6 rupees. In such a case, fixed cost EBIT less interest, then only it's 0. Then already fixed cost is you have how much? 18. In such a case, contribution minus fixed cost equal to EBIT. Yeah? Then EBIT plus fixed cost equal to contribution. How much contribution? Huh? 24. Yes or no? 24 equal to how much percentage? 33. So 24 divided by what about the contribution? My contribution is how much? 14. Fixed cost 8. Okay. Now it is how much? 14. 14 divided by 33.33%. How much? 42 less 66.67. 28. You got it now? When EBT should be 0 means your sales should be 42. Okay. So this is the approach. Don't consider this one. Because you take sales is how much? 42. Less what is the variable cost ratio of the company? 66.67. So 66.67 into 42. How much you got it? 42 into 66.67. 28. What is the contribution you got it? 14. What is the fixed cost you have? 8. What is the EBIT you got it? What is interest you have? What is EBT? 0. So these are the commitment you have to make it. Got it? So this is the strategy. In the problem, what the examiner is asked. Now I will tell you. What is financial leverage? Most important times he will ask financial leverage. Well, number 2, favorable financial leverage when? Number 3, preference dividend given in such a case preference dividend given means in the problem how should you to calculate financial leverage means financial leverage equal to EBIT divided by EBIT minus interest minus preference dividend divided by 1 minus tax you have to take. Next, fourth one, MOS. MOS means margin of safety. Margin of safety, how do you calculate means 1 divided by operating leverage into 100. This is the strategy you have to consider. Whereas operating leverage also you can calculate how? Contribution divided by EBIT. This is one point. You can also calculate like this. 1 divided by MOS into times. Okay, BEP sales. How do you calculate? BEP sales equal to that BEP sales equal to variable cost plus fixed cost equal to 0. Profit equal to 0. Okay. So fixed cost equal to how do you calculate? BEP contribution. Yes or no? BEP contribution. 9. PE ratio you asked. Debt equity ratio you must learn. Debt equity ratio. Then 11. Debt equity ratio. Earning yield ratio. Earning yield ratio I asked. EPS divided by market price. Then top to bottom analysis. At what level of sales? He asked, So top to bottom analysis. You have to make it a bottom. So for sales, you used to give it. But this time he asked top to bottom versus what is it? Bottom to top analysis. Thereafter, he asked a variable cost contribution, right? If at all any sales or any EBIT double means what is the percentage of change? Double. EPS should be double. EBIT should be double. That means any information or sales or variable cost, if it is a double, means the percentage of change is 100%. Hello? Percentage of change is required 100%. Don't get confusion. So percentage of increase must be how much percentage? 100%. For what purpose? To make what? Double. Yes or no? Then another one is types of risk. How many types of risk? 2 types of risk. What is it? Operating risk. Another one is financial risk. Operating risk arises because of fixed cost. Financial risk arises financial risk. Okay. Thereafter, what the point is asked? Asset turnover ratio, Reuta? No, asset turnover ratio. Asset turnover ratio. Basing on asset turnover ratio, how do you calculate sales? Already they asked. Next, 16. 1, 2, 3, 4. Margin of safety covered. BEP is covered. Asset turnover ratio is covered. Then financial leverage, combined leverage. Return on capital employed. Return on capital employed or return on investment. Return on investment also you have to ask one problem. Then financial leverage 3, 4, margin of safety, combined leverage. Sometimes what happen? He may design a question. 7 EBIT what analysis? EPS analysis with what? Risk. With risk what, sir? You will take the problem from EBIT, ra? Hello? You will end the problem at EPS. That is what analysis? EBIT, EPS analysis. From the EBIT, EPS analysis, again he will ask you, what is that? Calculate financial leverage. Calculate operating leverage. Calculate combined leverage. Such a model problem also given in comprehensive model. But that is hardly 1 time they are given. That is a MTP. But whatever the problems I covered, these are the repeated 3 model problem. So for the sake of time being, we don't have much time. That's why if you properly prepare well with respect to this given problems with the given concepts, so coming exam comfortably you can handle. Condition applies. Past trend, same trend if he follows in coming. If sometimes he will follow 2 different means, in such a case our prediction also goes, because Ratan Tata also failed in nano project. After all, how we bacha people. So Ratan Tata prediction also gone wrong. But Ratan Tata said it is just a prediction. But at least you will go to exam hall. That's is bar Ojatara financial management. Be with. But sometimes luckily if you ask a 4 marks question, what is a business risk? What is a financial risk? Jai Hind. Sir, is there asked, sir? Several times they asked, not 1 or 2 times. Several times from the leverage. See, these are the questions I identified. Or I think this is a capital structure, I think so. But here, what is the story about here the dividend decision in past exam? What is the point? You see, dividend decision maximum, not maximum, is only 5 marks. So that's why, see, 5 marks I cannot give attention to capital structure, because capital budgeting 2 marks, 2 hours we have to identify. Cost of capital, we have to give it for 10 marks. Much chances is that more time period we have to give it. Whereas capital structure, we have to give it more time. Dividend decision, what is that? Recently we discussed leverages. Leverage we cannot neglect, that is very, very less, but 10 marks chances are there. But this one is very, very easy chapter, but maximum 5, there is a chance for 3 and 4 marks also. But consecutively over the period, consistently they've been asking. So in this point, what been expecting means, he want to ask you, what is a dividend decision? What is a dividend? What is a dividend model? How many models are there? What is each model? Each model theme is what? Calculation is what? Formula is what? With that model, being a financial manager, how I am going to take advice in coming future. This is the chapter. That's enough. Simple. Are you getting? But here the entire question is nothing but with the dividend decision. Story is this. Let us take the past exam. what the indirectly it conveys, you see, Sun Pharma company declared a dividend. Dividend declared, but market value of share is decreased. Sun Pharma company declared a dividend, but the market price share is declared. Whereas a BHCL company is there. Dividend declared, but market value of share is decreased. You see, here the company declared dividend, market price decreased. Here also declared a company, dividend declared, market price is decreased. But now you are the financial manager. ఏం చేస్తా తలుపు వేసుకుని ఇలాంటి మొహం పెడతావు అంతేగా అరే వాట్ షుడ్ ఐ డూ యార్ టెల్ మీ ఎనీ వన్ ప్లీజ్ మీన్స్ ఓన్లీ వన్ పర్సన్ కెన్ కన్వే ఈజ్ నథింగ్ బట్ నాట్ ఓన్లీ యూ ఇఫ్ యూ లెర్న్ you all the people can convey this one. Then why don't tell me or what should I do means you have to help him, otherwise you cannot. But not in a sympathetic manner, right? You have to ask chillera market way cheppu, I will tell you whether dividend to be what is it declared or not. For that purpose we used to study what is that one of the chapter called what is that dividendation. Such a important chapter should we learn in a casual manner? Tell me. No. So that's why I thought it that yes, sit together, I will write 36 pages. Likho. Sir, I can, why man, these many years you are telling, go and tell. No, we have to write. Because unless until I cannot write, I cannot get the core information. I know a lot of information to convey. Hours together I can talk on the dividendation. But within the one limited time, whenever you will check on the even digital way, you should able to identify this information. Okay, this is the information Balu are told. Right, no problem. That's why at any cost I want to convey this 36 pages randomly, right? But what is information more important, I will show you only that, right? Yeah, what is the dividend decision? So first of all, theoretical concept, this is majority. First you should understand what is the introduction for this chapter. What is actually they want to convey, what they want to identify. You know that first beginning I showed the financial management, right? Financial management is the one of the what activity? Managerial activity. Okay, managerial activity which is concerned with to take what? Productive decisions to maximize wealth of the company, right? To maximize wealth of the company means you have to take decisions, you have to make policies. In leverage chapter what I told you that financial manager has to make a decision to take a policies to identify risk because you want to earn what? More return. Same logic here also gets applied. So financial manager has to take what? Decisions, financial management decisions being classified into how many types? 3 types. Financing decision, investment decision, abhi aa gaya bachcha hamara kya hai? Dividend decision. So this is, so just with this introduction I want to make a link with the financial management and dividend decision. Point number 1 gone. Next, what is the another point? What is a dividend, sir? Dividend is, what is that? Dividend, you should understand, it is a distributable profit. Distributable profit belongs to whom? Equity shareholders. This is a profit belongs to whom? Equity shareholders. Indirectly means, sir, nothing but man, a company has taken wonderful what decision? Investment decision. And taken effectively financing decision. So in finance, because of investment decision, company made returns more. Because of financing decision, company paid less cost. R minus C, you have what? Earnings, right? So what the company has to do this one? Hurry, what to do? Give it your dividend decision. Really, do you know the story about what is that? This company about this argument, right? When company declared a dividend, simply they declared a dividend. It's not the matter, right? What happened to Sun Pharma company? Market value gone. By taking as a role model Sun Pharma company, BHCL company declared a dividend. What happened? That declared dividend is gone. This declared gone. What is happening here? Because you don't know that what is that dividend decision perfectly. Declaring dividend is not a dividend decision, my dears. Not to declaring dividend is a dividend decision. Then what to do, sir? You have to make analysis. That is this syllabus. So the students will have a conclusion that, oh, declaring dividend is a dividend decision. No. Okay, retaining is a dividend decision. No. So what to declare, how much to declare, when to declare, these are the most important points. Now earnings of the company can be considered into 2 parts. What are they? One is retaining the profit and distribute as a dividend to whom? Equity shareholders. You can do this or you can do this. But the thing is, Then what is the dividend decision? You understand what is the dividend? Hello? So then next question, 2 marks question they asked. What is a dividend decision? Yes. Dividend decision means, what is a dividend decision, Balu sir? It is an decisional aspect. It is a situation, thinking what to do here now. This is a decisional aspect. With respect to what? Distribution of dividend. Distribution of dividend. It is concerned to answer to the question. What? What is the answer to question? What to do with the what? Earned profit. What to do with the earned profit? Should we retain or distribute? The question is needed. Distribute, sir. Have you know Sun Pharma company? Sir, retain, sir. Have you know BHCL company? That's why what to do with this answer? For that purpose, you have to take a decision. Decision plays very, very important, because sometimes decision gone, right? Sir, what is the story behind Sun Pharma company, sir? Because Sun Pharma company declared a dividend at the time of Corona pandemics. If you are produce a lipstick means it is a waste thing. Who told you to produce lipstick? Sir, I am retaining. Why you are retaining? Sir, I am producing lipstick. No. No. You are retaining my money and you are producing lipsticks, right? In such a case, market value, what happened? Decreases. But Corona pandemics, where is dividend? No dividend. Why? Unfavorable. All the people are struggling with a health condition. We are the pharmaceutical company. We have to get this opportunity. Corona is a painful for patients, not for the doctors. Not for the pharmaceutical companies. We have to what? A patient comes means not to treat, just a touch you can take the money. తెలుసు కదరా, అప్పుడు కరోనా వచ్చినప్పుడు ఇఫ్ యూ సీ ద పేషెంట్ దే హ్యావ్ టు గివ్ మనీ. చూస్తే డబ్బులు, టచ్ చేస్తే ఆస్తులు రాసి ఇవ్వాల్సింది అంతే. And at the same time, there would be their online, digital, completely system. In such a time, as a Sun Pharma company, you have to grab this entire opportunity. Instead of this, you are declaring dividend. Then immediately they sold all the shares and they purchased, they sold these shares and they invested in Ranbaxy, Dr. Reddy's Laboratory, Cipla companies. Because they said that, no dividend, because we are using opportunity. But BHCL company, heavy electrical based company, instead of declaring dividend, so they retained. All the people asked, what you are doing? I am retaining. What purpose? Reinvest. All the companies are locked down, right? In that situation, is it essential? That is the reason market value of gets collapsed. Without making all this analysis, you should not. Your parents used to make money, but they won't give total money now, right? There would be a time, there would be a procedure. Yes, how much to give or how to give. How a parent has to take a responsibility by keeping your future. As a financial manager also, you have to consider all these things, right, ma? So that is the dividend decision. In order to solve this one, right, this is 2 examples I take, Sun Pharma company. But in order to solve that issue, you have to study various models. Various models means there are certain people, they conveyed, they guided what to do with respect to dividend. One is a what model? Relevant model. Another one is irrelevant model. What is a relevant model? Relevant model argument is that there are certain analysts whose argument is dividend decision is very, 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 very important. Okay, these many varies are important because it certainly influence what? Market price. Learn very carefully here. Because of this, market value goes somewhere. Irrelevant model says that dividend decision not influence market price here. Not at all. So don't be serious with respect to what decision? Dividend decision. Okay. So how many members are there? Naluguru is there here. James E. Walter, Gordon, Graham and Dodd, John Linter. These 4 members influenced what theories? Relevant model. This argument is that must learn dividend decision effectively. Certainly it is going to influence your company market value. If market value increases, your wealth what? Increases. Whereas irrelevant model argument is, no need to learn the dividend decision so seriously because your market value not depends upon your dividend decision. Whereas your what decision? Your investment decision. Are you getting? Indirectly what it says, clear CA, your life goes somewhere. Relevant models. Irrelevant models, clear CA means you will get only certificate. Your life won't goes. Your life goes when you open office. And when client comes, you have to solve their problems, you have to charge money, they have to give, then only you will buy bangla. You are worrying about this one. You try to understand how different this one. Okay, so sometimes you have to do that end figure, then only you will make the money. That is whose theory? Irrelevant models. Are you getting ma? Relevant model, irrelevant. So in this model also, dividend decision, they been asked, what is that? The point of highlight is this ma. In this problem, total number of problems, total analysis also, you must know, because then only you will have identity. So here, dividend decision with respect to dividend decision. Total illustration 11, practical problems 9, MCQs 5, theory questions 5. MCQs maximum 50% covered just only. What is the dividend? What is the dividend model? What is the dividend decision? Which model comes? Who will comes to which model? Linter comes to Modigliani Miller. What do you mean residual model? Irrelevant model. Dividend decision absolutely influence market price. What model? Dividend decision nowhere concerned to irrelevant model. Company has to concentrate its investment decision rather than dividend decision. Is the right dividend decision? Yes or no? That is nothing but what model? Irrelevant model, right? So this is the dividend model. So provides why we should study this guideline, sir. Because we have to advise an innocent crying man. Who? This man is crying, So what should I do, sir? This man is crying. We have to advise in order to, if you learn this model provides you what? Guidelines for what? A productive dividend decision. But you should understand, each model has its own theory, Each theory has its own assumption, Each assumption's theory consists of what is that? The formulas to be considered, Formulas to be considered. With the formulas, you have to make a calculation, With this calculation, you will get a results, With this results, you have to make analysis, With this analysis, you have to come to conclusion, then you have to take decision. With analysis, don't take decision. You have to observe this. What is happening? First you analyze, then come to conclusion, then you take a decision. This is nothing but 4. Then only you can make money tomorrow. Otherwise, if a client comes means, don't tell that, sir, whether I should take a dividend decision. Then immediately you tell whatever the information you learned. Sir, I know dividend decision is nothing but this. Give me fees. Yes or no? Will you ask like this? No. You have to consider. Each model consists what? Theory, assumptions, formulas, results, analysis. What is that? Conclusion. And what is that? Decision. Most important model is nothing but what the provided is Walter model. You try to understand in your material how many times they've been asked. This is nothing but maximum only one model they asked what? Walter model. Only Walter model. These are the coming, all this model is nothing but what model? 90% Walter model, 10% Gordon model. You can take it at 85%. 85%, 10% Gordon model, 1% is MM model. Okay, so that is the point you should understand. What the Gordon model indirectly conveys. See, this model was proposed by who? James E. Walter. It is an what model? Relevant model. Simply what is his argument is, according to this model, listen carefully, a company can increase its market value of equity at what? Optimum dividend payout ratio. If it follows optimum dividend payout ratio, then it can increase what value? Market value. So simple logic is, Walter what told? Your ultimate job is to what? To take dividend decision? Yes, sir. With this, what do you want to do? Sir, I want to increase market value. You want to increase market value, then you follow what policy? Optimum dividend payout ratio. Then optimum dividend payout ratio depends upon two things. 1 and 2. Here you see. Optimum dividend payout ratio indirectly conveys, sir, if internal rate of return or rate of return of the company, that is nothing but to take optimum dividend payout ratio, you must know one concept. What is that concept? Is R. What is R? Return earned by the company. Array, if I have this money which is to be distributed to you people, right? So what is the Walter argument is this? If you are retaining this amount, right? If you declare a dividend, this amount goes to whom? Your shareholders. Who is going to invest? Your shareholders is going to invest. If the shareholders is going to invest means they will earn, what is that? Their yield rate. Yes or no? Whose yield rate is this? Investor expected rate of return. It is also known as Yield rate, which is also known as cost of equity, which is also known as KE. KE is 10%. That means, dear financial manager, if you give a dividend, your equity shareholders is going to invest. Do you know, being a manager, you should know, by if you give a dividend, he is going to invest. How much he is going to earn? 10%, right? Instead of giving dividend, if you retain, who is going to invest? Company going to invest. Company retains, that retained amount company is going to invest. So how much return company is to generate, you find it out. That is called IRR. What is that? IRR. Sir, what is that KE, sir? That is a KE means return earned by who? Investor. IRR means return earned by the company. You are a financial manager, right? Yes, sir. You are paid employee, right? Yes, sir. Are you owner? No. I work for company. Company means who here? Owners. If you give money to, who is going to invest? Owners are going to utilize. Hello? That means indirectly, simple logic, what you tell? If you give dividend, who is going to invest? Your owners are going to invest. Hello? If you retain, on behalf of owners, you are going to invest. It means, if he works better than you, then give a dividend. Simple logic is, he work for himself, you work for himself. Hello? He work for himself, you work for himself. If he works better than you, then why you are investing here? Give it money to whom? Him. But you work better than him for the sake of him, then don't give dividend, you retain it. That is the theory projected. You see here, if R is greater than KE, means R is who? Company is greater than KE, then company has to follow 0% dividend payout ratio. Don't give it, man. Just you retain. So 0% dividend payout ratio is the optimum dividend payout ratio. With effect, market price, what happen? Increases. Balu sir, then what is the situation if it is when R is less than KE? 100% dividend payout ratio is the optimum dividend payout ratio. If you follow this one 100%, then market price, what happen? Increases. Sir, you are saying your 0% follow. Here you are saying 100. That depends upon what? R and KE. Are you getting? When R equal to KE, in such a case, your dividend payout ratio is not influence what? Market price. Both are what? Same. Both are same. It does not make any identity. This is the point to be generated. In order to know this one, you should calculate R, you should calculate KE. Once you know this one, right, automatically you can take a dividend decision. Okay? Sir, 1 minute, sir. Sir, R and KE may changes, assumption. R and KE remain constant. Sir, one thing, if you declare dividend, sir, then we can use debt, sir. Company moves with what? 100% equity. Sir, we do one thing. We can rise for at least fresh equity, sir. Assumption. For the sake of investment, you have to use only retained earnings. Okay. Sir, company will work for 1 year or 2 years? Forever. Sir, tax is there? No tax. Flotation cost? No flotation cost. Sir, how should I know, being a manager, that investor is going to earn this much? You must have what knowledge? Perfect capital market. That means you must have an identity. Yes or no? But whereas you are going to buy a gold, prices are gets, we don't know, sir. But whereas you must have perfect market information. That means everybody knows everything. This is the theory. But here, in order to make this one, you should understand what is the market value of equity. Market value of security is the present value of future benefit discounted at what? Investor expected rate. Alright, listen, this is a very, very important standard dialogue. What is the market value? Market value is nothing but present value of what benefit? Future benefit discounted at investor expected rate of return. So here, to market value, if you want to find it out, he developed the formula. Formula is perpetual, Perpetual means present value of perpetuity. Hello? Market value is nothing but what value? Present value of future benefit. What the benefit you are going to get it? Madam? Madam, okay? Comfortable? Listen. Okay? So present value of perpetuity. Market value is nothing but present value of what benefit? Future benefit. Whatever the benefits you used to get it, you have to bring it into present. So infinite benefits used to come means it indirectly present value of perpetuity. That is nothing but cash flows divided by rate. What the cash flows you are going to get it? From the EPS, he is going to declare a dividend. Remaining balance he is going to retain, right? That retained amount he is going to reinvest. That reinvested based how much value he is going to get it, you have to consider that one and you have to bring it into present. This is the argument of whom? Walter. Let me tell you a small example. EPS is company 20 rupees. IRR is a 12%. KE is 10%, right? Following? See, even if I convey this formula, you will have a little bit doubt. That is the reason I thought it, why don't I write a problem so that instead of explaining that formula, if I give small example, you can easily consider. Before that, do you know what is the market value? Market value, present value. Present you have to bring it in. Is it a 5 years present or infinite present? Infinite present means present value perpetuity. Present value perpetuity formula? Cash flow divided by rate. So you know cash flow divided by rate. You don't have a problem with rate. Only problem with respect to cash flows. How many cash flows I am going to get it? Now the question is, here EPS is 20, IRR is 12%, KE is 10%, dividend payout ratio is 60%. Actually IRR is how much? 12%. KE is how much? Now tell me, if the really good financial manager, what he has to do? You have to retain, but this man is paying 60%. Now the market price of the company is the best or worst? Worst condition is there. So what is the market price as on today? Could you able to increase it? Yes sir, I can increase it by following what? 0% dividend payout ratio. This man argument is, whose man? Walter argument is, market value is nothing but present value. Yes or no? So dear Balasubramanian ji, you try to understand, company made EPS. You are the equity shareholders. So this equity shareholders, what if observation is that company made EPS 20, 20, 20, 20, 20, 20, 20. But he cannot bring the 20. What he is going to get it means he used to get only dividend. So number one, he is to get the dividend. Dividend, how should you get it? EPS into dividend payout ratio. Yes ma? Hello. So 20 into dividend payout ratio. Just now we calculated. 60%. 60% means how much? 12 rupees, 12 rupees, 12 rupees, 12 rupees. So 12 rupees he is giving means what he will do is 12 divided by, what is that? Market value is nothing but one of the income he is getting a 12 divided by 10%. He will find how much? 120. Immediately he will ask that, sir, only 12 you given, what is my remaining balance? What is remaining balance? 8 rupees. Sir, you are holding retaining earning, because of retaining it, what you are going to do? I'm going to reinvest. Okay. Because of retaining it and reinvesting it, you are going to generate some benefit, right? Could you please tell me what that benefit as on today? Are you getting? What is the benefit as on today? As on today, how I can make investment, sir? But you can make calculation, right? Suppose you retained how much? 8 rupees. You will invest when? At the end of first year. At what rate you will invest? Your company return is how much? 12%. How much you are retaining? 8. 8 you are investing means you are going to 12% means how much return you used to get? 0.96 when you are going to get? Second year onwards you are going to get it, right? What Maji? Second year onwards you are going to get it. The total benefit you are going to get it from second year onwards. If you want to calculate market price any value, MP0 means the cash inflow should generate from end of the first year onwards. Hello? Any present value means the cash inflow should generate when? First year onwards, right? If the cash inflow generates second year onwards, if I bring it into present means it will come to when? At the end of first year. So how much you are going to get it second year onwards? 0.96, 0.96, 0.96. If you bring it at investor expected rate, it will become 9.6 again. With respect to, now tell me, what is 20? What is the 12? What is 8? What is this 9.6? It is the present value of return on investment on retained earning. Completely imaginary identity. What is this 9.6 here? Not at all. So dividend illa. That dividend again, retaining. When? Here invest, there we will get the benefit. That benefit you will bring it at 9.6. What is hell it is going on? Nika concept connect ayindi kada? Ee concept connect avuddi. Are you getting? So this is the 9.6. So 9.6, 9.6, 9.6, you are going to get it. What is this 9.6? Really, it is imaginary calculation. Now you have to bring it into present. How much? 9.6 into 10%. Total is nothing but 216. This is the decoded with the formula. What the formula? D plus E minus D into R divided by KE whole divided by KE. D, declared dividend. What is the rest? Retained. Then what you done? Reinvested. That benefit you are going to get it in future. Bring it into present. So two incomes are there. Dividend plus the present value of return on reinvestment. Yes or no? Then you bring it into present, you will get the market value. So this is the calculation. Really student has little bit confusion with respect to this, means why KE 2 times has taken, Balu sir? Because dividend you are getting directly, that another benefit, you are not getting. What is that? Directly. You have to retain, you have to reinvest, that benefit you used to get in future, that benefit you have to bring into the same time of where dividend is standing. That means how much mechanism you have to identify it. So that is the Walter argument, ma. So dividend formula, if the company follows dividend payout ratio 0, it would be 240 rupees. It would be. If company declared, that would be the reason its market price is how much? 216. Right. Most important problem for this problem is here you have the repeated question what they asked in the public exam is a Walter model. Is this the problem? You see how many times they asked? Only one problem. That's enough, Ra. If you are able to solve this attempt, pakka pass. If you are not, get ready for crash. There is one batch after your class, that class only. Last time I told you, they considered me as a LKG kid. Chowthaland sir, enduku tondara. Ippudu chowutunnaru vallu. Be attentive. Solve now itself. 1 hour. 1 hour. How many days you are preparing is not the matter. Preparation should be like this. What, Maji? Take a pen. Make a calculation. Total earnings. How much total earnings? 2 lakhs. Right? 2 lakhs. Number of equity shares. Can you tell me EPS, please? 10 rupees. Dividend paid. How much? Can you tell me dividend payout ratio means? Sir, 1,50,000 divided by 20,000 means you got the dividend. How much dividend? 7.5. From that EPS 10 rupees you are paying 7.5 means what percentage you are getting? 75%. What is the PE ratio? 12.5. PE ratio means 1 divided by PE ratio is nothing but KE, you will get it. KE is how much, ma? 12.5 divided 1 divided by 12.5 into 100. How much? 8%, right? What is your earnings? 10%. How do you say? Total earning is how much, ma? 2 lakhs. What is your total capital employed? 20,000 shares are there. 100 rupees each. Yes or no? What is the capital employed? 20,000 into 100. That is nothing but how much R? 10%. Now in the model they asked, can you please tell me what is a KE? Tell me KE. KE equal to 1 divided by PE ratio. 8%. B. Can you tell me return on investment? 2 lakhs divided by 20. 10%. Question number 3. Sir, analyze whether the company following optimum dividend payout ratio. Whether following optimum dividend payout ratio. Na? Sir, what is optimum dividend payout ratio? Na? Sir, R is greater than KE. They have to follow 0%. But the company following 75%. So what is the answer is R is greater than KE. Optimum dividend payout ratio is 0. But the company following 75%. Okay. Another important question. Find the value of share at present dividend payout ratio. Present dividend payout ratio. You know that dividend. How much? 7.5. EPS 10. So 10 minus 7.5. 2.5. R 0.10. KE 0.08. So always calculate from right hand side to this. 0.10 divided by 0.08. How much you got it? 0.10, 0.08. 1.25 into 2.5 plus 7.5 divided by 8%. Came, right? So next, what is another question? Find out the value of share at a Optimal dividend payout ratio. Optimal dividend payout ratio means 0, sir. Optimal dividend payout ratio 0 means 0. Same 1.25. 1.25 into how much? 10 divided by 8%. 156 point. Right. Last point. Compute PE ratio when dividend policy have no effect. Dividend policy has no effect. Dividend policy should be no effect only what the policies are told. If R equal to KE. In the problem, R is 10%. Then KE also should be 10%. When KE should be 10% means PE ratio should be 10 times. Hello. When it is PE ratio 10 times, then only KE would be 10%. KE is 10% means R also 10%. So dividend decision does not influence what? Market price. Okay. This is whose theory? Walter theory. Right. Coming to next one, Gordon theory. Gordon model is very, very important model. His argument is little bit different from Walter. See, this is Gordon's dividend model. What is Gordon dividend model is? So logic is very, very simple. If R is greater than KE, right? When company follows 100% what ratio? Dividend payout ratio, market price, what happen? Increases. Whose argument is? When R is greater than KE, 0%, right? Then 0% dividend payout ratio will take what? Market price. But Gordon argument is this, it is not the right approach, sir. Because, when you retain that funds, right? When company, what to do? When R is greater than KE, company has to, so 0% dividend payout ratio, it has to do. That means how much it has to retain? 100%. This retaining amount company has to what? Reinvest. When company reinvests and submits, what is that? Growth rate. By seeing this growth rate, right? Investor expected rate, what happened? Decreases, right? Because company providing dividend and retaining and again giving what? Growth rate. In such a case, risk element of the company, what happens? Increase or decreases? Company retaining my money. Company, first of all, company made earnings. Listen carefully. From the earnings, company gave 100 rupees. From the 100 rupees, company gave 50 rupees dividend. 50 rupees dividend it is provided means automatically market price won't increase. My BP will increase. Because 100 they gave how much? 50. Remaining 50 what they done means they retained and they reinvested and they submitting 14% return. How much? 14%. That is nothing but growth they are providing 14. That means this company giving what is that? Dividend they are giving. And at the same time, after retaining, reinvesting, they were giving what? Growth also. In such a situation, if the company is doing in a very, very favorable manner, automatically I will expect more from that company, expect lesser. Less means my risk element will increase or decrease. My risk element. Na double ni, if you they retain and the reinvest, if they are providing more return means it's a great only, When I will feel very risky? When no growth. So what is this argument is, market price of the company is nothing but DPS1. Yes. For example, DPS1, 10, 50 rupees you are giving. Divided by KE, if you take means market price 1 will come, right? 50 divided by 10%, let us assume. How much it is? 50 divided by 10%. How much? 500. But the company remaining balance, that remaining balance, if they reinvest and submit a growth rate means automatically my KE, what happened? Decreases to the extent of growth rate because they are retaining and reinvesting and submitting growth rate. In such a case, market price equal to DPS1 divided by KE minus growth rate. So now 50 minus 10 minus growth rate, they provided 8%. In such a case, 50 minus 10 minus means how much it is? 2%. 50 divided by 2%. Here how much ma? 500. This time how much ra? 2500 it went ra. By chance if you invested and you got a negative, you said that actually I thought it, I invested, gone. 50 divided by 10%. But you gave negative growth rate and you started to cry. In such a case, instead of minus growth rate 8%, right? Hello? You gave negative. In such a case, what will happen? 50 divided by 18%, it goes out. With effect? 277 point. Now tell me, what 500? What is 275? What is 2500? When 2500 it went? When? Growth rate? When you are retaining and reinvesting and submitting growth rate, then investor expected rate gradually decreases, market value will increase. When you are retaining and reinvested, somewhere you done a mistake, then growth rate negative, total goes out. Being a father gives a birth to a baby girl. Over the period of 20 years, he studied, he allocated funds to complete her degree, B.Tech, all these things. She done one of the case study, what I know, MSc Aeronautical Engineering, he studied by taking bank loan also. But whereas one girl after birth completing over the period of education and getting aeronautical engineering job means how great that father is. Because he's taken some lakhs of decision effectively. That indirectly conveys in our language, sales to EPS, he brought it. Yes or no? Whereas that reinvestment EPS is there, some amount he retained, remaining balance he got a job in Chennai airport. And he went to Chennai airport and he identified same caste people is there working in the same department, same qualification. So same caste, same job, same area. Right? Immediately marriage is fixed. But he could not make analysis, Gordon says a financial manager should play the role of father. That much. How I have taken wonderful decision, right? What about growth rate? You tell me final one. Sir, final one growth rate got a negative. You see the press. 500, 2700, 272. Where it is a matter of growth rate. That's why when you are able to retain and reinvest, can submit growth rate, then only you retain. Otherwise, what? Declare a dividend. That is the point. When the market value has to increase means a financial manager has to think like this. This is his attitude. So with respect to market value, according to this formula, MP0 equal to DPS1 divided by KE minus growth rate. So what about the major MCQs question they will ask you? Growth rate equal to retaining ratio into rate of return on reinvestment. DPS1 equal to DPS0 into 1 plus growth rate. KE equal to 1 divided by PE ratio, you can estimate. Right? So basing on this model, where this file, yeah. No, this is capital structure, right? Here you see, this is the problem. And Gordon model, you see, there is one more problem they asked. This is the point. This is the problem. But very, very simple problem. Part A, we do it because time is lacking. Because very simple. Part B, printed solution is available. But whatever the theory I conveyed, you should understand. That's one. That is the reason. The following data available with respect to what? Ranbaxy Limited for the year ended 31st March 2021. Share capital is how much? 25. Reserves? 15. PAT is how much? 8. Now here dividend per share is how much? 1.6. PE ratio of the company is 8 times. Can you say what is the KE? 1 divided by 8. How much? Yeah. What about the dividend per share? 1.6. What is the EPS? EPS, PAT how much, sir? Divided by number of equity shares 2.5, right? Hello? Then you can calculate EPS. How much EPS? 2.2. 3. So how from 3.2 you are paying dividend how much? 1.6. Automatically dividend payout ratio. Then retaining ratio. That retaining amount you are reinvesting. How much return you are generating? How much I am generating, sir? 8 crores I am generating with a capital of how much? 25 plus 16. Total capital employed, how much? 41. With investment you are generating 8. approximately 20% you can take. So you are generating 20%. If the retaining, if you invest, you will generate a growth rate, you will generate, right? So now tell me from this problem, compute return on investment. Return on investment, how do you calculate? Return on investment equal to PAT divided by equity. 8 crores divided by, this is a 25, that's plus 15. How much? 20%. Cost of equity, 1 divided by PE ratio. How much? 12.5%. Competition of growth rate. Growth rate equal to retention ratio into return on reinvestment. How much you are retaining? 50%. 50% into 0.20. That is nothing but growth rate is how much? 10%. KE, market value of share, equal to DPS 1.6 already given, divided by investor expected rate. How much? 12.5. From this 12.5, you retained and reinvested, you submitted growth rate how much? 10%. So 1.6 divided by how much, ma? 2.5. It went to 64, right? By chance, if you said, sorry sir, growth rate negative came sir, anna anuko, enti parasthiti? 12.5 minus plus అయిపోతుంది. Yes or no? అప్పుడు 1.6 divided by 12.5 plus this is a 10. 20, which one? Market price, You try to understand. This is you want to convey. That means you are capable to retain and reinvest, generate a growth rate, don't give to him, you retain and make a market value and provide best rate. But you are not at all capable, right? Declare what? Dividend. Are you getting? So this is the identity of this one. Indian government also takes such a situation. The people who don't have a kids, right? They will take they go to the another ashrams, they used to take adoption. But the government will say that వాళ్ళని ఎలా సాగుతావు నువ్వు చెప్పు ఇప్పుడు ముందుగా. So could you, what is your earning? For your survival, how much income you have? If you take that baby, how much expenditure you supposed to make? Where that money? Everything makes a calculation. Sir, నారు పోసినోడు నీరు పోయాడా? ఎద్దవ మాటలు మాట్లాడబాలి. పోయిడు. Okay? This is the concept, ma. And last one, Modiglani Miller. Are Modiglani Miller, why I have taken Isaira? Mahabharat problem, this is also. With this, no Sai Baba temples are, okay? See, Modiglani Miller theory. This theory was proposed by, this model was proposed by Modiglani Miller in the year 1961. First point. It is relevant theory or irrelevant theory? It is not relevant. No, it is an irrelevant model. What indirectly dividend decision argument with respect to? So according to MM, dividend model or dividend decision of the company does not influence what? Market value of equity. Because market value of firm, whereas it can with the investment decision. See, market value never depends upon what decision? Dividend decision. Whereas what decision? Investment decision, which can make huge earnings. It means that dividend decision does not take market value top, because dividend decision speaks about your past. I made it earning, from that I retained, I gave a dividend. You speaks about past. But your investment decision speaks about future. Are you getting? Where you are going to invest, what return you are generating, that you tell me. Instead of thinking about what a dividend decision I provided. So Modiglani Miller argument is here at the in future, how much dividend you are giving, don't convey this to people, because they won't buy your company shares by observing the dividend, because paying dividend is from the earnings. Earnings is nothing but what last year you done it. I'm going to buy your company shares means I want to give a shake hand to you, right? I'm also coming your company here. That means for future purpose, yes or no? In future, how you are going to make, you tell me your investment decision, I will give my hand. I will join. That means I will buy your company shares. Then only market value will increase. So dividend decision is historical one, man. You see, whether you give it dividend or not to give dividend, you say that, sorry, I got lost. That's why I could not make earnings. I won't give a dividend, right? Market value won't increase. Market value won't decrease. But you tell the investment decision, what you supposed to take this year, people, even though you made very less earnings, people start to buy your company shares, because you are predicting your future by conveying with your what decision? Investment decision. This is his concept. So market value will be influenced. What Not with what decision? Dividend decision, but what? Investment decision. He took it an assumption that a perfect capital market is there, no taxes, no flotation cost, but certainly you have to take what policy? Fixed investment policy. You may speak about investment decision or not, go to hell, not bother. But certainly you have to take what decision? Fixed investment. That means nothing but you made earning, Balu sir? Yes, sir. So you want to declare dividend, either you say declared or retained, it does not make your market value. But certainly you have to take what decision? Investment decision. You have to tell that what is investment I am going to take. So risk of uncertainty does not exist. Time element, this entire market value calculation is only has taken, what is it? 1 year. So this is the point you should consider. Company moves with what? 100% equity. Let us take according to this model. What is this identity is there? No? Market value is nothing but present value of future benefit. Hello? Market value is nothing but present value of future benefit. Whatever the value you are going to get it in future, you have to bring it into present. So what happens, when you declare a dividend, certainly you have to undertake, I have to take an investment decision. The thing is, I have to give dividend. Stand up. Now the point is, I have a earning, listen carefully. I have a earnings. If I declare dividend, automatically my market value, what happen? Decreases. But immediately I have to take what decision? Investment decision. For that I have to issue for fresh equity. Fresh equity means, will they pay more of, will they pay lesser? Lesser. Because I don't have earnings. I told you, Indra Sena Reddy, while declaring all the property, next shot is nothing, Kasi Bambam Bole. Because while going on, Thisko, Rasko, ante, Prasadam, అయిపోద్ది మొత్తం మార్కెట్ వాల్యూ గెట్స్ కొలాప్స్ కదా. దట్ ఈస్ ఆర్గ్యుమెంట్ ఈస్ దట్ హిస్ ఆర్గ్యుమెంట్ ఈస్ వెన్ కంపెనీ డిక్లేర్స్ ఎ డివిడెండ్ ఇట్స్ మార్కెట్ వాల్యూ వాట్ హ్యాపెన్ decreases. For the sake of investment, company has to issue more number of shares. In such a case, what will happen? In the balance sheet, more number of shares gets added. With that amount in the asset side, what happen? Investment gets added. Both will take place. What is that? Set off effect. So that's why dividend decision does not influence market value. Now suppose, let us take a small example here. You can make it here, the observation. This is the 1 lakh. What is this? A company has 1 lakh shares, 10 rupees each. 10 lakhs, fixed asset is 9 lakhs and 9,000, 1,000. Total is nothing but how much? 1,000. They have a profit of how much? 1,000. Now the situation is, with this profit they may do D, they may do R. But certainly they have to take what decision? Investment decision. Now what will happen? His argument is calculation of market value of firm and market value of equity when company declares dividend. When company declares a dividend means, what is argument? So you have to take investment. Now simply step number 1. If you, whatever the profit you have, if you declare a dividend, automatically your market value comes to 9 lakhs. Hello? Because how many shareholders are there? 1,000. You have so far, what is that? Some amount, right? Profit you have. This profit gets disappear. When you declare dividend, automatically your value will come to how much? This 9,000 would be distributed by how many members? Then each share value worth would be 9 rupees. But you have to undertake what decision? Investment decision. You go to the market. Will the people pay 10 rupees or 9 rupees? 9 rupees. Because you want to take what decision? Investment decision. That means newly shares should be issued. 1,000 divided by 9 rupees. Then automatically the share value gets added to liability side. In such a case, old shares how many? 1,000. New shares again 111. So 1,000 plus 111 into 9. How much you got it? 10,000. With this issue of this shares, you got the amount of profit. With that amount, what you done? Investment 1,000. So market value will remain same. That means indirectly, if you declare a dividend, your income goes out. But you have to take investment decision. To take investment decision, how do you get the money here? You won't get money, right? Hello? For that purpose, what you have to do? You are going to issue fresh equity shares. When number of shares increases means liability side total number of shares increases. With that amount you are going to invest. That means balance sheet does not any effect. Okay. So this is the argument Mr. Walter argument is. Basing on this, Modiglani Miller. Basing on this, he identified some key formulas. Market price equal to market price as on today means you are holding for how many years? 1 year. In such a case, you used to get I am going to buy a company shares, I am going to hold it for just 1 year. In such a case, MP0 equal to DPS1 plus MP1 divided by 1 plus KE. Why 1 plus KE, sir? Because it is a future value factor. Hello? But how do you find it out? This DPS1 plus MP1, you can multiply with the present value factor or divided by with what? Future value factor. What? So present value formula, what is that? Present value equal to future value into present value factor, or else you can also calculate future value divided by what factor? Future value factor. Future value factor formula 1 plus r whole power of n. This is the strategy he identified. So market price equal to DPS1 plus MP1. MP1 equal to, in such a case, MP0 into 1 plus KE minus DPS1. Number of new shares, if you want to know, means how much investment amount is required, what is the earnings you have, out of that how much dividend you declared, that means divided by MP1. Whereas market value of equity shares, total number of shares plus what is that? Market price. Total number of shares means what shares? Existing shares plus new shares into MP1. So market value of firm, if you want to calculate, existing shares plus new shares into MP1 plus earnings minus investment divided by 1 plus KE. If you declare market value of equity, market value of firm will gives you same value. Okay? Basing on this, what the problem they given, if you able to analyze this one, this is the Modigliani-Miller theory. Now you solve this one, that's a matter. We will complete. See here. Doroflex Limited, how many shares are there? 20 lakhs existing shares are there. Outstanding. Accounting here, that the existing market price MP0 kitna ra? 300. The expected dividend is nothing but 20. The rate of equity capitalization KE is how much? 20%. Now you have to calculate market price per share when company declare what is that? Dividend. When company declare dividend, how do you calculate? You see, this is the problem was solved it. So here, market price at the end of the period. What is MP1? MP1 equal to MP0 into 1 plus KE minus DPS1. Na? So 300 into 1 plus KE 1.20 minus dividend you are paying 20. Yes or no? So market price would be. So this is when company declares dividend. When company not declares a dividend, there 0 will come. So 300 into 1.20, 0. How much it is? 360. Number of new shares. Number of new shares, how do you calculate? Investment minus earnings minus dividend divided by MP1. Investment needed how much? 8 crores. Whereas earning is 5 crores. Out of that 4 crores dividend used to pay divided by 340. How much it would be? 2,05,882. You will be number of new shares. Whereas here 8 crores investment, earnings is 5, but the dividend is 0. But market price what you calculated 360. It would be 83.334. Then market value of equity means existing shares plus new shares into MP1. 20 lakhs plus 2.05882 into 340 means you used to get how much? 760. Here 20 lakhs plus 0.83334 into 360, 75. You see, market value will remain same. Coming to market value of firm, you want to calculate existing firm, existing shares, new shares into market price plus earnings minus investment. So 1 divided by KE. Already this value you calculated 75 plus 5 minus 8 crores 1.2 means 60 crores. 75 plus 5 crores minus 8 crores divided by 1.2. Market value of firm remain constant. Market value equity remain constant. So whether dividend decision you declare or not to declare, you are not going to change which one? Market price and KE. But you certainly will influence where you are going to invest. That investment will declares your market price. So what you dividend decision is simply speaks 1 minute ma. Listen. Your dividend decision speaks about historical, what you have done. But your investment speaks about, Elon Musk have several companies, 80% companies won't declare dividend. But still people start to buy the shares. Why? Because, his investment opportunity is, with respect to future, you will get shocked. Intra babu anta. 8 lo 1 workout aina The total used to get it the returns. That means how effectively you will make investment. That speaks about your worth, not declaring dividend. Declaring dividend is past earnings. So this is the point, ma. With respect to this, these are the some important points I analyzed. Do you know EPS? Do you know dividend means? MCQs ra. Dividend yield ratio, dividend divided by market price. PE ratio, cost of equity, another name, investor expected rate, yield rate, return on investment, return on capital employed, growth rate, how to calculate? Retaining ratio into rate of return on reinvestment, dividend payout ratio, dividend divided by EPS, retaining ratio, retaining profit divided by EPS, intrinsic value of the share is nothing but fair value. Fair value of the share, intrinsic value of the share, both are same. Concept of overvalued, undervalued firms. Overvalued firm, undervalued firms means sometimes comparing to its intrinsic value, share price may floats at higher. That is called overvalued. Sometimes less. That is a undervalued. Irrelevant dividend models means what? Models. Irrelevant models means dividend decision does not influence market price. Relevant models. Yeah. Sometimes buyback of shares means MCQs. If the company has more earnings, which is not at all useful, in such a case, instead of keeping that one, the company will what to do? It will buy back its equity shares. Assumptions of each model, do you remember? Formulas for market value, you keep it in one. Market value for garden formula. DPS1 divided by KE minus growth rate. Walter model, D plus E minus D into R divided by KE. KE. What about MM? Existing plus, new plus, yeah. And finally, Gordon dividend model, MM model. This is non-constant growth rate model. Dividend is that sometimes dividend never be paid at fixed ra. Sometimes what happen? Up to 5 years they will pay 8%. Thereafter saturation. Thereafter they will decline. So this is the one of the identity. Constant, non-constant growth rate means they never pay dividend. First 5 years they will pay highest growth rate. Thereafter saturated. Thereafter declining. Like that, if at all growth rate never be stable, then they will follow non-constant growth rate model. These 21 points are very, very key. Once again, you check it. So you will get the best from this chapter, right? All the best. So today we're going to take one more most important chapters from the examination point of view. That is a working capital management. See this information, what is disclosed in front of you, it indicates the past exam trends from this chapter. So maximum they've been concentrating on how many marks? 10 marks. So maximum 10 marks. So here from this chapter we can expect absolutely 10 marks. But what are the areas we can expect and what areas we have to concentrate today is the most important, because in regular hours we used to deal this chapter more than 25 to 30 hours. But here exclusively hardly 2 hours. Okay, this. But first of all, you should understand what is a working capital. See, dear students, every corporate company, if they want to run effectively, means point what you have to understand here it is. You see, working capital. The fact is this, in fastest manner I will complete it. See, here is the introduction part. You should understand every corporate company need working capital. Before that, what any businessman, you are a businessman, you are planning to do business, right? When you plan to do business, right, certainly you will expect what? You will expect what is that? Capital. So any business, if you want to run, you need a capital. This capital is estimated basing on requirement. So basing on requirement means number one, what they need? Fixed capital. Another one is fixed assets we need. Another one is current assets you need. This building is a fixed asset. So this mic, this pen, all these things are what? Current assets. That means capital of the company is determined with two types. What are the fixed assets and current assets? In order to acquire fixed assets, the company has to invest on what assets? In order to acquire fixed assets, company has to allocate some capital from the given capital. That capital is called fixed capital. So this is MCQ question. MCQ question. Fixed capital used for what purpose? To acquire fixed assets. For the sake of current assets, you will use what is that? Working capital. If you observe the working capital, it is the amount of capital required to a company in order to acquire only current assets. Coming to meaning, 2 marks you can expect from this. Theory question. What is a working capital? What do you say working capital? Sir, working capital is the amount of capital required to maintain, what is it? Day-to-day business operation in a S manner. S manner means a smooth manner. Okay? Superb, smooth, sophisticated, whatever it, you can use it. So working capital is amount of capital required to maintain day-to-day business in a smooth operation. So it is amount of capital invested by the company on what assets? Current assets. Not, they are not going to invest on fixed assets. They are going to invest on only current assets in order to generate return from what assets? Fixed asset in a smooth manner, we can say. This is the 2 marks question already asked. Then one more MCQ question. MCQ question covered, right? Sir, what is another name of working capital? What is another name of working capital? You can take, what is it? Short-term capital, circulating capital. What is that? Short-term capital, circulating capital. Can you tell me a formula for working capital means? Current assets minus current liability. What is the current assets? Question, MCQ question. The assets which would be used only for the sake of 1 year. This won't generate any return. Okay, its lifespan is very, very less. Are assets which can be converted into cash within a short span. That is called current assets. MCQ question. What is the current liability? The liability which should be paid within 1 year is called current liability. Example for current liability. Trade creditors, bills payable, yes or no? Creditors, delay payment, wages, all these things. Current assets, inventory, cash, bills receivable, yes or no? Debtors, all these things comes. That is. One more question they asked in a 2 marks. What is that? What is the working capital management? Sir, just now we discussed, what we discussed? Working capital. Now what is going to discuss? Working capital management. 2 marks already they asked this question. What is the working capital management? Working capital management means 1 plus 2. 1 is what? Systematic. Number 2, what? Management. Management of working capital. Sir, everybody can manage, no sir, not like this. Here we used to manage very, very systematically. So what is a working capital management means? Working capital management means systematic management of working capital of the company. See, working capital management, right? So every company working capital management is to maintain, what is it? Adequate working capital. I repeat again. Working capital management object is to maintain adequate working capital. To maintain adequate working capital means you have to balance 2 things. What is it? Liquidity and profitability. What is it? Liquidity and profitability. It means that you need to hold more working capital. Why? Because to maintain more liquidity. Why? Because to solve the risk element of the company. But whereas if you hold, when you hold more working capital to maintain more liquidity to solve the risk, right? You want to handle the risk, but at the same time, negative impact also will happen. What is that? Once you hold more, automatically your cost, what happen? Increases. Your cost increases automatically. Your purpose of commencing business, that is nothing but profitability, gets damaged. So that's why you have to balance which one? Liquidity and profitability. Just knowing the knowledge of working capital, you cannot manage it. You must understand working capital management concept very, very comprehensive manner. Because what every company has to concentrate, what is cost? Cost should be very low. Cost should be very low means the company always holds working capital very, very less. Whereas a liquidity you have to maintain. Risk should be identified. Profit to be generated. By considering all these 4 factors, maintaining working capital need wonderful decision making power with respect to working capital management. Clear now? Yeah. Next, another one, they asked a 2 marks question in the past theory question. Significance of working capital. Balu sir, why should study this working capital management? Because to maintain adequate working capital. Balu sir, could you please tell me why should a company, by maintaining this working capital, what is the benefit it is going to enjoy? Hey, excuse me, Ra, if you have working capital with you, you can reduce what? Risk of uncertainty. Hello? Risk of uncertainty, it can be reduced. For example, in my wallet, 10,840 rupees is there. Anything may happen at any time, right? I can spend. If it is only 10 rupees is there, situation is different. Risk is very different, right? So that is I have working capital means I can reduce what? risk. And I can make a payment in time, whatever it may be. Whatever the payments I have to make, I will pay in time, because when I have what? Adequate working capital. When I make all the payment in time, automatically my goodwill will increase. I will become what leader? Market leader I will become. Okay. So everything gets one another. Every company wants to become a market leader. In that case, there is a one of the span to bring that place when you maintain adequate working capital, and in business you will reach top position and you will become a market leader. Okay, ma? These are also 2 marks questions they asked. Then, what are the various ways to estimate working capital? They asked that MCQs. Identify which method is used to estimate working capital. Dear students, each and every company, right, works in their own way, right? That's why we cannot attribute that this method you should follow. So there are multiple ways are there to estimate working capital. So working capital estimation can be done in 3 ways actually. One is specific percentage on what? Expected sales. Another one is specific percentage on fixed assets. You can take fixed assets. That these 2 things are not important, because here you will take a sales and you apply percentage. Here you will take fixed assets and you will apply percentage. So both are not systematically scientifically proved methods. Whereas another one is there. What is that? Working capital estimation basing on operating cycle period. Approximately 8 steps, 7 to 8 steps are there. The 10 marks so far I showed to you in your material, right? All these elements are from this 10 marks, this 10 marks, this 10 marks, this 10 marks. All these are what? Working capital estimation for 2 things. What is that? Existing company. Another one is a new company. Only this. Now, can you say in simple way, what is the working capital? Working capital equal to current assets minus current liability. So, working capital management means what to manage? Systematic management of what? Working capital. You have to manage working capital. For this purpose, what you have to consider? You have to consider L, liquidity. You have to consider what? Profitability. Okay. How to estimate the steps means you have different steps. First of all, to calculate working capital, I told you how many steps? Yeah, 8 steps. First step is operating cycle period, means you must also understand what is operating cycle. Again, 2 marks. What is operating cycle? Operating cycle is the time period in which raw materials are converted into cash. It is also known as length of time. It is also known as cash cycle. MCQs you can expect. So what is another name of operating cycle? MCQs. So cash cycle. Why it is titled as cash cycle? Because once the cycle gets completed, company able to generate what? Cash. That is called cash cycle. So an operating cycle is a consist of various holding periods. Various holding periods. What are the various holding period? Raw material holding period, work in progress holding period, finished goods holding period, debtors collection period, creditor payment period. If you want to tell the amount, right, the client has to tell the time. So a client comes to your office. What is the entire story from this chapter? I will tell you. A client comes to your office. He says that I want to produce how many units? 60,000 units. Okay, sir, 60,000 units I want to produce. And from the 60,000 units, next year I want to produce, sir. If I produce the 60,000 units, to produce 60,000 units, I need only this much of cash. How much? This much of cash. With this cash, if I produce this much, once I sold in this market, I will get how much cash? This much of cash. Are you getting? Hello? This much of cash if I give means once cycle gets completes, I will get more cash. So that means at any cost, I should produce how many units? The 60,000 units I have to produce. So my point is that by chance, if at all any problem arises in future, how should I handle the corporate company, sir? That's why please tell me how much amount I need to hold for the sake of any uncertainty, any disturbance happens, so that I can take that amount immediately and I can solve the issue. Are you getting? That is the working capital. Without that amount also you can handle what? Without that working capital also you can handle the project. But the issue is if at all any problem happens, Gaya, amen. So your company would be sealed properly. So that is the reason you should hold. working capital importance will happen only once you know the importance of working capital. Once you don't know the working capital important, right, the situations are, you can take it as very, very easy. So that is a previous class also I told you, this Guntur incident I told you. Yes, this is a Guntur incident, but I don't want to share this one, right? It's very, very painful. See, rat kills an infant at Guntur in government hospital. It is a painful issue, Nora. You try to understand. And here you see the same rat went to engine, the flight engine. It went to check all the buttons and came, right? Is it purpose for this? You are purchasing, idiot, you have that much of capital to buy what? Flight. You don't have money to manage it. You know, one of them, my family members in my apartment, they purchased 25 lakhs of gold. They kept a house, but they purchased 55 rupees lock. From Sunday market street is there, there he purchased. And now they are saying that we lost money. We went to Kottapakonda. Before that, what happened? The SI came and asked that how much gold? 25 lakhs. What is the cost of lock? 55 rupees. Go and attend marathon of Balu sir. Now he is taking what class? You have amount to purchase 25 lakhs gold. 55 rupees working capital, particularly lock. That is the working capital. Sometimes the people will be, that's why today class I told you, in India public sector is failed because, we never care about what? Working capital, nothing else, nothing chalta. Working capital plays very, very important. Clear ma? So in exam hall, what is the point? What is that straight question? Sir, okay. So far I covered, all are from past exam questions. Now directly enter into the problem. What is the problem? Client will come. He will tell, sir, I want a working capital, tell me. So when working capital, I want to tell, you tell me what is your operating cycle holding period. For example, I want to celebrate my marriage. Okay, marriage function. Sir, point is that, what I'm saying, the decoration parties are decoration, aisa hola, dadrali povalante. Dadrali povala, paisa gode hoddi. Dadrali povala. Tell me, sir, when we enter, blast should happen, flower should come. All these things means if I tell my requirement, they will also tell what? Amount also they will tell. If you tell, blast will happen, tarvat you have to give blank check. Yes or no? But he will say, sir, no need, sir. Sir, simple, sir. Sir, marriages are made in where? No problem, sir. After that, you will pay phone pay. He will say. But you say that heaven, smoke, give me blank check. So simple logic is that how much requirement you pose, so they will demand that much of amount. Similar to here, you have to understand, sir, what are the various your holding period, you tell me. So holding period, it indicates raw material holding period. There are 2 marks question asked that, what are the various holding period? Tell me. The client may convey various holding period. What is the holding period? Raw material holding period. Do you know what is the raw material holding period? See, I will give you a small, what is the presentation within 1 minute. Raw material holding period, I will take you, Tata salt is there. You see Tata salt. This Tata salt, in order to produce this raw material, they will keep, in store. This is called raw material holding period. You try to understand. To produce this Tata salt, rock salt should be needed. For how many days of production purpose, they need what? Rock salt. That is called raw material holding period. Raw material holding period 2 months means what? Raw material holding period 2 months. That means either rain will comes or whatever the disturbance may happen, they can run their company 2 months because they have adequate raw material. For only how many months? 2 months. If the Tata Motors, they are going to produce cars, so they need a raw material for, they will maintain 6 months. What is the 6 months, sir? Hello, car, one bolt is not also there. It is not at all called car. Hello. Okka bolt kada em kadale kanit, sir. Tape is పంపించేద్దాం దేన్ని కారుకి టేప్ వేసావు నువ్వు. 1 bolt also is not there. That is not at all called car. That's why their holding period should be more than 4 months, 5 months. That's why raw material holding period. Understood? Raw material holding period means this is the raw material kept by the company over the period. If you go any of the time, right, you will find adequately 3 months or 4 months stock of raw material. This is the raw material holding period. The next one, what do you have to, for example, Tirumala Tirupati Devasthanam, I told you, in order to laddu manufacturing, they will hold only 2 months, 2 days ghee, right? 2 days అయిపోయిన తర్వాత కిందకు వస్తారు కదా. కిందకు వచ్చి బకెట్లో పట్టుకుని మళ్ళీ పైకి వెళ్తారా? సో దే విల్ మెయింటైన్ యార్ 10 months holding, they will maintain Tirumala. If something shortages happen, that's enough. Okay, whereas thereof this is called raw material holding period. Length of time material are held between purchase and being used. Thereafter you have what is that, work in progress holding period, right? Work in progress holding period, where client says, Balu sir, raw material ho gaya na, work in progress holding period. What is work in progress holding period, sir? Very simple. This is the time required to convert the raw material into finished product. For example, if I give raw material to my factory, in order to convert that raw material into finished product, it will take how many months? 2 months means during the 2 months, I have to take care my raw material. Yes or no? Here raw material enter into iron sheet like this. This would become what is that? Wonderful car. Hello. It will possible only when how many months? 4 months or 5 months gets completed. During the period, I should hold money, For what purpose? For this raw material purpose I should hold. Here worker purpose hold. With worker heroes ali gelipote. Shall I close the factory? If I have money, Pobe, your grandfather will come. If I know money, father, please help me. I used to say. So that depends upon what is that? How much money you hold it. So that is the raw material, wages and indirect expenses. So while estimating work in progress holding period, you have to understand 3 things very sharp. The దారుణమైన షార్ట్ కట్ I will tell you. Work in progress, this is the W, లాగి కొడితే 3 వస్తుంది. అంటే in working capital you should hold how many things? 3. What are they? Raw material, wages, overheads. See, you can maintain wages, overhead with the average of 50% money. But for stock of raw material, 100% you need. That during the period, you have to allocate. For example, my marriages happen. I went to decoration party. I said, Anna, after marriage, I will give you money. He said, no. I said, no. What is no? Decoration of the pora. Na kosam vastar gaani decoration kosam raru po anna. That is the catering ayana kellanu. I said, Anna, after marriage, I will guess. He said that no. I said, okay, no problem. Yes. At least 25% I will give you. 90% I will give you. 100% you have to give means I have to allocate what? 100% money. So for wages, overhead, you can handle with what? 50% conversion cost. For raw material should be 100%. You keep it in mind. Conversion cost for raw material, how much? 100%. Once again, what is the work in progress holding period? Tell me. Sir, it is a time required to convert the raw material into finished product. How many aspects you used to make investment? 3. Raw material, wages, overheads. So to calculate this stock of raw material, what is the formula you should use? Raw material consumed during the year divided by 12 months into work in progress holding period. Sir, how much you take? 100% or 50%? Conversion cost. For that conversion cost, when direction disappear, assumption appears. Are you getting? In the problem, what happened? Direction disappears, assumption appears. If you won't give any direction, right? You can take 50%. 50%. So this is the stock of raw material, wages. For the wages formula, wages incurred during the year divided by 12 months into work in progress holding period. Overheads incurred during the year divided by 12 months. Here 50% is conversion cost. These are the 2 things. Thereafter you need find it out. What is that? Finished goods holding period. You see, cars are produced, but instead of selling, what he kept? Where? He kept in warehouse. That is a warehouse, you kept it. That means why he's kept it? Because once you produce a product, immediately if you start to sell in the market, means supply will increase, production gets what? Collapse. That is the reason to maintain sustainable demand in the market, produced product you should not sell directly to the market. So sometimes the tomato prices comes to 2 rupees. Because all the farmers, they will produce at a time, they will bring it into market. With effect, supply increases, price gets collapsed. If you are producing round the clock cars, right, every day you are dumping in the market, automatically your supply gets collapsed, In order to protect that one, what do you do? Even if you produce, you don't send directly to the market. Just hold it in a godown. So that what happen? Market moves in market, your demand will be sustainable. For example, you see a patient gets an accident. Saline should be injected. Hello. Saline ma. Inject cheyalanko. There is a wheel. The patient is emergency means wheel తిప్పేస్తామా? చక్రం తిప్పామనుకో జీవన చక్రం పోద్ది అక్కడ. So that's why that wheel would be there. If doctor nurse is delayed, don't play, you play with that, right? ఆడుకోరా నాన్న అని చెప్పేసాం వాడు వచ్చే లోపల ఆడుకుంటూ ఉంటాడు దాన్ని. That is the reason? So, yes sir, ma, not for Maji. So what is the purpose means? The saline should enter into the body with the speed of blood. That is the finished goods holding period. That logic you kept in mind. So now, how do you calculate finished goods? Means you have to take what? Cost of production divided by 12 months into finished goods holding period. Question arises, while calculating stock of finished goods, should we consider depreciation? Should we ignore depreciation? Ask that either is there DD, direction is there, no direction. Then you can go with assumption. What are the various assumptions? Number one, you can ignore depreciation. When you are ignoring depreciation means you are calculating only cash cost basis, because depreciation is a non-cash cost. If you are considering means you are considering cash cost and non-cash cost, thus you are considering what basis? Total cost basis. Are you getting ma? Yeah. Thereafter, debtors. So debtors means every company wants to become a market leader. If they want to become a market leader means they have to sell the produced product in the market. If you restrict yourself that I will make only cash sales means, sorry, you cannot sell at least 1 to 2 items also, because though only those people will buy the product from you only who have cash. But if you offer credit, you can sell more. If you sell more, you can produce more. If you produce more, you can control fixed cost. With effect, you may generate more profit. Keeping all these things in mind, you offer to provide what is that? Credit period. So that's why in order to provide credit period, how much money you should have? Because I have more money, I will give more credit period. I have less money, I will give only less credit period. I don't have money, I never give what? Credit period. But when you don't give credit period, you don't make more sales. Okay. You don't make more sales, you don't produce more number of units. Okay. If you don't produce more number of units, you cannot get fixed cost advantage, boss. That is the reason debtors should be valued. How to calculate debtors? Credit sales divided by 12 months into debtors collection period. But sometimes in credit sales, the contradiction happens that what to do profit, sir? Should we consider profit or should we ignore profit? If you consider profit means you are taking on credit sales. If you are ignoring profit means you are taking cost of sales, cost of credit sales. Are you getting? So debtor should be valued this. So thereafter you have what is that? Current liability, these are. Then you have to consider what is that? Current assets. So far we completed. Then current liabilities. Current liabilities means sometimes what happens, the raw material what from where you are buying, you may get what? A credit. Hello? In such a case, that will serve as a current liability. When it serves as a current liability, your working capital what happen? Decreases. Why? Because just now we discussed working capital equal to current assets minus current liability. So trade credit equal to credit purchases divided by 12 months into creditor payment period. So if the trade creditors provides a credit, that is a favorable. Thereafter workers delay payment will happen. Today is what is date today? 12. But still now I could not paid any my maid the amount what I used to pay the salary, I could not paid. That indirectly means I have taken 10 days interestless loan from her only, no? Yes or no? In my bratuku, I have taken interestless loan from her, because outside I am saying that istale amma antano, kani inside what happened? I am taking an interestless loan. So wages are overhead, you make it delay payments. That delay payment also serves what? Current liability. Are you getting overheads formula? Overheads incurred during the year divided by 12 months into time lag. If we make a delay payment, this will serve ma. So finally, dear students, you have to calculate current assets, you have to calculate current liability, you have to find it out net working capital. Once you got the net working capital, when prices of raw material gets fluctuated, in order to overcome, there is a what? Margin. Margin means additional amount to be kept. That is called margin of safety. Margin of safety, how do we calculate? When DD has disappears, assumption appears. You can take either current assets or current liability also as per direction. If not so, you always calculate on what basis? Working capital basis. Directly if you want to move means it is highly impossible, because first of all you should understand what are the holding periods estimation. This holding period estimation serves the problem, right? More than 5 to 6 problems, format is same. Now once again, stock of raw material formula. Raw material consumed divided by 12 months into raw material holding period. What is the unforgettable point with work in progress? That is nothing but what? Conversion cost. Yes or no? Conversion cost. That is how many conversion cost? 3 versions. Stock of raw material. Raw material consumed divided by 12 months into finished goods holding period into work in progress holding period into conversion cost 100%. What about the wages? Wages incurred during the year divided by 12 months into work in progress holding period into 50%. Overheads incurred during the year divided by 12 months into finished goods work in progress holding period. It is also stock of finished goods. Cost of production. Cost of production means total cost of production you will take. Cash cost of production to take. Cash cost of production means I am ignoring which one? Depreciation. I am considering depreciation when I calculate total cost. So total cost of production divided by 12 months into finished goods holding period. Coming to debtors. Debtors should be considered credit sales or cost of credit sales. So credit sales means you are considering what? Profit. Cost of credit sales means only you are considering total cost. So credit sales divided by 12 months into debtors collection period, you will get the debtors. Thereafter cash balance, any advances are also is there, you can consider. Thereafter current liability, trade creditors, credit purchases divided by 12 months into creditor payment period. Sometimes if the credit purchase is not given, in such a case you may take a decision. Raw material consumed during the year also serves as a credit purchases. Wages incurred during the year divided by 12 months are 365 into time lag. Overheads incurred during the year divided by 365 into time lag. So whereas net working capital, what to do? You have to take a current assets minus current liability and you have to add what? Margin to it. You will get what? Working capital with margin. So this is the dear students, all the problems are only this model, right? Whereas I gone to your material. So which problem been asking? One problem they have taken standard problem and they identified all the additional points. So that problem is, here you are going to study this one. There is one more problem also identified. So this is the problem you see. Several times they asked, but old syllabus this is MTP 2016, 15, 17, this one. Because sometimes these days what is going in the market, they are taking old problems. When 2017 and 15 problems, they are considering that and they are projecting now. So that is the one version. Whatever the version it may be, you can easily solve this problem. First, in order to calculate working capital, you have to understand. But this problem is one of the best problems. Which one? This one. This is from past, old study material, new study material, everything is there. From this problem they have taken and he added various points to be. How it is a treatment? Now I will take this problem and I will ask you, what are the various core concepts asked in remaining problems that we are going to discuss now. So in this problem you try to see. On 1st January, Managing Director of Vishnu Limited wishes to know the amount of working capital. Which company? Vishnu Limited. They want to know the working capital. So production during the previous year they produced 60,000 units. But plan to this level activity will be maintained during the present year. You see here, in order to make you confusion, he has provided long-term sources and fixed assets. This is one of the confusing element. So issued with the equity share capital. So issue share capital 3 lakhs. Debentures given, whereas a fixed assets also given. So expected ratio of selling price. Here directly they could not provided raw material everything. They have provided raw material is how much percentage? Wages, overheads 10%. So 20%. Sorry, raw material remains store in average of how many? So who is telling to what? Which company? Vishnu Limited is telling time. You have to tell to. He tells time. You have to tell the amount, right? That is nothing but working capital. So what is this 2 months? Tell me. Raw material holding period. How many months? 2 months. Whereas each unit expected in process, how many months? 1 month. So work in progress holding period is 1 month, right? Finished goods will stay in warehouse approximately 3 months they given. That is called finished goods holding period. Credit allowed to debtors is how much? 3 months. That is nothing but debtors collection period. credit allowed by creditors, that is nothing but creditor payment period. Wages and overheads are paid 1 month for the previous month. That means January should be paid in February, February should be paid in March. Like that, in 12 months you need to pay only 11 months, because 12th month you are not paying this year. When? Next year. So that means you are getting a current liability for how many months? 1 month, right? So you are required to prepare working capital with 10% margin. Okay, this is the standard. But by taking this standard problem, and I will ask you multiple questions, so whatever the points the covered in remaining problems, right, you are required to prepare profit and loss account. Okay, now in order to solve this problem, what we have to do, we have to prepare what? Profit and loss account. You see, in the problem, what is the given? Raw material holding period is given. First, what is that given? Inventory namsa. What, Maji? Raw material holding period, work in progress holding period, finished goods holding period, debtors collection period, creditor payment period, and time lag. What about the raw material? What about the cost of raw material? Tell me. 5 rupees is the raw material price. 5 rupees into 60%. How much? 3 rupees. Wages 0.5. 5 rupees into 20. Overheads 1. Cost of production you got it. Is it cost of production or cash cost of production? Huh? Cost of production, cash cost of production, cost of sales. An MCQ you can expect from this. Why it is called cash cost of sales? Because there is no selling distribution expenses. Why do you say that it is a cash cost of production? Because in the problem, what is not there? Because of not having depreciation, it will be cash cost of production. Because of not having profit, then it is called what? Cost. Because not having selling distribution expenses, it is called cost of sales. Next, selling price is given. Now, statement showing working capital requirement. Each and every individual assets we have to calculate, right? For example, stock of raw material formula. Raw material consumed during the year. 60,000 into 3 divided by 12 into 2. How much? 30,000. Raw material holding period. Work in progress holding period. Formula. Raw material consumed 60,000 into 3 divided by 12. What is this one? Work in progress holding period. What is this 100? Conversion cost. Why don't you take 50%? Sir, without raw material you cannot take, sir. Why? Because raw material enters into the factory in the beginning itself, right? You cannot handle with the 50%. If something happens, your company gets collapsed. That's why for raw material you better to hold always 100%. What about wages? Wages incurred during the year. How much? 60,000 into 0.5 divided by 12 into 1 into how much percentage? 50%. So 1,250. Thereafter overheads. Overheads incurred during the year. 60,000 into 1 divided by 12 into 1 into 50%. How much? 2,500. If you sum it up all the work in progress, you got it 18,750. Thereafter stock of finished goods. Formula, tell me. Sir, 2 versions you can calculate. Cash cost of production, cost of production. Yes or no? What is in this problem? Luckily, what is not given? Depreciation is not given. Okay. So that's why cost of production 60,000 into 4.5 divided by 12 into 3. 67,500. Debtors. You can calculate 2 versions. What is that? Credit sales, cost of credit sales. Okay. CS, CCS. What is the CCP, CP? Cash cost of production, cost of production. What is the difference between these two? Depreciation. What is CS? Cost of sales. What is the CCS? Cost of credit sales. What is the difference between these two? Profit. Should we consider or ignore? Already Mahamantra. DD is not there. AA will come. Okay. So that is the reason 60,000 into 4.5 divided by 12 into 3. How much ma? 67,500. Cash 2,50,000 minus 75,000. So you have already in the problem overdraft facility is there. That is the reason 1,75,000 taken. Total current assets 3,58,000. Coming to current liabilities. Trade creditors formula. Trade creditors formula. Credit purchases divided by 12 months. Balu sir, credit purchase not given, sir. Raw material consumption you have to take. So credit purchases 60,000 into 3 divided by 12 into 2. How much? 30,000. What about the wages? Wages incurred during the year into 0.5 divided by 12. How many months delay you are paying? 1 month. So 2500 will happen. So overheads 0.5 overheads equal to 60,000 into 1 divided by 12 into 1. How much? 5,000. So you have to consider total current liability. Are you getting? So 37,500. Net working capital, current assets minus current liability. You can add what? Margin of safety to it. So you can, whatever the working capital is taken, you take that working capital, you add the margin, you will get it working capital to it. You see, while solving the problem, you have to write compulsory what? Assumptions. What are the assumptions includes? See, while evaluating work in progress, it is assumed that conversion cost for raw material is how much? 100%, whereas 50% for what? Wages and 50% for overhead. Debtors are valued at what basis? Cost of credit sales. Alternatively, it can also be valued at credit sales. Credit purchases in the problem not given. What to do? Credit purchases are assumed to be raw material consumed during the year. Okay, this is the point to be considered. If they ask to prepare profit and loss account, what we can take? We will take the sales, right? From the sales, raw material consumed 1,80,000, wages 30,000, overheads 60,000 into 1, 60,000, and on interest debentures you have to pay interest, right? After deducting, you will get the net profit. Okay, this is the question they asked. Now, if the debtors valued on what basis? Following different problems, they asked multiple questions. I am going to bring everything in this one problem because you know that one problem by solving 1 hour goes. Now, tell me, in the problem, if debtors are valued on credit sales, what is the formula? Credit sales divided by 12 months. What point you consider, what point you ignore here? Profit, what you ignored, you have to consider. Okay, number 2. If the, another question, CRD 4, I think so. CRD 4, they have given work in progress, 75% conversion cost is given. Do you remember one problem? Work in progress is raw material 75%. In such a case, what to do? Sir, work in raw material 75% and wages overhead is how much? 50% given means in such a case what to do? Raw material you have to take how much percentage? 75%. Wages and overhead you have to take 50%. Right. In the one of the problem, manufacturing overhead depreciation is considered. Okay. With the depreciation he provided. But in the end he gave a direction that ignore what? I need working capital basing on cash cost basis. Hello? Cash cost basis. This is one of the question even recently with the artificial intelligence also I asked a question. So the question is that, Balu sir, tell me how should we estimate working capital basing on total cost basis, cash cost basis. Already this question is given. So total cost base means what you are doing? Sir, while calculating stock of finished goods, I will consider what? Depreciation. Cash cost basis means? Yeah. If the same thing I want debtors also on cost basis means what should I do? I should ignore consider a profit. I should ignore because you are asking cost basis, right, ma? Are you getting? That's okay. Another important point is, sir, 1 month delay payment, you know, that means how do you consider 1 month? Because last year 1 month will fall to this month, this year, right? But the thing is, you know, we are producing for 60,000 units. That 60,000 we are going to produce in future. Hello? So whatever the past expenses you are taking means you are thinking accounts, not financial management, because we are deals with what? Only future. That 60,000 working capital you have to tell. How should you take the past 1 month? Past 1 month is that 60,000 is there in the past? No. Are you getting my point, ma? So last year any expenses is there means we should not consider. Are you getting? My marriage is happened. Still now I could not provide the pujari fees. Now my brother is going to get this month marriage means ఆ పూజారి ఫీజు ఎంత అంటే రే నీది ఒక 30,000 నాదొక 20,000 మొత్తం కలిపి 50,000 ఇచ్చారంటే పెళ్లి చేస్తాడు నాకు రెండోసారి. అప్పుడు వాడే ఉంటాడు నాకు సంబంధం లేదంటాడు. దేన్ని? దిస్ వన్ బికాస్ యు నో హిస్ మ్యారేజ్ ఎక్స్పెన్సెస్ మీన్స్ హీ హ్యాస్ టు టేక్ దట్ పూజారి. ఆయన ఖర్చులు తీసుకోవాలి కానీ ఎప్పుడో పరిగెటింగ్ మా. దిస్ ఇస్ ద వర్కింగ్ క్యాపిటల్. Then another important point is, remember, raw material is taken 75%. In such a case, no direction. You have to consider. Credit purchase not given in one problem. In such a case, what to do? Raw material consumption itself is credit purchases. Okay. While calculating stock of finished goods, instead of holding period, He has given 10,000 units. In such a case, what to do? Finished goods holding period is not given. Listen, finished goods holding period is not given. Instead of finished goods holding period, he given a 10,000 units. In such a case, holding period is given means develop a formula. Units given means convert the amount. What is that? Convert the amount. 7,000 units means units into cost of production per unit. Sales units, 1 lakh units. Sir, debtors collection period where, sir? I don't have debtors collection period. What to do? 1 lakh units. 1 lakh units, sir. 1 lakh units into selling price. Are you getting? You have to understand. When holding period is not given, he will give you units. This model problem we considered in Aneja limited problem. Hello? There is a wonderful problem because I cannot touch that one. Again, 1 hour goes out. But what is that problem? PQRS limited problem. And one more PQR limited. Balu sir, in future I have a provision for taxation, sir. But sir, Balu sir, in the provision for taxation, I will pay tax for only 60%, sir. In such a case, what is the current liability, sir? You try to understand, Ra. I told you Hundi story, you know. Long ago, I told you in classroom, my father, whenever my sister, myself, whenever we used to go to school, right, we used to ask money, daddy double ivante. For my sister, he used to say, enta kavali. For me, he say, endu kavali. There is one of the worst things has happened. One fine day, I find it out. My daddy, mother called who? Nana Mama. She is a devotee of Tirumala Tirupati Devasthanam. One fine day, she kept a hundi there. Gaya. I stopped to ask money in this world. Because whomever they will ask you that, I say that, నాకు ఎవడున్నారు? దేవుడే ఉన్నారు. అందరికీ దేవుడు వెలుగిస్తాడు. కానీ నాకు వెలుగు లేనప్పుడు డబ్బులు ఇస్తాడు. The story is very simple. Now tell me, Ra, as long as that hundi is there, for me, no working capital is required. Similar to a company maintaining provision for taxation also, it serves as a hundi. So the client saying that, sir, I have a 1 lakh rupees provision next year, sir. Hey, 1 lakh rupees provision, that 1 lakh is serves as a current liability, you are. But what to do, sir? 50% I have to pay that year. That means how much current liability serves? From the 1 lakh, you are going to pay tax how much? 50% means remaining 50% only serves as a current liability. There is a problem, I think problem number 5. In the 8th problem, the CA Institute says the client have provision worth of, let us take 24,000. Listen. ఇక్కడ వినమ్మా, నేను అన్ని ప్రాబ్లంలో ఒక్కొక్క పాయింట్ చెప్తున్నా. ఎందుకంటే అన్ని ప్రాబ్లము నేను చెప్పలేను ఇంకా అందులో. సో దిస్ ఇస్ ద వన్ ఆఫ్ ద పాయింట్. ఐ మేడ్ ఇట్ ఆల్ దిస్ నోట్స్. సో దట్స్ వై ఐఎమ్ అబ్జర్వింగ్ అండ్ ఐఎమ్ మేకింగ్ నోట్స్. సో provision for taxation given 24,000. What is the treatment, Balu sir? Dear students, provision for tax serves as a current liability. But the thing is, if the client, whatever, for the sake of last year, he made a provision, he brought this year. This entire year, if could not make any payment, means during the year, that provision serves as a current liability. Do you agree? Whereas, from this amount, the client says that 50% I will pay this year means, so I will have current liability only worth of 50%. 70% he pays. Then again he will say, I have a provision, but immediately I will make a payment. In such a case, no current liability, understand? But don't consider that, hey, provision is there, you know. Where is that provision, Ra? You paid, you know. Are you getting? So that is the point. And in that problem, he asked, Balu sir, I have 1 lakh provision. Okay. 70% I will pay, sir. That means 30% is serves as a current liability. In the 70%, one installment I will pay what? Advance. Advance means current assets, sir. In such a case, that 1 lakh divided by 1 lakh is there, no? Out of 1 lakh, 30% you are keeping. How much you are paying? 70%. So 1 lakh into 70% you take. Divided by 4 crore. Each installment will come. But one installment you are paying advance. It serves as a current asset. So that is the problem. I think PQRS limited is one of the important point. Okay. One more problem is given. I want working capital on what basis? Cost basis, right? Whereas their problem is saying that working capital, the cost of production, the company makes a sales of 33% above the cost. Hello? 33% is above the cost. That point is irrelevant to me. Why? Because I am going to calculate working capital on what basis? Cost basis. With this point, you should understand, in order to make you to confusion, he will provide you irrelevant data. They will dump irrelevant data. So don't consider each and everything. Okay, ma? Direction, conversion cost, provision. Yes or no? one more. Cash. One more problem. Cash is given. What is another point is, cash is estimated on future current liability. Do you remember one problem? Cash is nothing but, how much cash? Cash could not provide it. He said, my cash is nothing but 25% of total current liability. In such a case, what you have to do? Before calculating current assets, you better to move to what? Current liability. You have to calculate all the current liability and you have to take that 25%. Are you getting? Another point is, one more point is given, margin of safety with working capital I need 15% with working capital. In such a case, what to do? So you need working capital with the provision, with margin. Yes or no? That is 100%. Yes or no? What, Maji? Working capital. This is working capital, ra? This is a provision. This is a working capital required means with what? Provision. But he told that how much provision he could not consider. But you said that what working capital without provision is 85%. In such a case, that 15% is provision. So 85% without provision working capital you calculated means this working capital is equal to how much percentage? 85%. If you take 100%, this would be 15% would be the difference. So these are the all the study material questions they asked. They will take this problem as a standard. You will add depreciation. Yeah, what to do? Will you consider a ignore? Ignore. Basing on direction. Profit, treatment. Consider a ignore. Basing on treatment. Do you know conversion cost how to take? Sir, 100 to 50, 50%, sir. Yes or no? Credit purchase not given. Raw material consumed. Time lag, will it be 6 months, 4 months, sir? Sir, time lag never be happen, sir. Okay, hardly 1 month in days. Are you getting? Sometimes, one more problem. Holding periods given is a raw material, 12 months given. Sometimes it is given 52 weeks also. What to do? Whatever the data he is given, you have to take that one also. Okay, ma? This is with respect to what? Working capital. By taking this problem, I covered all these concepts. Another important point with respect to this one is, you have to consider operating cycle. What is that? Operating cycle. So, important point to be considered is operating cycle. Here, what is the operating cycle? Okay, let me have an idea about this. What is the operating cycle, dear students? Operating cycle. What is the operating cycle? Operating cycle is the time period. You listen carefully. This is the second model. Operating cycle also one of the important model, but asked for 5 marks. Whatever the problems they asked 5, majority from operating cycle. What is the operating cycle? Operating cycle is the time period in which operating cycle also known as what is that? Cash cycle. Operating cycle, it is the time period or length of time duration in which raw materials are converted into cash. They will ask you MCQ questions. What is that? What are the various holding periods? What are the various holding periods? Raw material holding period, work in progress holding period, finished goods holding period, debtors collection period, and creditor payment period. Okay, why it is called cash cycle? Because once this cycle gets completed, automatically you can generate what? Cash. So how do you calculate cash cycles? How do you calculate cash cycle, Ra? So operating cycle is depends upon various holding period, right? So here what I will tell you here. This is operating cycle. See, operating cycle. It is the time period in which raw materials are converted into cash. Operating cycle includes various holding periods. What are the various holding periods? Raw material holding period, work in progress holding period, finished goods holding period, debtors collection period, creditor payment period. All these holding period. So, how to estimate net operating cycle period or working capital basing on operating cycle? Examiner asked 2 questions. How do you calculate net operating cycles? Or number 2, how do you calculate working capital basing on operating cycle? Net operating cycle period equal to, you can directly take raw material holding period, work in progress holding period, finished goods holding period, debtors collection period minus creditor payment period. One more thing is, dear students, MCQ question, don't forget this one. So net operating cycle period also can be calculated like this. What? Inventory conversion period plus debtors collection period minus creditor payment period. Inventory conversion period includes raw material holding period, work in progress holding period plus what? Finished goods holding period. Sir, if it is holding period is nothing but 40 days, sir. In such a case, how many cycles I can generate, which is also known as cash turnover. Array, to generate raw material from raw material I will give it to factory. It gives cash within a 40 days means in a year how many days? Let us take 360 days. In 360 days within a 40 days I'm completing cycle means how many cycles I can get it? 9 cycles I can get it. Every company wants to get more cash cycles or less cash cycles are? More cash cycles. More cash cycles you are getting benefit, right? So that indirectly conveys number of cash cycles or cash turnover equal to 365 divided by net operating cycle period. Working capital always never be calculated per annum. It is calculated basing on one cycle. In a year you are holding one cycle means nothing but whatever the total cost you incur, the total cost is nothing but working capital. 1 lakh you spending, 1 lakh, one cycle you are making means working capital is nothing but 1 lakh. But you are making it 10 cycles. 10 cycles means working capital is nothing but 1 lakh divided by 10 cycle. Each cycle comes 10,000 into working capital is always considered, what is that? 1. Here you see, total cost divided by number of cash cycles into you have to multiply with what? 1. Because working capital is always estimated basing on, working capital estimated for not the total cycles, for one cycle. Thereafter, examiner certainly will ask you MCQ question, how do you calculate individual holding period? He may ask you debtors collection period. Just now we discussed that if examiner gives time, you calculated what? Examiner gives time, you calculated amount. Now if he comes with the amount, you must calculate holding period. A raw material holding period, how do you calculate? Average stock of raw material divided by raw material consumed during the year. How do you calculate work in progress? Average stock of work in progress. For raw material consumption we have taken. For work in progress we have raw material plus wages plus overheads. That's why you can add the word, what is that? Cost of production. For finished goods, average stock of finished goods divided by cost of goods sold. What is the cost of goods sold? How it is different from cost of production? Opening stock of finished goods minus closing stock of finished goods is a difference. So average stock of finished goods divided by cost of goods sold, right? What about debtors? Average debtors divided by credit sales into 365. So creditor payment period. Average creditors divided by credit purchases divided by into 365. Average creditors divided by credit purchase into 365. Remember MCQ question. Creditors payment period also known as deferred period. What is that? Deferred period. This is most important. Now next question they will ask you, how do you calculate number of cash cycles? Formula for number of cash cycles. All these points. Now tell me, only examiner concentrates to ask you the following. Here you see, I took this problem from our material. So how many times they've been asked from this problem? Several times. In fastest mode, you simply calculate this one. You see, raw material 65, 45. Work in progress 51, 35. Finished goods 70, 60. Debtors 135, 112. Creditors 71, 68. Annual purchase of raw material, all the credit is 40 given. Annual cost of production 450 given. Annual cost of goods sold 525 given. Annual operating cost including what? Depreciation is 25, 325 given. Annual sales completely 585. From this point he is asking number 1, calculate net operating cycle period, calculate number of cycles and amount of working capital on what basis? Total cost basis, cash cost basis. Now tell me, total cost basis, cash cost basis, indirectly what it conveys? So if you ignore depreciation, then it is cash cost. If you consider depreciation, that is total cost. And if you are market leader, if you discontinue to provide credit sales, in such a case, how much working capital you are going to save basing on what? Cash cost basis. This is the problem they given. Here to calculate this one, raw material holding period formula. Average stock of raw material divided by raw material consumed during the year. Raw material average stock, opening plus closing divided by 2. How do you calculate average raw material consumption? Opening stock of raw material plus purchases minus closing stock. So opening stock plus purchases minus closing stock 350, 380. So 65 plus 45 divided by 380. You got how many days? 53 days. What about the work in progress holding period? Average stock of work in progress divided by cost of production. So opening 35 plus 51 divided by 2 450 into 365. Approximately how many days? 35 days. Finished goods holding period. Average stock of finished goods divided by cost of goods sold. So 45 days. Debtors collection period. Average debtors divided by credit sales into 365. How many? 77 days. Creditor payment period. Average creditors divided by credit purchases. 63 days. This is the individual holding period. Next you used to ask what? Net operating cycle period. Net operating cycle period, how do you calculate? Raw material holding period, work in progress holding period, finished goods holding period, debtors collection period minus creditor payment period. So 53 plus 35 plus 45 plus 22 minus 63. 140, 147. Number of operating cycles, 365 divided by net operating cycle period. You used to get it 2.5. What about the amount of working capital on cash cost basis means from 325 you have to deduct what is it? 25 depreciation divided by 2.5. Reduction in working capital. If you want to reduce the working capital for discontinuing of what? Debtors collection period, right? In such a case, can you tell me in proposed operating cycle how much would be? Raw material holding period 53 will come. Work in progress 35 come. Finished goods 45. In the debtors collection period 0. Hello? Minus 63. In such a case, how many days? 70 days. 70 days it will come. So 70 days means number of cash cycles. How many cycles? 365 divided by 70. How many cycles? 5 cycles. 5 cycles means working capital on cash cost basis. How do you calculate? 325 minus 25 divided by 5 cycles. But we need working capital only for 1 cycle. How much it would be? 60. Previously, how much working capital we used to spend? 120 lakhs. Because of reducing our working capital saved 60. This 60 lakhs, if you invest outside, you used to get what? Opportunity cost benefit. Because of having control of this cash cycles, you can generate more number of what? Cash cycles you can generate. Working capital also you can reduce. Okay. That is, but it is not such a damn important, but 5 marks compulsory question. There is a chance. But if this chapter is picked up for what? 10 marks, working capital estimation, with so far whatever the points I discussed with you, all the points, you take that points, keep it in mind, you would be given. Operating cycle 5 marks. Sir, is there any area to ask 10 marks, sir? Yes, absolutely is there. What is that? Debtors management. Another important point is 10 marks. With this debtors management, one more deep important point is nothing but factoring. But factoring is a very rarely used asked concept, but the last attempt they asked. So this attempt we may a little bit what? Get relaxed. Okay. पूछता नहीं है. ऐसा हम सोचना नहीं है. We have to solve it. What is debtors management, receivable management? Very, 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 very important point. So what is a debtors management? Debtors management means systematic management of whom? Debtors. So systematic management of what? Debtors. So this is the most important point, systematic management of debtors. Management, it indicates whenever it is a down, right? You have to increase. Whenever it is high, you have to decrease. So debtor should be properly managed. In order to manage that one, the company designs what is that? Credit policy. In order to make this one, okay, I will tell you the debtors management identity. Here you see, dear students, first of all, you should understand debtors. What is it, debtors? Debtors means many of the people have opinion that credit sales. No, no, no. Not a credit sales. In order to offer a credit sales, how much amount is required is called what? Debtors. You know debtors formula. What is the debtors formula? Credit sales divided by 12 months into what? Credit sales divided by 12 months into debtors collection period. In such a case, credit sales debtors, how it would be equal? So debtors means whenever I want to provide any credit to my client means I am producing product I am giving. She is taking outside. In order to run my company, I need a money, you know. If my money, in my wallet full of money is there, then I can offer more credit. If I offer more credit, I can make a more sales. More sales leads to more production, leads to more fixed cost advantage. So I will be, what is that, advise that తీసుకెళ్ళమ్మా డబ్బులు ఏముంది అని నంగనాచి మాటలు మాట్లాడతాం కానీ actually I too know why I am making a credit sales. Okay, the thing is, I used to get what advantage? Fixed cost advantage. But if I want to provide more credit, she will buy more. She buy more, I will sell more. If she sell more, I will produce more. If I produce more, I used to get what? Fixed cost advantage. If everything should happen means in my wallet children should be there. That is called what? Debtors. More debtors, more credit period. Less debtors, less credit period. No money, no. That's why sometimes they used to raise appu adagaradu. Why adagaradu? No chiller, sir. That is the point. What is the management? Management means what manager do. So debtors management means it is the systematic management of what? Book debts. For the sake the company debtors management, how they will do, one is increasing book debts, decreasing book debts. Both are part and parcel of debtors management. So by offering credit period, a company can increase what? Book debts. So sometimes first they will offer, sometimes they will extend. Examiner 99% they will ask a second model. What is that? Instead of offering, so they will ask you that if I want to extend the credit period, then how much would be the amount to be required, and whether it is good to extend the credit period or not. So company can, by offering credit period, by extending credit period, company can increase what? Book debts. Sometimes if company feels more book debts are there, then company has to reduce. How it can be reduced? By offering what? Cash discount. By taking what service? Factoring service. So here the factoring service will link with what? Debtors management. Will it be in increasing book debts or decreasing book debts? Decreasing. I made a credit sales. I have to collect it early. I will take whose service? Factoring service. This man goes and gets a collected and he will pay money. So finally what you have to understand, you have to make a evaluation. This is the format you learn. 90% you can set off all the problems. So the evaluation of credit policy consists A, B, C. What is that? A, B, C. What is the A? Take the sales. Hello. So from the sales, what to do means, in order to evaluate any policy, what you have to identify is, you have to consider, first you have to calculate what? Expected profit. Because of by offering credit policy or increasing from present to proposed, what is the profit you are going to generate? This is, you have to keep it in mind. For that purpose, what you have to take? What is the credit sales? Less, what do you deduct? Variable cost, right? From that, thereafter you will get what? Contribution. Less, you have to deduct what cost? Fixed cost. Less, if at all bad debts is there, deduct. If at all collection cost is there, deduct. If at all cash discount is there, deduct. Then you will get what? Profit before tax. From the profit before tax, if less tax is there, you pay it. Then you will get it. What is that? PAT. Here 2 lakhs is got. Here 5 lakhs, 4 lakhs he got. Is it favorable or unfavorable? By offering 30 days, you are making how much? 2 lakhs. By offering 60 days, you are offering 4 lakhs. That is a benefit only, but still it is a PAT only. It is not a net benefit, because still there is a what cost? Opportunity cost, because your money is getting blocked by how many days? 30 days. This 30 days opportunity cost I should calculate. Should I calculate on S or should I calculate C? What is that S? S means on credit sales. Hello. Should I go with what? Cost. So credit sales I will take or cost of credit sales I will take. Debtors can be calculated. Cost of sales you can take, or what is that? Credit sales you can take. Divided by 12 months or 365 into debtors collection period. If you calculate debtors collection period also, you can make it. So then you will get the net benefit. Net benefit is 4 lakhs here. Net benefit here 14 lakhs, here 14 lakhs. Here 4 lakhs, here 8 lakhs. What is your observation? What is your observation? Present policy, by offering how many days? 30 days. You are able to generate how much? 4 lakhs. Whereas by offering credit period 60 days, you are making how much? 8 lakhs. Extra how much you are generating? 4 lakhs you are generating. That's why we can say extra credit period can be extended. Are you getting? This is the debtors. Now coming to, in this model, we have to consider there is a problem which is very, very standard problem. So within a lack of time period, I don't have much time, but from this problem, I made it from past exams. You try to understand how many times, whatever the information is provided, this everything is an investigated one. It is not simply in order to motivate I have taken. Because, don't spend your valuable time, the random problems, time waste. So which problem is a repeated model, means CA Institute take that one, he won't ask that problem, but he will make mixing. So you should find it out that which problem is the best for mixing. If you take this one, you can add, okay, this point comes, what is the treatment? This point comes, what is the treatment? I have taken working capital 1, but I consider all the points. I explained, Amma, this is the point. Ila vastadamma, ila vastadi. At the same time, debtors management, whatever the problems are there, I considered and I took this problem. And while solving this problem, I will convey each and every point. Okay, na? Right. Coming to debtors management. First, debtors management consists of 3, I told you. What is it? A, expected. Another one is opportunity. C, A, B, C. Yes or no? Now in the problem, what we calculate? First, what you have to identify is you have to calculate A, expected profit, right? A, you have to calculate expected profit. Expected profit means you try to understand present policy. In this company, what you will take it? XYZ Limited Corporation is considering relaxing its present credit policy in the process of evaluating 2 policies, not 1. There is a one more problem is there. 5 policies are there in CMA. 5 policies. Present policy is there. For present policy, 5 policies added. Your valuable time gets consumed. So, but that is the reason sometimes you must be get ready to handle even 5 policies also. Procedure is same only. It's not a difficult. But the only issue is time. So, okay, present policy, proposed policy is 2. Currently, the firm has an annual credit sales of how much? 50 lakhs. And account receivable turnover ratio is 4. This is the very, very important. Account receivable turnover. This is nothing but how many times a company by providing credit period getting cash from debtors. In a year, how many times? 4 times. 4 times means 12 divided by 4. How many months? 3 months. Here 3 months. Here tell me, 4 months. Here tell me, 2.4 means 12 divided by 2.4. How many? 5 months. Ma, are you getting? This is one of the new innovative point. That's the reason he provided. Instead of providing credit period. Debtors. So, the accounts receivable turnover. This indirectly, debtors collection period is 3 months. The current level of loss due to bad debts. Currently, bad debts how much? 1,50,000. The firm is required to give return. Opportunity cost is 25%. If the client is delayed to make a payment, the company loses by how much? 25% on the investment on new account receivable. Company's variable cost ratio is given how much? He could not provide variable cost. Variable cost ratio how much? 70%. What about contribution ratio? 30%. Selling price on selling price. The given the following information. Value debtors at what basis? Variable cost basis. Right. This is the point is given. Now annual credit sales given. Account receivable. From this account receivable times you have to extract the credit period. Bad debts losses. 1,50,000. 3 lakhs how much? 4,50,000. Right. How should we calculate it? What I told you. 3 A, B, C. Right. What is A? Expected profit. First you take sales 50 lakhs, 60 lakhs, 67 lakh 50,000. Less B. What do you do? Here you have to write a less. Okay. Less variable cost. How do you calculate less? Sales into variable cost ratio. How much you will get? 35 lakhs, 42 lakhs, 47 lakh 25,000. Next, you will have bad debts. Less you again you have to deduct bad debts. Bad debts already given. So 1,50,000, 3 lakhs, 4,50,000. Now by deducting everything, you will get the PAT, right? PAT 13,50,000, 15 lakhs, 75,000. Next B, what you have to calculate? Opportunity cost. Opportunity cost can be calculated on variable cost basis. What is the variable cost? 35 lakhs, what ma? 35 lakhs divided by 12 months into what is the present debtors collection period? 3 months. 3 months into opportunity. How much? 25%. How much? 2,18,750. Whereas here 3,50,000 So here 42 lakhs, credit variable cost, 42 lakh divided by 12 months into 4 months into 25%. How much? 3,50,000. What about here? 47 lakh 25,000 divided by 12 months into 5 months into 25%, right? So after A minus B, if you do so, net benefit how much? 11 lakh 31,250, 11 lakh 50,000, 10 lakh 82,812. Comparing to present policy, company making a benefit. How much benefit? 18,750. Comparing to present policy, company making negative 438. So instead of providing 4 months credit, it is not at all good to provide how much? 5 months credit. You restrict yourself to what? 4 months. This is the problem, right? From remaining problems are there, in the study material. What are the key points? Point number 1. One of the point. What about the fixed cost? In the problem, fixed cost is not given. If the fixed cost is given, means where you treat. After variable cost, you have to deduct what is it? Fixed cost. Company offers cash discount will be provided 10% on sales. Present policy, 15% of sales. Proposed policy, 20% of sales is given. In such a case, where you treat. After fixed cost, you will get it, Yes or no? With that, you have to deduct what is it? Cash cost. Cash discount. In the problem, tax is missed. What to do? After paying all these things, whatever the profit you will get it, from that profit you have to pay tax. Okay, ma? Whereas in the problem, net opportunity cost clearly said, I want only on credit sale basis. In such a case, what to do? You should not consider variable cost. You have to take only credit sales basis. Okay? These are the observations you have to consider with respect to debtors. Thereafter, another important point there would be called, what is it? Factoring. What is the factoring? In simple term, factoring is agreement. Factoring is agreement between two parties. Who are they? Company and the customer. See, company here, customer means particularly factor. What happens, here there is a company which makes what? Credit sales. So this credit sales, 1 minute. Suppose here is company is there. Okay. This company makes whom? Credit sales. So after systematic evaluation, company makes what sales? Credit sales. So company offer credit sales means these people used to pay when in future, right? But the thing is, when these people unable to pay, or if a delay to pay, or this man need money now, in such a situation, what happen? He will approach to whom? Factor. So factor, he will approach the factor. What purpose he will go to the factor? Yes, it's me. It seems to be Trump dress. Trump is wearing my uniform actually. Whatever the shoot I will wear, Trump always makes a copycat. A company, a company is there. A company takes what service? Factoring service. Tell me in your general sense why company takes factoring service? Yeah, because reasons for taking factoring service. 2 marks question. Tell me. Number 1, effective collection of book debts, because factor has to go and get the money collected, and again he will hand over to whom? Company. So that is the reason. Another one is source of finance. If at all the company has factor has certain money, he can provide that money to him as an advance. So here the examiner will ask you evaluation of what service? Factoring service. So whether you are a CA, a client came to your office. He may say that to 2 reasons. Reason number 1, sir, is it good for me to take what service? Factoring service. That's you have to identify. In order to evaluate this factoring service, being a chartered accountant, you have to find it out. That, sir, because taking factoring service, what is the benefit you are going to get it? This is the benefit. Because of taking factoring, this is the cost you are going to incur. By the way, are you going to take loan from factor or not? Sir, I am going to take loan, sir. That is the only purpose. So you are taking loan means you have to pay 2 costs. What are they? One is, because of taking factoring, you have to pay what? Commission. Because of taking cost, you have to taking loan, you have to pay interest. Sir, how it should be properly calculated means this is the format CA Institute provides. Not CA Institute provides, CA Institute provides you the more information. But the entire information, if you concise in a simple way, you will get this format. Number one, you being a CA, you have to recognize that the client, your client who is going to take factoring service, right? You have to educate him that whether to take factoring service or not. First, you recognize what? B. What is the B? Benefits. What are the benefits? Savings of bad debts. If you take factoring, who is going to pay responsible for that? Who? Factor. Bad debts. Savings of what? Collection cost. Okay, totally he is responsible. And opportunity cost? Benefit. Opportunity cost benefit means if the factor collects money early and pay to you, okay, better time pay to you earlier to what you offered to your client. For example, I offered 3 months credit period. I taken factoring service. So factoring service, because of taking this service, what is the benefit I am going to get it? So that the 3 months, within 3 months, my factor is going to be in touch with him. And once the money get collected, he will hand over to me. But the point is, if 3 months time is there, my factor is too active. He may say that, sir, I will pay your money within 2 months. I offered how many months? 3 months. Sir, 2 months I will give you, sir. How, man? Sir, whether he will provide me not, that is a secondary story. But I will give you. Within how many months? 2 months. In such a case, I used to get one more benefit. What the benefit? Opportunity cost benefit. Right? If you make a delay, in such a case, opportunity cost loss. So contribution benefit. Contribution benefit means because of by trusting factoring word, if I make more sales, then on extra sales, I used to incur only extra variable cost only, no? Because fixed cost will remain same. So that is the reason. Another point also you can consider. This format is not given format. Format is whatever the problem is asked in your material, just I made it adjustment this. So that's why saving of bad debts, saving of collection cost, opportunity cost benefit. Another one is contribution benefit. You have to ask the 4, whether the 4 is there or not. In the maximum, in a problem, you may consist all these things, but sometimes it may not be. But you add all these things. Thereafter, ask the factoring cost. So factoring cost should be calculated. Factoring cost agreement always be taken per annum. That's why cost and benefit should be per annum. So factoring cost or fees, how much you have to take? Contribution loss. Contribution loss, how do you calculate? So sometimes what happen, because of by trusting factoring word, right? Factoring, we can reduce the sales. Factor may say that, listen carefully. Factor may say that, sir, don't make 50 lakhs worth of credit sales, sir. They are unable to pay. In such a case, I may reduce sales, By trusting factoring word, if I make more sales, I will add it to contribution benefit. By trusting factoring word, if I reduce what? Sales, then it is called what? Contribution loss. Thereafter, interest. If at all I have taken loan means I have to pay what? Interest. So these are the concepts I have to consider. Factoring cost, contribution loss, interest. Sometimes opportunity cost loss also I have to take. How to opportunity cost loss? Because he collects money but he don't provides money to me. He will keeps with me. In such a case, my debtors what happen? I'm not going to get it on that. So there is a loss may also happen. What is that? Opportunity cost benefit. Simple logic. If he collects money early, opportunity cost benefit. If he collects, he will make a delay, opportunity cost loss. Are you getting? If you take loan, you have to pay what? Interest. It is not a $1,000 question. It is not the chemical energy. It is nothing but an agreement here. You are going to handle a person. In your regular life, this transaction will happen. Don't think it is a something is what? Rocket science. అప్పు తీసుకోవాలి అంతే వాడు డబ్బులు ఇస్తాడు కన్సిడర్ చేస్తాం ఈ పాయింట్ you never go with beyond your imagination. Practically, if you observe that, what happens if I take money from this agreement? So what will? Everything you can make an identity. First, when I was in 5th class, we have a Gurkha. Gurkha, when I was 5th class at that time, Gurkhas are there. Now, nowhere Gurkhas. Unnara? I don't know, ma. These people, they used to make a whistle. There will be. And the Gurkhas are there. Whenever I listen the sound of Gurkhas, then only I will sleep. Because, Bhayyam, Dayyalu, ilantu untayani other feeling. But Gurkha used to watch. But the thing is, for Gurkha, every month he used to come and gets collected. But my mother appoint him as a servicer. How? Because my mother says that Puri box gives me and my sister in school always రమ్మనేది. ఇప్పుడు చెప్పు అందరూ ఇచ్చినట్లుగా మా మమ్మీ ఒప్పుకుంటామా? మా అమ్మమ్మ ఏమనేదంటే అందరూ ఇచ్చినట్టే కదా మేము ఇస్తున్నాం అంటది. బట్ ద Gurkha says, madam, you are taking extra service. Yes or no? When you are taking extra service means you have to pay extra. Nothing but Gurkha is nothing but indirectly serves as a factor. First, your job is to go and get collection money. But along with that, what happened? You are taking some additional service means you have to pay some additional amount. That is a basic observation. For example, if you provide a temporary loan to him, in such a case, what to do? నువ్వు వాడికి లోన్ ఇచ్చినావు, అప్పుడు నువ్వు ఏం చేస్తున్నావు చెప్పు? ఆ ఇంట్రెస్ట్ని వాడికి ఇచ్చే దాంట్లో నుంచి ఏం చేస్తావు? కట్ చేసి పే చేస్తావు. ఇట్స్ ద బేసిక్ ఐడెంటిటీ కదా, మినిమం కామన్ సెన్స్. ఇట్ ఈస్ నాట్ ఎ కెమిస్ట్రీ. ఎస్ ఆర్ నో? రైట్. సో 4 you consider saving of bad debt, saving of collection cost, opportunity cost benefit and contribution benefit, and cost of factoring fees, contribution loss, interest and everything. From cost benefit minus cost you deduct, you will get what? Net benefit. If net benefit is positive, accept, otherwise reject. So basing on this, only one problem, very important problem they given in this past exam question paper, that is a 6 marks problem. I told you, 6 marks problem. So Navya Limited problem is given in your study material. Why I have taken, the people used to ask the doubts in this problem. Sir, format ila kuda cheyochu kada, ela cheyocho, I gave the format for that also. You see, Navya Limited has the annual credit sales of how much? 45 lakh. Credit term how many days? 30 days. But the management receivables has been very, very poor, and the average collection period is how much? 50 days. So their company been suffering with what? 50 days. Bad debts is how much? 0.4%. There is a painful story. Hello? Yes or no? What is the bad debts? 0.4. Collection period is 50. Now the hero entered into the house. Who is he? Factor. A factor has offered to take a task of what? Debt administration and credit checking at annual fees of, right, 1%. He is not a what? Dharmaraj, right? He will charge us how much? 1%. 1% fees on what? Credit sales. Navya Limited estimates that it would also save how much? 35,000 per year in administration cost as a result. Due to efficiency of the factor, average collection period reduced to 30 days. Previously how many? 50 days. Now it reduced to 30 because factor effectively going and getting collected money. But factor would advance up to rascal collecting in 30 days but providing only 80%. So remaining 20% lies in the hands of whom? Factor. So is it opportunity cost benefit or opportunity cost loss? If he collect 30, if he gives total early means, we will feel super yaar. We will feel it is opportunity cost benefit. But here it is opportunity cost loss. Right. And 8% of invoice debt. Annual interest rate is how much? If he provides advance means loan he will provide, sir. If he loan provides means on loan we have to pay what? Interest. Okay. But he collects money within which days? 30 days. But he will give that amount in the form of loan how much? 80%. Remaining 20% is with him only, no? What? With him only. And Navya Limited currently financing receivables and overdraft cost of how much? 10%. That means if the Navya Limited unable to pay, if Navya Limited, if at all their money gets blocked, automatically they will lose what? Their opportunity cost. Are you getting? So opportunity cost rate is 10%. So here compute whether the factoring service should be accepted or rejected. Assume how many days? 365 days in a year. Evaluate the factoring proposal assuming interest will be collected in the margin of money retained by the factor. If the factor retains, the 20%, that 20% also we have to calculate what? Rate of interest. That is nothing but you have to consider opportunity cost on that concerned amount. Now here, what are the, just now I told you, what are the concepts we have to consider? A, B, C. What is A? Tell me. Expected benefit. What are the benefits because of factoring? Number 1, saving of bad debts. 45 lakhs divided by 0.4. How much? 18,000. Saving of administration cost. Directly given a yes, 35,000. Saving of opportunity cost. How opportunity cost is saving, sir? Excuse me, I will tell you how the opportunity cost been saving, right? So presently you try to understand present investment and debtors. You are making sales of how much? 45 lakhs divided by 360. How many days your debtors been blocking? 50 days. 45 divided by 360 into 50. How much? 6,16,438. This is your present painful story, ra? Yes or no? Hero came. Who? Factor. This hero proposed to collect the factor 45,000 divided by 365. Within the 30 days he gets collected. Hello? But 30 days he collected 80% he gave. Hello? Because of factoring, 20% stays with him. So how much of debtors are there after factoring? 73,973. Now previously how much we used to lose? 6,16,438. Now because of taking factoring, how much debtors left? 93,973. That means reduction in debtors how much? 5,42,465. 5,42,465. On that you have to opportunity cost benefit kada. Opportunity cost benefit how much? 10%. So 5,42,465 into 10%. How much? 54,247. So three benefits. One is saving of bad debts, saving of administration cost, saving of opportunity cost. 54,247. So it would be 1,07,248. Thereafter another one is cost. What the cost you are going to pay? Directly factoring commission you have to pay, right? So 45,000 into how much percentage? 1%. How much? 45,000. Interest also you have to pay, right? So interest how do you pay? You have to consider first of all loan. So loan, what is the receivables you have taken? 45,000 divided by 365 into 30 days he gets collected. But 30 days he 20% margin money with him only. In such a case loan he provided how much? 2,95,895. On this loan we have to pay interest how much? 11%. 11% means how much? 32,548. So 32,548 means the total would be 77,548. So net benefit 29,699. So this is the solution. This solution also in different way in your material is there. But the thing is once this format gets connected, once you understand this format, that answer somewhere gets what? Confusion. If you want that answer, right, this way you can follow. But both are what? Same only. So this is the factoring. Why corporate companies take factoring service? Tell me. In simple logic. I told you practical example also, right? At the time I was taking a class, this is mechanism actually takes place. See, there is a company, this company after evaluating customer, so it will make a credit sales. Goods moves from here to here. Then invoice document comes from customer to firm. Thereafter, what a company feels that it is in danger zone, only believing or following this client because he has a number of works tasks to be done. Immediately he will approach whom? Factor says that, sir, I made a credit sale, this person has to give. So you go and get money collected. So it will take an agreement. When agreement is taken, this document enters to who? This document, invoice document goes to in the hands of whom? Factor. Factor what happen? Waits for right time and goes whom? Customer and gets the money collected. Money collected and he will make a set of whatever the money. From that money he will take interest, he will take the commission, rest he will pay. This entire process will take place. This process is called what? Factoring. For example, I will take you, this is the Andhra Bank. When Andhra Bank 500 crores of loans are there. But the government of India said Andhra Bank is going to merge with what? Union Bank. RBI is restricted that gets all your loan to be collected. Then immediately this Andhra Bank went to whom? Bajaj Finance. Sir, serve as a what? Factor. Go and get collected money. Then this all the documents given to whom? Bajaj Finance. This Bajaj Finance went to all the customers of Andhra Bank, collected money and hand over to this Andhra Bank. And if at all at that time in the collection process, sometimes it may take loan also. Right? And the past exam trend, one more important 5 marks question, least condition they've been asking is, that is nothing but cash budget. From the trends I observed it. So one of the area they've been asking, one of the question is nothing but cash budget. There is a chance to ask a 10 marks also. You cannot neglect this one because you see how many times they asked. We've been concentrating working capital and all these things. Suddenly cash budget asked, Champa bagilipodante. That's why you must be very careful with respect. Bowler runs with what? A ball. But while running, he throw. But batsman thinks that a speed ball. But what happened? Slow ball. Mid wicket gone. That commentator says that the ball is very slow. But what you done, Ra? I guess it is a fast. Go to hell. So that's why that is the reason cash budget we can consider. So what is a cash budget? Cash budget is systematic estimation of availability of cash. So for a particular time period, you see, this is the cash budget. Cash is a liquid cum emergency asset. Cash budget is a systematic estimation of availability of cash of a business in a given time frame per the period, considering both total receipts, total payments. Try to understand when expenditure, when Diwali comes, Dasara comes, right? And what is that? Vinayak Chauthi comes, this may come in future, but already in my mind they came. I took a pen and paper, I prepared what? Cash budget. This is budget, Ra. Yes or no? Unless until being a responsible, you cannot consider it. It is not possible. So your parents has to take that budget. So cash budget means systematic estimation of availability of cash particular time period by considering what? Total receipts and total payments. So how the corporate, why cash budget is prepared? Cash budget is very, very important, sir, for the sake of what? Better cash. And for the sake of supports, what is that? Financing decision. Because once you prepare cash budget now, you can recognize that in which month you are in scarcity. Every month scarcity ante, no need of budget. Take a bowl, go to entire Bradipet. No need of preparing water. Cash budget, full cash of money. Okay? Because easy you can get the money. So 140 crores people, if you take a bowl, 100 crores if you touch, you will get a crore. Crore pati. Within one day. Water. But the condition apply, all the people has to give water. That much of Batku is no need. Okay, ma? Better cash management. So cash budget, better cash management supports financing decision. When you prepare a cash budget, you can identify scarcity. Ra. Once you prepare cash budget, you can identify in which time period you have what? Surplus cash. And finally, it serves as a what print? Blueprint. Once you prepare cash budget, yes, I can say, no problem, I can handle it. But whereas this cash budget should be prepared for not long period. It is prepared for short period. So monthly by monthly or week. So you try to understand one of the situation I told you, my father-in-law is a advocate, leading advocate. My brother-in-law also advocate. These people used to take the cases. But all the diverse cases, the fight will start after 25th only. They used to expert in diverse cases. But actually, they used to write, when actually fight started. What, Ra? When they actually fight started, they used to make a software. They used to record all these things. They used to say, Balu, one simple thing, Ra. All the diverse cases, I don't know, after 25th, maybe Yamaganna. Not Yamaganna. It is because of cash budget. వాడి దగ్గర చిల్లర అయిపోయి ఉంటుంది, ఈ దగ్గర ఎక్స్పెండిచర్ ఎక్కువ ఉంటుంది. ఇంకేముంటుంది చెప్పు? డైవర్స్కి బేస్ ఫైట్ అక్కడే స్టార్ట్ అయి ఉంటుంది. దట్ ఈస్ నథింగ్ బట్ క్యాష్ బడ్జెట్. Is it law? It's not a law. It is a cash budget. That person might have prepared that, yes, monthly ending, you must be careful with respect to your budget, right? This is a cash budget. Preparation, for the preparation of cash budget, depreciation, non-cash expenses should be considered. Old people not at all considered. Okay, hey, that is the purpose, right? So depreciation should not be considered. And opportunity cost should not be considered. Opportunity cost means once you get collected that money, that money, if you make investment, don't think like that, right? Depreciation is a non-cash expenses should not be considered. Opportunity cost should not be considered. And any other, what is that? Non-cash income should be ignored, right? Finally, how do you prepare cash budget? Very simple. Cash budget, whatever the months you prepare, it is a matter of what? A, B, C, D. So far, what is the strategy? A, B, C. Here, D. A, opening cash balance, take receipts, make payments, and finally you calculate what? Closing balance. closing balance indirectly conveys what is that? Opening balance plus receipts minus payments. This closing balance started to opening balance next month. So this is the procedure to calculate cash budget. But one of the problem, repeated model they've been asked, right? Don't neglect a cash budget, because sometimes fastest bowler also bowls slow ball. In such a case, mid wicket, boom. That's why you must be very, very careful with respect to cash budget. Within the 5 minutes, we will solve. It's a simple problem already, you know, but have a touch. Within 5 minutes, I will also give break. You know, I too need a break, right? But without break, you can solve this problem. I don't want to give a break to your exam. That is the reason I am restricting not to give break to this stupid break. Are online bache solve ra? Huh? Yes, is there ma? Right ra. Within 5 minutes, you will be able to solve means celebrate the break. A garment trader is preparing cash budget for the first 3 months ra. For the 2021, he estimated sales for the forecasted period. Total sales given January, February, March they provided. Sales given from the sales we can expect a cash. What Maji? The trader sells directly to the public, cash payment to do and other entities on credit. That means he will make a sales on what basis? Cash and credit. Credit sales are expected to be 4 times value of what sales? Direct sales. That means total sales, credit sales 4 ra. Hello? Out of that 1 is what? Cash. Hello? Credit and cash. Credit is 4, cash is 1. That means total is how much? 5. Out of that 4 times, if you make a 5 rupees sales, you know, out of that 4 rupees would be credit, 1 rupee would be cash, right? This point is very, very important. He expects 15% of the customer pay in the month. 15% customers pay in which month? In the month, right? And the balance would be whatever the remaining is there, you know, in the credit, 25% pay in the next month and 58% to pay in next month. That means totally it would be, what is that? 15%, 50%, 25% and what? 58%. And balance should be written off. Balance should be written off means bad debts. Purchase goods are made in the month prior to sales and amount 90% sales and are made on what basis? Credit. So company makes a credit sales 1 month earlier, purchases 1 month earlier. From that amount is nothing but 90% of the sales. But payment of this occurs in the month after purchase. Okay? No inventories of the goods. Payment. For example, January you want to sell ma. When you are going to produce? January. Yes or no? మా అమ్మ ఇప్పుడు రైస్ చేయాలనుకో, ఎప్పుడు కొనాలి రైసు? ఇప్పుడు వెళ్ళి కొనాలి. ఎప్పుడు కొంటది రైసు? She will purchase 1 day early. When she will cook? Now she will cook. Payment when she will make? Yesterday she purchased means if she has to pay yesterday, it's okay. But 1 day time which she will take means today she has to pay. Yes or no? So same logic, purchase of goods are made in the month prior to sale and amount of 90% of sale and made on credit. The payments of these occurs in the month of after purchase. No inventories of goods are held. The cash balance as on 1st of January 2021 is 50,000. Actual sales for the last 2 months 2020 is November sales 640, 880. You are required to prepare cash budget for the month of what? January, February, March. This is the problem is given. Very simple. You try to understand. You have to prepare cash budget for which month? January, February, March. Opening cash balance 50 you have to take. What is the total receipts? Cash collection from debtors, because you used to make a sales. Out of this total sales, 1 month would be cash sales. Total sales how much? 600 lakhs. For out of 600 lakhs divided by 5 into 1 means you used to get what? 120. What about the collections from debtors? Collection from debtors you try to understand. If company makes sales 100%, out of 20% is cash, they will collect in the same day. Remaining how much? 80%. From this 80%, 15% would be collected in the same month, 25% in the next month and 58% next month. That means if you comes to January, you made a November sales. Yes or no? November sales out of credit. Total November sales how much? 640. 640. Why I have taken only 512? 80% only. No, 640 into how much? 80%. 512. Out of this 512, first month 15. Second month what? 28. It won't come. But 58% will come. Yes or no? So 512 into 58%. 296.96. February, March won't come. In such a case, December. Total sales how much? 880 into 80%. How much? 740. 740 for January it would be 25%. Whereas February would be 58%. So 408, 176. What about January? January used to get only 15%, right? Total sales 600. Out of 80% credit. In that how much? 15% here, 25% here, 58% here. What about February? Total sales how much? 600. Out of 80%. So January it won't come. February 15%. March 25%. What about March? Sales how much, ma? 800 into 80%. How much? 640. 640 here nil. Here nil. Here you will get the 15%. That is the reason collection from debtors, if you calculate 544.96, 600.32, 496.40. So you have to take this value here, and if you make a summation, you will get the total receipt. Thereafter, payments you have to make. Payments, how much payments? January sales 600, right? From that 600, how much? 90%. But you will buy 1 month in advance. Yes, but you have to pay. This January purchases takes place when? December. But payment should be made at January. That's why 540, 600 into 90%. 540, 540, 720. Now if you total, it's 540, 540, 540. Now closing balance. Opening balance plus payments, receipt minus payments. What is the total? 664 plus 540, minus 540. How much? 174. This 174 turns to opening balance. Again opening plus receipt minus payment. Closing 355. Again this serves as a opening. So 355.28. And here closing 720 means it would be how much? 280 is negative, right? Negative. That means indirectly you would be very, very comfortable in which month? January, February, you are good. You are in danger. Which month? March. If your personal calculation, if you don't make, nothing is a problematic. But when some company keys are given to you means you must be very, very cautious. Okay? Right. Take break. Advanced concepts in investment decision. Dear students, advanced concepts in dividend decision is gone, right? Finished? Array, whatever the problems I conveyed, all are very close to public exam. Because there is a proof of evidence also with you. But the only thing is, if the same problems comes, sir, in advanced concept, what they asked? Only 2 models, bache. 10, 10. Both 10s are what? Replacement decision. Replacement decision, one 10 marks. Another one is adjusted NPV. What is that? Today class, one madam asked me, Balu sir, explain NPV, incremental NPV, modified NPV, adjusted NPV, annualized NPV. Give me clarity about all this NPV, they asked. Madam, this question for you, right? But wait 5 minutes. NPV, incremental NPV, modified NPV, adjusted NPV, annualized NPV, finally NPV. Okay, right. But meanwhile, what is the advanced concepts? 10 marks. You try to understand how important it is, right? Yeah. Up here you see capital budgeting, advanced concept. Dear students, very, very important concepts, advanced. While calculating capital budgeting, dear students, we used to consider different methods. First of all, simple, before going to giving a connection to this chapter, what is a capital budgeting? Capital budgeting is the systematic investment planning, right? To make investment on what assets? Fixed assets, whether it is worthable to make investment or not, right? Okay, good. So what are the various concepts we consider? 36 points I gave. Subsidy, working capital, what are? Present value factor, yes or no? Present value factor, working capital I gave, terminal cash inflow, By considering all these concepts, we used to evaluate a project by using traditional methods, modern method. Traditional method ignores, modern method considers. Good. Then what is this additional point, sir? In this model, we going to discuss some important topics. That is in advanced concept, what we going to study means, what are the point number one? What are the certain advanced concepts? Advanced concepts to be considered in what decision? Investment decision. This is the first point. This is investment decision. Another one is replacement decision. Another one is NPV and IRR conflict. Another one is adjusted NPV. These are the maximum. But here, these two are very, very important. 10 marks and 10 marks. Advanced concept, no need to discuss because already we discussed the capital budgeting, but we used to discuss this concept. This is the factor. This treatment you have to take like this. I will explain, right? Okay. Well, concept is that sunk cost. What is that? Sunk cost. What is the sunk cost? Sunk cost means before commencement of the project, whatever the cost incurred, that cost is called what? Sunk cost. This cost also known as historical cost. What is that? Historical cost. Historical cost. You keep it in mind. Historical cost. Baba. Gatam gataha. Huh? Gatam gataha means what? Before commencement of the project, whatever the cost you incurred. Okay. So sunk cost means before commencement of the project. I repeat, before commencement of the project, any cost is incurred. That cost should be ignored. So for example, Balu sir, how should I consider it? See, ABC company wants to purchase 1 lakh rupee worth of asset. In order to purchase this asset, right, the company made some research work. Research work is 40,000. Now in PV of cash outflow, should they show 1 lakh, 1 lakh plus 40,000? They want to buy asset 1 lakh. To buy that asset, they made a research work, transportation, research work, they done it. For the research work, they spent 40,000. While calculating PV of cash outflow, should we consider 40,000? We should not consider because that cost is already incurred. So that's why that cost should be ignored. Capital budgeting, whatever the problem we discussed, 2 days back. In the 2 days back, that problem they may consider and they may add it. You have to be very, very attentive that before commencement of the project, whatever the cost incurred by the company, that cost should be ignored because it is nowhere concerned to future. That is common cost. What is a common cost? Common cost means if a company undertakes a project, right? Because of undertaking this project, there should not be any additional cost to be incurred. But there is a cost. Because of making investment, there is a cost. That cost is not going to increase. That cost is not going to decrease. That cost is going to stay. If you undertake a project or not to undertake a project, that cost will remain same. For example, in Balaji campus, we are running a class, right? Now, Mastermind wants to plan a project in 5th floor. Let us imagine they want to install a machine, something they want to do. If they want to do any project means they will take cash inflow, cash outflow. But what about the watchman salary? Watchman salary is common cost. If you take that project, watchman salary would be there. If you won't take this watchman salary would be there. So such a cost is called what cost? Common cost. General office, administration office expenses comes under this category. So dear students, while evaluating a project, which cost should be ignored? So this cost, sunk cost is ignored. Common cost also, what happened? Don't consider, ignore. What is the opportunity cost benefit, opportunity cost loss? This already we discussed in Navajivani hospital treatment. Opportunity cost means because of your investment, listen carefully, because of your investment, an opportunity gets created. Because of that, if you get the benefit, then it is called what? Opportunity cost benefit. So that benefit should be added. Benefit should be added to your inflows. Opportunity cost means what, sir? Because of undertaking a project, so far whatever the income you've been getting, that income is going to cremate now. So you are not going to get it back. In such a case, that is called opportunity cost loss. So opportunity cost benefit should be added. Opportunity cost loss should be deducted. That is the opportunity. But both opportunity cost and opportunity cost loss must be, tell me, must be considered, right? Specific cost. Specific cost. Already we discussed the common cost. Now we are turning to specific cost. Sir, what is a specific cost? By undertaking a project, this is the cost exclusively incurred for that project only. Variable cost, selling administration cost, a promotional cost, all this cost is exclusively linked with that project. Such a cost is called, what is that? Specific cost. Variable cost is a specific cost because that's cost incurred. Advertisement. Now I will tell Today one ad came. Today one ad came. This is Samsung ad. Samsung, an Indian trustable brand. It is what cost? Only Samsung. Nothing is mentioned. That's specific. Mother just know. Samsung will produce these many products. So Samsung is given. Is it a TV, laptop, yes or no, iron box, washing machine, what not? Nothing is mentioned. In such a case, what happened? Just the Samsung, that's enough. So they are promoting the brand. That is nothing but if iron production, iron box you are producing, you should not consider that one because that is what cost? Common cost. Now, because Samsung mobiles they are concentrating, that is specific cost. Be attentive with respect to. Alright, okay? So mastermind provides means that is a common cost. CA final, CA inter, CA foundation, if they do so, that is called what? Specific cost. Paduta Thiyaga, few years back, mastermind used to sponsor. That is what cost? That is a common cost, yes or no? Even it will comes to mastermind intermediate college also it come because it is represents masterminds. But exclusively sports meet is going for CA inter students. Yeah, that is a specific cost. CA final, specific cost. That's you have to understand. Next, another one, working capital treatment. Tell me, what is a working capital? See, just now we completed chapter working capital where we discussed the most valuable concepts with respect to this. Working capital. In order to generate return from fixed asset, only what happens? Only investment on current assets does not work. So, sorry, if you want to evaluate any long-term project, just by investing fixed assets, if you want to run means it not works. You also make investment on what? Working capital. Working capital treatment, I told you, 100% leads to 100%. What? 100% leads to 100%. Beginning you will invest 100%, but end you will get 100%. But it may gets what? Fluctuates. Fixed assets may depreciate, may disappear, but working capital circulates, will remain same, right? Subsidy. What is the treatment subsidy? Subsidy, whenever you are undertaking any project which is a damn important to the society, okay? In such a case, Government of India will certainly support you. So when you are producing, what is that? Alcohol, liquor manufacturing or liquor production, Government of India restricts you. Cigarettes restricts you. So they will charge you high tax. But if you are producing FMG sector, because of that, what happened? Labor intensive technology you are producing, people are getting what is a job. Because of your production, right? Raw material which is going to getting waste that can be processed and you can keep the product which can be stored for the long period. Because of that, inflation can be hedged. If such a products are there, Government of India comes and they will give you subsidy. Take this one, very, very good. So whenever subsidy comes, automatically your investment decreases. That's why whenever you are tomorrow, if you become a chartered accountant, whenever any client comes to your office to start a project means you have to guide him, sir, start there, sir, produce this product, produce this way. You may get what? Subsidy. Because of this, your investment decreases, right? Another one is treatment of depreciation in the presence of tax, in the absence of tax. Sir, when T is there, D is there. When T is not there, another one is a tax and tax shield. You know that? Tax and tax shield. When a company makes a profit, you have to pay tax. When company makes a loss, company has to pay tax shield. Capital gain and capital loss. Capital gain, capital loss. What is a capital gain? How it is a difference from profit and loss? If you produce an asset, if you purchase an asset, by using this asset, you will produce a product. By selling this product, if you get the benefit, right? That benefit is called, what is it? Profit. Okay? If you get loss, that is loss. But at the end of the current year, at the end of the given year, if the entire fixed assets gets what? Depreciation, right? But even after, by selling this purchased asset, how much benefit you are going to get, it is called what? Gain or loss. Already I told you, gain happens. This is a post-mortem. Yes or no? Profit is a matter of what? Profit. Gain happens only once in a life. Okay? These are the concept. But your institute material, key points are considered, but there is a much chance to ask working capital, subsidy, specific cost, common cost, sunk cost, opportunity cost. Up to here, these are the advanced concepts. Okay, only this concept. For this purpose, no need to discuss one problem because time gets wasted. Okay, next another one is very, very important. I'm going to discuss this topic today is replacement decision. What is that? Replacement decision. What is a replacement decision? You must be very, very clear. See, a company may replace its existing machine with what? New machine. To increase, why company go for replacement? To increase its value or what? Wealth. It is called what decision? Replacement decision. 2 marks question. Tell me 2 marks question answer. What is the replacement decision? Sir, a company may replace its existing machine with what? New machine. To increase its sales revenue or value or wealth. It is called what? Replacement decision. Why company go for replacement decision? Reasons for replacement decision. What purpose? To increase output. Output leads to sales. Sales leads to what is that? Sales revenue. They want to get it. Another one is to decrease what is that? Maintenance cost. Array old machine here chhod do. You see my bike is there. Today I went to buy petrol, not for fill the tank, to set the fire because maintenance cost. తాగేస్తుంది అది దేన్ని పెట్రోల్ని. ఏంటి సార్ ఇది మీరు పెట్రోల్ తక్కువ కొడుతున్నారు ఇది ఎక్కువ తాగుతుందంటే సార్ ఆల్రెడీ మీరు రీప్లేస్ చేయండి సార్ బికాజ్ ఇట్స్ మెయింటెనెన్స్ కాస్ట్ ఈస్ నథింగ్ బట్ కాస్ట్ ఆఫ్ పర్చేస్ న్యూ బైక్. సో ఇన్ సచ్ కేస్ వాట్ షుడ్ ఐ డూ? Replace. And sometimes both will happen. What is the both? Increase output. Be silent, okay? Increase output and at the same time, yeah. Now Sangam diary is there, no Sangam diary. Previous class also I do that. At the time I just identified whether it is a factor. Now it is a truly they got a machine, biggest tanks. Previously they used to pour the milk and they used to boil. Now if you give the milk, then if this side curd will come, this side buttermilk will come, this side milk product will come, this type pure milk will come. What is this? Just okay ఒక మిషన్ అంతే పోయి మొత్తం వచ్చేస్తుంది. ఇప్పుడు ప్రీవియస్లీ లేస్ you have to give chips potato, it will makes the chips and it will gives you. Now if you give potato, tomato chips, butter chips, green chips, that chips, what is this? What sir? Maintenance costs are previously what is that? Headaches are. Now wonderful machine sir. Potato you throw it, that's enough. 10 chips it will come. Sir, really is there sir? Tell me, if really is there means Lay's company will replace its existing machine? లేదనుకో, ఒకవేళ ఉందనుకో, సంఘం డైరీకి చెప్పామనుకో పాలు ఇస్తే మొత్తం ఇచ్చేస్తుందంట అదే. అవునా అంటే సార్ then what to do? Sir, replace sir. Sir, now array your machine is very good sir. Sir, no. That machine even the good what I don't want because it taking what is that? Maintenance cost. 2 marks question ra. Yes, what are the ways in which replacement decision to be taken? Array 2 marks question. Replacement decision should be taken into total approach. Replacement decision would be taken into incremental approach. Total approach is nothing but very simple. You see, estimation total approach means you have a old machine. Hello, you have a new machine. So what happened? New machine NPV, old machine NPV used to calculate total NPV for existing machine, new machine you will calculate and you will compare both the machine. Then you will take a decision. That is called what? You will compare with the NPV of existing total machine, new machine total NPV. Then it is called what? Total approach. But instead of that, what happened? They developed another method is called incremental approach. What is that? What is the incremental approach, sir? Incremental approach means we used to calculate incremental NPV. What incremental NPV? Excuse me, I have a bike, if I want to buy new bike, what is my incremental cash outflow? That bike is 1,40,000. No. 1,40,000 cost of new bike, but I don't spend 1,40,000. Can you tell me? Because I will exchange or I will sell this one, right? So that means incremental cash outflow I have to calculate, incremental operating cash inflow I have to calculate, incremental terminal cash inflow I have to calculate. So incremental operating plus incremental terminal plus minus incremental cash outflow, I used to get what? Incremental NPV. When incremental NPV positive, replace. Negative, waste. For this purpose, I will explain the procedure, how to be done. Step number 1, remember the steps already in the material, it's also I projected, but the thing is, the replacement decision steps, all these steps, I thought it right because of examination point of view, it is a considered, that is important, I'm showing this. Yes, step number 1, in order to make incremental approach, what you have to do means, first calculate depreciation of what machine? New machine and old machine. So depreciation, it would be possible only when there is a what? Tax, because when tax is there, so depreciation may be calculated, how many methods? Tell me, depreciation, SLM method formula, cost minus scrap divided by life. Okay, what about WDV, how do you calculate? Balu sir told one small secret. Asset gets depreciation, everybody tell that one, but Balu sir tells in a stylish way, depreciation gets what? Depreciation. With this calculation tremendously decreases. Are you getting that? So that's you have to calculate. Incremental depreciation means new machine depreciation you take, existing machine depreciation. If you compare both, what you will get? Incremental depreciation. You see, this is the old machine, this is the new machine. If the company wants to replace means first you have to calculate what? Depreciation of each of the machine. What are? Next step, what to do? Next, you have to, if you want to buy new machine means old machine you have to sell. Be active, right? Okay. If I want to, see, I have a old machine. What I said, I will go to the market, I will sell the old machine. When I sell the old machine, I used to get the revenue. When revenue comes means uncle kid will come. Income tax person, Baluji, pay tax. In such a case, immediately I have to calculate written down value. MCQ question, written down value equal to? In your study material, MCQ question 2 times. Problem they may ask you, theory point they will ask you. Take a cost, accumulated depreciation. How many years you used that year's depreciation you take. MCQs. Then if you compare, you may get it either gain or loss. If loss is there, get the tax shield. If gain is there, pay tax. Finally, you will get what, sir? Net sale proceeds. This is the first step. Okay? Not this is second step. First step already. Depreciation we calculated. Okay, ma? Next, you have to calculate. You purchased, you got the money. Hello? You went to where? Market. To buy what? New machine. You want to buy a new machine. Cost of new machine this. But this much won't charge us, right? Hello? Less what to do? Net sale proceeds of what machine? Old machine. Old machine cost you deducted. Then if at all working capital is there, new machine working capital means, again question arises, sir, old machine working capital is there means, so old machine working capital 10 lakhs, new machine working capital is 20 lakhs. Additionally, how much needed? 10 lakhs is needed. If old machine working capital is not there, in such a case, what to do, man? This 20 lakhs would be the incremental working capital. What, Maji? Yeah, working capital you pay it. Then you will get the PV of incremental cash outflows. Are you getting? Right. With this, 3 steps is finished. Step 1, depreciation we calculate. Step 2, old machine bhej diya. New machine we purchased. Next, we need to calculate PV of incremental what cash inflow? Operating cash inflow. Incremental operating cash inflow we need it. Incremental. So because of this, what is the additional cash inflow I supposed to get it? So this incremental operating in cash inflow, they will give you in 3 ways. Way number 1, deadly cheapest way. A deadly easiest way, I will tell you. What is that? They will give you new machine CF80. Old machine CF80. So new machine CF80, 2 lakhs. Old machine CF80 is 1 lakh. What is incremental CF80? 1 lakh. Never expect such a stupid model. Okay. Then what is another alternative? Instead of CF80, he will give you PBDT. In such a case, what is the strategy? PBDT, what you will get? Incremental PBDT. But you need a CF80, right? Hello? But incremental PBDT there. But your CF80 here. How should you do? Sir, incremental PBDT, less. Depreciation or incremental depreciation? Incremental depreciation. Then you will get incremental PBT. Hello? Less tax. PAT. Add back to incremental depreciation, you will get what? CF80. Moderate problem. Difficult problem. Not PBDT. They will give you, this machine works 18 hours. Each hour it produces 40 rupees. 40 units. But units if you sell means 20 rupees is the selling price. That means not even sales revenue. They used to get number of hours operation. Now for that purpose, what to do? First you go outside, make a working note, calculate PBDT of each of the machine. Hello? PBDT you calculate. outside. Then bring that PBDT here. You got the PBDT, right? PBDT, you compare incremental PBDT. Thereafter, you can calculate incremental CFAT. Which model would be the toughest? Model 1 or 2 or 3 or 3. Examiner expects only this model. So 10 marks question, what so far they've been considered only this model. First 2 models, if they're given, no need of this class also. You can simply handle. Are you getting? This is incremental. Here you see, I have taken incremental PBDT. So assuming that what happened, they have provided what? PBDT, second model. PBDT, incremental PBDT, less water. Incremental depreciation, incremental PBT, less tax. Incremental PAT, add back to incremental depreciation, you will get incremental CFAT. If every year cash inflow equal, then I will take present value annuity factor. Every year different, I will take what? Present value factor. By summing up of all these things, I used to get incremental operating cash inflow. Next I will left, what is that? Incremental terminal cash inflow. Incremental terminal. Terminal means what? Last. So here you have to make an imaginary calculation that NSP of, not this, NSP of new machine at the end of which year? At the end of the period. Old machine if you sell, how much cash inflow you used to get it? So NSP of, this is a new machine, another one is old machine. If NSP of old machine, new machine at the end of the life, NSP of old machine at the end of the life you take it. By comparing these two, you will get the incremental net sale proceeds. For this, add back what? Recovery. Recovery also is there in a working capital. You add this recovery of working capital, then you will get it the incremental terminal cash inflow. No doubt at all. For this, you have to use only present value factor and bring it into present. You will get the present value of incremental terminal cash inflow. Now you can calculate incremental NPV. Incremental NPV equal to PV of incremental operating cash inflow, PV of incremental terminal cash inflow minus PV of incremental cash outflow. If NPV is positive, what is opinion? Project should be accepted. Otherwise, reject. Tell me the steps so far. Look at my face. Tell me, step number 1. Calculation of depreciation of each of the machines. Step number 2. Old machine you have to sell. Step number 3. New machine you have to buy. Incremental operating cash inflow. Balu sir told 3 strategy ata. Strategy 1, first floor, very easy. Strategy number 2, second floor, little bit difficult. Strategy number 5th floor, Gaya. So which model you will expect? 5th model you will expect. He will give from operating cash inflow, how company operates, he will provide you. From that you have to calculate, first you have to calculate PBDT, then from the PBDT you have to calculate incremental PBDT, then you have to extract incremental CFAT. Then you have to calculate last incremental terminal cash inflow. If NPV is positive, project should be accepted, otherwise rejected. Could you able to solve such a problem if it is given? Yeah, here I identified, even though it is time consuming process, but no other alternative, because this only model problem they've been asking in July 21 also they asked this problem. So it takes, because this is a lengthy one, but in study material that there are certain problems are there, but comparing to that study material, this problem is little bit complex. Even if I explain that problem, if you touch this one, it seems to be little bit difficult here. That is the reason if you are able to handle this one, that problems you can handle. You see, even I got the problem. See, this is the problem with me. This is the problem from where? This is the NPV problem. This problem from study material. But it is very easy. You can handle it. Our mastermind material only. But in latest problem is this. Because this is the latest problem. If you are able to solve this one, yes. Okay, ma? Can you able to? Remember steps? 3. Next. Right. Now you see that. Always keep the steps and able to solve this problem. Right. An existing machine has a machine life which has been in operation for how many years? 2 years. They purchased, 2 years is finished. Remaining how many years? 4 years left, right? The management is considering proposal to purchase what machine? Improved model of. Similar model was their old machine, an old model, but there they have taken SLM method. What method? Straight line method. But in this problem, what happened? Same problem we taken, WDV changed. So in such a case, calculation burden, how it will takes, right? That is the reason. The management is considering proposal to purchase improved model machine, which gives increased output. The vendor of this machine agreed to take old machine for how much? 2,40,000. However, the old machine could be sold for 3 lakhs. Here, now tell me, whom we are going to buy a new machine, that person is ready to pay how much? 2,40,000. Should we pay 2,40,000? Should we give it that machine for 2,40,000? No, because if you sell in the market, we used to get how much? 3 lakhs. So this is the story. Means you try to understand, your client has a old machine that he purchased 2 years back. Its total life is 6 years. 2 years is gone, 4 years left. For the sake of 4 years, he is planning to take replacement decision. But the new machine from whom he is going to buy, that person is ready to give 2,40,000. But instead of giving to him, nearby shop, if he sell, means he will get how much? 3 lakhs. This is the story. The existing machine purchase price is 6 years. New machine, sorry, 6 lakhs. Okay. Here it is a 10 lakhs. Estimated life 6 years. This is the 4 years. Residual value is nil. Expected output per hour, how many units? 20 units. This is how many? 40 units. Now the point is, here selling price per unit is 10. Material cost per unit is 2. Labor cost per unit is 2. 1.5. Fixed overhead excluding what? Depreciation 1 lakh 60,000. Working capital is required for 1 lakh and 2 lakhs. Income tax rate is given 30%. 30%. This is the details given. Now, which model it is indirectly given? Tell me. First model, third model given. That is the reason I picked up this one. So, your seniors might write this one in 2021. Certainly at the time they might have felt this problem is difficult. It is not a difficult, it is a lengthy. Okay, once you can good with the calculation ability, this problem is very, very easy, right? So, here you see. So far in replacement decision, one of the lengthiest problem is this. Remaining, whatever the problem is, that material you can comfortably handle. See, the expected operating hours is how many? 1,800. Assuming cost of capital is 10%. And the company provides a depreciation what method? 20% on WDV. Ignore tax on what is that? Capital gain or capital loss. Advise the management on the replacement machine by calculating what? NPV under what approach? Incremental approach. Incremental approach, he said. Now tell me, what is the first step I told you? Okay, depreciation we have to calculate. Thereafter, old machine you have to sell. What is the asset you purchased? Old machine you purchased for what? 6 lakh old machine. Now you have two values. Either you may give to your supplier or either you may sell. What you do? You will sell, right? But 6 lakhs worth of machine you sold 3 lakhs, you will get certainly loss. But then the problem what they clearly mentioned, no tax. In such a case, first I can calculate PV of incremental cash outflow. You can also calculate depreciation, no problem. See, purchase price of new machine is how much? 10 lakh. Add working capital also need a working capital 1 lakh. And less NSP of old machine, how much? 3 lakhs. Sir, how do we get, sir? We used to get loss, In such a case, what do you say? No capital gain on what? Loss. That is the reason you used to get a 3 lakhs exactly. So, total net initial cash outflow of the machine is how much it is? 8 lakhs. How do you get 8 lakhs? Tell me. Cost of new machine is 10. Working capital is 1. 10 plus 1, 11. But by selling old machine for 3 lakhs, you used to get 3 lakhs, In such a case, your investment out 8 lakhs. But sir, student used to ask this common doubt. Sir, 6 lakhs worth of asset, sir. But we are selling only 2 years, sir. We will get loss, Yes, you will get the loss. But problem, what is saying? Ignore tax on what? Capital gain, capital loss. Now we have to calculate incremental operating cash inflow. For that purpose, we need to calculate depreciation. Depreciation what method? WDV method. Now tell me, already WDV method we can calculate means already we purchased asset for how many years back? 2 years back. Today what is its condition we should learn, right? Because we are going to calculate depreciation for what machine? Existing machine from now onwards. For that purpose you have to calculate depreciable base for what machine? Old machine. See, this is the first year. Purchase price of the machine 2 years back. How much? 6 lakh. First year depreciation gone. How much first year depreciation? 1 lakh. Right. Thereafter it's written down value 4,80,000. Less again you have to deduct depreciation. 4,80,000 into 20%, right? 96,000. That means today its value would be 3 lakhs. Now onwards you have to calculate this value of 6 lakh. This 3,84,000 you have to take to calculate what? Depreciation. Yes or no? First we take 3,84,000 and we used to calculate depreciation for year 1, year 2, year 3, year 4. Why we calculated 3,84,000 instead of 6 lakhs? 6 lakhs is how many years back? 2 years back. 2 years depreciation gone, man. Today in fresh mode, the asset worth is how much? 3,84,000. Now what to do? 3,84,000, 20%, how much? 76. Once you calculate this one into how much percentage? 80%, you will get 61,440 into 80%. Yes or no? No need of all this calculation, right? Into 80%. 39,000. This is the depreciation for what machine? Old machine. But new machine you purchased for 10 lakhs. 10 lakhs into 20%? 2 lakhs. 2 lakhs into 80%? 1,60,000 into 80%? Into 80%? Now incremental depreciation means this is the new machine depreciation minus old machine depreciation. 2 lakhs minus 76,800. 1 lakh. Whereas here would be 98,560. 78,845, whereas year 4 is 63,078. You calculated what is this? Incremental depreciation. Now you need to calculate incremental operating cash inflow, right? Operating cash inflow, how do you calculate? What is the total units it is to work? How many hours it is to work? 800 hours, right? This is also 800 hours, right? Hello? 1800 hours. Sales revenue you want to calculate means hours into output per hours into revenue. So how many hours it is to work? 1800. Output per hour is 20. Hello? You make it just fastest make calculate it. 3,50,000. 3,60,000. I made it a calculation. Here it is. The data is eliminate. Where it is here only down, directly you can take it 1,800 into sales revenue, directly you can take it 1,800 into, tell me, 1,800 into 20 into 10 rupees. How much? 3,60,000. What about here? Yes, okay, gone. Let's see, you have to deduct cost. Material cost. Material cost. Number of hours into output per hour into 2. 72,000. What about the labor cost? For this only first one. Second one how much ma? 1,44,000. What about labor cost ma? 72,000. Yes, here 1,08,000. This see 11 fixed overheads given 1 lakh. Here 60,000. Now total cost set up. Total cost 2,44,000. From the revenue, if you deduct this cost, revenue cost 1,16,000 you got? Yeah. So now if you compare this both, what you will get? Incremental PBDT. Incremental PBDT equal to 4,08,000 minus 1,16,000. 2,92,000. 2,92,000. This is the incremental what? PBDT. Now you have to take incremental PBDT. First year 1, 2, 3, 4. Next incremental PBDT less what you do? Incremental depreciation you have to take. Next you will get a incremental PBT. Out of that tax 30% goes means 70% only you left, right? So that's why 1,18,160, 1,35,408, 1,49,206, 1,60,245. Next add back to depreciation. So you will get it incremental CF80, you will get it 2,41,360, 2,33,968, 2,28,054, 2,23,323. Now you have to bring it into present. Will you use present value factor or annuity factor? Present value factor. By multiplying these values, right? If you bring it into present, you got the 7,36,453. What is this? PV of incremental, what cash inflow? Operating cash inflow. Then you have to find it out what? Incremental terminal cash inflow. Gross sale proceeds, you could not sold the machine. Gross sale proceeds of old machine also you could not sold. So incremental net sale proceeds is 0. But recovery of working capital is there, no? That is nothing but incremental working capital is nothing but 1 lakh. This 1 lakh itself is the terminal cash inflow. Why? Because C plus D used to get the terminal. C is 0. In such a case, 1 lakh only you will get it. This 1 lakh generates when? At the end of 4th year. So you have to bring it into present. So 1 lakh into 0.683, then you will get it. What is that? 68,300. So now you have to calculate incremental NPV. Incremental NPV equal to PV of operating cash inflow plus PV of terminal cash inflow minus PV of cash outflow. You used to get it NPV 4,753. What is your decision making? Since incremental NPV is positive, the project should be, these are the points should be considered. Once again, you must be very, very attentive with respect to its steps. How many steps? Step number 1, calculation of depreciation of each of the machine. Step number 2, NSP of old machine. Step number 3, incremental cash outflow. Next, incremental operating cash inflow, incremental terminal cash inflow, incremental NPV. Okay? Yeah. The next one, what the concept we considered. Thereafter, NPV IRR conflict. NPV IRR conflict, hardly 2 marks. Hardly 2 marks. What is the conflict? Conflict indicates opinion different. Jagan Mohan Reddy, Chandrababu Naidu, Pawan Kalyan, BJP, all the people wants to take care of myself, right? బాలు సార్ని జాగ్రత్తగా చూసుకోవాలి. కానీ వాళ్ళు కొట్టుకుంటారు. ఎందుకు కొట్టుకుంటారు? నీ వల్లే సార్ అంటారు. అంటే బాలు సార్ని జాగ్రత్తగా చూసుకోవాలి. బాలు సార్ ఈజ్ నథింగ్ బట్ నాట్ ఎ ఇండివిజువల్. ఈజ్ రిప్రజెంటేటివ్ ఆఫ్ కంట్రీ, స్టేట్ పీపుల్. That simply you take Balu and Balu represent as a state people. All the people wants to take care. Andhra Pradesh people, I will take. What happened? I will take care. So I will take care. No. I put a message, sir. You do one thing, sir. Why you are individually going, sir? All the people conduct a general meeting in Vajra Hotel. You take care all the people, No. I won't join with him. I only take care Balu, sir. This is what? Conflict. Opinions are what? Difference. That is called, what is that? Conflict. So here, what is the NPV IRR conflict? 2 marks you can expect this model from this question. So 2 marks question means NPV IRR conflict. What is the conflict means? Just now I told you. What is that conflict? This is NPV IRR conflict. Opinions are differ. Sometimes, in your house also, మా అక్క నేను అసలు మాట్లాడుకోవాలి 3 నెలలు ఇది మాట్లాడుకోని. చైనాలో ఉంటుంది, ఈమె పాకిస్తాన్లో ఉంటుంది. అవునా? అలుగుతారా లేదా? దట్ ఈస్ కాల్డ్ వాట్ కాన్ఫ్లిక్ట్. దట్ ఈస్ నాట్ ఎ రైవల్రీ. దట్ ఈస్ కాల్డ్ కాన్ఫ్లిక్ట్. ఆఫన్ నౌ పొలిటికల్ పీపుల్ యూస్ టు సే, వ్యక్తిగతంగా వీ డోంట్ హ్యావ్ ఎనీ ప్రాబ్లం, పర్సనలీ వీ డోంట్ హ్యావ్ ఎనీ ప్రాబ్లం, బట్ యాజ్ పర్ రూల్స్ అండ్ రెగ్యులేషన్స్, యాజ్ పర్ లాయల్టీ, అజెండా, ఇట్ ఇస్ అ డిఫరెంట్. వాట్ ఈస్ అజెండా? టు కేర్ ఆఫ్ బాలసుబ్రహ్మణ్యం. నా గురించి కొట్టుకుంటున్నారు మీరు. ఎవరన్నా? It means that don't take it as a Balu. I am a representative of Andhra Pradesh. In such a case, try to understand. All the people wants to serve the public, right? But you do one thing here. Collectively, you will serve. No. So individually, that is the reason they have a fights with leads. NPV IRR conflict. Here also you see that. What is meaning? 2 marks question. What is NPV IRR conflict? In evaluation of 2 mutually exclusive projects, sometimes as per NPV IRR, sometimes what happen? As per NPV, one project is preferable, whereas as per IRR, another project may be preferable. Such a situation is called what? NPV IRR conflict. 2 projects are there, you want to choose the one project only. So one project only, if you want to choose, means you have to consider what? You will calculate NPV. What as per NPV, one project is preferable. As per IRR, another project is preferable. Such a situation is called NPV IRR conflict. You see, this is NPV and this is what? IRR. So what is the reason for this NPV IRR means? They will tell you beautifully. The given projects are mutually exclusive. MCQ question. Why conflict happens? Because of given projects are mutually exclusive. Another one is having what? Disparity. What is a disparity? Difference. Difference. One is a cash flow difference, cash flow disparity, size disparity, life disparity. Okay, even though disparity is there, how do you take a decision? MCQ question. What is answer? Financial management objective is to maximize what? Wealth of equity shareholders. So prefer the project which has highest NPV comparing to IRR. So prefer the project which has highest NPV. Right here, reasons, situations, how to resolve conflict, everything for MCQ question. I will show you. This is image. You see. First, what do you take? NPV. What is that, ma? NPV IRR conflict. Do you know what is NPV IRR conflict? Two projects. One project NPV is higher. Another project IRR is higher. Such a situation is called NPV IRR conflict. Reason, size disparity. Example, they will give you, ask you some identity. You just antunnadu. It is size disparity. It is antunnadu. So one project commences with what? 40 lakhs. Another project commences with 20 lakhs. If investment 40 and 20 means automatically which NPV is highest one? 20k. Alright, 40,000 always gives highest NPV, yes or no? But project B gives less. So how do you identify means? We used to calculate for 40,000, 20,000, investment is different. So what is identity? For 40,000, how much NPV you used to get? For 20,000, how much NPV you used to get? You used to compare what? That incremental NPV. Hello? Which project? For example, 40 lakhs you invested, ra? For 40 lakhs, you got it 30 lakhs. Okay? Suppose 40 lakhs, you got it 20 lakhs, ra? But 20 lakhs, you got the 15 lakhs. Which is best actually? 20 lakhs best, you know? Because for 20, you are getting 15. But that one is 40, you are getting 20. Sir, 20 is huge, you know, sir. 20 huge, no doubt at all. It's a big amount. But for 20, you spend how much? 40 year. That is the reason you used to calculate what NPV? Incremental NPV. You have to take incremental cash flow basing on that incremental cash inflow. If you calculate NPV, such a NPV is called incremental NPV. Listen carefully. What is a NPV? NPV, it is a value benefit derived from the project as on the day of investment. That is NPV. What is incremental NPV? Incremental NPV, it is a technique which is used to guide the investor to make incremental investment. Incremental NPV is computed by taking only incremental cash flows. PV of incremental operating cash inflow plus PV of incremental terminal cash inflow minus PV of incremental cash outflow is nothing but incremental NPV. If incremental NPV is positive, better to take biggest investment project. If incremental NPV is negative, better to take which one? Smallest investment. Because one project is 40, another one is 20. Now question is, when you are choosing project A means, additionally you decided to invest 20 lakhs extra, right? Logic understand. So 40 lakhs you are taking. I decided to take a 40 lakhs project, sir. 40 lakhs project you are taking means comparing to smallest investment project, you decided yourself to invest additionally 20 lakhs. Are you agree? Yes, sir. If with the 20 lakhs, if you are able to earn loss, then అవసరం నీకు 40 lakhs, better to ఏది చేసుకో 20 lakhs చేసుకో. Another one, if you get NPV positive, this one. Which one? Biggest one. Are you getting my point? So when that additional investment 40 you are taking, but that means comparing to B, you are additionally investing 20. By investing the 20, you are generating NPV means better to do always with the 40. Why you are doing 20? But NPV negative, don't touch 40. Better to do 20. If NPV is 0, both are what? Same. This is the what NPV? Incremental NPV. Another one is what disparity? Life disparity. Life disparity. See, this life is 12 years. This life is shortest. This is 8 years. Now, whenever lifespan is different, automatically there is a NPV IRR conflict arises. What is that? NPV IRR conflict arises. In order to resolve this one, you should not take total. You have to go with what? Annual NPV. What is it? Annualized NPV. So annualized NPV equal to what you will take? NPV divided by present value annuity factor or percentage n number of years. If you do so, you will get it a annualized NPV. Total NPV not a considered. Take annualized NPV. Keep remember, my grandfather approximately 72 years still he see Manasu Mamata cereal, 1 liter milk, 2 liters coffee. So he takes wonderful food and he always speaks about ethics. But Swami Vivekananda, greatest person in the world, but who lost his life approximately 32 years. Swami Vivekananda 32 years, but whereas my grandfather is 72 years. But as per time means my grandfather is great. అవసరమా అలా చెప్పండి వచ్చి తంతారు ఇద్దరిని అవునా సో యాజ్ పర్ టైమ్ ఎలిమెంట్ ఈజ్ నాట్ ద మ్యాటర్ రైట్ హౌ లాంగ్ యూ లివ్డ్ ఈజ్ నాట్ అ మ్యాటర్ ఎస్ ఆర్ నో how great how productively you lived, that is a matter. So here the idea behind calculation of annualized NPV means we never take a total, we will make a NPV divided by what? Present value annuity factor we will take, with that we will get it what? Annualized NPV formula NPV divided by present value annuity factor r percentage n number of years. Then modified NPV, this is happens only when there is a what disparity? Cash flow disparity. Modi amma, okay? Don't change its spelling, okay? So cash flow disparity. Cash flow disparity means there are two projects are there. One project initially gives more, right? Another project initially gives less. But one project initially gives more and later period it gives less. But another one is initially gives less, later it gives high. In such a situation, there is a disparity of NPV and IRR. In such a case, what do you have to do? Whatever the cash inflows are there, no, instead of considering that cash inflow, what you do? You have to reinvest the cash flow basing on the reinvested cash inflow. If you calculate NPV, such a NPV is called what? Modified NPV. Now tell me, MCQs, 4 NPVs. NPV formula? Cash PV of cash inflow minus PV of cash outflow. What is the annualized NPV? It is NPV per year, not for entire life of the project. How do you calculate modified NPV? Annualized NPV? NPV divided by present value annuity factor r percentage n number of. Annualized NPV knowledge of you, which conflict can resolve? Life disparity. This is the MCQ question. Next, what is the incremental NPV? Incremental NPV, when you want to make a huge investment to know whether that project is really worthwhile or not, or making that additional investment really worthwhile or not, for that purpose we used to compute what NPV? Incremental NPV. Incremental NPV formula? PV of incremental operating cash inflow plus PV of incremental terminal cash inflow minus PV of incremental cash outflow. What about modified NPV, sir? Modified means reinvested cash inflow based calculated NPV. Why? Because when there is a what disparity? Cash flow disparity is there. In such a case, NPV does not work. So, whatever the cash inflow is there, this cash inflow you reinvest. For project A, reinvest the cash inflow, get the reinvested cash inflow. Reinvest this cash inflow, get the reinvested cash outflow, cash inflows. By taking reinvested cash inflow, cash outflow, compute what? NPV. If you get that NPV is called what NPV? Modified NPV. Are you getting? These are. With life disparity, I can resolve life disparity with modified NPV. Sure? No, sir. Because there's a difference. Are you getting? So this is the NPV between IRR and conflict between NPV and IRR. Here the small problem is that, can you resolve this one? This problem why I have taken means this problem is asked, not asked. For MCQs, they may ask you, this is, how do you calculate this project life is how many years? Check it. This project life how many years? 3 years. This project life is? Where? Both are 3, This life disparity. This project life how many years? This project life? With which NPV you can resolve this conflict? Life disparity is there, no? Which NPV you will use? Annualized NPV. Annualized NPV formula? NPV divided by what factor you will take? Present value factor. With this, you can resolve this one. How do you get the present value factor? By summing up of all. Yes or no? This is the life disparity. Whereas another one is you can take cash flow disparity. Cash flow disparity, how do you calculate? Whatever the cash inflows are there, you should not take this cash flow. What do? You have to reinvest. Yes or no? After reinvesting whatever the cash inflow, you will get it, by considering this reinvested cash inflow. If you calculate NPV, then such a NPV is called what? Modified NPV. So modified NPV resolves what conflict? Cash flow disparity. What about the size disparity? Here project life is how much? Not life, investment 1 lakh. Here is how much? 3 lakhs. Additional investment 2 lakhs. If the additional investment is 2 lakhs, if this project gives NPV positive, what project I should take? Project B I should take, because additionally making 2 lakhs is giving better. Whereas negative, project A 0. Any of the project you can consider. With this, all the NPV finished. One more NPV left. What that NPV is? Adjusted NPV. What is that? Adjusted NPV. What is adjusted NPV? Adjusted NPV is nothing but, it is also one of the concept. Adjusted NPV. Adjusted NPV. You try to understand. There is an investor. This investor, listen carefully. This investor wants to take a project, but he is moving what is at 100% equity. When this project moves with 100% equity, NPV positive. NPV positive worth of how much? 14,000. NPV positive 14,000 means, what is his opinion? This project is worthable. Yes or no? Why? Because NPV is positive. Okay, good. NPV positive. Once this man gets a confirmation that NPV positive means, he will start to think that, I am moving with 100% equity. If I move with the debt, right, I used to get a tax advantage, right? If the tax advantage gets, automatically my future NPV might be more than this one. Then risk also would be less. Why? Because it is not my money. This is whose money? Others' money. Because he may think that when NPV is positive, in such a case, why should I contribute my own money? I contribute whose money? Debt money, outsiders. I will, with the outsider NPV, outsiders investment, I will make it, However, this project gives NPV, how much? 15,000 plus this time tax benefit also used to get it, right? So this 14,000 used to get it, plus tax advantage also you will get it. So finally, there might be a chance to get more, that is called, what is that? Adjusted NPV. So adjusted NPV means when company visualizes that what would be the NPV if I go with 100% pure equity. That NPV called base case NPV. What is that? Base case NPV. Then immediately company thinks that what might be the NPV I supposed to earn if this project is undertaken with 100% what? Debt. In such a case, what is the NPV? Where the financial manager changes his idea that why should I invest money? Let them invest bank. Let them there, they used to give rent. For example, simple logic is, okay, Udle, are you getting? This is completely visualized, guesswork only. But no company works 100% debt. 100% debt. Because company may think that if I might have done this project with the equity, what would happen? Are you getting? See, I told you example. My father's sister is there. వాళ్ళ అబ్బాయికి మ్యారేజ్ చేయాలి. బట్ ద థింగ్ ఈజ్ షీ యూస్ టు టెల్ వన్ ఫైన్ డే టోల్డ్ దట్ ఫస్ట్ టైం యువర్ ఫాదర్, మా నాన్నగారు డిఎస్పి అలయన్స్ బ్రాట్రా, ఆమెకి డిఎస్పి సంబంధం తీసుకొచ్చాడు మా నాన్న. అది వాళ్ళ కొడుకు పెళ్ళినప్పుడు చెప్తున్నాకు ఆమె. ఇప్పుడు పెళ్లి చేయాల్సిన ఎవరికి? ఏం మాట్లాడుతున్నావు నువ్వు? వాడికి పెళ్లి చేయాలి. ఇప్పుడు నువ్వేం చెప్తున్నావు అంటే, మీ నాన్నగారు అప్పట్లో డిఎస్పి సంబంధం, ఇన్స్టెడ్ ఆఫ్ దట్ ఇది చేసుకుని తెచ్చిపోయారు. ఇప్పుడు వాడండి బాలు, ఈ మూవ్ దేర్, నువ్వు 100 పో అంటే. సో థింగ్ ఈజ్ అంటే, మా అత్తమ్మ గాట్ మ్యారీడ్, he got a kid, that kid is get ready for marriage, but she start to think that DSP సంబంధం, that DSP got 100% depreciation. అసలు ఉన్నాడో లేడో కూడా తెలియదు. Okay, why you are thinking this one means think చేయడంలో తప్పే లేదు కదా. ఇస్తాను థింక్ చేయడంలో తప్పే లేదు. That is when then his son came and asked, hey, what Balu, what is saying? She's saying about adjusted NPV ra. Okay, what is NPV? Your marriage is NPV ra, but she is thinking what adjusted NPV. What is this? If I might have what 100% debt, what might be happen? That is called what NPV? Adjusted NPV. So first you have to calculate what NPV? Base case NPV. This is nothing but 100%, right? This is also problem. Array, why I have taken, don't take it as easy, because this problem is already given 8 marks ra. That too asked in May 2018. From 18 to till to the date he could not asked. దాచిపెట్టాడు మీకోసం. రేపు ఇచ్చాడనుకో తర్వాత చెప్పుకోవాలి. If I might have completed CA. So here you see, shall we close this one, right? Hanuman Limited, yes, getting time, right? Hanuman Limited is presently all equity finance. What is that? All equity finance. The directors of the company have been evaluating investment project which will require how much? 270 lakhs of capital expenditure for new project. Okay. They expect that capital investment provide annual cash inflow of how much? 42 lakhs indefinitely. Indefinitely. Let me tell you one simple fact. In this problem, first time you are calculating NPV where cash inflow generate indefinite period. So far what has happened? 5 years, 6 years would be there. But this is what indefinite period it is to going to get. So that's why pay attention for this one, right? Indefinite period means present value. How do you get it? You nothing but simple. Present value perpetuity. Cash flow divided by rate. So 42 lakhs. The net of all tax adjustments. The discounting rate which it applies to such an investment is how much? 14%. The directors of the company believe that current capital structures fail to take advantage of what? Tax benefit of debt proposal to finance the new project with undated perpetual debt secured on the company's asset. The company intend to issue sufficient debt to cover cost of capital expenditure. Sufficient to cover cost of capital expenditure and tax and after tax cost of issue. The current annual gross rate of interest is 10%. After tax cost of issue is how much? 10 lakh. Company's tax rate is 30%. So that means nothing but, dear students, simply company need 270 lakhs. If they make investment, they will generate 42 lakhs. Now the project is doing by 100% equity capital. Now 14% is the KE. Now if you by taking 14%, how much NPV will generate? That NPV is called what NPV? Base case NPV. Base case NPV is nothing but, what is the PV of cash inflow in the problem? This printed solution is not there. Now tell me. Now what you can say is, you have to consider currently company moving 100% equity. Yeah? So you are the financial manager. You used to think what is the benefit. నా గ్లామర్ ఏంటి, వాడి గ్లామర్ ఏంట్రా? ఏం మాట్లాడుతున్నావు నువ్వు? అరే వాడిని లెన్స్ కార్డు తీసుకెళ్ళండి రాని. ఓకే, లిజన్. Just for flow, right? I know that. What is that? Fair and Lovely does not working. Right. So okay, here you see. First, what we have to calculate? If the project is running with what? 100% equity, Nora. In such a case, what NPV? Adjusted NPV we used to, base case NPV we used to calculate. Base case NPV means cash inflow divided by rate minus cash outflow. So 42 lakhs we are getting. Our rate is how much percentage? 14% minus cash outflow 270 lakhs. What is NPV? 30 lakhs. Now tell me, 30 lakhs is NPV positive? NPV positive means company comfortably gets that, right? This project is worthable because it is giving NPV positive. But what the financial manager says, that point number 1 he will think, point number 2 he will think additionally. What is the first one? NPV is positive, by showing this one we can raise a debt, right? Because NPV positive. Number 2, if you raise 100% debt, we will get what? A tax advantage, right? Hello? Tax advantage means in such a case we won't get just NPV. We will get what? 30 plus additional NPV. In such a case, if you do business with our own capital, we will get 30 lakhs only. If you do with the other capital, right, we will get what? More than 30. In such a case, double vardi, bill vardi, thrill mandi. Yes or no? In such a case, why should we do? That thought will come, That NPV gives a base to him to make what? Adjusted NPV. What? Adjusted NPV. Where adjusted NPV means what he will think that what might be the NPV. Suppose same project I might have done with what? 100% debt. In such a case, for this adjusted NPV, you take what? Base case NPV plus tax benefit on debt. Modigliani Miller theory, I told you, tax benefit on debt you will get into debt into tax rate. Base case NPV how much? 30 lakhs. Plus tax benefit 270 lakhs is the investment. Plus 10 lakhs is flotation cost you are incurring. So 280 lakhs. 280 lakhs into tax rate how much? 30%. So 30% means 30 lakhs plus 270 plus 10 into 30%. 84 lakhs. Total NPV 104. Now tell me minus flotation cost how much? 10 lakhs. Total this is how much? 104. Final answer you tell me. Minus flotation cost also you have to deduct ma. This is a final 104. So this is. Now tell me what the financial manager thinks about this. What he thinks about this 30. What about this 104? Tell me. Sir, 30 is nothing but the NPV what we supposed to get it from our own capital amount. But 104 is nothing but if we take their money, if I do this our project, what is the benefit we supposed to get it is 104. 104, why you are getting this much? Because we used to get what? Tax advantage also. Are you getting? So this is the important point with respect to this, right? Okay. And in this chapter, there are certain questions you should consider is most important points I told you. Incremental NPV. What is that? Some points you can make it note. All these questions only replacement. Remaining MCQs. Target chapter. Modified NPV. So you take modified NPV, incremental NPV. You make a discussion. What is modified NPV? What is incremental NPV? What is that? Adjusted NPV. And another one is what is that? Annualized NPV. Yes, thereafter that is you may also calculate modified what? IRR you can also calculate, which is a reinvested, and a replacement decision. You can see what is the conflict. NPV, IRR, conflict. And various advanced concepts. How many advanced concepts I have told you? 7. These 7 concepts you pay attention for this. Here you see how many one question is repeatedly asking. You see how many times they've been asking. Certainly for the theory they will ask you only one question. Source of finance, right? See what is that? Debt securitization. This is the process. You know debt securitization? I will tell you, listen carefully. Just to have an idea, write an exam. Debt securitization. A company makes a credit sales, yes or no? A company makes a credit sales. When company makes a credit sales means it used to take the securities or invoice documents from the client. After systematically evaluating, it make a credit sales. But the people used to pay money in future. One person may pay 10 days, 30 days, 6 months, 8 months. But finally, all the people has to pay within a year, right? But the thing is, on fine day, I need a money. What should I do? Because whatever the capital is there, I brought it, I produced the commodity, I sold to these people. But these people promising that I will give you in future. But in order to get the tax, in order to get the fixed cost advantage, I made a credit sales. Now I'm empty. I don't have money in my pocket. What should I do? Now what I do means I will take all these documents. Whom I say? Subbarao, Apparao, Enkamma, Janakiram, Krishnamurthy, that one. This one people, I made it a credit sales. I accumulated all these things. And I went to another person. I said that, sir, I made a credit sales to these people. Sir, these people will give 10 days, sir. This is a 40 days, sir. This is 60 days, sir. This is 90 days, sir. Sir, total amount is 5 lakhs, sir. I need a money, sir. Take this one, sir. 5 lakhs. Give me some amount. That means whom I gave a debt. On the debt, I am planning to take a debt. I am trying to take debt on debt. అప్పు మీద అప్పిచ్చేవాడు ఒకడు ఉంటాడు. ఎస్ ఆర్ నో? వాడిని ఎస్పీవి అంటారు. స్పెషల్ పర్పస్ వెహికల్. వాట్ ఇస్ దట్? స్పెషల్ పర్పస్ వెహికల్. What happened? If I give this document worth of 5 lakhs, if the person by taking this one gives 5 lakhs means my entire risk from my shoulder to goes to whose pocket? SPV. In such a case, what you will do? What is the worth of Balu, sir? 5 lakhs. Sir, if I give 5 lakhs, comfortably you will take. Then risk comes to my shoulder, what is the benefit to me? What do you want? I will pay you 4 lakhs. 4 lakhs, sir. Yes. Because I am taking risk, sir. So now immediately what happened? I will think these people will pay within 1 year. 1 year means opportunity cost waste. If I give this one, this man gives 5 lakhs on spot. So this 5 lakhs, if I invest, I will get an opportunity cost benefit. Comparing to the opportunity cost loss, I would be safe. No bad debts, no opportunity cost loss, no thinking about all these people. I will concentrate my business by thinking 1 minute, say yes. In such a case, this document I will hand over to whom? SPV, and I will take the cash and I will come back. Now tell me source of finance. Sometimes equity, preference, debenture. Hey, stop all these things. Think different way. Take debt on debt. That is called you are converting debt into security, and security you are taking debt. That is called what? Debt securitization. What a wonderful process. So banks provides loan, housing loan, education loan, that loan, this loan. Where is the money? No money. ఏం రా డబ్బులు లేవు సార్. ఏమి ఇచ్చావు? లోన్ ఇచ్చావు. ఇప్పుడు బంద్ చేయి, లోన్ తెచ్చుకో. దేని మీద? లోన్ మీద. That indirectly serves as a debt securitization process. Now here this process, once a SPV gets money, this person will think that all these things, this entire money worth of 5 lakhs, he is going to get it within 1 year. But he need money when? Now what he will do? He will split this one into different parts. And he will say that, for example, 2 lakhs rupees is going to get within 3 months. How much? 3 months. So Supparao, Apparao, illandaru kalipi oka 3 months isar anuko. What he will do? He will convert into securities and he will issue to the banks, mutual fund companies, investment bankers. He will say that, sir, so and so company securities I purchase, sir. These people will pay 3 months, sir. Right? So by taking this one, I am issuing a security. You give me money. I will pay you your money within 3 months because these people will pay 3 months. If they not pay, I will call Balu sir. Balu sir will pay. If Balu sir won't pay, then I will pay. But sir, these people certainly pay. So you do one thing, sir. You invest in my company. I will give you highest rate of interest. In such a case, this security is not issued to general public. This would be issued to banks, financial organization, all these things. They can easily identify whose securities are going to be using as an instrument. Then immediately they will buy this one. With this, SPV will get what? Money. That the investors also get a new opportunity to invest in security market. So this is called a debt securitization process. Now try to understand. How many parties? Examiner will ask you. How many parties? First myself. I am a seller. Yes or no? Hello? I am a seller. Also known as originator. What is it? These people are buyers. These people called obligators. Originator, obligator, SPV, investor. Hello? Who are the investor? Whom the SPV is going to sell the security is called who? Investors. And meanwhile, in order to make the comfortable of whom SPV, I can appoint a person called servicer. What is that? Servicer. What I do means, sir, don't say, sir, if the people on due date you give me security, sir, or my servicer, this servicer goes to my client and gets collected amount and he will hand over. This is called what? A servicer. So now tell me, what is a debt securitization? It is a process. Illiquid asset can be liquid and you can generate the financial assistance. That is called a debt securitization. Question number 1. How many parties? Obligator, originator, obligator, SPV, investor. Why one person may be there? Who? Servicer. Simple process mechanism. Is the source of finance? Yes. Whom it is source of finance? Think for all the people it is a source of finance only. Because originator knows this concept, he will make a more credit sales. Because he know that no problem, take, tisko. Because I know capacity to convert that security into that debtors into cash. Okay na? That is the reason, don't expect that. What is equity? 20 marks. Yes or no? What is the preference? 18 marks. What is rate and earning? 6 marks. Pass. This is right. Another one. What is a bridge finance? You see, how many times they ask this question? What is a finance? Bridge finance. Those people who won't come this class, they will write, what is a bridge finance? This is finance used to construction of bridge. Okay. Then mummy constructs a separate. Okay. See, what is a bridge finance? Array, simple thing is, I'm not giving all the information because I know that these topics are very, very important. That is the reason. So bridge finance means, dear students, try to understand. You have an idea. You have an idea. The idea is nothing but you are an entrepreneur. You have a wonderful idea. You can implement this idea when you have what? Amount. You went for IDBI, Industrial Development Bank. They checked your document. They said, that's superb, sir, superb. We will ready to provide. Sir, how much capital is needed, sir? 40 lakhs is needed. 40 lakhs needed. Okay, just wait here. We are going to evaluate. And the 6 members, this project they studied. Who brought this one? Balu sir. Oh, this is a project. This is a project. Superb here. Approved. Approved. But they came outside and said, Balu sir, your project is approved. Thank you, sir. Thank you. Can I bring a polythene cover? Why? 40 lakhs kosam. 40 lakhs తీసుకెళ్ళడానికి. Okay. Wait for how many days? Can I wait for 40 minutes? Not 40 minutes. 4 days? No. 4 weeks? No. At least 4 months you wait, at least. 4 months, sir. Sir, approval ho gaya na, sir. Approval ho gaya, bhaiya. There are a lot of formalities, Sir, 4 months, somebody may copy my idea. There is a place, sir, I want to buy recruitment, I have to done. They have a lot of work, sir. So what? Hey, this is legal formality, sir. It will take at least 20 to 30 days. 30 days, sir. You do one thing. However, we are giving approval, You go to any organization and you take a loan. Yes, sir. Then if the people make a call to you, will you say yes? We will say no problem. Give me, sir. ఇప్పుడు దీన్ని తీసుకుంటాడు. ఎక్కడికి పోతాడు? HDFC బ్యాంక్ పోతాడు. సార్, మై నేమ్ ఇస్ బాలసుబ్రహ్మణ్యం. My project is approved, sir. 20 lakhs I'm going to get, sir. But it will take 20 to 30 days, sir. But meanwhile, I have to undertake this project, sir. Really, your project is approved, Approved. Which project? IDBA, sir. Where? Bradipet 4th line, sir. 1 minute. They will make a phone call. Balu, yes. Okay, done. Yes. Sit down, sir. Sit down. Sir, your project is approved, sir. Really, they too said. How much money is needed? Sir, I need 40 lakhs. Extra cheku. వాళ్ళు ఇచ్చేదే లోన్ 40 lakhs. ఇప్పుడు ఎందుకు నీకు 40 lakhs? From the 40 lakhs, we will give you in principal amount. How much? In principal amount. 40 lakhs is there, no? We will give you 10 lakhs. With this 10 lakhs, what happen? You do what? Preliminary work meanwhile. So, it will fill the gap where you are, where actually your funds comes. Are you getting? So, your funds comes there. Now, where you are here. But meanwhile, this gap, it will create, it will, instead of creating an opportunity, you are going to lose your opportunity. So that is the reason what happened. Bridge finance will be provided. Who is going to provide? Commercial bank will provide. For whom? Not for all the people. Those people whose loan is already approved, it is the delay because of legal procedures. For them only it is a possible. If our loan is approval, why you are going for a debt and here and there, man? Go to bridge finance. There is a chance here. Get the money. This is an innovative source of finance. Even loan is approved, sometimes instead of not knowing bridge finance, these people struggle here and there. Is it bridge finance is total finance? Provided by who? Commercial bank. Will they provide total amount? No. Rate of interest less or more? More they will charge. Because of this, are you going to start a project? I am not going to start a project, but preliminary work with respect to project I can start. This is the bridge finance, right? So this is pending. Thereafter, what is it? You see, commercial paper. How many times they asked? From only one question, from past point of view, if it is past examination trend, if it is given, it's great. So commercial paper. Commercial paper is nothing but short-term money market instrument. What is that? Short-term money market instrument. You see, if I go to my neighbor, if I ask, sir, I have to pay electricity bill. Okay. So give me 3,000 ante okay. Give me 3 crores ante. Sir, 3 crores. Ante, Balu, you are laughing because Balu may ask you 3 lakhs or 3,000. But ITC, Tata Motors company, sometimes they need to pay, what is that? Their short time period, 7 days they required money. but they need a worth of how much? 40 lakhs to 50 lakhs rupees. In such a situation, you try to understand the huge amount, the bulk amount, how they make a payment. So what happened? Commercial paper is an unsecured money market instrument issued by who? A company. But if I want to raise the funds, first I have to go to whom? Reserve Bank of India. I have to get the approval. Are you getting? Once I will get the approval, with that approval, I am going to issue security. It means that simply, I go to the RBI, I will say, I am a so-and-so company, sir, I need 40 lakhs rupees of amount. You need 40 lakhs, right? What to do? Sir, this is the purpose I need. This is the amount I am going to use. So these are the securities I am going to give it. So considering all these things, you give me an approval that Balu is capable to pay who can invest in his company. Then remaining I can take care. Then they said that, okay, approved. Then I will come to market and I will say that HDFC bank is there, mutual funds are there, but not public, general public. I will go to that, sir, I need a given 40 lakhs, sir. So each security is 5 lakhs. So 40 divided by 5, 8 securities I am going to issue. If you have surplus money, you invest in my company. 100% within 15 days I will pay. High rate of interest I will give you. The company which is decided to declare a dividend in next month. But immediately they got an opportunity that within 8 days, they can invest if they get it high rate of interest. In such a case, what they will do? Hey, wait. Instead of declaring dividend, we can postpone 1-2 days, because if we invest here, we will get the benefit, right? Sir, if we invest in this project means if by chance if he gets default, no default here. There is what? RBI approval is there. So this is the short-term financial instrument. After taking approval from RBI, some financial organizations, they will issue securities to whom? Public, not public. Banks, financial organization, all these things. This is called what? Commercial paper. Its face value generally 5 lakhs, not 1 rupee, 2 rupees. But repayable period is very, very less. Maximum how many years? 1 year. Within 1 year. But the time period is maximum 7 days also you can repay it. Are you getting? This is the commercial paper. Along with this, I personally say one more question also. The one more question is venture capital financing. What is it? Venture capital financing. Next you can take it. Venture capital financing. This is also several times asked. Actually, they missed this paper. Venture capital financing. What is a venture capital? This is called high risky project. What is that? High risky project. Whenever high risky project. You remember that day I told you snake poison. I told you an example. Snake poison. So high risky project means a qualified entrepreneur is there. A qualified entrepreneur. He is new to market. He has an idea, is wonderful. He has a great idea to commence a business. But the thing is, idea you have, but you don't have technical knowledge. You don't have practical experience. So he really new to the market. But idea is wonderful. His whatever the project he designed, it's really superb. But by trusting this one, somebody makes a investment. He is called venture capitalist. What is that? Venture capitalist. But that person takes huge risk. He makes investment in this project, or a huge risk this is. And at the same time, by making this investment in this project, right, whatever the capital he will provide, that finance is called venture capital financing. What financing? Venture capital financing. MCQs they will ask you. Who is a venture capitalist? The venture capitalist who trusts the new qualified entrepreneur behavior, and basing on that who will make investment is called what? Venture capitalist. Are you getting? Another point is that what happened? Whatever the finance he will provide to them is called what? Venture capital financing. And with that capital, if the business gets started, that is called what? Venture capital undertaking. Venture capital undertaking. Okay, these are the compulsory. So how he will make investment means he may part and parcel of equity. He may invest in equity shares of the company. He may invest debentures of the company, and he may pose the conditional loan. Conditional loan means what he will say, sir, I will invest in your company. You have to give every year interest. Even after giving interest, after paying all expenses, still you have a profit. You have to give share in that profit also. He may pose what? Lot of conditions, because he is taking huge risk, man. Yeah. So that is called venture capital financing. Thereafter, repeated one more question. With this, I'm going to conclude. ADR and GDR. What is that? ADR and GDR. ADR means American Depository Receipt. Very, very important. American Depository Receipt means Infosys company is there in India. Recently, Infosys company issued ADR where America. What is how they issue? See, Infosys company, they've planned a business. They want to issue equity shares. So 80% they issued in India, remaining 20% they decided to issue where? United States of America. But the thing is, if 80% shares are issued, the formalities. Company accounts, par, premium, right? First call, second call, like that. They will pay the money and the company gets the identity, and their shares can be listed in Indian stock market. And because they will become a owners automatically in our company. They used to get a dividend also. Yes or no? But what happens to American ADR, sir? How the situation is? The situation is there. What the mechanism is there? Mechanism is. So Infosys company has to get the approval from first of all RBI. Sir, I am going to issue the securities in United States of America. Because without RBI means Americans pay only dollars. But you need to get Indian currency. Without RBI, could it possible? Point number one. Number two, they also follow the formalities of what is it? Indian capital market. That is a SEBI rules and regulations they have to follow. Once this rules and regulation follows, what to do? Infosys team members, should we go to the New York? No. What they will identify that they will recognize the authorized bank or merchant bankers in India. For example, HSBC is a bank in India. So whatever this 20% stocks, they will go to the merchant bankers and they will keep all these securities. This is called, they will custody. Custody means they will keep all the securities here. 20% securities are there. Whom? In a HSBC. Where the HSBC bank? In India. This bank branch must be there in where? United States of America. What this HSBC of Indian branch will convey to HSBC of United States of America, I have 20% shares worth of whom? Infosys in my custody. So what is that means? This company followed all the capital market rules and regulations, right? Now what happened? By keeping this security there, right? You can issue securities to the Americans who want to buy, who want to invest in Infosys company as a not equity shareholders, as a depository receipts, as a depository receipts. But when they want to issue means how Indian stock market plays an active role. There also there is a capital market. It says SEC, Security Exchange Commission. So you have to follow their rules and regulations also. By following that rule, their rules and regulations, you need to issue these securities to custodian bank, another exchange bank of where? United States of America. This bank, this taking this custodian document, they will go to SEC and they will get the permission, and one fine day they will inform to custodian bank of HSBC, American SEBI, American capital market also approved. Now they will issue the securities to the Americans. They will say that depository receipts are available of Infosys company in United States of America. If you are interested, you purchase it. We will pay interest. Being Americans, we are changing title depository receipt, right? But if you are in India, you would be called what? Owners of the company. So this is the procedure. You have to issue the security. How Indian can sell the security to NSE, BSE, yes or no? Same procedure. Americans also can sell their capital market, New York Stock Exchange also they can sell and they will get the money. Because of this procedure, what will happen? A company can enter into the international market and the raise the funds. When company raises ADRs means indirectly you try to understand their books of accounts is very clean and their rules and regulations they are 100% following. Number 3, they will enter into the international market. Are you getting me? This is ADRs. If they concentrate entire globe, that is called JDR. Clear? These topics are enough for you. This is for the sake of marathon. I prepared this notes. You see, every company, I hold my hand to wish. I take a bow in front of Rama because I compared Rama with always Ravana. Are you getting my point? So ratio analysis, very simple concept. You tell me, you are a financial manager. Your job is to take what? Analysis. You have to make decisions. For the sake of taking decision making analysis, what you have to do means you have to analyze the income statement of the company. You are, for example, a doctor. You are a doctor. A patient comes to your office and he says that, sir, I have a problem in my mind or ekkada undannadu anuko. Appudu so what, being a doctor, what do you have to say? Sir, I have a health problem. He came, just I'm a doctor. You are a patient. You came. Sir, I have problem. Then I said, you have problem. What is your name? This. So this is the medicines. You take it. Ante, what you will say? Hello. What is this, man? You could not made any test and any reports and nothing, but then you are giving a prescription. Then I said, నీ కళ్ళల్లో ఏముందో గుండెల్లో తెలుస్తుంది. You told in గుండెల్లో నొప్పి, I saw your kallura. Your kallu conveys that what? That means the doctor knows analysis. Yes or no? How a doctor identifies a report and gives, like that you are also doctor, yaar. You are also doctor. That doctor deals with what? Health. You financial doctor deals with what? Wealth. A company is identity. So a client comes to your office. A client comes to your office. For doctor, patient comes. For you, what happened? Client comes. The club there, he will show hand. చూడండి సార్, కళ్ళు చూపిస్తారు అక్కడ. ఇక్కడ మనం చూస్తాం ట్రేడింగ్ అకౌంట్ చూస్తాం, బ్యాలెన్స్ షీట్ చూస్తాం. We will identify. So at the same time, how a doctor, by examining a body, identifies the health condition. Similar to a financial manager, you identify income statement and balance sheet and everything. You will identify what is the company is this. Finally, this is the analysis. In order to, without making analysis, you never take what? Decision. To make analysis of the income statement, you see here, what is my point is, my observation point, there is a company. This company prepares income statement. Income statement, what is that? Consists of trading account and balance sheet, another cash flow statement. In order to, you are the financial manager. To take a decision, what you have to make? You have to make analysis. Because income statement cannot provide ready-made information which is needed to the company. Because see, basic financial analysis, planning and decision making, the financial manager has to make analysis. For the sake of analysis, there are multiple tools are there, multiple ways are there. What are the ways? I will tell you. Here you see, this man is doing analysis. What are the analysis? Comparative statement analysis, common size statement analysis, trend analysis, trend ratio analysis, cash flow statement analysis, funds flow statement analysis. Yesterday, day before yesterday, we calculated leverage analysis. All this analysis, we will study company performance is good or not. But here, we are going to concentrate which one? Ratio analysis. What is a ratio? First of all, you should understand, ratio is a statistical yardstick that provides measure of relationship between two figures. Two figures, it will identity. A company sales, my company sales, sir, how much sales? 40 crores. Oh, 40 crores your sales. What is your gross profit ratio? 80%. Sit down. Because gross profit ratio 80% means tremendous. What? 80% gross profit ratio means cost of goods sold less or more? Less. That means company is a superb. Same situation, if the company is 1,000 crores, where is a variable cost ratio 80%? Sales same, but opinion changes within seconds. That is because of what? Analysis. Are you getting? Gross profit ratio 80%, variable cost ratio 80%. Within the 1 second, what happened? By comparing one another, you will come to conclusion whether the company is a superb or worst. Okay, so ratio is a yardstick. Our simple thing is, a ratio means financial ratio or accounting ratio, which shows the relationship between, mathematical relationship between two figures, two accounting figures. That is called ratio. What is analysis? Analysis means analyzing what? Ratios. By analyzing ratios, by taking income statement, by taking balance sheet, you have to analyze. Sometimes to make analysis, we will take the data from profit and loss account, trading account, both we will take there itself. For example, gross profit ratio. Where we will take that? Trading account. Yes or no? Asset turnover ratio. Hey, asset turnover ratio. Balance sheet and current ratio. Exclusive balance sheet. So that means, in order to identify ratio, need only profit and loss account? No. Only balance sheet? No, we need what? Both. Sometimes we will concentrate balance sheet. Sometimes we will concentrate profit and loss account. Sometimes we will concentrate both. But finally, what purpose we need? What is the purpose behind making analysis is the most important. How many types of ratio? Somebody will ask me that. The question I will answer. How many curries are there in the world? How many curries are? If you pour water, one curry. If you want oil, one curry. Without vegetables, one curry. So how many curries? These many curries, ra? Like ratios also, how many ratios? More ratios. But first of all, before asking what is ratio means, tell me your purpose, ra, idiot. What purpose you came here? What purpose you tell me? Tell me ratio. Why you need ratio? You tell me. That is the important. Ratio shows the numerical relationship between two figures and brings a conclusion, right? Objective of ratio. What is for objective? To know why the people study ratios in order to know performance. Because from past 10 years I've been investing in where? Stock market. Even I won't study the people's psychology and everything. I don't want. Chudanda all manasika sthiti. Chal bhai. I don't want manasika sthiti. I need company's income statement. You show me income statement, I will become Chandramukhi. This is super, yaar. This is how. Because I want to make investment. There is one security, Elsud investment stock, 3 rupees went to 2,40,000. 2 days I could not take any Kerakai also. Kadup manta. 3 rupees will become this much. Unless until we cannot, people won't, the people might have made analysis. That is the reason they purchase, right? You try to understand, this is a practical study. Ratio analysis is the face of financial management. If you don't know ratio analysis, you never show your face. Because you cannot talk. Right? You see, performance, to know why we study the ratio. We know the performance of what? Past, present, as well as future. To know what is it? Strength and weakness. And can take decision relation to firm. This is your ultimate objective. Sir, to study the ratio, what are the data we have to consider, sir? You have to take annual report, you can study. You can take an interim financial statement, you can state. Note of accounts, statement of cash flows, and business periodicals. Often now they used to give that information. Basing on that, you can make analysis along with financial statement of the company. Thereafter, sir, okay, steps involves how this ratio analysis should be done. First of all, you need what? Purpose. How many ratios are there? That is a secondary issue, man. First of all, you define what is the purpose you are studying here. Then purpose you need. Then you identify what is that? Ratios. What you want to tell? Sir, from the sales, how much profit I earned? Okay. You want to know this one, right? From the sales, how much investment I made it and how much sales I'm making. First analysis is how much profit I made from the given sales. Second one, how much sales I made with the given investment, sir. Yes or no? Sir, finally from the sales, how much net profit I generated, sir. Sir, from the sales, what is my credit sales? What is the cash sales, sir? From the sales, what is my bad debt, sir? Are you getting? So this is nothing but you have to define your purpose. Then you have to work out with the ratios. Then you have to interpretation of ratios. Once the ratios are calculated, you have to interpret it with the how, whether the company is performing or not. You have to consider various benchmark companies' data you can identify. And once you understand that your condition is very, very worst, then you have to take what? Immediate actions you have to take, and the variance with the objective of improvement efficiency. Are you getting? Sugar is how much? 248.9. ఈడు ఉంటాడా పోతాడా ఇక్కడే పోతాడా ఇప్పుడే పోతాడా డాక్టర్ చెప్పేస్తాడు కదా చూసాడు షుగర్ రిపోర్ట్ ఎంత షుగర్ 540 నర్సు అంబులెన్స్ వద్దు క్రిమేషన్ రెడీ చేసుకోమని చెప్తాడు సార్ వాట్ యువర్ టాకింగ్ ఏందో టాకింగ్ ఎంత ఉందో షుగర్ నీకు అసలు ఎలా బతుకున్నావో తెలియదు స్వీట్ షాప్లో నిలబడుకొని మాట్లాడితే ఉన్న వస్తువులు కూడా స్వీట్ అయిపోతాయి అక్కడ అంత ఉందో షుగర్ నీకు అవునా అసలు ఇంతసేపు ఎలా బతుకున్నావు నువ్వు సార్ డోంట్ టాక్ లైక్ దట్ సార్ నో ఐఎమ్ నాట్ టాకింగ్ యార్ యువర్ స్టేట్మెంట్ ఈస్ టాకింగ్ లైక్ దట్ సో దట్స్ వై వీ హ్యావ్ టు టేక్ రెమిడియల్ మెజర్స్ sometimes BP no problem Baluji no problem chalta hai no problem sir actual BP no problem yaar it is okay sometimes what happen sugar this much gaya sugar coating oats right this is the ratio analysis ma what is the steps array don't mug blindly don't jump it that ratio good this ratio good no first you define what is the purpose then you have to understand the step by step okay this is a purpose in order to know this one, what are the concepts I needed? Basing on that, what is the ratio I developed? This one I should compare with the benchmark company. Then I have to come to remedial measures, right? Here the another point is, who are the parties interested? For what purpose? Who are the parties? Who? Management is interested. How the company performing or not, they want to know. Management. Thereafter who? Investors. Whether to make investment. I always study ratios from what point of view? Investor. Then who? Creditors. If you go and ask loan, right, the people will give. Suppose మన ఫ్యాకల్టీ ఎవరన్నా ఉండండి, సార్ ఒక 1000 రూపీస్ తర్వాత ఇస్తున్నాను అనుకో, కింద నుంచి 10,000 చూసేవాళ్ళు, ఇది గోల్డా, ఇది గోల్డా, ఇది గోల్డా, ఇది గోల్డా చెక్ చేస్తారు. అలాగే కళ్ళతో స్టడీ చేస్తారు. బ్యాలెన్స్ షీట్, రేషియో అనాలిసిస్. గోల్డ్ 1000, 2000, 5000 పర్లేదు, మొత్తం మీద 1,00,000 రూపాయలు దాకా ఉంటుంది, 10% ఇవ్వచ్చు అంటే 1000 రూపీస్. ఒంటి మీద గోల్డ్ 2 లక్షలు ఉంది, 1000 రూపాయలు ఇవ్వలేవా? 1000 డివైడెడ్ బై 2 lakhs into 100 కళ్ళతోనే క్యాలిక్యులేషన్ చేస్తారు వాళ్ళు. ఓకే సార్, నో ప్రాబ్లం, ఇవ్వు అను. నౌ వన్ ఫైన్ డే దే కేమ్ టు నో దట్ ఆల్ ఆర్ రోల్ గోల్డ్. దే విల్ స్టార్ట్ టు క్రై, గయా మేరా మనీ రా. దట్ ఈస్ indirectly what happened. They will make analysis. For example, mastermind goes to SBI bank and asks a loan, if you go, they will give you chair to our directors. So sit down sir, ఏం కావాలి సార్? లోన్ కావాలా? లోన్ కంటే ముందు కాఫీ ఇస్తారు. నువ్వు వెళ్ళి లోన్ అడుగు, ముందు పోలీసుని పిలుస్తారు. ఈడెవడ లోన్ అడుగుతాడు, ముందు నేను పంపించాను అని. సో ఇండైరెక్ట్లీ దే కెన్ ఐడెంటిఫై దిస్ వన్. సో ఇన్వెస్టర్స్, ట్రేడ్ క్రెడిటర్స్ రా, దిస్ ఈస్ నథింగ్ బట్ బ్యాంక్స్ ఆల్సో మేక్ అనాలిసిస్. Then customers also make a identity. So these are the, and one more point is, these are the MCQ questions you can identify. So analysis they will do for what analysis? Internal analysis, external analysis, and horizontal analysis they can make it. And finally, to understand this income statement, all the people they used to run behind what is ratios. First of all, you have to study income statement and balance sheet of the company. Because whatever the information you are going to extract, right, this is everything from what is it? Your income statement and balance sheet. How many versions you can recalculate, readjust your income statement, that is the most important. Income statement from the leverage also we've been calculating. Sales less what is it? Cost of goods sold. When you will get a gross profit. This gross profit also known as product profit. What is it? Product profit. From this product profit, agar gross profit is there, your purpose is working out. My friend father is there, he been working out. One fine day I went there, shop, and I asked it, ఎంత వస్తుంది? నెట్ ప్రాఫిట్ ఇస్ సూపర్. నెట్ ప్రాఫిట్ బాగుందిరా అన్నాడు. నెట్ ప్రాఫిట్ కాదు, గ్రాస్ ప్రాఫిట్. టెల్ మీ. గ్రాస్ ప్రాఫిట్ జీరో. గ్రాస్ ప్రాఫిట్ జీరో means not zero. Gross profit is very less. It means that what is the purpose for you started your business, it's not working out. Purpose is not working out. Why you are doing business? Hey, we are getting net profit. See, net profit is nothing but an accidental profit. Because of accidental incident you are getting a profit here. Actually your gross profit is zero. This also called, what is it? Product profit. Your business survived, good. Your gross profit super, net profit negative. What I will say? Hey, continue business. So net profit zero. Net profit is zero. Gross profit super, wonderful, right? You can continue, uncle, you can continue. Within identity we can say, without gross profit, how you are getting a net profit? Waste, sir, right? So that indirectly, less other operating incomes, other operating expenses, you will get it operating profit. And non-operating incomes and non-operating expenses you can consider. Thereafter interest, this is everything, EBIT, tax, earning after tax, preference dividend, and finally what is that? Equity dividend. This is nothing but income statement. Then you have to understand balance sheet. So balance sheet, not only one version. You can study this balance sheet in 2 more versions. Third version also you can study the balance sheet. Everywhere the people have equity share capital, preference, reserves and surplus, and current liability. Here fixed assets, non-business investment, current assets and fictitious assets. But sometimes data changes. In such a case, balance sheet may change. And the third way, this may also you can identify. Long-term funds, current liability, fixed assets, NBI, current assets also balance sheet. And here you see capital employed, current liability, fixed assets and current assets also balance sheet. And final current liability, current assets you will be considered as what? Working capital. This is nothing but adjusting the balance sheet in a multiple way. So this is the way you can consider. Finally, what the point? Ratios, you will make a 4 analysis. The total ratios are given in your material is CLAP, what I told you. Capital structure ratios one, liquidity ratio another one, activity ratio another one, profitability ratio. You see the first one, liquidity ratio. So major of the people, tomorrow you are a chartered accountant means you must have the command over this concepts. You must have the concept of this one and you should able to find it out this one. Liquidity ratio, what the question? Could the company has the ability to pay off its short-term liability? And at the same, how quickly company can convert these assets and use them meeting dues that arises. This is called liquidity ratios. For this purpose, we will study the liquidity ratio. Once the liquidity is good means the company able to pay its short-term identities. For this purpose, you know the various liquidity ratio, current ratio, yes or no? Current ratio, quick ratio, and at the same time, cash ratio, absolute liquidity ratio, all these things. This is one category. Another category is nothing but leverage ratios. So the investors have a doubt. Can the company has the ability to meet the long-term obligations? Could the company has an obligation to pay its long-term funds? What about the long-term stability and capital structure of the company? How could it possible? So if the investor is satisfied, then he will make investment. This is a second analysis. For that purpose, some ratios are developed. Whatever the CLAP principle I told you, reason with respect to this, here leverage ratios. And another point you used to get it is nothing but here activity or turnover ratios. How efficiently the company managing its assets. This is asset turnover ratio. We calculated, right? Working capital turnover ratio, cash turnover ratio, fixed assets turnover ratio, whatnot. Everything is linked with what? Sales. This is called activity ratio, turnover ratios. Okay, these are the third one, activity. Last one left what? Profitability ratios. What? This is the profitability ratio. I told you CLAP, right? This is the CLAP. 4 basic principles. Okay, you understood this. Very good, very good. Profitability ratios, right? Profitability ratios means what is the profitability or operational efficiency of the company? Whether the company is generating what profit? What about the gross profit? What about the net profit? What about the profit belongs to equity shareholders? What about the profit belongs to debenture holders? And everything you have to understand. So whatever the ratios and formulas are linked with your subject, right? Based with this. Simple thing is what I would like to say is whenever you want to make analysis, you have to compare with one another. Unless until you cannot compare, right? You cannot draw the what? Conclusion. Because of financial manager, tomorrow you have to take decisions, you have to make a policies. When you don't know to find it out exactly the capability to study the income statement of the company, what decision you can take here? For that purpose, one of the analysis is very, very important. One is called what? Ratio analysis. To remember this ratio. Finally, what are the categorization? Liquidity ratios, activity ratios, profitability ratios, right? You can go with this. All the best. I would like to say one thing. CA is not a tough course, but course designed for tough people. Okay? And you are going to examined by who? ICAI Institute, right? Cracking CA exam is not as simple as walking in a park. So you need a learning, practicing, attempting, and finally winning strategy is needed. So that's why what happened, before check it, before hit it, you must check it. That's why you try to understand your question paper pattern and writing mode of exam. Because I studied with proper, whatever the marathon classes you have taken, you take a plan. What areas are told, what questions being asked, what methods are conveyed. Everything you need a plan. Not else today you are going, tomorrow onwards you are rendering regular life and you want to make attempt means very difficult. Because you must have a proper plan. You try to understand, you fail to plan, you have a plan to fail. Make a plan, try to understand what questions, 10 marks questions, capital budgeting, working capital management, cost of capital, capital structure. Maximum leverages. 5 marks question, this area. Theory questions, this. Certainly one problem is tough. That's why don't take any choice of any questions. Take all the questions and make an attempt. Improve calculation ability. Maintain a small book. Whatever the core formulas are there, make it note. And don't blindly mug up. Have an idea. Theory part. What is the concept? This. Have it knowledge. But in a simple language also, you write it, you will get the 100% marks. So, Isa, Vaza, Varra divided by all these things. No need of. CA Institute never shows that one, right? And don't worry with respect to present value factors. These days asking, sir, will they give present value factor? This is question. Okay? They will give you present value factor. Right, ma? So, all the best. Jai Hind.